Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company.
Very good morning. You're watching India Market Open, and after a quiet start to the week yesterday, you can hope for some upward moves today. Good morning, gentlemen. It's looking decent with results so far panning out better than expected.
Yeah, and we probably see some differentiated moves today because it's kind of amongst the reported numbers, it's split right down the middle today, right? Chalk and cheese both. But broadly, the sentiment doesn't seem to be too bad. Do we see a continuation of the up move post 25,000? A lot of people were talking about 26,000, including Lawrence Belanco. Yeah. Could be interesting to see if we see some evidence of that this week.
Yeah, and banks and IT both going to be in focus, right?
Tech for sure.
Yeah. I think globally the big mover will be, and the big question will be, whether there is actually an end to the Ukraine-Russia war. That's at least what US President Trump seems to be indicating. He got off a 2-hour call with Putin, but that's still up in the air. Anyhow, this is the wrap-up of what US markets were like overnight. Wall Street has closed with gains as winning sessions continue for the 6th day consecutively. So that in key indices, not massive gains, I would say, but all up in the green. Pretty much the Dow as well as the Nasdaq. Treasury yields have also trended up after Moody's downgraded US credit ratings to AA1 from AAA. The 30-year Treasury yield briefly hit 5%. The 10-year is at 4.45%. So that was the highest rate for the 30-year since 2023. Crude is also trending higher as Moody's has downgraded the U.S. credit rating. Brent is slightly above the $65 mark. For Asia, rate changes in China in focus this morning. You've seen Asian markets also open up in the green. But quickly, let's take a look at the implied open for India. And you're seeing maybe a gap up start of about close to 100 points for India as far as what the implied open is saying right now. We'll have to wait and see how it goes. Just one thing that caught my eye as well, which I want to focus on, is something Jamie Dimon said, and I'm quoting, this was of course at the JP Morgan Investor Conference. He says that maybe we have taken it lightly when it comes to what's happening with the US economy. And I'm quoting here, he says, we have huge deficits. We have what I consider an almost complacent central banks. You all think they can manage all this? I don't think they can. My own view is people feel pretty good because you haven't seen effective tariffs. The market came down 10%, it's back up 10%. That's an extraordinary amount of complacency. I think earnings estimates will come down, which means PE will come down. The odds of stagflation, which is basically a recession with inflation, are roughly double than what the markets think. So I thought that was quite a statement coming in from Jamie Dimon at this point of all times.
Yeah, I mean, one thing that when Jamie Dimon speaks, you listen, right? Because he sold off, for example, the JP Morgan stock right at the peak before this whole tariff tantrum started in the fall that came in. So that was important. But two, I thought, guys, the move from China is really important. I mean, it's just a token 0.1% cut in the prime lending rate. But it shows the thrust that China is making or trying to make towards the support to the economy. And I wonder, I mean, purely from a selfish perspective, I wonder if metals have some bit of a leg up again today because of China, what China does. Sure, frankly, I would have hoped for a bit more here, but I think looking at the global press, it does seem that everybody is excited about the fact that China, on all counts, continues to try and push the pedal on reviving the economy, which is great news for metals. So I think that's something we watch out for.
If I remember correctly, there was another cut not too long back. So this directionally, I think, seems to be along the lines of what they've said in that meeting also, monetary easing going forward. So I think it makes sense.
So monetary and non-monetary measures all being taken.
Yeah. So China, so far, it's all been a lot of talk, but where's the action? At least some action is what we're beginning to see.
Absolutely.
Yeah.
So watch out for the metal pack in trade today. But let's talk about what happened in trade yesterday as well. And we've got an interesting graphic for you starting today. So hopefully we can pull that up. I'm talking about the flows data. And this should tell you not just what happened yesterday, but what happened over the course of the last 1 week, 1 month, and the year-to-date picture as well. So take a look at that 1 month picture. Nearly 46,000 crore rupees worth of FII buying, and domestic institutions buying about 30,000 crore rupees on a net basis. This is, of course, cash market data. In trade yesterday, though, you had a net sell figure, very small numbers from both foreign institution and domestic institutional investors. We were anticipating that there would be a cool-off after the rampaging run that you saw last week. And in fact, you had the benchmark index, the Nifty 50, end about 1/3% lower at the end of what was a pretty choppy session. The benchmark remained in a very narrow band, if you think about it, of less than 150 points from high point to the low point, and it broke below that 25,000 mark in trade. Of course, the indicator open today is positive. The broader markets gained, but ended off the high point of the day. By the way, Bajaj Auto was a top Nifty 50 gainer after KTM or the KTM bailout plan was announced, that borrowing by its overseas subsidiary just ahead of a deadline, a key deadline for KTM, is something to watch out for in trade today as well. Frontline IT, and I'm talking about the Nifty 50 here, as well as RIL, Eternal, ICICI Bank proved to be a bit of a drag. In the broader markets, the mid-cap index gained about 0.2%, small-cap index up about 0.7% or thereabouts. IT was the worst sectoral performer in trade yesterday, losing about 1.3% or so, and the defense pack finally saw some signs of profit taking, not across the board, because you had something like a Zentek that continued to gain ground yesterday, but the pack as a whole losing about about 1% or so. Realty outperforming and gaining about 2%, 2.3% or thereabouts. PSU banks also gained 1.5%, and they outperformed the Nifty Bank, which only gained about 0.1% or so. Now, market breadth favored the advances with 2 gainers for every decline, and the VIX rose about 5% in trade to 17.4. Just a couple of mentions because it could be in focus today as well, and I'm sure that one of us will talk about this. Graphite HEG gained very sharply, apparently on account of the stoppage of electrode manufacturing in China by a Japanese player. Banco Products, Neeraj pointed this out, the start of trade, not the largest company, but what a stellar move. As much as 20% locked in upper circuit on the back of that Q4 performance. And Vodafone Idea dropped as much as 9% after the Supreme Court rejected its AGR relief plea. Neeraj.
Yeah, any of you on the Vodafone subscription? I think
I still am.
I still am.
The good old Vodafone.
we hope it lasts, really.
Yeah.
I mean, the country needs it.
You as well?
No, I swapped. I was Vodafone, but I've swapped.
You'd ported with the same number?
Yes, ported with the same number, but some time back, of course. But it's interesting that Alex spoke about tech as well, because that becomes center stage today. So firstly, I mean, from a trade setup perspective, very likely that Nifty will be range bound. The question remains whether this week sees the start of that up move, or do we still see range bound activity? And frankly, we'll be okay with both, right? We've had a really good move. It's okay to have a week or two of consolidation before an up move begins again. So very sector specific moves likely. And Alex spoke about defense. About time that defense took a bit of a breather. So we saw that yesterday. I wonder if auto now does an encore to defense, because the auto rally does seem a bit stretched. I was reading a note today on two-wheelers which says that the two-wheeler demand isn't looking as robust as people make it out to be. Maybe a TVS stands out, maybe an Eicher stands out, but otherwise the two-wheeler demand is also slightly to wobble a bit. And Puneet, our auto analyst, was talking to me about Hyundai, and you will hear a conversation with Alex today with the Hyundai management. Their forecast of demand isn't necessarily the strongest as well. So I wonder if the auto rally, which has had a bit of a bounce, remains a bit subdued. And yes, tech was down. The street was short yesterday on the US downgrade and the belief that this would make the stocks come off and the US markets come off. NASDAQ ended in the green, right? I would reckon that this would mean that tech could actually see a bit of a bounce in the session today. So from a sectoral perspective, just for the start and maybe for the first couple of hours, you might well see tech being in focus on the upside. It may not turn out to be that way, but I reckon that the probability is high that tech shows a bit of a bounce back today. So watch out for Indian IT services in trade today.
Some of the other factors to watch, and I agree, maybe IT always has one down day, one up day.
Yeah.
So by that logic, yes, today could be a tic-tac-toe, could be an up day for IT. But I think you are going to see some choppiness. The Nifty trajectory will remain choppy on lack of directional cues. You can expect a trading range for the Nifty within the 24,800 to 25,200 zone in the short term. A decisive break below 24,800 could trigger major selling pressure. So look out for that. No big cues to bring down the market per se right now. It's all going to be very stock specific and result specific more than anything else. A break above 25,200 though may open the doors for a move towards 25,500 to 25,700. So I quite agree with you, Neeraj. Maybe path to 26,000 this week, not this week, but yeah, the path to it. We may see it building up. I think the street is also divided on whether the current consolidation phase will persist or give way to a directional move soon. As far as the Bank Nifty is concerned, resistance at 55,500 to 56,100. There's a heavy call open interest in these ranges. Support at 55,000 also coming in. So those are the levels as far as the Nifty and the Bank Nifty is concerned. But what's happening on the F&O side of things, Puneet is joining us to tell us what the setup looks like.
Well, thank you for that. We've also added a couple of new elements, and we'll get to that in just a bit. At least in terms of the Nifty as well as the Bank Nifty, we mentioned yesterday that we'll be trading in a narrow range. That's played out. Again, today we are expecting a 30-point up move on the upside, but largely we'll need some more positive cues, as you guys rightly mentioned, for a breakout and maintaining the 25,000 level as a key support. Now, currently, 24,800 is one of the levels to watch out for. In terms of the Bank Nifty as well, we've seen 55,500 being largely maintained as one of the key levels. And again, a long-term support is at 55,000 for the Bank Nifty and as well. Now, we've added a new element, which is the long-short ratio, essentially for the Nifty futures as well. This is for the fund for picture for FIIs, what they've been maintaining across indices. In terms of the Nifty futures, yesterday we saw a net short position by the FI by 352 crores. We've also added another separate column for the open introducers distribution in terms of rupees crores as well, what's been maintaining as well. Seen a high one in terms of volumes on the Nifty options side, and in this chart is also indicating for for the long position that's been maintained on the index option as well as the Nifty Bank futures by the FIs as well. They have been maintaining a negative, which is a net negative and a net short position in terms of stocks futures specifically. But this is one of the key elements that we've added. Going forward, we'll be maintaining that as well. Let's also look at the F&O positions as well. That's another key addition. The FI index long ratio is at 0.42%. While the FI net open interest put call ratio is at 0.95%. An indicator above 1 is slightly negative, because that indicates that the puts are higher versus the calls, which is a simple formula that we derive in. So one of the key levels to watch out for will be this one. When you look at the open interest distribution change in terms of both calls and puts, 25,500 is one of the key levels that's been maintained. We have been talking about that key level being created once we cross that 25,000 mark, but that's been maintained. 25,200 as well as 25,000 has been one of the key ones to watch out for in terms of puts. 24,700 has been maintained as the one, and we've seen increased interest in terms of put open interest at the 25,000 level. In terms of finally the stocks which are to watch out for both in open interest distribution gainers and losers. We've seen long build-up across stocks like Hutco, Alchem Labs, as well as the bank, PSU banks names. While in terms of open interest losers, finally, if we can pull that up, we've seen short covering across stocks as well, which is another bullish momentum. Stocks like Delivery was up yesterday, largely on the back of quarterly earnings as well. And that's been one of the key drivers essentially for all the stocks in this particular market. So again, indicating that we'll be in the narrow band again today, but let's watch out for some of the key cues and how they impact the index level as well as the key stocks that will be buzzing in trade today.
Yeah, absolutely. The great elements over there. So the new and improved F&O segment with Puneet every morning. Don't forget to catch it on India Market Open. All right, stocks on my radar. My top three or first three that I'm talking about. I'm starting off with Bharat Electronics. Numbers out after trading hours yesterday. It's a thumbs up from our side because they've beaten estimates on pretty much all counts. And anyway, you've seen defense stocks rally. You might see some cool off in defense stocks because of the run up, but we're looking at Bharat Electronics just on its core numbers. Revenues up 6.8% to 9,149 crores versus 8,564 crores. EBITDA was up 23% to 2,815 crores versus 2,287 crores. So a beat on estimates as well. Margins at 30.8% versus 26.7%. Again, a clear beat on estimates. Net profit was 18.4% to 2,127 crores versus 1,797 crores. There were other expenses which have fallen. That has aided EBITDA, so keep that in mind. Other expenses, in fact, fell by about 33%. So that's the first one. Eris Life Sciences, numbers look decent, but it's a thumbs down because it's below expectation. So if you look at it optically by itself, numbers don't look bad, but you have to compare with what the street had penciled in and some pressure that they have seen in Q4. So revenue was up 28% at 705 crores versus 551 crores. Again, estimates were 758 crores. For this company, EBITDA was up 70% at 252 crores versus 148 crores. The estimates from Bloomberg were at 265 crores. Margins at 35.8% versus 26.9%. This was a beat on estimates. Profit up 32% at 93.8 crores versus 71 crores. For Eris. There was an 18 crore deferred tax credit which has aided as well. But there was a slip in execution for the company, particularly in insulin revenue, which is why you might see a bit of a negative sentiment on the street, and we saw that yesterday in trade as well. Third stock on my list is DLF, and a thumbs up largely on most counts. Revenue was up 46.5% to 3,128 crores for the quarter. EBITDA was up 30% to 978 crores versus 755 crores. Margins at 31.3 versus 35.4%. So slip in margins there. Net profit up 39% to 1,282 crores versus 921 crores. All in all, the numbers look pretty solid for DLF as well.
So I've picked largely on earnings as well, and the first stock on my list is Acme Solar. Operationally, the numbers look very, very strong, and do note that this is a stock that gained over 5% in trade yesterday. I wonder whether investors had an inkling of what the company would report. Revenue is up as much as 65% in the quarter gone by, stood at 487 crore rupees, so significant top line growth. But take a look at the EBITDA and the EBITDA margins, because the margins have expanded to 89.5% versus 68% in the year ago quarter, and the EBITDA has risen to as much as 488 crore rupees. The bottom line does not reflect that. It is down actually about 77%, but there is a one-off in the year ago quarter. There was other income of about 790 crore rupees or thereabouts. And if you adjust for that, therefore, there is a significant improvement operationally. So watch out for this one in trade today. I would be curious to find out what our experts over the course of the morning have to say about something like an Acme Solar and whether or not it makes sense, considering that the stock is up as much as 25% over the last 1 month, to deploy from this point on. Petronet LNG is not the best numbers, and that's because it's a weak top line growth. In fact, it's pretty much flat. The revenue coming in at 12,316 crore rupees or thereabouts, the adjusted EBITDA. And the reason why we're talking about adjusted EBITDA is because there was a one-off 234 crore rupee gain related to an impairment reversal. So adjusting for that, the EBITDA is up only about 2.5% or thereabouts, and the margin is coming at 62.4%, once again an expansion, but the adjusted PAT is only about 3.6% higher or thereabouts, and that's because volumes picture has been pretty bad for the company in the quarter gone by. The volumes were down as much as 10%. Now, there is a note that came through Macquarie on Petronet LNG. It's maintained an underperform with the target price of 260 rupees, the stock price at 320. Do note, what it's saying is that it saw volume moderation from Dahej in the fourth quarter, and it does not see any near-term uptick in utilization for the Kochi terminal as well, and it's expecting that the foray into petrochemicals is going to be returns dilutive for this company. So seemingly a weak quarter for Petronet LNG. The final stock is not on earnings, it's on a significant update, and this is on Shyam Metallics. And this is the thumbs up because the company has announced a foray into wagon manufacturing. It's building a greenfield facility at Kharagpur in West Bengal, and that facility is going to be capable of producing 4,800 wagons per annum in 2 phases. Initially, the facility is slated to commence operations by March 2026, not very close by, and this is likely to ramp up over a period of time, but a new area of revenue growth, or a new line of revenue growth to look forward to for this company and its shareholders.
Okay, so my 3 stocks pretty much on similar lines. Actually, a clutch of earnings today. The first one is on earnings, and that is HEG. So the revenues were flat, 0.9%. There's an EBITDA loss of 55 crores, reported EBITDA loss versus an EBITDA profit of 42. But adjusted EBITDA is actually up 137% at about 99.68 crores versus 41.89 crores. This is because the other expenses line item included about 159.9 crore rupees of a one-off due to decrease in the fair value of investments in a company called Graftech in the US. So if you adjust for that, the adjusted EBITDA is actually very, very solid. So I would reckon the street might actually look at it positively. Keep in mind that Alex spoke about the global supply moderation as well. Resonac Holdings, which is a Japanese company, has recently shut down its graphite electrode production units in China and Malaysia, effectively scaling back about 1/3 of its total production capacity, which augurs well for HEG in Q1 as well. So the stock saw a bit of an uptick yesterday on that. I think that just EBITDA numbers should please the street as well. So watch out for HEG in the session today. Don't know about the quantum, but I would reckon it could do well. Gujarat Gas is the second one. The numbers came out okay, but brokerages have maintained a sell. So Citi maintains a sell, says Q4 better than expected, but the valuations are expensive. Most importantly, the outlook is relatively uncertain. Macquarie maintains an underperform with the target price of 380. The brokerage is cautious on volume growth outlook. So watch out for Gujarat Gas. May not react positively to the numbers or may get sold at higher levels. And lastly, NLC India, revenues were up 8%. I'm taking the larger company right now, the clutch of smaller companies, which we'll talk about later on in the show. But margins very strong, PAT at 482 crores because of a deferred tax. But even despite that, I think the bottom line numbers look okay. So maybe this stock too has a positive reaction.
All right, Ajay Bagga joins in on the conversation this morning. Market expert Ajay, always great to speak with you, and thank you so much for your time to us this morning on NDTV Profit. Just to get a recap of everything happening globally first, let's start there because that's something you track so closely. The Moody's downgrade for US credit rating and the impact that it's had on the 30-year. How do you see that panning out?
Rating agencies are largely irrelevant and they lack credibility, Tamanna. The first rating agency to cut the AAA for US did that in 2011. So what were Fitch and Moody's doing for the last 12 years? In the case of Fitch, it reduced the US rating in 2023. And now we see Moody's coming by after giving a negative outlook last year. So largely the market has discounted it because S&P had cut it in 2011. What happens post the rating cut? Normally there is a bit of a market reaction for a couple of days, and then it's business as usual. The exorbitant privilege that the dollar, enjoys in the world as the reserve currency is what is helping the US despite running a 6.4% fiscal deficit. As the largest economy in the world, to run a 6.4% deficit, fiscal deficit, and then to have more than $1 trillion as payout every year in terms of interest outgoes, running a fiscal deficit of absolute number of about $1.8 trillion. It would not have been possible for any other country in the world except for the reserve currency home base, where they have the exorbitant privilege to print as much as they want. So that's a well-known fact for the markets. It's discounted in. And post 2011, both the sovereigns and the banks changed their investment playbook to allow them to invest in AA plus or AA1 rated instruments so that the US Treasury safe haven status stayed intact. There was the expected attacks on the rating agencies by the White House as well as the Treasury Department. Scott Bessent called it a lagging indicator. It is a lagging indicator, and this time around, it is a 14-year lagging indicator. So these agencies had lost a lot of credibility post 2008, and to even give a AA plus or AA1 in the case of Moody's to the US with such broken government finances, it just shows that a lot more goes into these ratings.
So what do you think would be the credible rating in that case? What would be the realistic assessment of the US economy? Because that is the core question, isn't it?
Yeah, you're spending $6 trillion and you're earning $4.2 trillion. You're adding in $5.9 trillion more over the next 10 years with these latest tax cuts. Which just got passed by the Republican caucus yesterday. Now it will just, it's a breeze to go through the US Congress. When you did that in 2017, there was expectation that revenues would rise with these tax cuts. Rather, you ended up spending nearly $2 trillion more over the last 7 years. You didn't get excess of revenues over the tax cuts, and that's a continuum since the time Ronald Reagan first cut taxes to get out of the recession which the Volcker shock had gotten in 1983. Since then, whenever taxes have been cut, even the Democrats are not able to raise back the taxes. So a country which is earning 4.2 is spending 6 trillion plus, is putting tariffs on top of it on global trade of at least 10%, which takes you back to 1971, if not to the 1940s. Where do you rate that? I would leave that. I'm not needed to be a credit rating agency, but I don't agree with these lofty ratings that the US enjoys. And a country like India, which pays up all its debt, which is always prompt on all its payments, is still at the lowest rung of investment grade.
Yeah, it's a fair point. And speaking of countries that are rated highest at this point, Ajay, it's a dwindling list, but there are 10, and among them, Luxembourg is now rated higher than the United States of America. But having said that, I do want to ask, and the numbers that you were pointing out with regard to the latest tax bill, we're talking about now debt of $42+ trillion that is going to be added up for the United States. I'm just wondering whether there are going to be takers for this additional debt. Of course there will, but is that something that people will think twice about? You have yields that are at 5% on the 30-year and 4.5% or thereabouts for the 10-year. There are better opportunities, in your opinion, globally? People have gone towards gold as well?
Those are very small. For you to go into, say, the Swiss franc, there is very little leeway. Absorption capacity is very low. Yen is overowned already. So you come back to the US. Euro, about some amounts are going into the euro, but the euro has Spain, Greece, and it has Germany and France. So which euro are you really buying? If there was a Deutsche Mark or a French franc, you could have had more options available. Today, you don't have that. Sterling pound, not much of traction there. The Swiss franc 2-year paper is already in negative yields because of this excess of demand. So the Swiss central bank is charging you to allow you to hold its bond. So it comes back to the US. This will keep on working till it stops working. That's how it works. So right now, there is just no alternative. You have $33 trillion of global savings that are sitting in the US stocks and bond markets because people feel there is no alternative. The Chinese are withdrawing about 20 billion a month. They don't want to rock the boat. They've come down from number 1 to number 3 in terms of treasury holders. Everybody's buying gold, but gold has limited capacity to absorb as well. That's a well-known case. So there is a gold buying where central banks 10 years, 15 years back used to buy about 200 tons of gold a year. Now they're buying 1,000 ton. They bought for the last 3 years, 1,000 ton plus has been bought. More gold will be bought, but the capacity is not there in the gold. Will there be a digital global currency which will emerge as a reserve currency? The US will ensure that doesn't happen. That's why they're not very keen on a digital dollar, because that could assume a global, a form of itself. And this is very good to have this exorbitant privilege and continue with this.
All right. Thank you for that, Ajay. Always a pleasure to have you on. Time for an NDTV Profit exclusive, and Vishwanath Nair joins us in for more on that. Sources tell us that Emirates National Bank of Dubai is planning to take the wholly owned subsidiary route for IDBI Bank's acquisition. Now, they got a nod from RBI yesterday, which was significant. Tell us what we're learning, Vishy.
That's what actually prompted this story. So essentially, the RBI has given Emirates NBD an in-principle nod. What we understand from our sources is that this was specifically done so that Emirates NBD becomes a more acceptable bidder for IDBI Bank. Now, remember that the wholly owned subsidiary model is something that foreign banks actually want to avoid actively. So for a bank like Emirates NBD, which currently only has about 3 branches in India, for that to target such a business model, there's obviously a reason behind it, and that reason is IDBI Bank. What does this model essentially do? Well, for a bank like Emirates NBD, it allows you to open branches without specific approvals from the Reserve Bank of India. If you're a branch-led model like, say, an HSBC or a Standard Chartered Bank, there the RBI has to specifically approve opening of fresh branches. In Emirates NBD, that is not, that won't be a requirement anymore. What it will also allow is an easier acquisition, because at this point in time, the race is between 2 bidders. One is Emirates NBD and the other is a Fairfax Capital. Fairfax already has CSB, so they have to go through a complex structure to then acquire IDBI Bank. things become easier for Emirates NBD if they have a wholly owned subsidiary in India, because it's essentially an India entity acquiring another Indian bank, and therefore things become easier for the regulator as well as investors, which are essentially government and life insurance corporation. What the bidders are expecting is that there's going to be a conclusion of this process by say March of 2026 or early first quarter of FY27. That's when the transaction will conclude and IDBI Bank will be sold to a potential bidder. What they're watching out for, what's the one thing that is actually worrying them is employee unions reacting to this news, because if it is observed that a foreign lender is actually buying a domestic lender, they are expecting that there will be some amount of objection by these employee unions, and that may delay the entire process by another 2 quarters, which will be clearly a problem for any foreign bidder.
Just a quick question, Vishy. We're talking about 49% owned roughly by Life Insurance Corporation. Who sells? LIC?
So, according to the bid document that was put out now about 3 years back. So according to that, part of LIC and part of government stake, both will go, and both will remain as minority shareholders, while whoever is coming in will become the controlling shareholder then at IDBI.
So it paves the way for
That's the expectation, yes.
Yeah, that's I think the key takeaway from all of this, that it paves the way for a foreign bank to come in and hold a significant stake. So that would be a huge policy change. All right, watch out for IDBI Bank. Very short break, but so much to cover this morning on India Market Open. We're coming back with all the stocks that should be on your radar and much more. Stay tuned.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Back with India Market Open right here on NDTV Profit. Can you pull up the implied open just to give a sense of what is it that we are likely to start off with? About 99 odd points in the green. So there is some bit of optimism this morning. Let's see if it picks up. Now, therefore, the stage is set for some of these mid and small companies which have come out with a good set of numbers to do well today. Which are these? Aside of the ones that the three of us have highlighted, let's get in Mahima with a list of What, Mahima, 3 or 4 companies which have delivered some good numbers?
Right, so 4 companies on my list. I'll start with Global Spirits first. Overall, it's been a great quarter for IMFL and whiskey manufacturers this quarter. Global Spirits, in terms of revenue, saw a growth of 11%. EBITDA grew 97%. Margins improved from 3.3 to 5.9%. And net profit was up at 5.5 crores versus that of 25 lakhs. Now, what's worked? Overall, operational efficiency, the company has worked towards that, and that has improved margins. Sales volume was up 62% in terms of prestige and above categories. So premium categories exceedingly performed well, and regular and other segments volumes were also up by 16%. Next in line is Borosil, where revenue was up 15.7%, EBITDA was up 57%, margins improved to 13.7%, and net profit was up at 11 crores versus that of 5 crores. Now, in terms of what has worked in aiding profits, cost of raw material remained flat for this particular counter, which is one of the reasons why margins were aided, and finance costs reduced by 39%, and there was also a reduction in terms of deferred tax liability by around 14%, which kind of aided the bottom line. Next in line is HLE Glasscoat. Overall, good set of numbers. Net profit at 20 crore versus that of 10 crores, almost doubled there. Revenue up 8.7%, EBITDA up 42%, and margins stood at 15.6 versus that of 11.9. The company also is set to pay a dividend of 1.1 per share. Now, margins have risen sharply. In terms of margins, this is the best quarterly margin since September 2022, and profits have doubled. Lastly, Honda India will also be one of the counters in focus, where revenue is up 16%, EBITDA at 43 crore versus that of 10 crore. Margins at 16.2 versus 4.5, and net profit up at 36.2 crores versus that of 15 crore. In terms of what has worked, overall stock in trade has significantly gone down by 24%. Deferred tax credit has been observed this quarter versus that of deferred tax liability, and of course Q4 FY24 also had an exceptional gain of around 4 crores in the base year. So these are the 4 small and mid cap space earnings to watch out for in trade today.
Okay. Thanks so much, Mahima, for laying that out for us. And we've also spoken about nine stocks amongst ourselves. We will speak about a few that have underperformed ahead of the start of trade. But before we do, let me introduce our guest today. We've got Sunny Agarwal, who's head of fundamental equity research at SBI Cap Securities, joining us this morning. Sunny, very good morning to you, and thanks so much for taking the time. Let me start with a stock that is part of a whole pack that is in focus and has gained quite considerably in the recent past, and that is BEL on the back of earnings. What did you make of the numbers? The one number that stood out to me among everything else also, despite the great operational performance, is the order win number, because it's not as much as they had anticipated. It's still a very large number. What did you make of the numbers?
Yeah, Alex, I think pretty much inline set of number from BEL. And for BEL, basically, if you look at a management commentary, also the few large orders to the tune of 20-25,000 crore that was in pipeline, and that is expected as somewhere in the first half of FY26. So, basis that order, the street is very gung-ho on this stock. But again, post the recent run-up in the stock, we feel the stock is trading now close to its fair value band of close to 350 to 370 rupees. So at a current market price, we continue to remain neutral on BEL. Maybe buy on dip is the right strategy. And with regards to order win, as discussed, I think a few large orders are expected during the first half of FY26, and those orders will be to the tune of close to 15 to 25,000 crore number. In case that order materializes, then order inflow concern is something which will get addressed in case those order flow for the company. So let's see how they play out.
Sunny, hi, good morning. Tamanna here. In the list of some of the companies that have reported numbers yesterday, what has stood out for you? And of course, we've recapped some of them between Neeraj, Alex, myself, and of course our team. But what has stood out for you as a sure winner? And are you getting more and more a sense, are you agreeing to this view that Q4 numbers are turning out better than expected?
Yeah, so again, stock specific, we can say that select few companies among the mid cap and in fact among the large cap also are reporting a slightly better set of number as compared to the consensus estimate. And as we discussed earlier, we believe that going forward, ultimately market will be a kind of bottom-up stock pickers market, and the companies which are delivering a better than expected number are getting rewarded also by the street. So there are a few examples like CCL product earlier reported very good set of number from mid cap, small cap pack. Or for that matter, care rating, after long time, we have seen our credit rating companies reporting very good set of number. Among the large cap, we all know that ICICI Bank, HDFC Bank has reported good set of number. In fact, yesterday DLF came out with a very solid set of pre-sale booking, as well as if you look at the contribution from the annuity portfolio, that is also continuously increasing. So DLF continue to look positive. So again, a very what we can say, rather than sectors, entire sector reporting good set of number, there are few select companies which are looking good amongst the entire market, and those will be the companies which will get rewarded by the street over the period of next 3 to 6 months.
Okay, well, viewers, we're going to tell Sunny to tell us one or two of those very specifically in a few minutes. So you're going to wait for that for a bit, right? Stay tuned to us, because we'll ask Sunny for his top ideas in a moment. For now, I want to take a detour and get in Somit Sarkar to talk about one particular stock, and that is Zinca Logistics. It's had a bit of a run in the last few days. It's going to be a stock in focus today, because 6 months after the listing, pre-IPO investors are now allowed to and maybe planning to sell the shares in the firm. Somit has some details. Somit, it has had a serious buzz when you consider what some of the other logistic players have done in the last 1 month. But what are you gathering on Zinca?
Well, as Zinca Logistics will remain in focus given the fact that 56% of the shareholding will be coming out of the lock-in period. Today is the last day for this lock-in period to end, and this is the lock-in period, that is a 6-month lock-in period post-listing for the pre-IPO non-promoter investors that is opening up. So 56% of the shareholding is valued at close to 4,600 crore rupees, which is nearly 4 times the IPO issue price that Zinca Logistics has done. Now let's see first how the share prices have moved for Zinca Logistics since IPO till now. Now the IPO price for Zinca Logistics was 273. The listing day closing price was 260. The all-time high for Zinca Logistics was 551, and the current market price is around 460 or 470, which is 16% down compared to the all-time high, but 70% higher compared to the IPO price of the company. Now, who are these investors who can go ahead and sell pros the lock-in period is over? Now, most likely it could be the foreign investors, because they are sitting on handsome gains, like for Assel, who owns close to 13.5% stake in the company. For them, the average cost of acquisition was just 67 rupees. Now, if you compare this with the current market price, they are sitting on a gain of nearly 7 times. Quick Routes owns around 9% stake. Their average acquisition cost was 52 rupees per share, and they are sitting on gains of nearly 9 times. IFC, Sands Capital, they are sitting on gains of close to 2.5 to 3.5 times. Apart from that, it's Ethan Creek, which is sitting on a gain of just 5.5%. Sequoia is holding close to 1.3% stake and sitting on gains of nearly 50%, while B Capital is sitting on gains of nearly 8.4%. Now, the only company which is sitting on a loss is Tribe Capital. Now, they had invested in the last round of funding for Zinca Logistics, and they are sitting at a loss of just 4%. Now, of this 8 investors who are coming out of the lock-in period, 5 did sell partial stake in the IPO as well, and these IPO sellers were Quick Routes, Assel, Sands Capital, IFC and Sequoia. Also, 6.9% of the promoter shares will also come out of the lock-in period. So that also remains under focus, whether the promoter will go ahead and sell their partial stake or not in the company going forward. Now, how are analysts viewing Zinca Logistics at this point of time? Now, there are 6 analysts who are covering this stock. Out of this 6, 4 of them have a buy rating, while 2 of them have a hold rating. Now, the highest target price on the street for Zinca Logistics stands at close to 650 rupees, while the lowest target price sets on around 474, and the consensus target price is at around 553, which suggests a return potential of around 20% from the current levels.
Okay. Somit, many thanks for that. Just very well summarized. Keep in mind, viewers, what we are saying, and Somit, correct me if I'm wrong, what we are trying to say is that there are shares opening up, and therefore these shareholders may come to sell. As of now, we haven't spoken to the shareholders to know if they're going to sell, right, Somit?
Right. As of now, there is no clarity whether the shareholder will sell or not. But yes, the lock-in period is opening, so we need to keep an eye out for. Because last time when this happened with Swiggy few days back, we did see multiple block deals coming in.
No, most important. And Samit, thanks for that. The other piece, guys, is that some of these shareholders have sold in the IPO round as well. So they were willing to sell during the IPO. Maybe not in entirety, but in part. And now maybe post-IPO with the prices being high, as Sumit said, some of the gains are 7 or 8 times, right?
Yeah, 5.8.
For Sequoia, it's 50%, but I think for the others, it's much higher.
Axle and quick routes.
Axle, essentially, yes. So therefore, could be interesting to see if tomorrow, maybe today a little bit of pressure, I don't know, but tomorrow or day after, if there are block deals that happen on Zinca.
Yeah, so we told you first, keep an eye out for what you're seeing on Zinca Logistics. Of course, Sunny Agarwal still with us, SBI Cap Securities. Is that a stock that you've been tracking? Any views on a Zinca, Sunny?
Sorry, Tamanna, I'm tracking this stock.
No, that's all right. That's perfectly all right. I'm just wondering if you have a view on the metals space today, and this is something that we've been discussing since morning. Rate cuts and the whole, path of rate cuts being kicked off by China looks good for metals. Do you think metals is a story that will play out next couple of days in trade?
Yeah, definitely. I think within metal pack, if you look at non-ferrous companies, especially on aluminium side, so companies like Nalco, Hindalco, especially on Nalco side. So if you look at alumina prices, that has inched up slightly post December quarter. And at the same time, aluminium prices, which is again one of the key finished good for Nalco, that is trading between $2,400 to $2,600 to the ton. And at the same time, on valuation front, if you look at companies like Nalco, trading close to 5 times EV/EBITDA, which we feel that the downside is capped over here. So we continue to remain bullish on Nalco from an aluminium pack. Within steel, because of two factors. One is because of softening in the input prices, and at the same time, because of this safeguard duty implemented by the government of India. So that has led to the possibility that EBITDA per ton for ferrous companies, steel companies may go up during the 1Q and 2Q of the next year. So again, within a ferrous pack, we believe Tata Steel is relatively well placed in terms of risk reward ratio. And amongst the mid-sized company which are looking good is the Shyam Metallic, again a very well diversified player. So there we have seen a consistent earning growth, a well diversified portfolio. So Shyam Metallic is the one company. And one indirect play on stainless steel is basically manganese. So we like a smaller player over there. So we have seen a decent amount of correction in Moil as well as Sandur Manganese. So again, Moil being a government company. So again, a play on manganese, which is usually blended in the ratio of 5% while manufacturing a stainless steel. So there we also feel that the prices have bottomed out. So if somebody want to play a high risk, high return kind of bet, then Moil and Sandur.
Got it. Sunny, sorry. Did I hear you say about Shyam Metallics? And the reason I asked this is because today it's a stock in news as well, right? It's going to set up a wagon manufacturing facility. So, I mean, yes, they are trying to integrate, but this is a slightly different business, right? If I'm not wrong. And there are set players out there. So one, is that change your view on Shyam at all, positively or negatively? Also, does it have any impact on the existing wagon manufacturers if somebody which is into sheet metal and the metal products, etc., is getting into their domain?
Yeah, definitely. I think slightly unrelated kind of diversification as far as Shyam Metallic is concerned. So definitely in a short term, street may take it in a negative way that it's unrelated business and why they are pouring into this business. But again, the opportunity in the wagon business is phenomenal. So if you look at other three players, they are in the range of they are manufacturing capacity in the range of close to 12,000 wagon per annum. And this Shyam Metallic new capacity is likely to come on stream by FY27, if my understanding is right. So till I still feel that the opportunity there is significant, and all the existing three players are sitting already on a robust order book, which we are expecting to get well executed over the period of next 2 years. So yes, maybe in the short term there may be a kind of negative reaction on Shyam Metallic, but again, I feel that still the majority of the contribution of the business will continue to remain from the metal part rather than the wagon part. So maybe I feel that today during the correction, it's a good opportunity to accumulate the stock selection.
Interesting. All right. So you're expecting correction today. Gotten an answer. By the way, I thought that was, I guess that this is open to interpretation, and in a sense, this is something that will play out maybe March 26 onwards. And suddenly, I thought backward integration would be positive. They're essentially going to be probably improving on the margins that are currently seen in the industry because of the kind of setup that they currently have. But then let's see how that pans out. For now, let's turn to a few earnings that were not necessarily that great. And there are a few companies that have posted a weak set of numbers, among them something like a JK Paper. But Puneet joining in and telling us about some of those numbers. Puneet, does JK Paper make that list?
Well, definitely, and it's a weak set of numbers for JK Paper along with JMR Power as well as, Northern Arc. And let's start first with JMR Power. Revenue was up 6%, but EBITDA was down 14%. And that's led by the margin fall of 530 basis points in this particular quarter, coming in at 21.9. Overall, that's dragged because of operating deleverage. The profits are down 73% in this particular quarter. Now, the increase in material costs was one of the key reasons. That's almost doubled in this particular quarter, as well as the decrease in other income that had propelled the profits in the same time last year. So that's dual effect has impacted the profits meaningfully in this particular quarter. So definitely the increase in material costs might be a key negative for the stock today. So watch out for that. JK Paper is the other one. Revenue was almost flat to a negative bias, 1.7% down, but EBITDA has been impacted by 39%, which has dragged the overall margins by almost 700 basis points. And the key reason was the cost of materials. The cost of materials has inched up by 816 basis points. So that's essentially dragged the margins down. Lower sales realization was the other aspect, which was, because of higher imports in the country, as well as, the increase in wood costs, which has impacted the performance. And the last one is Northern Arc. Now, this finance company recently listed, while, the company's numbers weren't too much to talk about. Profits were down 57%, and that was because of a spike in the credit cost of the company. So provisions are up at 175 crores versus 25 crores in a year-on-year period, and so that's almost up 6 times on a YOY basis, and even on a quarter-on-quarter basis, it's up 138%. We are also awaiting more details on the con call that's scheduled at 11 a.m. today, but the microfinance space has been impacted because of that. So these are 3 key stocks in earnings. Weak earnings essentially, and we could potentially see a negative reaction in trade today.
Watch out for that. We've covered a whole host of stocks, and we'll find out what our experts have to say about that. And we'll come back on the other side of this very quick break to tell you about the pre-open levels. So do stay tuned.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with.
Welcome back. You're watching India Market Open. Just about 6 minutes left for the pre-open session to begin. And you're going to open with a bit of a gap up today. Nearly 90 points up in the green. Sunny Agarwal with us this morning of SBI Cap Securities. Sunny, give us a sense of what you would buy in the market right now. We are in a consolidation phase, but a broadly upward move that we're seeing. As we get into the pre-open session and the opening session for the day, what is on top of mind for you?
Tamanna, I think very stock-specific ideas. So if you look at auto, M&M again, they continue to remain a top pick. Play on both farm equipment, basically tractor and SUV. So again, M&M, there we feel the fair value is close to 3,500, 3,600 rupees. Again, a smaller auto player, auto names like Force Motor. So we feel because of this Urbania, which is getting a very good response, and we have seen a very good response, volume growth over there. So Force Motor, we believe the fair value is close to 13,000, 14,000 rupees. And again, we are bullish on auto and name also. So few companies have reported very good set of numbers. Case in point, SJS Enterprises, despite of slowdown in two-wheeler industry, they have recently onboarded new client like Hero Motocorp. So that's a small cap company, SJS Enterprises. So there we feel, so we have got a coverage also there. So we feel the fair value of SJS Enterprises close to 1,300, 1,400 number. Lumax Auto, again, a company under our coverage, we believe, which is catering to players like Bajaj Auto. So basically their Chetak, M&M and a few others, and they have recently done 2 acquisition also. So Lumax, we have got a price target of 850, so that comes to the auto pack. Within BFSI pack, again, selectively, we continue to remain constructive on names like ICICI Bank, HDFC Bank, among the private large cap banks. Among the mid-sized bank, we feel the banks like Federal Bank, where we have seen recently a management change over there. So there, over the period of next 2-3 years, we will see a significant improvement in terms of the way bank operates. So Federal Bank, as well as Karur Vysya Bank, which has reported the numbers yesterday. So we feel a decent set of numbers from Karur Vysya Bank. Coming to PSU pack, we continue to remain bullish on Indian Bank. So we believe that amongst all the PSU bank, barring SBI, Indian Bank has reported a very good set of numbers. And there we feel the valuations are comfortable. So Indian Bank is a top pick as far as the PSU banks are concerned. Among the NBFCs, we continue to remain bullish on housing finance as a pack. So PNB Housing has reported a very good set of numbers, and there, because of this, their shift in focus toward the affordable housing, we feel the NIM will continue to remain stable during the FY26. So PNB Housing among the housing finance pack. And coming to, we feel that cement as a pack is likely to do well during the FY26 and 27. So the worst of the earnings is behind the cement pack. So within cement pack, we would like to bet our money on mid-sized players. So basically players like JK Lakshmi, where which has got an exposure on north as well as the western side. So JK Lakshmi continue to remain our preferred bet. Star Cement, which has got an exposure to a northeast belt, again a mid-sized cement player. So Star Cement is something which
Sunny, that's about 20 stocks on last count. I don't think our people can buy so many. So we'll try and nail it down to 1 or 2, yeah? We'll do that in moments from now. Let's focus, but that's a lot of ideas. So Sunny, thank you for those. We'll try and pick up your favorites in some time, right? Let's try and get in other voices as well. And now before we get in Rahul Sharma on the show, let's get in my colleague Varsha to talk about the Macquarie view on Sun Pharma, simply because Macquarie's done some research on some bids being done, right, Varsha? And they figured out that while Sun is paying higher, maybe it is still positive, something like that?
Yes, absolutely. So they have given outperform rating to Sun Pharma basis due to strategic benefits and the potential value accretion from the acquisition of Checkpoint Therapeutics. Now is the breakdown for their reasoning. So what they say is, despite Sun Pharma's bid being significantly higher, that is almost 2x than other serious buyer, Macquarie believes the acquisition will still add value to Sun Pharma because they view that unlocks it, which is a Checkpoint's lead asset, which is the FDA-approved drug for skin cancer, as a strong strategic fit for Sun Pharma. And this drug addresses a crucial gap in Sun Pharma's dermatology or oncology portfolio. It aligns with the company's focus on the Medicare channel as well. And they say significant NPV potential when it comes to Unloxit. Now, Macquarie estimates a base case, a net present value of over $500 million for Unloxit alone, with a bull case exceeding $1.5 billion, suggesting substantial future revenue potential. And they've been also increased their earning estimates for FY 25, 26 and 27 by 1%, 3% to incorporate the anticipated sales of Unloxit, and of course due to updated foreign exchange rates. And Macquarie identifies several potential catalysts for Sun Pharma, including the closing of the Checkpoint acquisition, which is the main thing, strong Q4 FY26 results, which are upcoming on 22nd, and the launch of specialty products. So the next growth driver for Sun Pharma is basically this specialty portfolio. And they believe that the Sun Pharma's focus is shifting towards high margin branded business, which should lead to more sustainable growth, better pricing power, and improved profitability and higher return ratios.
All right. So watch out for Sun Pharma and trade today. By the way, the first ticks are in terms of the pre-open session, and it's too early to call which direction we're heading, because there's a few stocks that are looking a little bit worse for the wear in the initial ticks, but then I'm sure that will settle down. The indications are, of course, for a minor positive start today. But let's get in Rahul Sharma, who's Director and Head of Technical and Derivative Research at JM Financial, to tell us what he thinks about the near-term trends. Rahul, thanks so much for joining us this morning, and good morning to you. We've seen a very secular move last week and across the board, and more often than not you've seen the broader markets outperforming, barring those two trading sessions. And yesterday you saw cooling off in a few pockets where perhaps the run-up was very significant. In your opinion, do we enter a stage of consolidation, or is there further upside at this juncture?
Yeah, very good morning. So definitely, after the big move that we
Okay, I think we might have just lost Rahul. There's a little bit of a technical issue at this juncture.
Just look at the movers in the first few minutes of trade, and it's all about results. Just want to pull up NLC, and of course with the caveat that this will settle going forward, but 11% up on those blockbuster numbers. DLF also shining this morning. Let me pull up Acme Solar as well and see what's happening there. Zentek again on a 5% upper circuit. That's a story that we've seen playing out for the last several days. Raymond as well, actually, after the demerger. Raymond has been buzzing, but that could be, a sort of volatility in the stock settling down more than anything else. JSW Steel on radar this morning, and we talked about how steel stocks could be in focus. Sonata Software also doing fairly okay. So you have some movers there. I suspect you'll see pharma stocks doing fairly okay as well. I want to just pull up Pfizer for you for a second and see what's happening there. Sun Pharma we talked about, Macquarie note, but Pfizer really firing the first few minutes. Rahul, can you hear me clearly? Tamanna here.
Yes, Amanda, very much audible and loud and clear.
Hi, good morning, Rahul. Let's start with your levels very quickly, because we're just a few minutes away from the opening session as well. What are the levels you see on the Nifty and the Bank Nifty?
Yeah, so Nifty 24,800 is the immediate support that we see. We feel that this dip is expected to get bought into. If you look at Bank Nifty, it is relatively holding well, and we feel that the next round of up move could be coming in from the Bank Nifty space. So as far as Bank Nifty is concerned, the major support for Bank Nifty is 55,400, which is where we've closed in yesterday's session. So we've closed very near to the support. If we manage to sustain above this, the next possible level on the upside is 56,000.
Okay. Rahul, good morning. One, what are the ideas that you're sharing with us this morning? And two, something that we're talking about in the morning, Rahul, the IT index is playing a bit of tic-tac-toe, right? Up one day, down the next. Today might be a bit of an up day because NASDAQ has done okay and the street was presumably short. Is there a trade in Nifty IT? So two questions. Is there a trade in Nifty IT? And two, what are the stock recommendations for the morning?
Yeah, so Nifty IT, did well in over the last couple of weeks, post which we saw a bit of a cooling off happening. The trend in IT index is still positive, and I think structurally we may see another 4 to 5% up move in the IT index. So overall, the view is positive in IT, and this dip may get bought into. Coming to the two actionable ideas for the day. One is the real estate space. So we like the reality index, which is the top pick is Brokerage Properties. The stock has formed a very good base around the 1900, 2200 area, and now it seems that it is ready to shift gears. So from a positional perspective, one can look to buy Brokerage Properties for a target of 2500 to 2600. Stop loss can be placed at 2090, and this can be traded long in anticipation of a good rally in the reality space. The second stock, which looks very good on the charts, is Paytm. The stock has been consolidating above its crucial moving averages, and we feel that yesterday's close was quite a firm one, about the 870 mark. So positionally, we feel that this stock is ripe for a target of 900, 930 on the upside, can be bought with a stop loss of 850. So Paytm and Brokerage Properties are the two top picks that can be bought in today's session.
Okay. Thanks, Rahul. And those are some good ideas to work with. Watch out for those viewers. On to the big brokerage call for the day today. CLSA has upgraded Amber Enterprises to an outperform rating. This is after the numbers and the call yesterday, I presume. Harsh Johnson with more details from that note. Harsh, what is CLSA's rationale?
Well, I want to first talk about stock price, Neeraj. The stock is down 19% year to date, so something to keep in mind on the back of that CLSA upgrade. What they've done is they've increased the target price from 7,000 to 7,275. So it's not a meaningful upgrade in terms of target price. That's the other piece I want to quickly highlight. But now offers a 16% upside. Let's talk about Q4. Q4 was in line with consensus as well as CLSA expectations. Revenue growth was strong, 34%. Electronics up 74%. That was where the growth came from. Durables was softer at 25%. Mobility continues to face challenges, 2% growth. In terms of guidance, it was extremely strong. Double-digit revenue growth in durables is what they are penciling in. Electronics to grow at 30 to 40%. Gradual margin improvement from 7% to 10 to 12% over the next 2 years is what management is guiding for, and CLSA is penciling in. Mobility revenue to double in the next 2 years, so that's where some bit of growth will pick up. And India AC sales from a India standpoint to grow from 1.5 crore currently to 3 to 3.5 crore in the next 2 years. That is what they will look to capitalize on in terms of opportunity. But the uptick in non-room air conditioner segments is going to be the key to drive margins higher. Electronics to be a key growth driver. The gross capex in this space is expected to be around 3,000 crore. It's expected to contribute to revenue from FY28 onwards. The capex in electronics is under PLI and is likely to generate a very high teens ROC, or rather return on capital employed. As consumer electronics reduces, margins will likely inch up. They are expecting the return on capital employed to rise by another 350 basis points in the next 2 years. JV losses likely to come off. So they've therefore raised the EBITDA by 6 to 9%, upgraded it to an outperform.
Okay, so Amber Enterprises is the big brokerage call this morning. Stock not doing much as of this point. Rahul Sharma, are you tracking Amber? What are you seeing on the charts?
Yeah, so looking at the technical setup, the stock is consolidating around its 50 DMA. Overall, this base is still there in place around the 5,700 mark. And we feel that once it crosses the resistance area of 6,600, there could be a meaningful up move towards the 7,200, 7,300 area. So as of now, this is more of an accumulation zone. The stock may spend some more time around this area, post which, once the breakout happens, one can look to add on to long position. So as of now, 6,000 remains a crucial support, and which is also very close to the 200 EMA, which is placed around the 5,900 mark.
Okay, 8 minutes have settled. Let's just try and figure out which of these stocks have actually made a move from amongst the companies that came out with the results. So certainly Petro and LNG should be one that we should try and figure out, because the volumes were a bit of a disappointment. The stock is marginally lower, but There are a lot of others which should be in focus. So BEL, solid quarter, but the stock has had a bit of a rally. NLC is up 6%, BEL up 1.5%. HEG is the other one which came out with the EBITDA numbers looking positive. But no, the street is looking at the reported EBITDA down about 2.5%. Okay, maybe a couple of others. Acme Solar, Borosil, Honda India and HLE Glasscoat. Acme Solar flat. Global Spirits, Borosil is up 6%, thank you. Honda India and HLE Glasscoat. HLE Glasscoat 18% because margins came in at 15.6 versus 11.9. Global Spirits is up 3. Honda India is the last one I just want to mark. Margins at 16 versus 4.5%. The stock is up 20%. Solid movers, some of the small caps out here. So, Sunny Agarwal, do you track any of these? And if you don't, give us a view on maybe Acme Solar if we haven't spoken about it.
Yeah, so I think among all the companies which you have discussed, I think Global Spirit is something where where I feel that there is a kind of turnaround which we are seeing on basically ethanol front. So if you look at EBITDA per liter, that number earlier used to be in the band of 6 to 7 rupees. That collapsed to close to 1 rupee, 2 rupee band. Now most of the players are indicating that because of the cool off in the corn prices, maize prices, now EBITDA per liter is likely to head towards the 5 to 6 rupee band again. So I think Global Spirits seems to be kind of turnaround story, and with already the company is already sitting on close to 30 crore liter annual capacity. So there we feel there is a value buying which one can see as far as Global Spirit is concerned. Coming to Acme Solar, again a very solid set of numbers. So we have seen a kind of 1.2 gigawatt of capacity that have been added to the fold in FY25, and now the total capacity is 2.7 gigawatt, and that has led to the very solid set of number by Acme. And this capacity is likely to go to close to 6 to 7 gigawatt over the period of next 2 years. But looking at a current structure, I think for a 15% ROE business, a regulated business, already the Acme is trading at 3 times price to book. So again, I would like to remain a kind of neutral at a current market price as far as Acme is concerned. Maybe during FY27, we may again see a bump up in earnings when the new capacity comes on stream, and at that point of time, kind of re-rating can be seen. HLE Glasscoat was a totally surprise. I mean, their main industry, which is the end user industry, which is the chemical and pharma. There we have seen a kind of muted capex from both the industry, and there, despite of a muted capex, we have seen a very good set of numbers from HLE Glasscoat. So again, seems to be a re-rating candidate, but we need to hear more from the management in terms of the future growth.
What would you do with some of these at this juncture, Rahul? Would you venture out, considering the kind of run that you've seen in something like an HLE Glasscoat, something like Honda India moving up so dramatically on the back of earnings? Would you venture out at all?
Yeah, it's a good time to book profits, because there is a lot of stuck positions that has been there over the last 5-6 months. So a lot of investors would be looking for an exit, and in case you're sitting on profits after this big move, it is prudent to take some money off the table.
Well, so you've seen the pre-open rates now, Rahul. Based on this, whether on the index or on specific stocks, what is maybe one top trade for the day, or you do the trade today with maybe a positional bias?
Yeah, so if you look at a positional basis, one stock which looks good to us is MCX. This setup is, the stock is strongly in the grip of bulls. The stock has crossed the 6,500 mark, and now it seems ready to be heading for the 7,000 mark. We've seen some of the other exchanges like BSE do extremely well. Similar suit is expected to follow here. So if we are positive on this space, so one can look to buy MCX at these levels. Have a stop loss placed at 6,300, and 7,000 is something that we can expect in the very short term.
Speaking of exchanges, let's also talk about BSE then. What do you make of the recent performance, particularly last week? It's been in focus. It's up about 1% in pre-open. Would you trade this, Rahul?
Yeah, I think it's best to be a trader in BSE at this point in time. As an investor, it's better to wait for a sizable dip or a correction. The stock has definitely extended its gains and looks a bit stretched, especially if you are an investor. So book some money definitely, book some profits definitely at these levels. But as far as the trading bet is concerned, given the momentum in the stock, we won't be surprised even if this head towards the 70-800 mark. So it's best to strictly be a trader using options or very short-term derivative contracts, or maybe create bull spreads using the at the money and out of the money call options. But as far as the positional setup is concerned, this seems like it is a bit stretched, and a correction of around 8 to 10% will make it attractive for re-entry for positional traders.
Okay. Thank you for that, Rahul. Stay on with us. We're hitting the opening rates right now. It's all going to be about results. It's all going to be stock specific. So remember that when you look at the first ticks coming in, the Nifty a little muted compared to what the implied was indicating. Just thereabouts, hanging on to the 25,000 mark, which is good enough for now, one presumes. Bank Nifty, remember, has been underwhelming and underperforming relatively for the last several sessions. Continued to do so. The seesaw of the Nifty IT continues, 0.75% up in the green. Down day yesterday, up day today. So that we see pairing out. Broader indices actually looking like they're doing better compared to the Nifty and the Sensex this morning. So maybe portfolio is not looking half bad, 0.5% up on both those key indicators. Let me pull up the heat map for you very quickly to see what the picture is looking like on the Nifty this morning. And we talked about metals, how China's interest rate cut, the first in 7 months, might be a boost for metals. The Chinese economy, one of the biggest consumers in the world, and if they are going to prod up their economy, good for commodities. Hindalco, Tata Steel, all doing decently today. We told you about the Macquarie call on Sun Pharma and the top line there. Infosys, along with the whole IT run-up, showing up there among the winners, though not massively. I mean, the highest gain on the Nifty right now is just 1.5% up. So remember, it's a consolidated range-bound kind of trade. Overall, JSW Steel also not doing half badly. More green than red on the screen, which is good. Watch out for Eternal through the day. Their board meeting is on, and they're limiting their foreign ownership to 49%. You might see some volatility in the stock thanks to that. On the losing side, Bajaj Auto stocks are coming off after a good run-up. So you're seeing Bajaj Auto, Hero Moto down today in trade. Power Grid having a bit of a tough day as well. After results, it's not been that great. Maruti also on the lower side. But I would say this is not a very active kind of a morning or an opening for the Nifty. More of the action is stock specific and on the broader end of the market.
Absolutely. And the list that I pulled out, Tamanna, not in any particular order of size, but there is an interesting list of stocks. And by the way, you've seen a little bit of a choppiness in the broader markets as well. We were up about 0.4% for the mid-cap index. We've given up some of those gains. So keep an eye on the market breadth. That should settle in the first half hour or so. But let's pull up some of the reactions to earnings and some very, very good numbers coming through. Let's pull up HLE Glasscoat. Let's look at what the reaction is. The pre-open suggested that the stock is going to react very positively, and Honda India, both of these stocks are arguably the stocks of the day. Let's see if this continues to be the case. Remember, Rahul has pointed out that you might want to exit if you are holding. This is going to provide you with a nice pop, nice opportunity to exit. We will get a fundamental view also over the course of the day. Something like an NLC India, very strong PAT growth. This is on the back of expansion in margins. This is evident in the stock price. The stock price gaining as much as 6.5% in trade today. Global Spirit as well, very strong volume growth. And our performance on the operational side has been good in the quarter gone by, 1.8% higher at this point. Let's pull up something like a Restaurant Brands Asia, and this is where there is an expansion in the margins that has led to a narrowing of the net loss. It is still a net loss of about 25 crore rupees, but that compares with a net loss of 30 crore rupees in the comparable quarter, and that's seen as a positive 4% growth or thereabouts at this juncture. Acme Solar is a bit of a surprise to me personally because the numbers look very, very good. Of course, there was an other income in the previous year or the comparable quarter, and that's quite a sizable number, as a result of which the PAT number is down over 70% if I remember correctly, and that seems to be what the street is focusing on at the start, down about 3% or thereabouts. Let's also pull up a Shyam Metallic and see what the reaction is to the announcement of a new wagons business. This is something that kicks in March of 2026. and it's a reasonably positive start, up about 0.6%. Remember, Sunny Agarwal has said that if there was a downtick, he would be a buyer in the stock, just purely based on what the outlook is for the overall business for Shyam Metallics. Let's pull up a Borosil. Not the largest counter, but in the glass space, doing particularly well on the back of the fact that its PAT number has more than doubled in the fourth quarter. Very strong set of numbers, in the stock reacting 4.5% higher at this point. Round off the list with a few stocks that are likely underperforming. Something like a Petronet LNG, not the best set of numbers, and in fact it is bearing out. The street looking at it slightly negatively, down about 2% or so, and that's because the volume picture for Petronet LNG in the fourth quarter was not particularly great, and the margin picture is, largely something that has had a bearing on the performance. GMR Power as well, you've seen the PAT decline of as much as 70+%. Yeah, there you go. The stock is lower by as much as 2.8% or so. And as a bonus, we've also pulled up Reddington for you, a good set of numbers by this company, and the stock reacting positively as much as 8% higher or thereabouts. So a lot of stocks, Neeraj, reacting positively on the back of earnings, a couple dropping quite precipitously, one unexpected move in the form of Acme Solar.
Yeah, maybe valuation driven, if you will. But, you know, 2 or 3 trends just before we get to Rahul Sharma. One, IT is up today. We spoke about it. And Nifty IT is up about 1% on a day when the small cap index too is down about 0.2%. So the breadth isn't the most positive, but IT is seeing a bit of a bounce because the street was short yesterday. And NASDAQ has done okay. So that is one. Two, I think defense stocks and railway stocks are taking a bit of a breather today, because I saw Jupiter Wagons, for example, down in the red. So that's one name to keep in mind. But I think some of the other defense names also maybe just taking a bit of a step back in trade today. So a bit of a breather out there. HAL is down, Wrights is down, Garden Reach is down. So some corrective move. Nuclear Software is down 4.5%. So some of those stocks which have done really well in the last few days are down. And the other standout move of the day today is Quest Corp. 9% lower post their numbers. So that is actually one of the top losers on the BSE all cap as well. So bear that in mind. Rahul Sharma, opening thoughts. It's a pause, if you will, for the small caps, because we've seen the indices being flat, but the small caps largely last 6 days have done really well. A bit of a pause today, 1/3% low. Doesn't mean it'll stay this way, but you've told us beautifully about large caps, Nifty IT, etc. Tell us a bit about the broader markets and any stock that stands out for you post-open.
Yeah, so Nifty did witness a lot of call writing yesterday in the 25,000 strike price. So definitely, maybe for a session or two, we may see a bit of cool off happening. This is something that was expected after the big up move and 25,000 being taken out. Now, what is standing out today is the IT index, like you said, and one stock that is taken out crucial resistance levels is LTI Mindtree. Now, LTI Mindtree is heading for its 200-day EMA, which is around 52.50. So that becomes our immediate target. But I think the legs are pretty longer. It could even head towards the 5,500 mark. So LTI Mindtree can be bought at these levels. Stop loss can be placed in the vicinity of 4,950. And IT is the sector to trade today, especially given the overall consolidation cooling off in the broader market. And we feel that this is one sector that can outperform in today's session.
Okay, thank you so much, Rahul. Thank you so much, Sunny, for joining us on the first leg of India Market Open. Always great to have you on the show. And we're welcoming now Sanjeev Prasad, MD and co-head of Kotak Institutional Equities. Sanjeev, very good morning and great to have you on. You know, this is an interesting phase that we're seeing in the market right now, because the worst is over in terms of external shocks, whether it's regional politics, whether it's geopolitics, whether it's trade war, etc. And then now we've come down to bare basics. When you look at bare basics, what are you seeing right now, Sanjeev Prasad?
Well, first of all, I hope the worst is over. On the trade front, keep in mind the fact that the tariff issue has only been put on abeyance for now. On July 9th, the current pause which we have gets over. Hopefully, by the time there will be a lot more clarity on the trade and tariff arrangement between the US and other countries. But as of now, as you know, only one deal has been signed, that between the US and UK, and US actually had a large surplus with UK. I don't know what to make out of this, market excitement that, most of the tariff and trade issues are behind us. Clearly, that's not the case. Hopefully, it will not be as bad as what we saw on April 2nd, but clearly tariffs are going to be higher than whatever we have seen in the past. I don't think there is any doubt about that. But coming to the other points on the more fundamental issues of earnings and valuations, the challenge remains valuations have been quite high, for the last several months. And after the recent rebound in the market, valuation again extremely high. Even sectors where we were finding some value earlier, namely banks and BFCs, telecom, even there, most stocks now trading at near full valuations, I would say. And other parts of the market, consumer related stuff, most of it is supremely expensive. Investment stocks, again, fairly expensive. So the challenge remains, valuations are very, very high, pretty much across the board. And earnings numbers are still not looking that strong. If you see the fourth quarter, nothing really to talk about. The underlying parent still on the weaker side. So hope remains that somewhere, we start seeing some earning recovery. But for now, we are still seeing earning downgrades. For 2026 for the Nifty 50 index, for example, we are looking at about 10 to 11% growth in net profits for now. And our earning numbers have been cut about 5 to 6% since the beginning of the current calendar year. That's the challenge.
Just a minute, Sanjeev. Just a minute. I just want to come back and drill down on that point, because this is, I won't say contrarian, but different and maybe refreshingly different from what we've been hearing so far, which is Nifty earnings have been great, corporate results have been much better than expected. You're saying you're not necessarily seeing it in that view.
I don't know. I mean, historical numbers, the company reported what they reported, and at least looking at the numbers, there's nothing really exciting about the numbers, no? If you look at the Nifty 50 numbers, for example, whatever beat has come at the aggregate level is largely because of SBI, which reported almost 60% higher net profit number compared to our expectation. That was the back of, factors which are not really recurring, I would say. I don't want to get into the specifics over here. Same way, if you look at a broader universe of stocks, the real beat has come from the OMCs, actually, oil marketing companies, which have reported far stronger refining margins. And they do have this tendency from time to time, the reports are very, very hard to believe, refining margins. But otherwise, if you look at the broader set of companies, sectors, no real excitement there.
From that perspective, then, hi, morning, Alex here.
Difference of opinion on reported numbers. Yeah, reported numbers are what they are.
Yeah. You're absolutely right. The difference of opinion is not on reported numbers. I suppose the difference of opinion is on whether it's as bad as was expected or not. Expectations can be subjective. Numbers can't.
That's okay. I mean, expectation known, right? So not as if the numbers are surprised, very sharply versus expectation. Yeah, in a few cases there are some beat, but the larger sector, there doesn't seem to be any big excitement, to be honest with you.
So from that perspective then, given that there aren't any significant surprises, and if anything, from your lens, it's not looking particularly exciting. At 25,000 on the Nifty 50, and considering the way that the broader markets have also moved in the very recent past, would you say that valuations at this juncture are perhaps a little bit heaty? And would you say that deploying at this stage is more difficult?
Yeah, that's what I said, right? Look, on the one side you have, a decent macro, which hopefully will translate into, some earning growth as we go along. But on the other side, you have the harsh reality of a very uncertain global environment. Lower global growth for sure, and some slowdown in domestic growth, at least in the first half of FY 2026. After that, hopefully, you start seeing some recovery. And in that context, valuations are high. I don't think there is any debate or dispute about that. Look at, as an example, any of the cement companies, they are trading at 35 to 70 PE now. And that is on the back of expected big recovery in profitability in FY 2026 compared to FY 2025. We have built something like 200 rupees per ton improvement in EBITDA in 26 over 25. And given the track record of, consensus estimates and on the cement sector, where practically every year we see large downgrades compared to the beginning of the year estimates, I really doubt even the assumptions are going to come through. And what sense does it make giving 35, 50, 70p for a cement company? I have no idea, but market seems to be quite okay with it. Same way you look at consumer staple names, most of them are trading north of 45p, 45 to 60p. And the kind of earning numbers you're delivering, you can't even justify 20p for this company now. Most of them are delivering low single-digit top line, hardly any volume growth, etc. So how do you justify 50p? I think people have forgotten the basics of valuation these days, looks like to me. People are just going by the historical valuation, multiples. But at that time, these companies were growing much faster. Most of the consumer staple companies, if you look at the 2010 decade, and written a note also on this, most cases they were delivering, low double-digit, mid-teens kind of, bottom line growth. Compared to that, the numbers are, very, very low for now. So that is all struggle here. How do you justify this? The multiple, the context of the growth of the earning numbers the company is delivering.
Yeah, that's a very fair point that you're making, Sanjeev, and we would like to drill deeper into some of those aspects that you've spoken about. We have to slip into a very quick break, but on the other side, we'll be back to talk to you about some of the aspects that you just spoke about. Do stay tuned, viewers.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock.
Back with India Market Open and in conversation with Sanjeev Prasad, MD and co-head of Kotak Institutional Equities. Sanjeev, Neeraj here, good morning. It's been a while that we're talking. Just trying to understand, can I ask you to kind of think of what is it that could make you constructive at the valuations? Because clearly valuations cannot prove to be the trigger point for turning constructive. Maybe it's flows, but that's probably one or two of the reasons. So what is it that would make Sanjeev Prasad constructive on Indian markets from where we are right now?
You have to have value in the market.
But that would mean a correction or a time correction.
I don't know. We have seen 1 year of time correction or whatever it is. Maybe we need more time correction or a price correction, whichever way it is. Or you need earning growth to surprise significantly on the upside, which clearly doesn't seem to be on the cards. Sorry, just going back to the point on earning growth in the fourth quarter, I just opened my file. Nifty 50 EBITDA numbers to look at, yeah? That's a 9.4% growth, which is okay, but that's actually about 0.7% lower than our estimates. And this one does not obviously include the bank, so all the beat has come at the net income level has come from SBI. If I look at the broader set of companies, at the EBITDA level, 11% growth. If I exclude the OMCs, which is what I was talking about, it's absolutely flat in line with expectations. So clearly numbers have not beaten our expectations. And our expectation, I would assume, are on the lower side compared to the street, which seems to be supremely bullish most of the time.
Okay. So effectively, since earnings growth may not necessarily be the driver, you would bat for correction, time or price correction for you to turn constructive. The follow-up that I have to that, Sanjeev, is that, and tell us what you think about it, that in Q1 and Q2 of the last financial year, there was a slowdown, notable slowdown, both in earnings and economic growth. Does the base effect aid the optical earnings growth for the first half of FY26?
I don't know. The fact of the matter still remains that we are not seeing a big recovery in the underlying parameters. Like you look at any of the volume numbers for the major sectors, like you look at the volume numbers of two-wheelers, four-wheelers in the month of April, not very good. You look at any of the high frequency indicators, it's not as if we are seeing any big rebound in the underlying parameters, and that is much more relevant. You see, this market is already at FY 2027, to be honest with you. The first half, whether you see a rebound in earnings or not, just 1 second, let me just check. The base was low in the first half, so that should support, at least on optical basis, show some growth in the first half of FY 2026, but that's about it. It's not as if, we are not building an earnings growth, right? As I was saying earlier, we're building 10-11% growth in the Nifty 50 index for FY 2026. And despite that, the valuations are supremely expensive. So at the end of the day, ultimately, we are here to buy stocks. And if you don't like the price of the stock you're buying, why buy it? You're not compelled to buy something at some stupid valuations or stupid price, right? Ultimately, if you go to a shop and want to buy something, if you don't like the price, you don't buy it. Price is what you pay, value is what you get. Very simple thing in life.
Yeah, you said it. Buffett said it actually as well. So therefore, from that perspective, are you keeping powder dry? Would you say that that's the best approach at this juncture? Keep cash?
I can't give very generic
I'm not
advice.
asking you to, I'm saying, is
people to figure out what they want to do. See, all I can say is the risk-reward balance in the market's point of time is not very favorable. Valuations are expensive. And I don't think at least people should be fooling around with the basic fact that valuations are cheap. At least we shouldn't be making such atrocious statements, which is what a section of the street seems to be doing. Valuations are high in the context of the kind of earnings growth Indian companies are delivering. In the context of historical valuation, I don't think there is any dispute about that. And if anybody is trying to make some story around that, be very, very careful. That's a limited point I would make.
Okay, Sanjeev. So the final question, therefore, would be that in this period, which might, in an ideal scenario, as per your thesis, need to see a price or a time correction, where is it that people can hide? Let's put it that way. In your ideal portfolio, where is it that you are constructive?
To be honest with you, very little here. So last 1.5 years, we have been, more constructive on the financial space, where at least the valuations were a lot more reasonable. But they've also gone up in the last, 3-4 months, as you would have noticed, the banks and BFCs have performed rather well. Telecom was another hiding area, but that has also gone up a lot in the last 6-7 months. And it's honestly a struggle to find value even in Bharti, which we have, lying for a long time. The stock is now at 35-37 times 1 year forward P, which is certainly not cheap. And this is already factoring, by the way, a big tariff increase. And other area which we have been positive on the last, I would say, 1 year, 18 months is the healthcare pharmaceutical space. Again, they have done reasonably well. They've actually held up quite well in the market. So that's the challenge over here. We had a few hiding places. Even they have gone up sharply in the last 3-6 months, which leads to very little value in most parts of the market, I would say. Other parts of the market like autos, consumption, cement, investment, I'm not even going anywhere near them because I just struggle to understand the valuation of these companies.
I find that very interesting, Sanjeev, that you're describing these spots as hiding places in this market. It's a different take. Thank you so much for speaking with us. We want to give our viewers all kinds of opinions and views there so you can make the right decision for yourself. That's the view coming in from Sanjeev Prasad of Kotak Institutional. We'll take a very short break. On the other side, listen in to our conversation with Tarun Garg, COO at Hyundai Motor India, on their numbers.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
All right, a number of factors have stood out for Hyundai Motor India in its Q4, and several factors have aided that bottom line outperformance. Among them, the mix as well as the average selling price and the lower discounting in a pretty tough operating environment. I'm joined by Tarun Garg, who's the COO of Hyundai Motor India, to talk about the quarter gone by and to talk about the outlook going forward. Mr. Garg, thanks so much for taking the time. Let me start by asking about that volume picture. Understandably, for yourself as well as the industry, it's been a little bit of a sluggish period. Do you see that changing in FY26? What is the anticipation for volume growth for you?
Thank you. Actually, if you see, India is one market where the car industry has been steadily growing, over the past, of course, 30 years. I have been in the market now for 31 years. After every 5 years, there is always 1 year where the growth is muted, sometimes negative. I don't think it should really disturb us, because post-COVID, we also all saw that market had grown by more than 20%, and again, almost 10%. So obviously some kind of a demand moderation had to happen. On top of it, a car customer does not like uncertainty with the tariff scenario and the geopolitical situation. Obviously that crept in. So I think this is very normal. Also, in any case, this period of April to August is a period where there is generally heat wave in the country. There are no festivals. So I think it's very normal. What we have to do is how to navigate this situation. You saw in our last quarter results how, despite sluggish market, we were able to keep our discounts low by introducing some new value trims for the customers, by making sure that the SUVization continues. Our SUV penetration, in fact, in the last fiscal touched now 68.5%. The rural penetration continues to go up. The first-time buyers continue to go up. Overall, we could get a EBITDA margin of 12.9% for the year, and in fact 14.1% for the last quarter. So I think a good balance between volume and profit is what has helped Hyundai Motor India. Now we have a very aggressive product pipeline in place, and the Pune plant kicks in the third quarter of this fiscal.
Yeah.
So I think things are looking up.
So things are looking up, but then am I right in assuming that you will grow along with the industry, and what is that level of growth that you're anticipating in volume terms?
Look, if you talk about the next 5 years, obviously with the kind of model mix and the kind of new model launches, and of course the Pune plant capacity being added, because we are currently at 824, we will add 170,000 in phase 1, which is in October to December quarter, and then 80,000 in 28. So which will help us reach 1.1 million. So we are definitely looking at beating whatever the industry growth happens in the next 5 years. As far as this year is concerned, we have given a guidance of an export growth of 7 to 9%, and domestic, of course, like I said, probably in line with the industry. Siam is saying around 1%, so we should be broadly in line with that.
Okay. So thanks so much for giving me clarity on that. Would you say that with the addition of the new plant in the third quarter, overall, therefore, capacity utilization might be a little bit on the lower side overall in FY26, and that will of course pick up, Mr. Garg, over the course of the next 5 years, as you point out?
Look, Hyundai has always prided itself on having a very good capacity utilization. Over the past so many years, we have managed a capacity utilization of between 90 to 95%. One big reason for that has been, in addition to our very strong domestic presence, we have a very strong export portfolio. Currently, export constitutes about 20 to 21% of our sales. Going forward, we plan to take it up to 30% by fiscal 30. So I think while the new plant comes in, yes, initial period, obviously, it cannot reach 100% immediately. I mean, that is for everybody to know. But I think the kind of track record we have, we believe that, and the new model launches, we should be able to really reach a good number in a very short time. Exact month and exact numbers would be very difficult for me to give. But I don't think there is anything of very undue concern which is coming because of the Pune plant. On the contrary, I think it will be a turning point for Hyundai, like I said, because we have managed to marry our new model introduction with the capacity addition of the Pune plant.
Okay, talking about the market X, the ICE, so I'm talking about EV and I'm talking about CNG. In both of those, what is your opinion of the current playbook for your company? For example, can you give me a sense of what the current booking numbers are for the Creta EV, and what is your playbook in terms of CNG?
So look, as you know, Hyundai Motor India is a part of the Hyundai Motor Group, and the advantage we have is that we have all kinds of technologies. At the entry level, we are offering the customer petrol and CNG. At the SUV level, we are offering petrol, diesel, and now with the Creta electric as well. Of course, in the Varna segment, petrol and turbo. So we are very confident that this kind of technology agnostic approach will really help us to navigate the future challenges. On the EV space, Creta EV has had a very good response. We are selling more than 1,000 a month already, and I think going forward, the kind of model plan we have, like we said, 6 EV models by 2030 we are going to launch. Also, it is coupled with a very strong localization drive. So currently we have battery packs which have been localized. Now with the Indian partner, we are going to localize the cells as well. Also, we are doing a big thing on the DC fast charging infrastructure, because so far we are focusing on the AC fast charging AC charging infrastructure. But now we believe, based on the customer research, we have seen that customers are hesitant to take their cars on the highways. So we have taken it upon ourselves to a big time focus on that activity. Currently, the number of DC chargers, including the DC chargers on the dealerships, is already about 88, 89. We plan to take it up to 600 by 2032. Okay. So I think CNG is about 13 to 15% currently, going up consistently. EVs, we believe by 2030 we should be in the range of 15%. And of course, we have also announced the launch of hybrids in the future as well.
Understood. Okay, understood. Now, I want to specifically talk about what you mentioned in terms of the SUV increase, right? Of course, as a country, there has been this move towards the SUV category, and as a result, the small car category has shrunk, Mr. Garg, and you've been witnessing this for 30 years, so you know exactly what I'm talking about. So would you say that, considering that the pricing of the small car is now coming very close to that small SUV category, that this small car category will continue to shrink? And what is the implication for you and your portfolio?
Look, I would say that the customer's choices have changed because his key buying factors have changed. So it's not as if the price range like for example, in the price range of 6 lakhs to 10 lakh rupees, earlier there was nothing called an SUV so much. Then of course the venue segment opened up, and now the extra segment has really opened up. So it's not as if the customers are not buying the cars, say in the 6 to 7 lakh rupees range. Only they are shifting from hatches to SUVs. Why? Because they are getting a good body type, they're getting more space, they're getting 6 airbags as standard, they're getting more features. So I think as an Indian, I'm very happy because this shows that people are progressing. That said, hatches are still about 23% of the overall market. Indian market is 4.3 million. That means hatches are still constituting about 1 million. We are very much there with i10 Neos as well as with i20. So I think we are a full range manufacturer. We need to give new solutions to the customer. For example, the dual cylinder CNG in Neos and Exter has really taken the CNG penetration up. And like I said, Exter has been launched. Going forward, maybe some new segments will open up. What is the most important thing is whether the first-time buyer is coming to you or not. I think that is where Hyundai has been able to shift the first-time buyer from hatches to SUVs, and my overall portfolio first-time buyer has gone up from about 34-35% 5 years back to about 40% now. So I think there's no need to worry, and I'm very happy that we are progressing as a country.
Yeah, interesting. And I think that is what has had a bearing on your operating performance as well, that mix, what you're talking about, right? But speaking about segments, and you're saying that a few segments might open up, Mr. Garg, but can you give me a sense? You have a pretty wide bouquet of products, but do you see any gaps that you need to fill? You said that you have a very extensive pipeline. Can you give me a sense of what gaps you're intending to fill?
Look, obviously new segments are always emerging. I already mentioned about Exter. A few years back, even Creta was a new segment. In 2015, when we launched the Creta, SUV penetration was 13% of the overall market. Who would have thought that Creta will end up being the number one brand across all models? Last 2 months that has happened. So I will not be very specific here, but I would say that with full model change of the existing models, what happens is they become more bigger, and that is where the new opportunities come. So we have very clearly identified some of those opportunities. More details, please wait for the Investor Day, which we have already announced in September, where we will be giving a detailed deep dive into our future models and the new segments that we are going to enter.
I look forward to that. Mr. Garg, my last question to you has to do with the margin profile. And you mentioned the various reasons why it has come in at what it did in the fourth quarter. You've given us the expectation for both exports as well as domestic. But there are a few factors that played out in your export mix as well, with Africa having a larger share. That had a bearing on the margins. So would you say that you would either maintain or better your margins in FY26?
Look, it is very difficult to give exact future guidance, on the margins. But what is more important is your volumes increasing? Are your, especially in the export area, we are really looking at new markets as well. Like, for example, Venue in Indonesia, Venue in Yemen. Going forward, we are going to have extra left-hand drive, which will open up some markets in the Latin American space. Already we launched the extra right-hand drive in South Africa. So EVs, we started with, Nepal, even Bhutan, where exports had been muted or banned, have opened up. So we are really looking at all kinds of markets, not only the neighboring markets, not only the Middle East and Africa, which have been very, very strongholds, Latin America. I think there are many opportunities to open up. A big factor here is, like I said, the capacity, because last few years probably capacity constraint, was making our export efforts a little bit muted. But now we are going full hog on exports, and we believe that going forward exports can contribute 30% to our overall volumes.
That's huge. That is a biggie. It's out of there.
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest
back. You're watching India Market Open. Markets giving up some of its gains in the first half of the session. The Nifty dipping down now into the red, about 70 points down, not massively, but yes, down in the red. I want to see if the IT index is still holding up, because the Bank Nifty is definitely giving up any kind of stability it had. Yeah, IT is going to be the outlier of the day, if at all. But it's stock specific. That's the name of the game right now, depending on how the results have come in. That's the big focus that the market is looking at. And our next company that we're focusing on is Hitachi Energy. The stock has made some recovery from its opening lows, about 0.5% up. But if you look at the numbers in isolation, it's a good set. In Q4, yes, which came in yesterday post-market close. EBITDA has risen about 30%. Profit has jumped over 60% on a yearly basis. We'll be speaking with N. Venu, the MD and CEO, India and South Asia of Hitachi Energy in a bit. But first, let's get in my colleague Anushi to break it down for us.
Right, thanks for that, Tamanna. As you've said, it's a good set of numbers that we are looking at, especially on the margin front, wherein we've seen about a 190 basis points of an expansion to 12.6% as compared to 10.7% last year. Revenue up over 11%, and net profit seeing about a 62% of an improvement. Now, more than this, what is in focus is the order book position of the company. Now, Q4 orders, if we see, they had reported about a 56% of a growth here at 2,191 crore. It's the FY25 orders in particular interesting one, 228% of a jump, and this was aided by the Q3 order win that we saw for its HVDC order. Again, this took the backlog to 19,246 crore, providing revenue visibility for the company forward for the next few quarters as well. Now, in terms of if we exclude the large ticket HVDC orders also, exports contributed to about 37% of the inflows for the year, so around a 77% of a jump that we've seen in inflows as well. In key segments, transmission was the particular one which was in focus, along with renewables, but it's data center, railways, data centers and industry, wherein we've seen about a decline over here. Other than that, in QIP proceeds also, the company raised about 2,480 crore via the QIP route, which it aims to utilized towards expanding its capacity, along with improving the working capitals and rest to be used for corporate usage as well. On to the outlook forward, the expectation is for the share of services and exports to increase to 15%, 25% of the total revenues going forward, and to sustain and improve margins in the double-digit range that we've seen as well. So this is the overall outlook for Hitachi Energy. So it's a strong set of numbers that we've seen for both the fourth quarter and the FY25, and a commentary on the upbeat side for FY26 as well.
Is looking good as well. Stock reflecting actually the overall market mood, but N. Venu joining in. He's MD and CEO, India and South Asia, Hitachi Energy. Mr. Venu, thank you so much for your time with us this morning. Just take us through what Q4 has looked like, because operating margins have also bumped up quite solidly. What has contributed to this?
Yeah. First of all, thank you for having me in your show, and also very good morning to all of you. And as you know that we have been consistently saying that we have been building in a very strategic, focused manner in this last 3 to 4 years, and we are continuously saying this. And we see the tailwinds of energy transition is so huge in India. One is the transmission, renewable, and also in the data centers market and the transport and industries. And we have also our go-to-market strategy, especially on targeting the high growth segments. All those things have given consistent results over a period of time in that. If I come back to the specific Q4 and the FI last year, in that as you know that our revenues have gone double digits in the quarter as well as in the whole year, and also our order inflows has been a very robust with HVDC or without HVDC as well. And all this thing is since we have a huge order backlog, and then we are converting that order backlog in a very sustainable manner, in a strategic focused manner, and also both domestic as well as exports and the service has contributing to the revenues growth, and which has resulted into margin accretion in that. So on a yearly basis, on an operational EBITDA level, we have improved almost 250 basis points. And our guidance, if you recall in your own channel, I've been talking about last year that we enter into double-digit EBITDA margin. We not only entered in the third quarter, but we are sustaining that. So going forward, our guidance as well that we will quarter on quarter might change depending upon the order mix, depending on the revenue mix, etc. But on an overall year basis, so we will be in the range of double-digit EBITDA margin.
Double digit, definitely in this 12.5% range. Mr. Venu, and just on the point of your high voltage direct current, your HVDC order book, which has also bumped up the balance sheet, looking good this time around. You're seeing a second big order coming in this category?
Yeah. We have actually we have an order backlog. End of 31st of March is 19,000 crores. And there's one more HVDC order which we have already announced, and that will come in the Q1 of this new fiscal year in that. So that is a HVDC new order in that. So that's also quite a sizable and substantial. That will come in the new financial year.
Got it. Mr. Venu, good morning, Neeraj here. And
Good morning, Neeraj.
it's a treat to see an investor presentation of a company which at the start talks about safety, integrity, quality, and environmental performance for FY25 before the financial performance, which is very healthy. So kudos on that. Now,
Thank you.
Now the question is, when you've spoken about the last deal that you did about a month ago when you spoke to us and the focus areas of FY26, one can see the transmission, big growth, renewables, very good growth, over 100%. I mean, I'm saying it very good because transmission was 700% odd, right? And railways didn't. So when you talk about harnessing new segments, which is data centers or battery energy storage systems, etc., for FY26, do they eclipse the growth rates that transmission and renewables have shown on FY25, or do all of these move in tandem?
Yeah. So in our view, as I said, the market is growing at a certain growth rate.
Right.
And there are certain segments we have been consistently saying there are high growth segments. So those are the segments that are growing much higher than the market average, such as transmission, such as renewables, such as the data center, and also some of the new emerging sectors in our view going forward, like energy storage, will grow much higher than the market average in that. So we are again concentrating on those segments and looking at our portfolio will go into all of those segments. Our portfolio, be it products, systems, services, and software, will get into all of those segments which are required for the energy transition, and we are also working on those segments as well.
So, the reason why I push this, because when we speak to, for example, we were talking to one of the solar players, a leading solar module manufacturer, and they said that they believe that battery energy storage systems could actually become as large as maybe modules for them, and maybe for the other players as well. So do you reckon that some of these newer segments that you're looking to harness could actually have strong growth in the next 2-3 years and could become very large relative to your current segments?
I would say I would not call it a battery energy storage, but I call it energy storage. Okay. Energy storage could be battery, could be pumped hydro, or any of those things. Would be definitely a significant segment, and this is required for the energy transition. That because so much of solar and wind is coming, and all these things, intermittent nature, you need to also balance the grid. To balance the grid, two things you need. One is that grid expansions, and other one is that also you need sufficient storage is required. Storage could be in the form of battery energy storage, or it could be pumped energy storage, or it could be mixed of those things in that. And I would say that in all those areas, whether it's a battery energy storage, is a pumped energy storage, our portfolio will go into it in that.
Mr. Venu, what is the export outlook looking like? Can you give us a sense of what has been the export vertical performance for this last quarter, and what do you look at it like for the current financial year?
As I said, last year, if you remove the HVDC, our whole exports were in the range of 37%. And we have been consistently saying that our main focus is going to be in the domestic market. And that's how we have been expanding our factories. We are expanding our product lines. But having said that, we also ensure that a sustainable export strategy. Our export strategy is a sustainable, growing on a year in that. We set ourselves that in the last 3 years that to bring the exports as a percentage of our total orders to 25%. We already reached 2 years back, they would like to sustain there and maybe go a little bit up that, but exports is not at the cost of a domestic market. As I said, our key focus has been domestic, and we see a lot of tailwinds of our pipeline, whether it is a transmission, renewable, and data center. We see a huge amount of tailwinds, and our focus is that. And exports is a complementary, and we have been working on the export strategy as a very consistent from 25%. We brought to 25%. We have stabilized 25%. Maybe we take one more step to go up there.
No, so one more step to go up in the sense in terms of your revenue split, you hope to keep exports at 25% or now move upwards? And what is the sort of margin differential you're seeing between the two?
No, right now we would like to keep it at 25%. That's our strategy. But once we stabilize, maybe we'll look at it, depending upon how our expansion of the factories come in, how our domestic market, all those things will be looked into it before we look at it, where else, we can send our supplies or our products in that. And you know very well that, exports margin profile is definitely better than the domestic margin.
What is the difference? What is sort of, can you give us an apple-to-apple comparison and give us some sense of substantially higher to what extent?
Yeah, I wish I could, but we don't want it. It is definitely substantially better.
What are the capex plans for this year, Mr. Venu? You've raised funds. What do you plan to do with it? And what is the strategic outlook for the financial year?
So we said we have raised 2,500 crores, and out of that, 2/3 of that will go into pure play capex expansion of our factories, and expansion and bringing a localizing of our new product portfolio, etc. in that. And if you see in the last 4 years, we have been spending almost at an annual run rate of 100 crores per year. And this year we would like to jumpstart, and we will be spending close to 500 crores. Close to 400 to 500 crores in this year. And then the whole of this 2,500 crores will be spent in the next 4 or 5 years in that.
Mr. Venu, one question on Hitachi India doing work for the global markets as well, because you said in your presentation that you continue to focus on export and shift the center of gravity to digital. But I also see a clutch of orders being executed for Thailand, Philippines, etc., essentially South Asia. Do you expect the share of this pie, which is work in India, but for the South Asian market, to pick up from where it is right now as a percentage over the next 3 to 5 years?
It has. If you see our history, so when we started our journey in 2020, it was our exports were in the range of 15% of our total orders and total revenue. Okay, and we set ourselves from 15% to be moved to 25%, and we are now, as I said, we are stabilizing the 25%. But our main focus is the domestic market. We see a huge tailwinds in that. So we have right now, we have to manage our factory capacities to ensure that we fulfill our commitments for the domestic markets, and then we go to the export markets. But having said that, our export strategy, again, I'm repeating that it's a very sustainable. We want to grow in a year on year, and also go to different geographies, and also take our new portfolio into the different geographies. And that has really playing well so far. And in our view, it will also, going forward, will play very well as well.
Okay. I'm presuming you are constructive on growth ahead. Just one quick question on any risks to the growth tailwinds as you see them right now.
No, of course, with so much of going on the geopolitical tariffs and all those things, definitely we need to watch out how it will play out in terms of our supply chains, etc. in that. So that's the reason we are very agile, and we are able to look at it, how those things are panning out, so that we are able to take quick decisions in terms of our capacity expansion, in terms of our geographical penetration. All those things are definitely need to be looked into it.
Okay, Mr. Venu, wishing you all the best for this and more. Thanks so much for taking the time out and speaking to us. All the best for FY26 and beyond.
Thank you. Pleasure talking to you, Neeraj. Thank you.
As always. Well, that's Hitachi Energy. Splendid numbers, strong guidance, confident management. No wonder the stock is reacting even today while the management was speaking to us. after already showing a strong reaction to the numbers.
I mean, not to draw any conclusion, but the stock started
the
off
commentary is
negative.
Constructive.
Stock started off negative before we started that conversation, and very, very constructive commentary, up about 1.5% right now on it. All right, more focus on earnings, and we must talk about Pfizer. Pfizer has been a firecracker, actually, for Q4. Stock about 10.5% up. Rarely you see that kind of a move on a Pfizer. So Q4, what worked for them? Varsha joining in to tell us more.
Yeah, thank you so much for that. So, the revenue growth for Pfizer, if you see that this only 8.5% of revenue growth that you're seeing at 592 crore versus 547 last year. But what the highlighting factor over here are two things. One is EBITDA. If you see, EBITDA is up 20%, margin at 38% versus 35% last year. Now this was because of lower other expenses that the company has seen, lower power and fuel cost the company has seen, which has led to EBITDA margin increase. Net profit up 85%. Now this is due to impact. The net profit impact that you're seeing is led by higher other income and of course lower tax. So company had an exceptional item which has led to the higher other income, which has led to uptick in the net profit, and of course lower tax has also aided net profit. And company has seen lower interest cost, which has also helped net profit grow. Now there is a recent just a few hours back there was a recent announcement by Pfizer US, which has made a deal with the Chinese biopharmaceutical company. Will that have an impact on Indian Pfizer company? No. Why? Because if you see the export for FY24 stands at around 4% for the company, because Pfizer sell its products through independent distributors primarily in India, and there has been no related party transaction with the US Pfizer company. And since this is a licensing agreement, Pfizer, the US company will have to sell these products in China only. So maybe because the name Pfizer has been attached, this is a reason. Because of the sentiment, the stock is up 10%. But yes, one of the reasons why Pfizer is buzzing in trade today is because of the good numbers. Operationally, if you see, margin have increased and net profit increases due to the higher other income that the company has seen.
Varsha, thanks for that. Now go on to Puneet, because while Pfizer is showing strong gains, Quest Corp is showing deep cuts after the numbers. Puneet Johnson to tell us what has disappointed the street so much. Puneet.
Well, thank you for that. So definitely one of the biggest impact was the exceptional loss in this particular quarter. They had an impact of about 150 crores. And out of that, 120 crores was because they've not received, it's basically a trade receivable. They've given the service to the client hasn't paid back. And for a company like Quest Corp, with just roughly between 1.8% to 2% EBITDA margins, that has just dragged it, the profitability to a loss in this particular quarter. The other key factor that's been, hurting the company in terms of financials has been that the three-way demerger of the company that's been talked about a lot has been facing execution risks. Now we've seen that the company has been unable to maintain top-line growth. It reported a 9% decline on a quarter-on-quarter basis in terms of revenue. The main two sectors, which is IT as well as BFSI, that has also not been contributing. So there's been a headcount reduction in this particular quarter, and while that was expected to have some impact, it's happened has happened a material impact as well. So IT sector, which is 65% of revenue, and we've spoken to a whole host of IT companies this quarter, headcounts hasn't risen that much over the last 4 quarters, and that's visible as well. And finally, in terms of guidance, they were expecting a 5% guidance in terms of margins in this particular quarter. That's also not been met. Overall, multitude of negatives, but largely the 120 crore negative impact because of trade receivables has just dragged the profitability into a loss-making company in this particular quarter.
Okay. Thanks, Puneet. 10% lower for this one. Now, the stock or the conversation in focus next is Sai Life Sciences. The stock is maybe a bit lower today, but has had a decent quarter despite the fact that margins contracted. I think a couple of brokerages have turned constructive on this one too. We will be speaking to Mr. Krishna Kanumari, MD and CEO of Sai Life Sciences in a minute. But first, let's get in Varsha to give us more highlights about the quarter. Varsha.
Yeah, thank you for that. So overall, as you rightly said, it was a decent quarter for the company. Now the revenue growth that you're seeing was led by higher execution when it comes to CDMO and CRMO, that is research services, and followed by developing and manufacturing services that the company provides. Now the EBITDA margin impact that you're seeing is because company had some kind of provisions which has led to decrease in the margin year on year. They've launched dedicated pipeline research center in Hyderabad, which is a highlighting factor when it comes to company. Lower interest cost have actually aided profits. Now CDMO, if you see, contributes almost 63% to the overall revenue, while CRO, that is contract research services, contributes almost 37% of the overall revenue. Now if I were to talk about the client concentration rate, so overall there's been steady client concentration when it comes to company. In FY23, 11% came from top 10 clients. In FY25, that the number is at around 10%. Now overall, if you see on the financial highlights, in the last 3 years, company has seen 25% CAGR growth when it comes to revenue. EBITDA has the company has seen 48% CAGR growth when it comes to EBITDA, and overall company is expecting 15 to 20% revenue growth in the next 3 years. Now the highlighting factor here is EBITDA margin expected at around 26 to 28%. If you see, the current EBITDA margin stands at around 24%. Now the key factors would be here: what is the order pipeline when it comes to CDMO and CRO, and what will be the levers when it comes to EBITDA margin, and how tariff concerns will actually impact the company. These are the key highlighting points that should be asked by the management.
Well, we'll try and get those questions answered. Varsha, thanks for that. As we said, Krishna Kanumuri, MD and CEO of Sai Life Sciences, with us on the conversation. Krishna, good having you. Thank you so much for taking the time out. Appreciate your time.
Thanks, very glad to be here.
Okay, so one of the things that we were trying to understand when we looked at the numbers and some of the brokerage notes that came out is that the US biotech funding has been soft. How is it that your CRO division clocked in this 26% growth that it did in FY25? And if the biotech funding is since still slow, right, what gives you the confidence of doing the capex that you are doing?
See, look, I think if you look at generally, if you look at our CRO business, it's only 35% of our business. And basically, our pharma contribution to our CRO business has gone up significantly over the last year. We believe that in the short run, most of the outsourcing to India is going to be driven by large pharma, as they're taking long-term views in terms of building alternate supply chains, both on the discovery, development, and commercial side. So I think, yes, it's really good to have the biotechs and CRO fund and biotech funding as well. But I think the short term, I think the pharma diversification should give you enough headroom to continue to grow at a reasonable level for the next few years.
Could you, for the benefit of our viewers as well, just briefly tell us what are the segments percentage-wise that exist for you right now in terms of CRO, CDMO, pharma, what have you, and how do you see the company, let's say 3 years out or 5 years out, in terms of the contribution that each of these segments will have to your overall revenue, just to get a sense of where you are and where you will be?
So I think we are 35% CRO and 65% CDMO, which includes both development and manufacturing. We expect the ratio of CRO, CDMO is going to be more or less the same. They'll be going back and forth depending on which year we have. On the CDMO side, about 70% of the revenue comes from large pharma. And from the CRO side, about 39-40% comes from large pharma. So we long-term will think maybe large pharma will go a little bit more on the CDMO side, and maybe biotech funding will be 50-50 large pharma and biotech. But we don't see meaningful changes more than a few percentage points, maybe 10-15% here or there, depending on how things will move. Things will be fairly consistent going forward.
Good morning, Mr. Krishna Kanumuri. This is Tamanna here, and great to speak with you. Let's just come to your numbers for a second for this quarter. And numbers look robust apart from the slight margin contraction. How are you looking at it, and what do you put this down to?
Look, I think margin quarter we clearly indicated we took some provisions for some products which are in destocking mode. That was a cautious move. Other than that, if you look at it, the number growth has been very good for the year. It's been really good performance in terms of both the execution, new capital investment, and in terms of more engagement with clients. And we've always guided to that the steady state margin will be 28-30%. It'll take us about 2 to 3 years to get there because we had upfront a lot of capex and opex to kind of position ourselves for the strong growth momentum in the market going forward. And I think that's going to kind of deleverage itself over the next couple of years. And that's where we see clear traction in terms of improvement of margins.
And what is the pathway to this improvement in margins looking like? What are the key headwinds that you have to navigate? And I'm asking that from the context of what is happening in your space right now. Tariffs on one day, possibly off the next day, from a US perspective. So I'm just wondering how you are navigating all of this.
Right now, look, there's nothing really you can do at this point, right? Because amount of changes, I don't think anybody is making long-term decisions based on data points at this point. I think the long-term trends continue to stay. The three main trends are global diversification, where India is going to play a role no matter what. Lower cost, end of the day, cost pressures are still there in the market if you look at it. So I think net, the fact of the matter is we are primarily focused on NCE market only. We don't do any generics. So I think as a percentage contribution, the NCE piece about 2 to 3%, the entire API cost and even tablet formulation costs are 2 to 3% of the product. So I don't think tariffs will have a meaningful impact for pharma companies in terms of cost pressures.
You don't expect price erosion to come in even when you're seeing the other aspect of it. One is tariffs, one is the most favored nation perspective that the US now has, where they want drugs available to citizens there at the lowest possible price. How does that impact you, if at all?
Right now, to be honest, we don't know what the impact is. I'd love to come and say we have a crystal ball to say what the impact is. But as of now, we had no conversations. It's very hard to predict. And it's also, we don't even know what's going to happen with the most favored nation clauses, right? There's so much which is going to happen. All I can say, as of now, we have not seen any pressures, had any conversations on that count with any customer so far, at least. But what it is, we don't know at this point.
Krishna, the other question is the growth rate forecast that you've done now. If various companies in the CDMO CRO space are being a bit cautious because there has been a bit of a choppy, let's say, outsourcing, if you will, or customer inquiries for a clutch of players. I would love to know, are you in the camp which believes in under-promising and over-delivering, and therefore is the 15 to 20% a conservative number which you will definitely meet, and maybe you could exceed it over a period of time in a CAGR manner for a 3 to 5 year period?
Look, I think the problem with this market generally is that it's very cyclical, and it's more than cyclical. It depends a lot, very lumpy, I would say, because generally when you're dealing with new molecules, you have three main criteria, right? The success of the molecule in the clinic, success on launch, stocking, destocking, R&D cycles. So if we look at the trajectory overall, we expect reasonable growth. At this point, it's hard for us to guide. We're going to beat or not beat it year by year, quarter by quarter. But we have a reasonably good pipeline at this point, and we continue to invest aggressively. We feel bullish on the business, but I think 15-20% is a reasonable guidance. Where we see we'll hit over 3 to 5 years. Also might not be, we might have a bad year, bad quarter, but we're really guiding this over 3 to 5 year period in how we're looking at it.
Hence,
so I don't have much more context.
Yeah, no, it does. But hence, I was saying that I was not asking whether do it as a constant quarterly growth rate, but more like a performance at the end of 5 years. Does it kind of match up to it? Okay, fair call. Just some color on the CDMO pipeline as it is shaping up. Again, different players, depending on where their capacities are, where client conversations are giving fairly disparate colors. How are you seeing your own CDMO pipeline, conversions, et cetera, et cetera?
As of now, I think our CDMO pipeline is fairly strong. And I think it's in a good position at this point. We feel confident about our growth in the CDMO sector.
What are the capex plans, sir? You've obviously opened a huge facility in Hyderabad in April. What are you looking at going forward? And can you give us a bit of your strategic vision really on drilling down on what your core strength is or follow the molecule?
Look, I think our core strength is really able to handle complex chemistry, complex projects, and being fully integrated end to end, right? We're the only company which does things from discovery to commercial. And also, we're also getting in a lot of new modalities. So I think we provide probably the most balanced opportunity for customers to do multiple services with one company, and that's a key strength we have. Another key strength is the team. We have one of the best management teams in this business, which has been there doing this for a long period of time. And also we have meaningful relation with a lot of the global players, which we've cultivated the last 20 years. And I think these are going to continue to drive the strength of the business as we move forward, essentially. And CapEx plans, we are guiding to about 700 crores of CapEx this year. About 550 crores of that is going to be needed to deliver a pipeline for 27 financial year. We're putting about 60 to 70 crores in new modalities. And we've also put some money aside because if there's an upside in pipeline, we want to be able to invest in that as well to cater to those needs as well.
I saw a figure of 900 crores for CapEx. Is there a change there or is that an earlier guidance?
900 crores was probably guided over the 2-year period in the past. But I think this year we're guiding to 700 crores. That could have been guidance over a couple of years period. But the number is nothing we put out there.
Okay. All right. Thank you so much, Mr. Krishna Kanumuri, for speaking with us. That's the MD and CEO of Sai Life Sciences. I think pharma, quite the flavor of the season. Not much happening with the stock right now with Sai Life Sciences. At the end of the day, they have seen a contraction in margin, but that is, as they explained, because of destocking. Overall, the numbers didn't look half bad. I think the uncertainties is the big question mark over here. And as the management told us, if this comes into play, I mean, what's going to happen with tariffs? I don't really know. Not his fault. No one really knows.
Yep.
What's going to happen with most favored nation? I don't really know. And to assume that none of this is actually going to happen would be a little foolhardy, like Jamie Dimon said. To underestimate that any of this is going to pan through would be a bit foolhardy right now.
Yeah, well summed up, Tamanna. I mean, nothing more to add, but for the fact that it's also a business which lends itself to lumpiness and uncertainty. But just as we wrap up India Market Open, just want to mark the markets a little bit. Not that volatility is perked up, by the way. Remember, India VIX is still down about 1%, but there are some movers. So notable moves that come in today. One is DLF, 5.5% post the numbers. So it's a very strong, solid move. You don't normally see real estate stocks being very active on a day when the market is dull, but DLF is quite up there. Amber Enterprises is the other one, which after that CLSA upgrade, I presume, is up about 4%. So that's one large mover. We've already spoken about Pfizer. And then the couple of smaller ones on the gaining side, HID Glasscoat, which had a phenomenal quarter on the margins front, doing really well for itself, up about 20% as we speak. HLE Glasscoat should come up on your screen. No, not HEG. HEG is down 5.5%, but HLE Glasscoat, that one is up about 20%. Last but not the least, before we start wrapping up, is a stock from yesterday, Banco Products. Just want to mark what it is doing because had a big 20% up on strong numbers yesterday, Banco. Let's see if it is showing any kind of green in the session today. Actually completely flat. No, this is Bank of Baroda, sorry. Can we get Banco Products?
Banco.
Yeah, let's get Banco Products because that one could be interesting.
Yeah. Just want to mark out Amber as well because Amber had a bit of a slow start, but remember it was our big brokerage call of the morning. And CLSA quite excited about Amber Ent at the end of the day. And you're seeing that firing up as well. What we're doing here is we're trying to find you some winners. Zensar Tech spiking, interestingly. I'm not very sure why that kind of a spike. But NLC also doing very well this morning on the back of numbers. So it's going to be about numbers largely. And that's where you're going to see most of the might coming in, as you're seeing from a Pfizer too. When you look at the broader markets, we'll just wrap up looking at the advanced decline ratio once before we lead out to Ask Profit, where your questions and your specific portfolios looked at. Look at the volatility there, that crisscross pattern telling you what's happening in markets right now. and converging very, very closely. This is a range-bound market. This is a conservative market. This is a volatile market, seeking and hunting for direction. Either way, for now, you have to be very, very careful on what you're going in for. Nevertheless, that's all the time we have on India Market Open. So from Neeraj, me and the team that put the show together, thank you so much for watching. Stay tuned. Ask Profit up next.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew. With me is Mahima Vachrajani, and we'll take you through the next 1 hour of trade. Quite a bit of chop and churn on the screen, and that continues from yesterday's session where you saw the benchmark drop about 1/3% or thereabouts. We're down about 0.2%, and we've broken below the 24,900 mark very briefly. Let's see if that continues to be the case. And like yesterday, once again, you are seeing a pretty narrow range for the benchmark Nifty 50. Let's look at the contributors and see what's moving the needle for the benchmark Nifty 50. And yesterday, you saw a few heavyweights drag, and those same names are at the bottom today as well. The likes of HDFC Bank, ICICI Bank, Reliance Industries, Eternal losing ground. By the way, Eternal in focus on account of that board meeting that's ongoing. On the top end of the screen, and you have a few IT names that are up and about, and we were discussing this in the India Market Open show, where IT as a pack is playing a game of tic-tac-toe seemingly, where one day it's positive, one day it's negative. Yesterday it was the worst loser. Today it's up about 0.9%. In fact, the IT index, let's pull that up and see where it is at right now. 0.9% higher for the IT index. Banks, on the other hand, proving to be a bit of a drag, down about 0.4% or thereabouts. In fact, let's also look at the sectoral picture to see what is moving the needle. I won't be surprised if defense is losing ground. Yeah, see, there you go. Right at the bottom of the screen, you have the defense pack that is losing about 2% or thereabouts. and is cooling off from the frenetic run that it's had over the course of last week. Yesterday, you saw some signs of a cool off, and that continues in trade today. What's also not doing well is the auto pack, which, by the way, has run up quite considerably as well. And something like a Bajaj Auto maybe in trade losing ground. Let's pull that up and see what it's doing today. Okay, so we pulled up the entire list. Bajaj Auto down about 1% or thereabouts after yesterday's stellar move, 3% plus. Eicher down about 1% or so. Hero is also losing about 1.5%. And I think the thesis, Mahima, is that the run-up that you saw may be unsustainable, considering that the signs that you're seeing are not the best for automakers. We spoke with Hyundai earlier today, and the outlook for FY26 domestic growth, they're saying they're going to track the domestic industry, which is expected to grow in volume terms just about 1%, which is not too much, really. Yeah. So it's a little tepid, it's a little quiet. The broader market's also a little choppy in trade. That's how it's looking right now.
Absolutely. And I think the entire consumption space, you know, if you include auto also in the consumption space, it's the same story, right? Volumes are not picking up, whereas value-wise, things are going up. And that's the only thing that's showing up on the top line, unfortunately. Yeah. I mean, some other names that are also buzzing on the back of earnings, there's Quest Corp taking significant heating in trade today, down by about 9%. Some defense name, Cochin Shipyard, Paras down almost 7%. DOM seeing profit booking today. HEG down 5%. Railtail, right? Some railway counters also seeing profit booking, down by about 5%. Some counters doing really well in terms of its earnings. Actually, Glasscoat locked in upper circuit of 20% Zensatec doing well, 8%. Banco doing very well today as well. Yesterday was locked in upper circuit of 20%. Today up 8%. Newgen Software, another day of gain for this particular counter, up 6%. DLF up 5%. GMM Fodler also up 5%. So all of these names, Alex, buzzing in trade today on the back of earnings and of course news flow.
Yeah, no doubt. And a few of those stocks in the broader market is doing particularly well. By the way, Amber Enterprises also doing quite well. It started a little tepid, but it's gained ground. There's a CLSA note out that is quite positive on the stock. It's up about 4% at this point. I wonder what our experts have to say about that. We've got Swati Hotkar, AVP Technical Research at Nirmal Bang, as well as Asta Jain, Senior Research Analyst at Hem Securities. Thank you so much, ladies, for taking the time. Good morning to you. Let me ask the first question, and this one's on WhatsApp. And by the way, I didn't mention, you see the numbers on your screen. You can message us on the number on the top of the screen, and you can call us on the landline number on the bottom of the screen, and we're happy to speak with you. Suvadeep Chatterjee has got a question in the cement space, and he's got 50 shares of Ultratech Cement. 9,000 rupees is the buy price, and he's holding for the long term, so he's making a stellar gain here. He wants to invest in cement for a swing trade. Should he add Ultratech or ACC at the current level? And why don't I extend that back, Swati, and talk about the entire cement space? You can even go broader and look at some of the smaller names. What would you pick?
Whatever the position the Ultratech Cement they have, definitely they should hold on at the current market price, just because he's earning a very good handsome money. The interesting fact that on a larger degree, if you look at the monthly chart, the stock is under the formations of the flag pattern and it's on the verge of giving the breakout. So Alex, I believe that this positive momentum is likely to be seen in the near term also, which might take a counter towards to 13,000 to 14,000 levels. Up to that level, I'm looking forward to the positive momentum into the Ultratech. No need to add on at the current market price, just hold on. If you want to add on the another counter into from the cement pack itself, ACC really looks good, because if you look towards on the ACC chart, this particular counter has shown a very strong retracements level from 2600 to 1800. Now we have seen the 100% retracement which rally we have witnessed in the 2023 to 24 levels. So after such kind of a correction, I believe that we are likely to see some sort of a trend reversal from the current market price, because the risk reward ratio is really favorable and it has formed a very good sound supports nearby 1800 levels. So if you want to take any long positions on the fresh side from the cement pack, ACC looks attractive. The short-term target will be at 2200, and beyond that level 2300 levels can be seen. So ACC will be the top pick from the current market price.
Okay, so that's the view with regards to where the cement pack stands, and hold is the view on Ultratech and buy is the view on ACC. All right, our first call for the day, Basavraj is calling in from Bengaluru. Basavraj, a very good morning to you. How can we help you?
Very good. Good morning, madam.
Good morning. Go ahead with your query.
I have purchased 100 shares of Alkylamine.
Okay.
At average price of 2112.
Okay.
My query is whether should I average it or exit. I'm ready to hold. I'm a long-term investor.
You're a long-term investor. Okay. Just wanted to follow up on this one. Any particular thoughts as to why you bought alkyl amine specifically?
No. I wanted this chemical sector in my portfolio. For diversification, I purchased this.
Okay, got your point. Asta, good morning to you, and I'll take this up with you. Alkyl amines is the counter. Should he continue to hold at the current levels, or if he wants to, diversify his portfolio and invest in a chemical company, what would that be?
Hi, good morning to all of you out there. So talking about this counter, basically what we have seen that there was a growth, but it was basically volume-led growth. But there was some pressure in the pricing also, which we have seen in the results. And that is why I think this counter will yield the results, but not in a very short run, in a very long run, because we really need to see the coming quarterly results. In this quarter, there was some pricing pressure, which we have seen. And that is why I recommend to hold it for a longer time period, maybe for 3 to 6 months, with a price target of around 2100 only, which is the cost price as of now. Looking after other chemical stocks, I think Navin Fluorine is very strong counter in that space. So if anyone wants to go for any other chemical counter, then we prefer Navin Fluorine in that space. But regarding alkyl amine, I think there is no need to book loss. Just hold this counter. Maybe time period can vary from 3 to 6 months.
All right. Just a quick follow-up and a quick one. Asta, do you think that the margin expansion that you've seen in a few of these specialty chemical names is sustainable, or do you think that it's something that could turn negative in the first half of this year?
So basically what I feel is that the pricing power is playing right now a very important role, and that is why we have seen the alkyl amines was also not able to maintain its margins. So we really need to see how these manufacturers will be able to sustain the pricing power. But I think in the coming quarters, definitely we can see some sort of expansion in the margin on the basis of the strong demand which we are getting. And that is why I think that demand will definitely help the margins to be at the sustainable level. So overall, we believe that margins will be rising from here on. But for the alkyl amines, I think it will take another 1 to 2 quarters more to show that sort of growth.
Okay, all right. So that's a view on the chemical space and specifically on alkyl amines. IREDA is the name of the counter, IREDA, and we're taking the next question from Srinivas, who's writing in from Andhra Pradesh. He's bought at levels of 236 and he's got 450 shares. He's wondering whether to hold on to this. He's bought at slightly elevated levels. Swati, on the charts, what would you do with IREDA?
The chart doesn't look that much promising for a shorter period of time, but definitely on a longer duration, if we check, we have seen a very strong retracement from 300 to 150 level. Now stock is under the consolidation phase. It got stuck within the range of 190 to 160, 150 levels. So as of now, it is under the consolidation. Any move on either side will decide the clear trend of the market. But if you look towards the weekly chart as such, I believe that the momentum indicators such as the RSI, which we looks on the technical front, looks positive. Try to average it out at the current level price so that your buying price will come down and you will earn a good amount of money if the stock manages to give the positive rally towards the 240 to 250 level. Up to that level, I'm looking for targets on the higher side. So hold your long position at the CMP if possible. Try to average it out at the CMP. Downside, it has a very good support at around 150 level. So as long as it's hold that level, a positive move can be witnessed in the near-term future for short-term targets of a 220 to 240 levels.
With regards to where IIDA stands, the next caller, Pradeep, is calling in from Visakhapatnam. Pradeep, a very good morning to you. How can we help you?
Yeah, good morning, Mahimaji and Alex. Thank you for the inputs and for the experts also. It has been very helpful for me. And I look forward to the show every day.
Thank you so much.
My query is regarding HAL. I have bought 70 shares of HAL at 4645.
Okay.
2 days back, it was touching 5145. I thought of selling it, but I withhold it.
Okay.
Is there any upside to it? So that I'm looking for the level of 5,000.
Okay.
To sell and again buy at dips.
Buy at dips. Okay. And you saw the technical charts, I believe, before buying HL.
Yes.
And
yes.
Even in short term, from a short term perspective, what's the time horizon that you can continue to hold HL?
Yeah, it's 3 months.
3 months, okay. And also, Pradeep, thank you so much for the compliment. It means a lot to us. Swati, I'll take this up with you. HAL, he's sitting on a profit of 19,000 odd rupees right now. What's the view like? Should he continue to hold from a next 3 months perspective and reach that 5,000 level, or should he book profits right now and again enter?
The 5,000 level is not too far away. If probably the 1 to 2 trading session also we might witness some sort of that levels. But the concern is that on the daily chart, the counter is trading in the overbought zone, and we are already witnessing some sort of a negative divergence on the RSI front. So we might hit some sort of a profit bookings at the higher level, because already the counter has given a very smart rally from 3,800 to 5,100 levels. So the profit bookings cannot be denied at the higher levels. So I will suggest you to book your hold your long positions. If possible, try to keep a profit stop loss of 48.50 levels on the lower side, and hold your long positions more than 5,000 levels. You will definitely get a upside towards at least 5,080 to 5,100 levels. So those are the target I'm looking forward. But try to maintain the profit stop loss of a 4,850 and hold your long positions.
Long positions on HAL. All right, so that's a view on this stock that is in the defense pack that is doing particularly well. The next question is from Nigeria, and we've got Vijay Pratap Singh, who points out that it is just about 6:10 in the morning and he's tuning in bright and early. He's asking about Ola Electric, which he's bought a significant quantity of, 55,000 shares. At a price of 52 rupees. I hope that I'm reading this right, and it's not too far away from the current market price, but he is losing ground. The stock is currently at 52. He's got a long-term perspective, and he's looking at whether or not to hold this 2 or 3 years. Asta, it's not rewarded shareholders, and there are a few issues that it continues to be grappling with. Would you suggest a hold or an exit at this point?
Alex, I need your help. At what price he has taken the counter?
He's bought at levels of 62, and the stock price is, or 61, and the stock price is 52.
Okay, so now talking about this counter, I think there are certain problems which the company is facing, and in that regard also now what we have received the new information from the company that they will be considering, issuance of the debt securities in order to raise the fund. And I think the meeting is scheduled on 22nd or 23rd of this month only. So I think now it seems that the company has started facing certain issues, and what we have seen with the launch of the Ether Energy IPO, which is one of the pair of the company, the product line which the company is having, the kind of product they are having, it is not now receiving so much of traction in the market, and that is why if we look after the data also, their market share has shown a considerable reduction also. So we are not very much positive on this counter. The only problem is that the cost price is high at which the investor has taken the counter. So definitely by exiting at the current level, it will yield some losses. My idea here is to exit partially from this counter and remain invested in the partial quantity, but don't hold the entire quantity now, because fundamentals are not seem to be very strong at this point of the time. So this is what we can suggest regarding Ola Electric: book partial losses and hold the partial quantity for a few months at least.
So that's a view on Ola Electric. Let's turn to an exclusive update that NDTV Profit is picking up, and this has to do with IDFC First Bank. If you've been tuned in to NDTV Profit, you will know the context, but in case you don't, let me remind you, yesterday you had domestic institutions that voted against the election of a director on the board for Warburg Pincus, which is a new investor in IDFC First. Vishwanath Nair joining in. He brought you exclusive information about why they voted against that resolution yesterday. Vishy, lay the context for us, and what is the latest that you picked up?
So last month, IDFC First Bank announced that they're raising money from Warburg Pincus and ADIA. Now, Warburg Pincus, because of the amount of money that they're investing, they're getting about 10% stake in the bank, and it was customary, it is normal for a 10% stakeholder to have a seat on the bank's board. So there was a proposal put in front of the shareholders to appoint a non-retiring representative from Warburg Pincus to join IDFC First Bank's board. board. Now, what happened, however, is that when the shareholders voted, a majority of the domestic institutional investors voted against this proposal. What we understand from sources is this is primarily because of the non-retiring clause that exists on this recommendation. Of course, currently what our sources are telling us is that the bank is working with these domestic institutions to allay any concerns that they may have. Now, what the final representation will look like, we do not know at this point in time, but we will hopefully see these concerns being allayed, and then, of course, these domestic institutions voting in favor of allowing a Warburg Pincus representative to be on the board. Now, the primary objection was that this non-retiring clause is a problem for a private equity investor to come into the bank, because private equity investors typically go out and then reduce a stake, raise a stake, depending on whatever their strategic interests are in the bank. And what the domestic institutional investors seem to be thinking is that a non-retiring position is too much power for a private equity investor. So now the discussion is whether this non-retiring clause needs to be there or not. I repeat that we do not know what the final clause is going to look like, but it does seem that the bank is allaying the concerns of these domestic institutions now.
Okay, so just to be very clear, and of course this is obvious from non-retiring, but this means that you have a permanent seat on the board.
A permanent seat on the board, essentially somebody who's not liable for retirement, so you can't remove them unless they step down on their own.
Got it. Okay. All right. Vishy, thanks so much for bringing us those details. And of course, Vishwanath Nair will be back when you have clarity, when he has clarity on what has emerged and what is proposed by IDFC First on this development. We've got our next caller on the show. We've got Ravi calling us from Hyderabad. Very good morning, Ravi. How can we help you today? Ravi, can you hear me? Okay, we'll wait for Ravi to call us back. In the meanwhile, let me get Ashwini's question answered. Ashwini's writing in from Chennai asking about Piramal Pharma, bought at levels of 217 and incurring a loss at this juncture. If I remember correctly, Piramal Pharma results were this week. Asa, have you looked at the numbers? What did you make of it? And would you suggest a hold on this?
Yes, they have announced the numbers this week only, and what we have seen in the quarterly performance especially is there is a single-digit growth, especially 8% growth in their revenue and EBITDA. It is what we have seen. So, I mean, the growth is there, but it is not very strong. But yes, the bottom line has shown a good growth, because bottom line, and that too, I think it is the inclusion of some exceptional item which was there in the last year's result. So that is why bottom line growth seems to be strong. But top line and EBITDA is looking okay to us. Now, talking about this counter, the yearly results are in the fine shape. And we believe that net debt to EBITDA ratio has improved significantly for this counter. So all these, parameters are signaling towards a good upside from here, but not in the short term. In the longer run. So my idea here is to stay invested in this counter with a price target of 230 to 240 in the medium term.
So that's the view with regards to where Piramal Pharma stands. Our next question is on an interesting stock which saw significant downtick in trade yesterday. Let's pull up Protein Egov and see what it's doing in trade right now. Kanishk Raj wants to know whether if this is the right time to make an entry into this counter or not. The stock is seeing a downtick of almost 9% in trade today as well. Asa, I'll come to you on this one specifically, because yesterday's news, in terms of they being no longer contended for government's PAN 2.0 project was a big negative for Protein Egov per se. But the management in the con call did come out and clarify that it might not have a very significant impact on their financials per se, but the street clearly is not perceiving it in that way. The stock did see a downtick of 20% today, almost seeing a downtick of 9% today. But do you think that the financials are strong enough to make an entry at this point when the stock has seen a significant downtick?
So what I think is that right now it is not the current, not at the current level one should make entry into this counter, because we believe that street is still not convinced and hence we are seeing a sharp downfall in the stock prices. Maybe this downfall can be extended to the level of 1,000 to 980. So I think those are the good levels to make entry into this counter, and we still need to see how the things pan out for this company. So right now, don't directly jump into this counter. Let this counter stabilize at around those levels until that time some more clarity can be seen, and then one can make the entry. So right now our idea is do not buy at the current level. Buying is recommended some more under some more dips.
Okay. All right. Let's take the next question. It's a caller. Nagarjuna is calling us from Andhra Pradesh. Good morning, Nagarjuna. How can we help you today?
Yeah, good morning, sir.
Please go ahead.
I bought it NCC at 205 price, 1,000 quantity. Can I hold it?
Okay. And when you bought it at 205,000 quantity, what was the thinking? Did you buy it based on the fundamentals, or did you buy it as a trading strategy?
No, sir. I bought from fundamentals because there is a lot of orders to Amravati region for the state capital. They are the major projects.
Right.
And the company is fundamentally, technically very good.
Got it.
That is the reason I bought it.
Okay. So you don't have a rush to sell the stock, right?
Yes, sir. I don't have a rush to sell the stock.
Okay. All right. Asta, on the fundamentals, then the question is, he's seeing a decent gain at this point. What is the potential for the upside based on the fundamentals?
So fundamental seems to be quite okay for this counter, first of all. And yes, in the quarterly results, we were not very much convinced with the kind of the bottom line this company has posted, because if I remember it correctly, there was some minor degrowth in the bottom line of Q4 numbers. I'm talking about Q4 numbers as of now, not full year 25 numbers. So it was a 8% sort of degrowth. It was there, but it is one of the largest, or second largest construction company in the listed space. So this company is very large. In fact, they have got a very strong orders, and the kind of industry tailwind we are looking after, I think they have a good and a strong potential to move up from here. So yes, I think fundamentally also it seems to be good. Maybe in the short term, due to not very strong quarterly numbers, the stock might not show that sort of upside momentum. But in the medium to long term, we are positive and optimistic on this counter. Remain invested with a price target of 270 to 280.
So that's with regards to where NCC stands. The next question is on NLC India. Bala wants to know the target for the next 1 week for this counter. In terms of earnings, it came out with its earnings yesterday where revenue was up 8%, EBITDA was up 43%, margins significantly improved to 22.5%, and net profit was up almost fourfold. And there was an income of around 820 odd crores due to movement in regulatory referral account, which has overall impacted the financials in terms of a positive way. Swati, I'll come to you on this one though. In terms of the charts, what are they indicating? The stock is up 4% today. Is this the right time to make an entry, and what's the target like for the next 1 week?
Mahima, the chart are really positive, but I would not suggest to make the fresh entry at the current market price, because on the today intraday basis, we have seen a spike of 270, 257 rupees on a higher side, and from there onwards, we are witnessing some sort of a profit booking or say the selling pressures. If you want to create any long positions, I will suggest any dips towards 235 to between the 240 levels, one can go for a long positions, because the risk reward ratio will be favorable. The history says that the stock has formed a multiple support at around 220 levels, so that will act as a very crucial support level as well as the stop loss for the long positions. Upside momentums can be seen once the stock manages to give the positive closing above 250 levels. So the today's closing will play a very important role in this particular counter. If it manages to give the positive closing about 250, this rally is likely to be extended towards 265 to 270 levels on the high side. So I will suggest just wait for a time period, let the stock correct on an intraday basis, or at least for 1 to 2 trading session. If you're getting any dips towards 235 levels, one can go for a long position, but not at the current market price.
Okay, not at the current market price, but if the stock falls around 235, then you can make an entry. Is the view coming in on NLC India. All right, our next caller, Shailendra, is calling in from Odisha. Shailendra, very good morning to you. How can we help you?
Very good morning, madam. Madam, I'm having Torrent Power.
Okay.
500 shares. 500 shares at the rate of 1100.
Okay.
I'm a long-term investor with a 2 years time frame.
Okay.
So kindly suggest whether I should hold it for 2 years.
Okay. Shailendra, just wanted to get a sense as to what was the thinking behind buying Torrent Power, because you entered at the right levels and you're making a profit of over 1 lakh rupees.
Madam, I think that power consumption will be increased from day by day, and in for future it will be in demand. That's why I've taken this up.
That's absolutely correct. Asa, I'll quickly come to you on this one. I mean, the line of thinking is perfect when it comes to Shailendra. What's the outlook like for Torrent Power? Should we continue to hold for the next 2 years?
Yes, one should, because what we are seeing now in the, in fact, in the result itself, that they have started seeing the increased contribution from the gas-based power plant. So that seems to be really good to us. And in fact, they have now getting the contribution in the revenue, which is at the higher level from some of the licensed and the franchise distribution business also. So I think now the overall, in fact, in this result, there was some reversal in the tax liabilities also. And hence we have seen some sort of adjustment there. But overall, yes, the industry tailwind is good. The gas-based power plant has started contributing significantly in the top line of the company. On that basis, we find it as a good long-term bet and remain invested in this company is what we can recommend at this point of a time. Although we are limiting our price target at the initial level to around 1500 to 1520.
Okay, a good long-term bet is the view coming in on Torrent Power with a target price of 1500 from Asta. All right, with that, it's time to step into a very short break, but we'll be right back with an interesting management conversation as well as more queries on the other side, so stay tuned.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind?
Welcome back. You're watching Ask Profit, and we have a very interesting conversation with Heritage Foods. Now, it came out with its earnings yesterday, and it's been a good quarter. Revenue is up 10%, EBITDA up 14%, margins have improved a tad bit, and there's a strong procurement when it comes to their milk, and there's improved sourcing efficiencies as well. And on the back of that, we've seen margin improvement. Now, to discuss as to how the quarter has gone by and how FY25 has shaped up, we're joined by Brahmani Narao, Executive Director at Heritage Foods, joining us now. Very good morning to you, Brahmani. My first question to you is, it's been a good quarter overall in terms of how Heritage Foods has performed. Just wanted to get your sense as to how has it been as per your expectations? And in terms of the overall growth, what does the volume versus volume growth be like? Value versus volume growth.
Thank you so much for having me, first off. It's been, I think, a strong performance for us in terms of revenues. We've earned 4,135 crores at the consolidated level. And I think we've consistently delivered over 1,000 crores in revenue every single quarter when it comes to FY25 performance. Aside from that, margins also have been trending quite strong. Our Q4 EBITDA margins were higher than the previous year, stood at 7.6%, and our financial year FY25 margins, EBITDA margins also stood at 8%, and we've recorded quarter-on-quarter, Q3 to Q4 margin growth as well. Aside from that, there was strong growth in value-added dairy products. As reported by us, our value-added product contribution to our overall revenue increased by 2.4% approximately, which is a huge increase year on year. And it stood at 32.5%. If I had to add consumer pack fat sale to our value-added products, the growth was much higher in terms of contribution of revenues year on year. The growth was at 3.7% for Q4 and 3.3% for the financial year FY25. So over and all, we have shown strong growth, both in terms of revenues as well as margins, which we hope to continue to deliver going forward.
Ms. Nara, morning, and thanks so much for joining us this morning. Alex here. Just want to get a sense on the volume picture, what you've seen so far, and you explained that perfectly. Can you give us a sense of the outlook and what you're seeing on the ground right now? Will that mix of value-added products continue to rise? What is the contribution mix that you see in this current financial year?
Sure. We obviously are looking at a continuously growing trend of value-added products. In fact, if you looked at the previous year itself, the growth of value-added products in terms of volumes was at the high teens level, much higher than milk growth. So, that's something that's really positive for us. And we are sure that we will continue to deliver on these growths. And if I had to specifically speak about certain value-added product categories, curd, which is the largest contributor, was at 12% growth in terms of volumes in the previous financial year. Aside from that, other core value-added products such as paneer, which had grown north of 60% in terms of volume, has done very well. Our buttermilk has also done really well with over 40% growth in terms of sales volumes, as well as consumer fat, consumer products growth also in terms of volumes has grown significantly. Ghee has grown north of 35% in terms of volumes, and this is our peak season, Q1. It is the summer season wherein a lot of our value-added products get sold, and we are confident to move in the right direction to improve our value-added product contribution to our overall revenue to see about 40% plus in the next 3 to 4 years.
So, Brahmani, if that goes to 40%, just wanted to get a sense, because your margins have been improving and that trajectory has continued. Just wanted to get a sense that how will the margins then improve, because I believe that value-added products will have better margins. So from that, if I'm not wrong, overall in FY25, you've done almost 8% in terms of your operating margins. Where will that number go going ahead?
So you're right, value-added products have a much higher EBITDA as well as net margins compared to milk. And more importantly, our product mix or product portfolio is such that most of our revenue from value-added product comes from fresh products such as, curd, buttermilk, paneer, etc. So the margins this will only contribute towards improving our margins going forward. In addition to that, we're investing into premiumization of our existing value-added products. One proposition that's taken off really well for us within existing products is probiotic buttermilk. Another proposition is the protein proposition within paneer. All of our milk is fortified end to end. So all these propositions in existing products are also helping us as a brand garner premium in the market, both in terms of pricing as well as perception. In addition to all of this, we are taking a lot of initiatives on the operational excellence side, and we are digitalizing most of our operations for efficiencies. In addition to that, a lot of our CapEx investments are also going into automation of existing facilities, which will drive margin improvement going forward. Lastly, but not the least, we are also innovating in our existing, bulk of our product, which is milk, which is we are introducing region-specific milk variants. Just to give you one or two examples, we had introduced something called Sarvagun milk in the Delhi NCR, Haryana area, and the traction is really good. We'd also introduced something called Sampurna milk in the Maharashtra, Mumbai market. That's also seen some really good traction. In addition to that, there are other milk variants such as village buffalo milk, etc., that we have introduced in different markets based on the consumer needs of those specific markets.
Right. Ms. Nara, sorry to belabor the point, but 8% margins is what you achieved. I'm just wondering, based on what you've told us, does that inch up? And to what extent can you expect? Even if you give us a range, that would be fine.
We hope to, our ambition is to obviously improve margins through the various initiatives that I mentioned earlier, and also through selling most of our fat within the system, within the organization through consumer pack versus bulks, fat sale, which would only improve our margins going forward. In fact, the loss from bulk sale had decreased year on year from 40 crores in FY24 to under 3 crores in FY25. So I think given all these initiatives, one can expect a target, EBITDA increase of around 9% in the next couple of years. And we believe we are putting in efforts in that direction to be able to achieve those numbers.
And Pramini, one more thing. In this entire value-added product space, there's a lot of competition coming in. There are new startups that are bringing in their products in terms of paneer, ice cream, frozen desserts as well. What's the sense like? Because these brands are really picking up when it comes to your quick commerce space. And you also have very well established your products in the quick commerce space. But what's the strategy in place, and how do you plan to kind of compete with these products?
I think that's a very interesting point, and we are happy that there are many innovative companies that are introducing value-added products and growing, which only means that it's a bigger opportunity for us because there are other players also educating the Indian consumer about the benefits of value-added products and the range of value-added products that are available. We are competing with them, and it's also something that you brought up that we are also investing into new age channels such as e-commerce and quick commerce. So what used to be, say, a 0% contribution of our revenue a couple of years back, today is about 6% contribution of our revenue. So we're seeing great traction in that space. So I think we're there to compete and grow with them and to increase the size of the pie for value-added products and build awareness in the market.
Very interesting point. We're running out of time, but I do want to get some clarity on that acquisition that you've made, the majority stake in Heritage Novandi. And I know that it's not a very large amount of money that you've spent on this, but what is this about?
So Heritage Novandi Foods Private Limited was a 50-50 JV between Heritage Foods and a French company called Novandi. And the company has, decided to reduce its stake in the JV for business priorities changing. And Heritage Foods will now be about 95% shareholder in that particular company, which is an interesting opportunity for us because I think yogurts, which was what the JV was producing, is a very exciting extension to our existing portfolio of products and only propels our growth towards value-added products. And we see significant synergies because the processing facility is actually located in our existing mother plant premises in Maharashtra being an attractive market for yogurts and other value-added products. And aside from yogurts, we are free to manufacture other products as well, such as lassi and curd and other fermented and non-fermented products going forward. In addition to that, there is a lot of interest in co-packing, arrangements with other companies in this particular facility. So I think it's an attractive, synergistic opportunity for Heritage Foods to be able to continue yogurts as well as other value-added products and to be able to cut down costs because it's the same teams that will be managing S&D and supply chain and plant operations, etc. So we believe that within the next 1 or 2 quarters, we will turn around this business and almost immediately increase capacity utilization to north of 50%.
Interesting. Ms. Nara, thanks so much for joining us this morning on NDTV Profit. Pleasure hosting you and look forward to speaking to you soon.
Thank you so much for having me.
All right. So, management of Heritage Foods speaking about the quarter gone by and the outlook going forward. Let's turn back to the questions that we've gotten. We've got several that have piled up, and we really appreciate the patience that you've had. Venkatesh is the first person who I'll take a question from this time. And he's writing in from Chennai asking about Karnataka Bank, which he's bought about a week back. He's got 10 shares at a price of 193 rupees per share. And he's looking for a 2 to 3 year view. Asta, thank you as well, and Swati for your patience. So I'll come to you on this one. What is the view on Karnataka Bank?
So Eric, this is a question to me?
Yes, it is. Asta, to you.
Okay. So Karnataka Bank, I think the kind of results they have posted, that seems to be quite okay. So the average results which we have seen being posted by this bank. So medium-term outlook is positive. In the short term, we might see some sort of pressure in the prices because we still want to see the more strong asset quality by this bank. And hence our price target for this bank in the medium term, not in the short term, in the medium term is 225 to 230. So remain invested in this counter at least for 3 to 6 months point of view.
Remain invested is the view coming in on Karnataka Bank. All right, the next question is from Krish, who's writing in from Hyderabad and wants a view on Suzlon Energy. I'll take this with you, Swati. I believe he's not entered into this particular counter, but he wants to know if this is the right time to make an entry. Is it correct? The stock is currently trading at 61.
Yes, already we have seen a very strong momentum rally, Mahima, from 55 to 61 levels. And I believe that it is forming a cluster resistance nearby 60 to 63 levels. If you want to take any long positions, wait for some more time. I believe that if you're getting any dips towards to 57 to 55 levels, that will be a very attractive level to take a fresh long position because the risk reward ratio will be favorable. 50 is acting as a very good support levels on the weekly charts. So if you want to take a long positions, wait for some more time, let the stock correct in the near term futures. If you're getting any chance or dips towards to 55 levels, you can go for a long position. Short-term target will be a 72 to 75 rupees.
Okay, so that's with regards to where charts stand for Suzlon. Next caller, Sikan is calling in from Odisha. Sikan, a very good morning to you. How can we help you?
Good morning. I'm asking for Bajaj Pinjab.
Okay.
I am holding it for 2051 since last month.
Okay.
And I was hoping for a short-term gain of 2-3%.
Okay. What's your question?
Should I hold it for more month, or should I sell it at a loss of 1,000?
All right, got your query. I'll take this up.
I bought 50 shares at
2051. Yeah, okay, got your question, Sikan. I'll take this up with Swati. Swati, what are the charts indicating for Bajaj Finserv? On the earnings front, it was disappointing for sure, the guidance also being cut. But in terms of the overall view as to where charts are concerned, should he book his losses right now or should he continue to hold for some time?
The client is looking for a very short-term period from the trading point of view. But if you look towards the last 10 to 15 trading sessions data, the stock got stuck within the range of 2000 to 2070 levels on the high side. The today's candle is also really little bit concerned because the open and highs are the same. It's not giving a breakout of that day's high level, which indicates that the selling pressure is we are witnessing into this particular counter. Now, another interesting fact on the negative part is that the counter is on the verge of giving the breakdown of the 20 days moving average, which is the second concern on the technical front. I believe that one should hold the long position, but if possible, try to keep the strict stop loss of 2000 levels. If it's break that level, then more selling pressure is likely to be get triggered, and which might drag a counter to us to on a downside 1950 to 1970 levels. So I will suggest hold on, but please keep a strict stop loss of a 2000 levels on the downside. Positive momentum can be seen once the stock manages to give the breakout of 2070. As long as it stays below that level, the view will remain cautious for a short period of time.
All right, let's talk about Natco Pharma next. And this is a counter that has moved up in the recent past a little bit, but it's underperformed. If you look at a 6-month time frame where it's down about 40% or thereabouts, over the last week it's up about 4%. This is a question all the way from Hong Kong, and Prasad is asking, he's bought at levels of 1,422's elevated levels. He can wait for a period of over a year, and he's wondering what he should do basis fundamentals. Asta, what's the view here?
So talking about the fundamentals of this counter, first of all, would like to say that results will be there on 28th of this May. So I think one really need to wait at least till that time. Otherwise, I think this counter is well placed because we are, medium term optimistic on the pharmaceutical space, and in that space, we find it to be a good candidate. So right now, just wait till the results and then please put your query again. And in case if results come on the expected line, we are expecting this counter to move upwards till the level of 930 to 940.
So that's the view with regards to where Natco Pharma stands. Our next caller, Shankar, is calling in from Bengaluru. Shankar, a very good morning to you. I believe you have a query on Maxens Pharma.
Good morning, madam.
Good morning. Go ahead with your query, Shankar.
I'm already for 3 years at 228.
Okay.
I'm an investor. Now
It's a little patchy there, Shankar, but I believe I have your query with me. Maxens Pharma is the counter. He's holding 60 odd shares at 228 a piece. So I believe he's just bought it because the stock is currently trading around those levels. 244 is the level. Asta, I'll again come to you on this one. What's the view like for Maxens Pharma?
The view is positive. Why? Because in fact their bottom line has shown the growth of more than 20% in the quarterly number. In fact, the valuation seems to be okay. They are trading at a price to earning multiple of 30 against the industry price to earning multiple of 40. So view is positive on this counter. Remain invested in this counter with a price target of 270. But there is one point which I believe that this upside can be seen over the period of time, not in the shorter term. So remain invested in this counter at least for the medium term perspective with a price target of 280 at the initial levels.
All right. The next question is to you, Swati, on the charts for Tata Power. And this is a question from Vivek, who's writing in from Bangalore. And he's asking about whether or not he should add at the current price. He's bought already at a price of 394 and he's got 79 shares. What would you do? Is this a good time to average his cost price?
The view is positive on the Tata Power, this particular counter. The stock has given the downward sloping trend line breakout, which is a very positive indication on the technical front. Now it has just changed its trends from a low trend towards now the upper trend. The slowly and steadily the stock will move on the higher side towards to 440 to 450 levels. I will not suggest to average it out current market price because anyways the buying price will not come down, it will go up only. I will suggest if you want to do the averages, if the stock finds any sort of a corrections between 380 to 360 levels, in that period you can definitely take a long position to average out your long buying position, but not at the current market price. Upside, I'm looking for a target of at least 430 to 440 levels if the stock gives the breakout of 410 on the closing basis. So the view is positive. Hold your long positions. No need to average it out at the current market price.
Okay, so that's the view on Tata Power. We've got our next caller from Chennai. Purushottam is calling us. Very good morning to you. How can we help you?
Yeah, I bought the Reliance shares at 1453, 1,800 shares. Shall I hold it or shall I wait for the target, or is there anything more on that?
Okay, when did you buy this, and what is the time frame that you had in mind?
Matter of 10 days.
10 days back. Okay, so and what did you have in mind in terms of time frame? Was this a long-term view?
Yeah, if it is continue to increase, I don't mind to wait for long. So I would like to know the fate of that. Shall I hold it or shall I come out or shall I continue with that? I would like to know.
Okay, Purushottam, the reason I'm asking is because I need to know whether to ask this to the fundamental expert or to the technical expert. If you've got a view of less than 1 year, then I'll go to the technical expert. So should I go to the fundamental?
And that is 1 year, I don't mind to hold it.
Okay, fine. So Swati, I'm coming to you. This is a stock that is only recently started performing, and it has played catch up, so to speak. What is the potential upside from this point?
The overall counter is definitely positive on the technical front because on the daily charts or the weekly chart, you can say the stock has given the formations of the flag pattern. It's on the verge of the breakout. Slowly and steadily, the counter is really moving on the higher side. If the Nifty and Bank Nifty performs in a period of 3 to 6 months, definitely this particular counter, we will get a new high, which might get triggered beyond 1600 levels. So if you look to hold at least for a 1 year and so period, definitely you should hold on the long period, position in this particular counters. I'm looking for a target of 1600 levels on the high side, and beyond that level 1800s can be seen. If you want to add on any long positions, want to increase the quantity, if you're getting any dips towards to 1300, definitely you can add on. But at the current stage, one shot momentum we cannot be seen into this particular counter. A zigzag momentums can be seen in the formation of the high tops and high bottoms. So no need to worry or the panic. This is the one counter definitely one should hold on into their portfolio. So whenever the market performs, you will get a good amount of profit from this particular stock as well.
Okay, so that's the view with regards to where RIL stands. The next question is from Surendra, who's writing in from Chennai. His question is on Electra Green Tech. He's bought at the levels of 1277 and wants to know whether he should continue to hold or exit at the current levels. He's looking from a longer term perspective. So Asta, I'll come to you on this one. Electra Green Tech, what's the view like?
For long term, I recommend hold on this counter because we believe in the long term that that is a counter which will definitely post a very strong numbers. So yes, the financial performance front, we believe one can remain invested in this counter for the price target of 1350 to 1380.
So that's the view with regards to where Electra Green Tech stands. Our next caller, Mansing, is calling in from Andhra Pradesh. Mansing, a very good morning to you. I believe you have a query on Thomas Cook.
Yes, ma'am.
Go ahead with your query.
I'm holding 100 shares, madam. Average price 201 rupees, madam.
Okay.
Should I add more shares at current price? Technically it broke in its resistance level at 170 rupees. So should I add more, madam?
Okay.
I want to know technical view, ma'am.
You want the technical view, all right. All right, Swati, I'll take this up with you. What's the view like where Thomas Cook is concerned? What is the support and resistance level that you're seeing?
As of now, Mr. Singh has rightly pointed out that the counter has given the multiple resistance breakout of 150 levels of the closing basis, which is a positive indication on the technical front. The short-term target I'm looking for at least 175 to 180 level. Up to that level, we can witness a positive move, and then onwards, we might witness some sort of a selling pressure as well. So if you want to bring it down your buying price on a downside, definitely you can add on at the current market price. But if possible, try to keep a strict stop loss of 140. If it's break that level, then again we are likely to witness some sort of a selling pressure in this particular stock. So buy at the current market price. If you're getting any momentum towards to 175 to 180, book your profits till the time you can hold on the long positions by maintaining the strict stop loss of 140.
Okay, so that's a view on Thomas Cook. It's up 5% in trade today. The next question is from Raza, who's writing in from Hyderabad, and he's asking about Happy Forgings, which he's bought at a price of 830. This precision equipment manufacturer, market cap of 7,700 odd crore rupees. The question is, should he hold for the long term? Asa, coverage on this?
No, Alex, sorry, I don't cover this.
No problem. So, Swati, Happy Forgings, current ticker is 820 or thereabouts, up 0.2% in trade. What's the view on the long term?
As of now, the view is a little bit cautious, Alex, because the counter is trading in the formation of the low top, slow bottom formation. We are not getting any signs of the trend reversals on the weekly or the daily charts. Continuously, we are witnessing a selling pressures on every rise. So it is the only concern point on the technical front. Also, the interesting fact that the stock is not able to surpass the important moving averages on the closing basis. So the technical parameters a little bit shows the weakness in this particular counters. Try to exit the long positions on every rise towards to 840 to 850 if you want a stop loss at the current market price. 810 will be the my stop loss, which is support provided by 20 DMA. If it's break that level, more selling pressure will be intensified, which might take a counter towards to 770 to 760. So I will suggest to sell your particular position on every rise towards to 860 levels.
That's a view on Happy Forge on the technicals. It's time to hit the rapid fire round, and ladies, you know what this means. We'll throw as many questions at you over the course of 2 minutes to keep your answers as quick and cogent as possible. Let's start with BSE Limited. Would you buy the current market price for a long-term period, considering that there is going to be corporate action? This is a question from Vijay. Asta, on the fundamentals?
Not at the current level. We would like to see some dips and then recommend a buy.
Okay, the next question is from Prabhakar, who's writing in from Huzur Nagar. He's bought SJS Enterprises, that's 1090 a piece, and wants a view on this. Swati, on the charts, what's the view like?
Yeah, as of now, the view is positive as long as the counter holds 1060 levels. The view will remain a positive. Upside levels 1150, 1170 levels can be seen. So hold your long positions by keeping the mentioned stop loss.
Okay, CDSL is the name of the counter. Mohammad Ziauddin from Kolkata wants to know. He's bought at levels of 1175. Hold or exit is a question. Swati, on the charts?
I'm really positive on this particular counter. I'm looking for a target of 1540 to 1600. So hold your long positions by keeping a strict stop loss of 1400 on a downside and hold the long positions.
Okay, Vishwanath wants to know whether he can buy Orchid Pharma at the current market price or not from a longer term perspective. Astha, your view?
Not at the current level, I suppose. Maybe some dips at around 720 to 710.
Okay, Dixon, if I'm not mistaken, post numbers today. Devendra has bought at levels of 3,500. Wow. Would you hold on for the long term is the question. Would you book profits? Astha?
Hold. Definitely we would like to hold this counter with a price target of 18,000.
Okay, Saumik from Kolkata wants to know if he can enter SPI at the current levels. Swati, on the charts?
It's been not to add at the current market price, but if you're getting any deeps towards to 770, 760, that will be the attractive price to take a long position.
Swati, Moschip, holding 300. I don't know what the buy price is for 6 months. Would you hold or exit?
Definitely, I will hold this long position because from the last few weeks, we are witnessing very positive momentum in this particular counter. I'm looking for a target of 200 to 210. So if you're having any long position, hold on by keeping a strict stop loss of 175 rupees on the downside.
Okay, thank you so much, Swati, for that view and indeed for joining us today. Astha as well. Thanks so much for taking the time. Pleasure having you.
My pleasure.
All right, and that brings us to the end of this edition of Ask Profit. We've got you stock views, we've got you management conversations, and we've also got up next Know Your Company. So from Mahima and myself, thanks so much for tuning in, and do stay tuned. This is NDTV Profit.
That's huge. That is a biggie. It's out.
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with.
Hello and welcome. You're watching KYC. I'm Harsh Saita. We'll quickly look at the company that we're going to talk about. That's going to be Tips Music. Why are we looking at this company? Because it's super duper interesting. It's around 8,000 crore in market cap, but it has an asset base of just 300 crore. That's one of the reasons. The other reason is it has a very high free cash flow that it distributes straight to shareholders. So again, that's the other piece that you want to keep in mind. But one, what are they changing in terms of strategy? There is going to be a large change. The number of songs that they produce annually is going to go down by 70%. Yes, you heard that right. And there is a reason for that change. Now my question is to the management is going to be as to whether that large change is actually warranted or not, and whether that rationale is punchy enough for that large change. So that's the first thing I want to know. The second one is what gives them confidence to guide for a 30% growth when the number of songs that they are producing is going to come down from 450 to nearly 125 at the very maximum. So despite that sharp fall in the number of songs that they're going to produce, what's giving them confidence to drive a 30% growth for the foreseeable future and not just for FY26? The third one is going to be the outlook on cost per song. Cost per song has gone up from 8 lakh rupees for production to 16 lakhs. And this is average cost per song. That's the math we've done basis the commentary that's come out at the end of Q4. So over the last year or so, we've seen costs rise very, very sharply. What's the outlook going forward? Given that there are these large changes when it comes to the number of songs, does the cost of song change as well? And therefore, what's the impact of that on margins? And therefore, are they confident of maintaining that 64% kind of margin number? Last couple of things that I want to know is what happens to the free cash flow that continues to come in? They've done large amounts of buyback over the last few years. Does that continue? Do they continue to distribute the cash to shareholders? And last one, what's the aspiration from a 3 to 5 year period? So it all looks good, but if you're able to justify the rationale and you're able to take care of margins, what's in it for the next 3 to 5 year period and beyond? What is it that the company is looking to achieve? This and more. But let's first, as always, dive deeper into what exactly does Tips Music do. And I'm going to quickly pull out what it does. First, it was founded in 1988. It has around 11.5 crore subscribers on YouTube. It's basically a music production and thereafter streaming company. So it produces and distributes the music that is produced by them. They are into the acquisition and exploitation of music rights. So they have already a bouquet of music songs for which they have rights. And those rights, they have a library of around 30,000 odd songs. And those rights are thereafter distributed. They also have produced and released around 40 Hindi films over the last 2 decades or so. They also sell theatrical, satellite and various other rights to distributors and broadcasters. A lot of this currently is with regard to music. It's a debt-free company. It has around 271 crore of cash and investments. This is as per their investor presentation. I want to just highlight that because cash otherwise on the balance sheet is not as large. The company earns all its revenue from license fees. Something to keep in mind. 70 to 75% of its revenue is through digital platforms. Not surprising, given YouTube, Spotify, the advent of digital is what the company has capitalized on. And the remaining 20 to 30% odd comes from other digital platforms. You have 45 to 50%, and those other digital platforms are platforms like a Zoom TV, right? So you have TV channels which broadcast music as well. So So those are also some other means in which they make money. But 45 to 50% of the digital revenue, so to kind of break this down, 70 to 75% of total revenue comes from digital. 45 to 50% of the digital revenue comes from YouTube. So you have around 35% of the top line coming straight from YouTube. The export of services is a large chunk of their revenue. The domestic, not as much, because most of these streaming services are all sitting in the US, they're platform companies. Now, in terms of digital versus non-digital, that's the breakup, 75 versus 25. So non-digital now commanding a smaller share and will continue to come down, mind you. Let's talk about partners that they have and they distribute through. And these are just illustrative because there'll be several more partners as well. You have YouTube, Meta, Spotify, and Apple Music among the plethora of other partners that they have. This is in terms of the new songs that they added every year. FY22 saw 276 songs, FY23 896, FY24 733. Here's where things start to change. You look at the degrowth, 18% in FY24, 40% in FY25, and a likely 70% lower from that point in FY26. So you will want to watch out for this number as to why this is falling, and we will talk a little bit about that with the management. Let's also talk about the YouTube views which are being clocked, especially over the last few quarters. You look at the way in which the YouTube views are shaping up, and this obviously depends on number of days as well. But broadly, you have 5 crore plus views, around 6,200 crore plus views that, or 5,000 crore plus views that it clocks nearly every single quarter. And that obviously has an effect on the top line of the company. So that's how it's shaped up. Now let's quickly look at the metrics that we'll look for with regard to this one. We'll first look at the income statement. We'll thereafter look at the balance sheet, the cash flow. We'll look at shareholding. We will look at return ratios. We will look at street cred. We'll look at valuations, and we'll look at analyst recommendations. We'll look at all of these and try and assess as to whether this is a good business or not to possibly consider. Let's start off with the income statement. And if you look at the income statement, at least over the last 3 years, it's very healthy growth that you're seeing. Top line has gone up from 140 odd crore to 311 crore, which is a 32% growth. EBITDA has gone up from 86 odd crore to 210 crore, which is again a 30% growth. Margins have expanded a wee bit, which has allowed profitability to go up by 37%. It's difficult to give a business like this with a past performance, 3-year performance like this, anything but a thumbs up. So we've given it exactly that. It's as good as it can get. One thing that you should know with regard to how the numbers have shaped up, they largely spend their expenses, which is before EBITDA. All their expenses are largely on creating music, creating content. And they actually expense that out immediately. So say, for example, they are creating a song in Q4 of FY25. They will expense that entire amount in Q4 of FY25. But the revenue, largely from digital means, will come for maybe the next 1 year. Sometimes, if lucky, over the next 5 years as well. So therefore, you'll have recurring revenue over the next 5 years, but your expenses are realized up front. And therefore, you're seeing the kind of margin number that you're seeing, because the expenses for a song which was launched 3 years ago were already booked 3 years ago. And therefore, that income continues to flow to the top line. As the income continues to flow to the top line, you have margins which are holding up very well. But you might have some expenses in a quarter or two which may be elevated because you will be producing more songs in a particular quarter than another quarter. And therefore, you might see some bit of choppiness on a sequential basis with regard to margins. But overall, when you're looking at the annual trend, you're seeing margins between that 60 to 67% kind of bracket. More so in an even tighter range between 63 and 67%. So that's something you want to keep in mind, that you don't want to look at this business from a quarterly perspective. You want to look at it from an annual perspective, whether they are able to achieve the annual numbers that they have been looking to achieve. So that's something you want to take care of. Now let's talk about the balance sheet. So income statement behind us. The balance sheet, its net worth is roughly 210 odd crore. Its net worth will continue to rise, but it's doing buybacks on a regular basis. It's a cash-rich company, mind you. They did mention in their PPT that they have 271 crore of cash plus investments. Now, when you're looking at cash on a standalone basis, you can see the number on your screen, around 40 odd crore of cash. They had 131 crore of cash at the end of FY24 as well, which they've used for some buyback as well in April of 2024. So something again to keep in mind is that they regularly distribute the cash that they have. They don't hold on to cash for a very long time. They hold on to cash only to produce new music over the next quarter or two. So that is something again that you want to take care of. The second thing is there's no debt on the balance sheet. It's a clean balance sheet. The asset base is extremely small. We spoke about that. It's just about a 300 crore asset base in terms of total assets. And last off, they regularly buy back shares. So your equity, your absolute equity base has continued to shrink. In terms of when I'm removing reserves and surplus from that equity line, just the equity base is shrinking on a consistent basis. Over the last maybe 10 years or so, we've seen a shrink on that number. Something again to look out for, that the equity base is shrinking. So that's with regard to the balance sheet. It's a thumbs up because there's very little to nothing to complain about in terms of either debt or in terms of cash. There's sufficient of all of those factors. Let's talk last about cash flow now. Cash flows are largely in line with profitability. There was a chunky amount in FY24 which came through, due to which there was a little bit of excess cash flow which came through in FY24. FY25, that has normalized. Largely, it's a steady state in terms of the cash flow. Nothing to complain about. In terms of cash balances, they keep smaller balances. I did speak about that. Also, they have a high payout to shareholders. So they largely pay out all of their profit to shareholders. Let's now talk about return ratios. In terms of return ratios, the asset base is very small and hence the return ratios that you are seeing on your screen extremely high. I want to also highlight that this is one of the highest return ratios that you will see. But it's that type of industry where if you're expensing out immediately and you're not capitalizing any of your costs with regard to music made, your return ratios will tend to be higher. I want to highlight FY21, the ROCE was 47%, FY22, 62%, FY23, 62%, FY24, 79%. That's how the return ratios have gone. ROE is also 48, 63 in FY22, 64 in FY23, 81 in FY24 and 86 in FY25. So you're seeing a gradual inch up with regard to ROEs as well, but expect that to happen because you've expensed out a large part of whatever you've built in terms of IP, and the unwind of that is happening in subsequent years, and therefore that explains the ROC and ROE metrics, but it's a strong number and hence the thumbs up. Now I want to talk about shareholding for a bit. Promoter holding 62% odd, 64% odd. No concerns with regard to that, and therefore we won't delve into this too much, but a clear thumbs up with regard to promoter holding as well and shareholding as well. There's plenty of skin in the game. Let's talk now about street cred. The last 6 months, the stock has been under pressure. Year to date, the stock has been under pressure, but the 1 year returns on the counter is good at 49%, and the 5-year returns is very strong. We'll give this one a neutral. That's how we look at street cred. Now let's look at valuations. Now when you're looking at valuations, Tips Music trades at around 49 times. You have Saregama, which is the other competitor, which trades at 51 times. But you look at the 1 year forward of Tips, and this is where it starts to kind of stand out. While it's an expensive counter, 1 year forward, it's looking at 39 times. And when you're looking at maybe 2 years forward, it'll compress even further to sub 30 times because the growth clip is very fast. So valuations, there seems to be some comfort, but you want to see whether the new strategy is getting executed because currently it's sitting at 50 times. If the new strategy does not execute well, then you might not see such a fast compression in price to earnings. And hence we've given this a neutral because there's a bit of a question mark there. The last one is with regard to analyst recommendations. There are 5 buy calls, 1 hold call. There's only 6 analysts covering this, and hence we're cautious. We've given this a neutral on that count, but the return potential is 21%. In terms of multiple, this is trading at the lowest multiple in the last 12 months, 1 year forward, that we have seen this trade at. So at 39 times, the multiple is also the lowest, and hence you are seeing that upside that we are seeing. Let's quickly though go across to Kumar Taurani, who's the managing director at Tips Music, on what the strategy is and what he is looking at in terms of market share. Welcome, Mr. Taurani. It's good speaking with you. Let me first start off with why this change in strategy? Why go from 450 odd songs to do 100 to 125? What's the thought process behind this like?
No, we won't give out market share. On the contrary, we will increase our market share. See, when we make 500-600 songs, so our time is limited. It's distributed in all the songs. We have a team of around 10 people. So if you calculate, one person is making 50 songs a year average, I'm talking just an example, a number, and 50-60 songs versus 10 songs he has to make. So I think he will be more focused and give me more quality, and we can reject more songs. And we are not compromising on the quality and on the money also. Whatever money we have planned to invest, we will invest that money. We will sign bigger artists, we will do bigger marketing, all that we will do. So that is a focus for coming years.
Got it. So that's for FY26. What about beyond FY26? Will you go for a larger base in terms of songs beyond?
Please understand that our focus is on a quality. So maybe 80 we karenge, yeah, maybe we can go up to 150 also. That's not a hard and fast rule. We have to just stick to a number. Whatever good quality songs we will get, and we have a budget, we will invest and we will acquire or produce. I think the way FY26 is behaving, I think more or less we are already there. And I think this year, okay, maybe last year some songs left out, maybe it will touch that number. But around 125, 150, yeah, this year.
And sir, the total market in terms of how India is shaping up is going to grow from around 7,000 to 10,000. So despite that, you will stand out and you will continue to do 100 to 125. So the number of songs is not going to be the focus at all.
I think we must realize what is the success number. I think if you see, our main focus is on film side. So if India produces 1,000 films, the success ratio is only 8-10%. So our focus is we should be in that space maximum. And if you see my Tips ka track record from 2005, 4-5 onwards, 90s we were a very aggressive player. We were the 60, 65, 70% of that period's content Tips has acquired. And if you see at that time, from 88 till 2002-3, anywhere, any award function or any award, out of 10 songs, 7-8 songs, of top 10 songs, 7-8 songs belong to Tips. And among the 5 nominations in many awards, we had 3-4 nominations. So we want to, after that, when market changed to physical to non-physical, so we concentrated on maybe 30-40 songs a year, but my success ratio is 90%. So that is the key to the music business, I feel. And touchwood, we have a very experienced team, so I think we can make it. And that is the next growth for us as well. So I think our focus is there. Plus, one more thing, nobody understands that music business repertoire catalog is very, very important. If we all combine entire industry produce good new numbers, then our new numbers business will be 20-25%. But still 75-80% will be a catalog business. Whatever your favorite songs over the years you have selected, you have separated, you have made your own playlist, you won't forget listening those. In case you like 2 more songs, you will add to your playlist, but you keep listening all those songs over the years you have liked. So, and whenever there's no good new releases, so there will be a 95% of a catalog business, only 5% will be new releases. So majority is catalog, and our catalog is touchwood doing very, very, very well. If you see, there is a no major new releases we have done for last 4 or 5 years, and we are growing 30% year on year. So that is because of our old repertoire, whatever hard work we have put in last many years, that is actually giving us fruits.
Right. No, sir, I fully appreciate what you're saying. So, but you've also guided for a 30% growth. Give us the breakup. How much of that comes from old songs versus how much will come from new? And will that 30% growth be sustainable?
I think so far our new releases, you can say 15% contribution and 85% comes from catalog. But our going forward, our target still is a 30% top line we have to do for next 2 years, at least 3 years. So among that also, we want new releases should be more. So now target is we should achieve 20-25% to new releases, and 70-75% should be a catalog.
Very interesting. Now, sir, the other piece is with regard to costs. When I'm looking at, and I've done this math, the cost per song has doubled last year versus this year for you. Where do costs go in this new shift in strategy? Where do costs go?
Cost will continue to rise. First, please understand, we can acquire a song from 50,000, say, leke 7-8 crores also. So that is the range. So we can't actually pinpoint. If I'm taking a big blockbuster movie of a multi-star film or something, so I have to pay 25 crores, 30 crores, 40 crores. Pata nahi abhi kya ho raha hai. But there's a very tough market. But we are not in that rat race. But there is like that.
Point taken. And sir, therefore, where should margins be at? 85% is from old catalog, 15% from new. Costs will rise. Where do margins go?
My catalog is doing really, really well. So our margin and then that entire catalog, whatever we release, whatever music we make or acquire, we release that music, we write off that content cost in that same year. So that is a big advantage Tips has. Or this is not, we are not doing from now. We are doing this since beginning. If I carry forward for 4 years or 10 years, then I have to pay more tax and it will hurt my cash flow in those days. Those days there was a very cash flow was very tight, so we have to need money quickly. So we used to write off entire content cost same year. So that is from beginning we are following. Still we are following that.
Okay, so sir, therefore EBITDA and PAT should also grow at 30%.
EBITDA will maintain. And PAT also, we are trying we should be at 30% in the 30% range, 30% top line, 30% bottom line. We should achieve PAT. That is our target for this year, next year. Yes.
What about distribution? You're a low capex kind of business, and therefore, will you continue to distribute dividend?
We give it to our we declare dividends. Or whatever last year we made money. Last year, our PAT was 127 crores. We given 136 crores to our investors, shareholders by way of buyback and dividends. So we keep continuing doing that. Big dividends.
Right. Sir, talk to us about what the aspiration is in the next 3 to 5 years. Your low capex intensive, your 30% growth on top line, bottom line. What's the aspiration in the next 3 to 5 years?
See, we are very focused on this business, music and films. We have both two separate companies, films companies separate, music companies separate. And we are very focused and we are really doing good. I feel we can really do good in film business as well. It will take little time. But I think our focus is to build these two businesses properly and keep growing. And if we don't want to do anything other than this, so very focused, we'll continue doing this.
Okay, and so what's the risk like therefore? It looks like a very low risk business, 85% of top line largely guaranteed. Is the distribution model a risk?
I don't feel there is any risk there because they also need a business. They are also having they are not paying us any, earlier they used to pay us upfront, minimum guarantees, but now they are paying us from earnings. So they also making money from us and they are getting content, you can say directly free actually. Okay, they are sharing some money with us and on a streaming basis or a advertising or a subscription basis. But we are investing so heavily, so they understand that. So I don't feel anything about that. And this is happening for last so many years. And if you think this is the same practice they are doing internationally. So why you want to disturb a smooth business is going on? Nobody disturbs that, I feel.
Okay. Thank you so much, sir, for coming in and breaking this down for us. Very interesting, and wishing you all the very best for the next year or so on this new strategy and its implementation. But what we're going to do is we're going to quickly also look at the ratings that we've given, the KYC rating on this one. Such strong growth, definitely a thumbs up. Balance sheet, thumbs up. Cash flow, thumbs up. Return ratios, we've seen how return ratios have gone up because the asset base is so low. Shareholding is a thumbs up, 65% owned by the promoters. Street cred, there's been some bit of a hiccup with regard to returns over the last 6 months or so, but the last 12 months have been solid. Valuations, again, not looking cheap by any stretch. It's at 50 times. That's what its peer also trades at. But there's going to be a new strategy at play. Whether that valuation holds fair or not is a neutral on that count. And analyst recommendations, just very few analysts covering this one. So we've given this a 6.5 on 8 on KYC, at least for the moment. So that's our KYC rating. With that, it's out of time on this edition of KYC. We hope you found this helpful. Very interesting business. At least that's how I found it. Stay tuned. More action on the other side.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready.
Hello and welcome to Markets at 12. I am Puneet Zaveri. Before we get into some of the key stocks as well as the markets are doing, let's first look at one of the key news items as well, because we've seen India has been witnessing a marginal uptick in COVID-19 cases. Health authorities are turning to their focus as well to JN1 variant. The new version of the coronavirus has been reported in parts of Asia, with rising hospitalizations in Singapore and deaths reported in Hong Kong as well. Now, the variant is under close scrutiny globally as well, even though India's current COVID situation remains largely under control. Currently, government data shows 257 active COVID cases across various states in the country, with most of them coming from Kerala, Tamil Nadu, as well as Maharashtra. Now, to discuss this a little further, we are now joined by Dr. Rama Subramaniam, who is the Senior Consultant in the Department of Infectious Diseases at Apollo Hospital, Chennai. Dr. Rama Subramaniam, thanks so much for joining in. A very good afternoon to you. It's Puneet this side. Firstly, I just wanted to start off, before we get to the preventions, what according to you is leading to this rise in COVID cases again across the Asian continent? Let's first start off with that, and we'll get into the preventions much a little bit after that.
Yeah, good afternoon. Glad to be here. Now, this is the normal process of an infection, the evolution of the virus and how it spreads. This is exactly how it happens. We have realized that COVID is probably here to stay. Just like the earlier versions of the coronavirus, the mutated SARS-CoV-2, which came in by late 2019, is now adapted to survive in the human population and cause periodic outbreaks, just like probably the influenza virus. So this is nothing new. The virus constantly keeps mutating. It changes itself so that you get a newer version with several different mutations. But fortunately, all the current mutations which we see are mild infections only in the majority of the population. So just like the flu, it causes a little bit of a fever, cough, cold, sore throat, lasts 4-5 days and settles. But in people who are very elderly, people who are obese, people with severe comorbidities, people who are immunosuppressed, in these patients, it can cause severe illness, sometimes even leading to death. So this is not something new. This is what is expected, and it is behaving that way.
So not something new, something that's expected, something that we've seen in the past as well. That's what Dr. Rama Subramaniam is mentioning. Dr. Rama Subramaniam, just to get into some of the key preventions, both for people, as you mentioned, who might have some pre-illness or pre-disease, what are some of the key aspects and precautions that they should be taking, as well as for people who are, moving around for jobs and traveling across in public transport, what would be some of the key precautions that you would suggest for them as well?
Okay. Now, it has been very clearly shown that vaccination probably is the only major factor which can prevent seriousness of infection once you get it. So ideally, you need to have a vaccination, at least people who are elderly above the age of 65, people who are immunosuppressed, they definitely need a booster which will cover the current circulating strains of the virus, which unfortunately is not available in India. So this small group of people who have a higher risk of complicated infections should be ideally covered with a booster shot of vaccines. But otherwise, in India, still the good old advice with regard to wearing of masks when you are in crowds, especially when you are in traveling, in functions, in gatherings, you definitely need to wear a mask. The same thing what we advise for influenza also holds true for this. Hand hygiene periodically, avoid taking your hands near your face. The same advice is what we can resort to. So just by doing this preventive measures, we can definitely help protect ourselves. But vaccination, I hope only if the seriousness of the infection increases, Indian companies will come out with vaccines. So we have to wait and see how this pans out.
Also, Dr. Ramasubramaniam, over the next, we have been seeing that the monsoon onset will come in, and that's generally, of course, the flu season as well. So this could lead to some more increase in number of COVID patients as well. My final question to you, it's a time of travel as well, and we've seen across Hong Kong, Singapore, and Asia, it's a key travel destination as well. So anything on that aspect that we need to take care of, because that's been one of the key aspects, and we've seen those states as well which have a high, travel quotient. Maharashtra, Kerala, Tamil Nadu, there the infections have been rising as well. So in case you are traveling either for business or for personal, what are some of the key aspects to note in those countries as well, where these infections have been rising, as well as which you might catch in a country that's not been seeing increased infections at this point of time?
First of all, if you have symptoms of cough, cold, fever, body pain, do not travel, because you are likely to pass the infection unintentionally. You may not be aware, but you could be having COVID. So please do not travel. Stay at home if you are unwell. If you are traveling, we strongly urge all people to use masks when in public. Carry a small bottle of hand sanitizer, which you use periodically. And as far as possible, stay away from people who are coughing or who seem unwell. This would be the simple ways. Do not touch inanimate objects around you, because inadvertently you take your hands near your face. Frequent hand hygiene, masking is still the good old way to keep yourself safe.
Got that, Dr. Ramasubramaniam. Thanks so much for joining in, giving us a whole host of views, of course, on the new COVID increase, as well as some of the key precautions needed to take. We look forward to our next conversation, but thanks so much for joining me today.
Thank you. Bye-bye.
Well, now let's shift focus to the markets as well. We've heard Dr. Ramasubramanian give some key precautions as well for travel. If you're traveling outside also, so do take those precautions going forward as well. Let's see how the Nifty is doing, because we did mention in the morning in the F&O segment that we might see a narrow range-bound trading day today as well, similar to yesterday. The Nifty currently down 63 points. It has not been able to sustain that level of 25,000 as one of the key supports. 24,800 is the next one to watch out for. We have seen roughly about the day's high of about 25,010 points slipped around 150. So we just bounced back 40 odd points from the low of 24,844. But that's definitely on the Nifty. Let's also look at the key sectors as well. And bring out the sectoral heat map. We have seen sectors such as the Nifty CPSE metals as well has been rising, and that's largely because of what's happened in China today. We've seen a rate cut there. Nifty Energy and Realty also continuing its momentum. IT has been playing hopscotch, to say the least. It's negative on one day. Yesterday it was down, the biggest Nifty loser. Today it's one of the biggest gainers. So definitely the Nifty IT being one of the gainers today. On the losing side though, we have seen the Nifty consumption down in trade today, and that's definitely one of the negative indexes to watch out for going forward as well. Nifty Auto as well has been largely very positive over the last couple of weeks, giving up some gains today. Let's look at the mid cap, small cap index now. Both those indices have actually been outperforming. But today largely in line with what the benchmarks are going down 100 odd points. Finally, let's look at the BSE 500 as well. Small cap slightly in the green, but not too much to talk about. And for the BSE 500, we've largely seen a lot of moves in terms of individual companies that have been buzzing on the back of earnings. Now we've seen actually Glasscoat has been one of the big ones. Pfizer we'll discuss during the show what have been the key updates. Apart from that, we've seen something like a CCL Products and Raymond also up on the positive side. On the negatives though, the one which I want to start with, it's HEG is down. We've also seen some impact on Graphite as well post earnings, and now Quest Corp. Now for Quest Corp, of course, the results it had come yesterday. Not so much to talk about, to be honest. The 1.8% EBITDA margin, but the company had 150 crore exception item. Out of that 120 crores was largely because of trade receivables. Essentially, that means that they've given the service to the client has paid them back. But it's a huge amount for the company that has profits of about 50 to 60 crores. So definitely collections could be one of the key concerns going forward. They're also seeing some, which would be saying the demerger issues largely in some key businesses. We've seen, the top two sectors that employ both IT as well as financials has been slow on both ends. We've spoken to multiple IT companies. They've seen that the headcount reduction has largely been stagnant, to say the least. But hence, Quess Corp down in trade today almost 8.4% as well. Another counter that I want to talk about is Bharat Electronics. Now, the company came out with its earnings yesterday. We've also, Anushi did cover this in the morning. She's back now to give us some of the key highlights from the con call that happened at 10 a.m. today. Anushi, what were some of the key highlights from BEL, as well as anything that you can mention on the guidance as well?
Well, it's the order inflows, which is a particularly interesting one for FY26 that we should be watching out for. Overall expectations of 57,000 crore of order inflows, the management has segregated into parts. This is 27,000 crore of order inflows that are expected for various orders that the company expects in the course of the years. But with that, there's a big ticket order with the size of 30,000 crore for QR SAM that is expected for this year. But in the worst case scenario, this could maybe shift to April, so this could spill over in the first quarter of FY27 as well. So order inflows remain on a stronger positioning that we are looking at. Other than that, if you're talking about where the revenue growth is projected to be 15% is the expectation that is seen for FY26, but overall for the next 5 years, the company projects 15 to 17% of a revenue growth. Margins are expected at the levels of 27%. Do note that in FY25, the management had guided for 22 to 25% of margins, which they exceeded to the mark of 28%. Now, if you talk about the defense to non-defense mix of the business, it's expected to be 90% and 10% respectively, with the management's focus on higher focus on non-defense as well going forward. Other than that, other major expectation is also for next generation Corvette related orders. This would be awarded from any of the shipbuilding companies which will receive this order. Well, that would be at the size of 6,000 crore to 14,000 crore that we should be watching out for. For exports, now we did see about $106 million of exports for this year. The management expects about 15% growth from here, seeing exports at the range of $120 million, and from here onwards, from next FY27 onwards, from this 15% of a growth mark, they do see about a 20% of a growth as well coming for exports going forward. Overall, it had been a strong quarter for Bharat Electronics. While revenue was in line, it was the margins which were a beat. Now, we did see a healthy margin expansion for the business, up over 407 basis points to 31% as compared to 27%, and net profit was up over 18%. Order book at the end of FY25 stood at 71,650 crore. So this is the overall perspective that we are seeing for Bharat Electronics. It's the order inflows in particular, along with higher share of exports, that we should be watching out for.
Well, thank you for that, Anushka. And definitely the company missed its guidance in FY25 as well, but that did carry forward in April. We've seen order inflows as well. Another counter that's in focus is DLF after the company reported its Q4 earnings. Anushi is still with us. Anushi, you mentioned that results isn't the only thing to look out for a realty company. What are some of the other key highlights?
So I'll start off with the key operational numbers first off. Now, if you see in the fourth quarter pre-sales, now they've reported about a 39% of an increase here to 2,035 crore, with a healthy growth in collections as well. Collections were up over 51%. So taking the fourth quarter in consideration, overall FY25, we are looking at a 44% of a growth in new sales bookings for the year at the tune of 21,223 crore. This is against the guidance of 17,000 crore. So a big beat in terms of where the FY25 guidance is. Do note that the company had already achieved its FY25 guidance in the 9-month period itself, and this was due to the launch of its Dahlias project, which had fetched these higher bookings for the business. Along with that, if you look at collections, that were up over 36% at 11,773 crore at the end of FY25, with operating cash flow surplus seeing about a 128% of a jump. Overall, if we see for DLF, now it's been a particularly strong year in terms of where the launches are concerned. The target for FY26 being that they expect the 15% of their overall launch pipeline to be launched in this next financial year. Even the net cash position, if you are seeing, that has improved further to 6,848 crore versus 4,534 crore in the fourth quarter that we are looking at. So just quickly also looking at the headline numbers, do note that real estate companies follow a lumpier record in terms of their revenue recognition is concerned, they recorded about a 47% jump in their revenue, while margins stood at 31% as compared to 35.4%, and net profit saw a 39% of a growth. So overall, if we have to break down DLF, it's healthy set of collection and pre-sales growth number that we are looking at, along with improvement in the net cash position as well. So strong quarter for DLF is what we are seeing.
Well, thank you for that, Anushi. Another stock in focus is Pfizer. Now, the company did report its Q4 earnings, but the key news flow was also the company's US and US and China biopharma deal. Now, let's get in Varsha to tell us a little bit more about both these aspects. Varsha, good afternoon. What are some of the key highlights to look at?
The revenue growth for Pfizer, if you see that this only 8.5% of revenue growth that you're seeing at 592 crore versus 547 last year. But what the highlighting factor over here are two things. One is EBITDA. If you see, EBITDA is up 20%, margin at 38% versus 35% last year. Now this was because of lower other expenses that the company has seen, lower power and fuel cost the company has seen, which has led to EBITDA margin increase. Net profit up 85%. Now this is due to impact. The net profit impact that you're seeing is led by higher other income and of course lower tax. So company had an exceptional item which has led to the higher other income, which has led to uptick in the net profit, and of course lower tax has also aided net profit. And company has seen lower interest cost, which has also helped net profit grow. Now there is a recent just a few hours back, there was a recent announcement by Pfizer US, which has made a deal with the Chinese biopharmaceutical company. Will that have an impact on Indian Pfizer company? No. Why? Because if you see the export for FY24 stands at around 4% for the company, because Pfizer sells its products through independent distributors primarily in India, and there has been no related party transaction with the US Pfizer company. And since this is a licensing agreement, Pfizer, the US company will have to sell these products in China only. So maybe because the name Pfizer has been attached, this is a reason. Because of the sentiment, the stock is up 10%. But yes, one of the reasons why Pfizer is buzzing in trade today is because of the good numbers. Operationally, if you see, margin have increased and net profit increases due to the higher other income that the company has seen.
Well, thank you for that, Varsha. But another stock in the pharma space that's in focus is Sai Life Sciences. Now, we spoke to the management. They mentioned that they feel confident about the growth in the CDMO segment. And that's what Mr. Krishna Kunumori said, who's the MD and the CEO of the company. Listen in, where he mentions about the company's guidance for FY26.
So I think we are 35% CRO and 65% CDMO, which includes both development and manufacturing. We expect the ratio of CRO, CDMO is going to be more or less the same. They'll be going back and forth depending on which year we have. On the CDMO side, about 70% of the revenue comes from large pharma. And from the CRO side, about 39-40% comes from large pharma. So we long-term will think maybe large pharma will go a little bit more on the CDMO side, and maybe biotech funding will be 50-50 large pharma and biotech. But we don't see meaningful changes more than a few percentage points, maybe 10-15% here or there, depending on how things will move. We think this will be fairly consistent going forward.
Well, that was the management of Sai Life Sciences. On to an NDTV Profit exclusive. My colleague Vishwanath is now joining us to tell us what's happening at the IDFC First Bank after shareholders reject Warburg Pincus' board seat. Vishy, tell us a little bit more about what you're gathering from your sources.
Right. So what exactly happened at IDFC First on Monday was essentially that the institutional shareholders voted against a proposal to appoint a non-retiring, non-executive director who was a representative of Warburg Pincus. And of course, since then, there have been a lot of speculation about what will happen to the large fundraising deal that the bank was doing with Warburg Pincus as well as ADIA. Remember, last month, the bank announced 7,500 crore worth of fundraise from these two investors. What our sources are telling us at this point in time is that the bank is in conversations with these domestic institutional investors, trying to allay their concerns, specifically over the non-retiring part of this resolution. What the domestic investors seem to suggest is that a non-retiring director may not be appropriate for somebody like who's a private equity investor, simply because private equity investors tend to sell their shares, and obviously after a point in time, they do not hold the requisite shareholding to to ensure that a director can be on the board or not. Now, of course, the bank is in direct conversation with these investors, but we need to see what the final outcome is going to look like. Just a little while ago, IDFC First Bank put out an exchange notification where they said that they're confident of getting through these issues, but in parallel, they're also getting the other regulatory approvals needed to conclude this fundraising from Warburg Pincus as well as ADIA.
Well, thank you for that, Vishy. Let's look at some of the key earnings that are in focus now. Global Spirits, Borosil, as well as Restaurant Brands Asia, which operates the Burger King franchise in India. Let's get in my colleague Mahima to talk a little bit more of what were some of the key highlights from these results.
It's been a great quarter overall for the entire Alcobev space. Volumes have gone up for a lot of these companies, and premium and above category is something that's growing very well. In terms of global spirits, revenue is up 11%. EBITDA significantly went up by 97%. Margins improved from 3.3% to 5.9% because of operational efficiency. And net profit stood at 5.5 crore versus that of 25 lakhs. Now, in terms of key highlights, sales volume was up almost 62% in Prestige and above category. There was both volume as well as price hikes here, and the regular and other segments volumes were also up in 16 digits. I mean, it's very rare to see Prestige and above category growing in such high double digits number. The next is Borosil Limited, where revenue was up almost 16%, EBITDA up 57%. Margins significantly improved from 10.1 to 13.7%, and net profit stood at 11 crores versus that of 5 crores. So net profit also doubled, more than doubled for this particular counter. Now, what worked for the company, what aided the profitability? Cost of raw materials remained flat. So there was no escalation in terms of cost of raw materials. Finance cost significantly reduced by 39%. And there was reduction in terms of deferred tax as well, in terms of as compared to Q4 FY24, there was a reduction of almost 14%. That kind of aided the profits. Lastly, Restaurant Brands Asia is also on my list. Again, a thumbs up. Again, a good set of numbers in terms of improving, in terms of narrowing their losses as well. Revenue is up 11%, EBITDA up 36%, margins stood at 15.3 versus that of 12.5%. This is very important to note because Restaurant Brands has been trying its best to improve their margins. Net loss came at 25 crore versus that of 31 crore, so net losses have narrowed. Same store sales growth stood at 5%, which is lower than that of Westlife or Jubilant Food Works because they grew in double digits, and company increased footprint to around 513 restaurants in India, and strong focus in terms of value offering led to overall growth for Restaurant Brands Asia. So these are definitely three key earnings to watch out for in trade today.
Well, thank you for that, Mahima. But let's look at a global story now. The number of H-1B visa applications received by the United States Citizenship and Immigration Services for FY26 witnessed a 25% fall. Now, this comes as uncertain macroeconomic conditions are leading to layoff and application fee remains high. My colleague Haripriya joins in to give us a little bit more details on this.
H-1B visa applications for 2026 have dipped significantly by 25% to 358,737. Last year, this number was at about 44,900. From the total registrations this year, about 1,20,141 have been accepted, which is again lower than 1,35,000 odd that were accepted last year. US typically issues 85,000 H-1B visas every year. H-1B visas are the non-immigrant visas which allows skilled workforce to pursue a job in the US. Majority of the H-1B visa holders are Indians. For instance, 72% of the visas issued in 2023 were to the Indians. Mostly the Indian tech workforce depends on this to go and pursue opportunities in the US. The tech companies in the India and US both exercise this visa. In this context, the dip in the registrations is seen when there is a lot of inconsistency in the job market and there's a lot of uncertainty. We see that multiple tech giants are laying off. The most recent being Microsoft laying off 6,000 employees, Amazon laying off 100, and other companies like Intel, CrowdStrike have also laid off employees in the recent past. Another reason for the dip is also that the registration fees has been hiked significantly. In the previous US administration, that's Joe Biden administration, the fees had gone up from $10 to $215. Now with the new Trump administration coming in, there is a lot of uncertainty around the immigration policies and what it means. That's also causing a lot of confusions and concerns for the people who are looking to shift to the US for the jobs.
Well, thanks for that, Haripriya. But another stock in focus is Hero MotoCorp. Now, after the company invested more than 500 crore rupees to invest a third and essentially get a stake of a third in Euler Motors, what does it mean for the company? As well as we spoke to Saurabh Kumar, who's the CEO of Euler Motors, about how the dynamics for the company are looking in. Listen in to what he had to say.
So in this round, that we have raised the 638 crore, where Hero MotoCorp and British International Investment has come on board. BI is already an investor, but they have increased their investment. For them to invest this significant amount in Euler gives a deep sense of satisfaction that we are on the right path. We are executing. There's a sense of commitment. So our focus toward becoming India's largest, I would say, electric commercial player, that sense of confidence is there. That vote of confidence is very, very highly valued. BII and HMC both have invested in the EV manufacturing these segments. So there's also, other than the capital, these are the investors that are looking at like maybe fairly long term. So, and in automotive, as you know, the businesses are often, the results and outcome of your strategy, they take years to come. So that's also a good set of like investors having on your cap table. Hero particularly, they are the leading player in the automotive segment. They have looked at the EV adoption in past, and they also have their own player. They have worked with the startup ecosystem. So having them on board along with their capital will help us also learn from some of their strategies, work with them there with their partners in the vehicle financing or in the distribution space. So those are the areas that Euler will also work with them over the next couple of years and see how we can take some of those learning and implement it in our growth journey.
So clearly the synergies are immediately emerging for you as various parts of the business. If I got you correct, this does fit in well with your aim or target to become India's #1 electric three-wheeler company?
So I would say both electric commercial vehicle company. So we launched electric three-wheeler cargo in October of 2021. And recently, last year in September of 25, we have also announced our four-wheeler cargo. So we are presently playing in both three-wheeler and four-wheeler space, and looking at that entire electric commercial vehicle space. We would want one of the top player, whether you're looking at a three-wheeler cargo product or a four-wheeler cargo product. That is the way we would look at the opportunity.
Well, that's all the time we have on this edition of Markets at 12. Stay tuned to NDTV Profit for more.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve.
Hello and welcome to NDTV Profit. You're watching Profit Buzzers. I'm Hiral Datia, and with me is Anushi Vakharia. A very good afternoon to all the viewers as well. But let's quickly take a look at what markets are doing at this hour. There is some bit of profit booking that's coming in as well. Let's pull up Nifty 50 on the screens and see what that is doing in trade. You are near the day's lowest levels with cuts of around 0.3% coming on that front. Let's pull up Bank Nifty as well as the PSU Bank Index, and then we'll look at the sectoral picture very quickly. You have Bank Nifty, which is underperforming the benchmark indices as well. And if we can have the sectoral picture, PSU Bank Index, though pretty much on a flattish note as we speak. If you have to talk about the sectoral indices, real estate, interesting moves on that front. 0.6% higher. Metals is doing pretty well in trade, and that's on the back of the Chinese central bank, which has gone ahead and cut interest rates. The way this functions is it will help boost demand for industrial metals like steel, aluminium, and copper. And the increased activity in China will aid metal demand as well as prices. And that's the reason why you're seeing this kind of a move. In fact, for the last 5 trading sessions, the metal index itself is up around 2.5%. Energy also on a front footing. Consumer durables is another one. And oil and gas, which is on the borderline. What's losing out? Auto is down 1%. Consumption is down and under pressure. Media is interesting because the last couple of trading sessions, it was one of the front runners, though a small sector today is seeing profit booking today as well. And in terms of healthcare, that has been trading under pressure. Let's pull up the mid-cap and the small-cap index as well, and then we'll look at the Nifty 50 components. If you talk about the mid-cap index, there you go, 0.5% kind of cuts you're seeing in terms of mid-cap 150, and if you talk about small-cap 250 as well, that's pretty much on the borderline. So there is some bit of resilience coming in terms of the small-cap names in today's session. If we can have the heat map in terms of Nifty 50 as well, to understand the kind of stocks that are moving in trade today. There you go. Coal India, the top gainer today, followed by ONGC. Hindalco will be reporting numbers, so ahead of the numbers, that stock is seeing gains of 1%. Tata Steel, Dr. Reddy's, ITC. So your metal names are up only on the back of China rate cut. Eternal is interesting, 3.5% downtick coming in on Eternal, which is Zomato, and a Cipla, which is under pressure. But first, let's quickly address the flashes at the bottom of your screens. This is Gensol, which we are revisiting, where MCA sources are indicating to NDTV Profit that the Corporate Affairs Ministry is to complete Gensol case investigation in the next 3 to 4 months. That's the latest bit of information that we're picking up, where the ministry is going to take 3 to 4 months to look at the investigation. And the aim is to complete the investigation into Gensol Engineering. The investigation is regarding Blue Smart, which will be completed within the next 3 to 5 months as well. So you're talking about Blue Smart, which will be 3 to 5 months. And if enough evidence is found, MCA can move ahead without involving SFIO. That's interesting. If there is any conclusion to that investigation, they will be going ahead without involving the SFIO on this front. So that's with regards to Gensol. No point looking at the stock as well. You can just pull up the counter for the benefit of the viewers in terms of what's happened with the Gensol. Literally no movement on that front. It's locked 68.83 is where that stock is right now. But very quickly in terms of individual names, Pfizer on the back of earnings, 12% up move. Inox Green, New Gen, Zensar Tech, as well as BSF are the ones which are seeing some smart moves. Quest Corp is losing, and major concerns coming in after the fourth quarter numbers. Protein, again, on the back of the large order that they bidded for, has not gone to them, and that's the reason why second consecutive session of downtick coming in on this one. Cochin Shipyard is also interesting. After the kind of surge that we've seen in terms of defense companies, there is some bit of profit booking coming in terms of defense names as well. In fact, you should be watching India market close to understand the bull and bear case with regards to defense companies, which Anushi will get for us. DOMS as well as Bajaj Holdings also trading under pressure. So an interesting mix, Anushi, that we're picking up in terms of today's session so far.
Right, we've covered a bunch of earnings in focus. Another interesting earnings is something like an IRB Infra. Now, if we look at what has happened in their fourth quarter, they've reported a 4% of a revenue growth, but it's the profit which grew by 14% compared to the last quarter, and the toll revenue also saw about 17% of a jump. Now, the company does expect a lower double-digit growth in FY26 in their toll collection, but to talk to us about all the developments that are happening and the growth expectations for FY26, we are joined in by Anil Yadav, the Director, Investor Relations of the company. So firstly, welcome to the show, Mr. Yadav. I would like to start off with the Q4 numbers. Your assessment of the overall quarter, how have they shaped up? We are looking at a 4% of a revenue growth, but it's the margins wherein we are seeing higher expansion this quarter. So talk to us about these headline numbers.
Yeah, I think thanks for having me here. With respect to the Q4, we have witnessed healthy revenue growth. In fact, if you look at the full financial year, we have our revenue growth was around 23%, as against India's overall toll collection, which grew around 12.5%. So we have seen a robust growth as far as toll collection is concerned. And in terms of the quarter gone by, we have witnessed a 17% toll growth. And for next financial year, because in FY25, we started a couple of TOT projects where the toll collection was better than our estimate. And in FY26, we are not adding any new asset per se. With the existing asset, our revenue is expected to grow between 10 to 13%. We have witnessed 10% growth in the month of April. It's a like-to-like, so roughly 3.5% kind of tariff revision and plus the traffic growth. We have a couple of projects where tolling for one project, which is 4 to 6 laning project, there the tolling from 75%, it will become 100% and plus 3 years inflation. So there the tolling will increase, and plus Ganga Expressway project, we are expecting to start by second half of this financial year. So we are expecting growth on that count. So we expect around 10 to 13% kind of growth on toll revenue and similar kind of growth on the PAT as well.
So 10 to 13% is the growth that you're expecting in the toll revenue is what you're saying. Now this, if compared to, FY25, we've seen about a 23% of growth. Isn't this on the lower side that we are looking at this number, considering that in FY25, we did have a couple of setbacks also related to elections and other factors, muted orders. So just want to get your perspective on that.
I think in FY25, there was an impact of two projects which started from 1st of April 25 itself. So the base revenue didn't had those two projects. So that's why the growth is higher. Even the Hyderabad project also started during the financial year. So there was also impact of this three projects on the FY25 revenue. Now in FY20, those bases are already improved. From the improved base, we are expecting around 10 to 13% growth. Here, we are not factoring any new toll road addition in the current financial year. If we add more projects, then definitely growth will be much better what we are discussing today.
Okay, so that's the perspective that we are seeing in terms of where the toll revenue growth is concerned. Now, coming to your order book, just want to understand the overall picture in terms of the current order book, which is there roughly at the size of 30,000 crore is what we are looking at. What's the kind of execution that we are supposed to see for FY26? New order inflows also, if you can give a color on all these three aspects.
I think the order book is in excess of 30,000 crores and large portion of the order book is O&M order book. We expect out of this order book around 3,500 to 4,000 crores kind of execution in FY26. But if you look at IRB, the 85% value comes from the asset business. And if you look at IRB private InvIT, where we are planning to transfer the 3 assets to the public InvIT. And the EV, what we are transferring is around 8,500 crores and expected to realize equity value of roughly 4,800 to 5,000 crores. With 5,000 crores of equity realization, typically the BOT and TOT gets funded 70-30 debt equity. We can bag another project of roughly 15,000 with 5,000 crores kind of equity, which is getting released from the sale of their 3 assets. And there is enough pipeline available, I think almost 600 billion worth of TOT opportunity, that is 60,000 crores of TOT opportunity available for bidding. And there is almost 450 billion, approximately 45,000 crores of BOT pipeline is also there. As and when those projects will come for the bidding, we will be participating for those bids.
Right. Anil, good afternoon. This is Hiral on this side and happy to speak to you as well. Firstly, you mentioned about the bid pipeline with regards to BOT as well as the TOT, which is the toll operate transfer projects which are underway. Now, one aspect is the pipeline looks pretty strong, but the kind of competition which is coming in is also pretty intense. Taking that into consideration, what's the realistic picture that you see that could translate into an order book for your company?
Yeah, that's a very good question. And in terms of, as you rightly mentioned, we have seen intense competition in EPC and HAM. And you might have noticed that project is going 40-45% below NHAI TPC as well. And this is the project which is getting awarded on EPC and HAM. If you look at historically also, we are not bidding for EPC, very selective on HAM. And going forward also, we will be focusing on TOT and BOT. And if you look at the TOT and BOT which got awarded in last 2 to 3 years, we have not seen more than 3 to 4 players coming and bidding for the TOT and BOT. So I think there will be some competition in BOT and TOT, but not that intense competition which we see EPC and HAM, because BOT and TOT are capital intensive project, and where typically we are competing with the funds and not the EPC guys.
So tell me one thing, Anil, from historic performance, if you have a bid pipeline of say your 100% is 10,000 and the conversion rate is say 50%, currently taking competition into consideration, whatever the number be, what according to you are you baking in terms of conversions?
Yeah. So in terms of, if you look at our asset base, we have asset base of 80,000 crores. Our aim is to reach an asset base of 1,40,000 crores in next 3 years. So we are talking about roughly 15 to 20,000 crores kind of order accretion in terms of BOT and TOT.
Okay, Amit, you mentioned about, there being pressure with EPC and HAM projects wherein because of intense competition, there's a bit of pressure in terms of margins also. So taking all that in perspective, if you have to see a sustainable margin profile going forward for the business, what are the kind of margins that should be expected?
So I think as far as company is concerned, EPC is only complements the asset business. We don't do any kind of third party EPC. We are doing the EPC for IRB assets and EPC and O&M for the public and private InvIT as well. So considering that, I think we should be able to maintain the margin what we are reporting so far. And in terms of our market share for TOT, it's almost 33% market share for the TOT projects.
Okay, so that's in terms of the margins that we are looking at. Now, in terms of, you have talked about the strategy to monetize assets from private InvIT to public InvIT. Just want to get your overall perspective for FY26. What is the kind of outlook or strategy that you have in this? There's been an increasing focus towards this area that we have been seeing, right?
Yeah, so IRB has devised one policy which we coined as BEST, that is the best. B means build, execute, stabilize, and transfer. So we are bidding the project. We are executing those projects through a private InvIT. Once the asset is stabilized, we will transfer it to the public InvIT, and we will unlock the capital and again use that capital for the future bidding. For example, private InvIT is bidding with an equity IRR of 14 to 15% and transfer those assets to at 12.5% to the public InvIT. Again, use that capital for bid the future opportunity. So that is the stated objective and strategy for the company, and we are going to implement the same.
Okay. Anil, in terms of the CAPEX plan and the outlay that the government has in terms of FY26, the growth number that we've seen so far, do you see that incrementally flowing in, right now in terms of business, or are you seeing a disconnect there?
I think the government has a robust plan. If you look at last 1 decade, the large infrastructure spending was done by the government itself. And now the government wants to monetize those assets, and government pushes basically to do the most of the project on the PPP basis. So that will consist of BOT, TOT, and also certain strategic importance assets will be on a EPC and HAM. So I think if the award activity will start, I think there is a robust order book. But having said that, because of the last year was impacted, first half was impacted because of election. In the second half also there was lower activity as compared to the previous years. And if you look at, we are in this sector from last 3 decades. And historically also we have seen 1.5 years lull in terms of awarding, and thereafter the awarding activity again starts. So I think going forward, the kind of opportunity which government has showcased, I think there will be enough opportunity coming our way, and as and when the bidding will start, we will participate for the same.
So that's the outlook so far. But, Anil, the key over here is from an investor perspective that the stock has been seeing cuts of almost 25 to 30% in the last 1 year. Anything that you have in terms of investors as to where is the improvement going to come from, specifically taking into consideration the return ratios?
So I think if you look at with the existing business, as I was talking about, with the existing business, we will be growing 10 to 12% in terms of the bottom line is concerned. And if we'll back the more project, there will be further improvement in terms of the profitability is concerned. I think on price, if you look at the price, it was not largely driven by the business. I think overall sentiment in the market, especially small cap and mid cap, was impacted in last 6 months. So there, I don't foresee that people have a concern on the business. It's across the spectrum in the road sector, the award activity is low, and I think it's a temporary feature. And in long run, we will see the more project will be up for the bidding.
Right. Thank you, Anil, so much for speaking to us and the investors as well. Clearly, so that's interesting. The bidding pipeline seems to be strong. Profitability is expected to improve, and from here on, there could be improvement going ahead as well. So that's with regards to IRB Infra. But moving on, latest in the Gensol engineering scam that we were just alluding to as we started off the show, we understand from sources that the Corporate Affairs Ministry plans to finish the probe in the company and its 18 affiliated firms soon. Let's head across to my colleague Rishabh Bhatnagar for more. Rishabh, what's the kind of information that you're picking up with regards to the MCA, the timelines, and what is the end resolution out of this as per your sources?
Right. What I'm picking up is the fact that this investigation into Gensol Engineering and its various affiliated companies is broader than we initially expected. In the SEBI order, it only outlines about 6 companies. But what we're picking up from MCA sources, Ministry of Corporate Affairs sources, is the fact that the investigation involves around 18 companies, actually 19, which would include Gensol, plus 18 other companies. And what the MCA also wants is to complete this investigation, given that this entire incident is very hot right now. It's not too far in the past. So all sorts of evidence that the MCA aims to collect, they aim to do it within 3 to 5 months. That is the internal timeline that they've set for themselves with regards to this. What they've also said is that if enough evidence is found purely through their internal investigation, then there is no need to involve the SFIO or the Serious Fraud Investigation Offices, and the MCA can proceed unilaterally. Remember, this is the Jaggi brothers-led Gensol Engineering, which is under the scanner. It is being scanned by various regulatory bodies. It is SEBI has already barred the company. It is also facing an insolvency petition that was filed by one of the lenders that helped it loan a lot of these electric vehicles on which the Blue Smart's fleet was built. So this is what we're picking up from the Ministry of Corporate Affairs sources as far as Gensol Engineering is concerned.
Thank you for that update that we are seeing, Rishabh, for Gensol Engineering. But the next management and focus is Jupiter Wagons, which also reported its fourth quarter earnings yesterday. Now, what we saw was a revenue downtick about 6% or so. Margins at the levels of 14.6% as compared to 13.2%, and net profits are about a 1.8% of a downtick. In terms of where the order book is concerned, order book stands at 6,301 crore. But to discuss more on the FY26 outlook for the company, we are joined in by Vivek Lohia, the MD of Jupiter Group. Welcome to the show, Mr. Lohia. First off, the fourth quarter earnings. Now, we did see margin expansion at the face of it at the levels of 14.6%, but it's the revenue where we've seen a particularly downtick, but overall FY25, a 9% is the kind of growth that we are looking at. Talk to us about the fourth quarter as well as the year gone by.
So, thank you for inviting me. So, definitely, if you look at year on year, we have had a substantial growth in revenues. So, this year we have achieved 4,000 plus in terms of revenue. Fourth quarter, there was a supply issue from Indian Railways in terms of supply of wheel sets, for which we had a slight production delays. So we again in this first quarter itself also that challenge remained a little bit, but we expect the wheel set supplies to improve from next month. So this year we have set ourselves a target of about last year we produced about 8,000 wagons, and this year we have set ourselves a target to produce about 10,000 wagons. And given that if the wheel set supplies are consistent, we are very confident of achieving those numbers.
Right. Vivek, good afternoon. Hiral on this side. Vivek, you also, you did mention about the supply issues from railways. So one, railway wagons execution has been lower this time around at 2,375 wagons during the quarter as compared to Q4, as well as if you have to look at Q3 of FY25. Now, leaving this aside, if you have to look at the coming quarters, FY26, what is that number that you're looking at? Because from what I read, around 10,200 to 10,800 is the kind of range that you're anticipating. But do you think that is something which will be achievable, taking into consideration the challenges that keep coming in?
Definitely, in terms of a production capacity, we have built a very strong production capacity, and we are confident of achieving those numbers. On the private side, definitely about next year, the order books which we are going to be executing, about 50% of the order book is on the private side, where we have our own wheel production capacity and we are not depending upon Indian Railways. So we are very confident of achieving that. We have been told by the Indian Railways that post-June, the wheel supply position is going to improve and there will not be any challenges. So if that happens, we are very confident to make up in terms of the loss of production which we have suffered in the first 2 months. But that is the only caveat. Beyond that, we are pretty confident of achieving the targets which we have set ourselves.
Okay. So Vivek, what you're saying is that the brake and wheel set business will definitely double in terms of FY26, correct? From FY25. And if that is the case, what is the revenue contribution you're seeing from this business in FY26?
So on the wheel set business, we expect the revenues this year. We did a revenue of 300 crores, which we expect it to be 600 crore plus, and we are very confident on that. Further, we are undertaking a huge expansion in Orissa, where we are investing over 2,500 crores to build a complete integrated capacity to produce about 100,000 wheel sets, and that is going to be a future growth driver. Not only these wheel sets will be used for the Indian market for our captive consumption for the high speed business in India, but again, in Europe itself, we have a captive demand from our partners, Tata Vagonka, who are the biggest producers of railway wagons in Europe. So they require close to about 25 to 30,000 wheel sets for their own captive demand. So that is a project we are very, very gung-ho upon, and we see a definitely a demand in the market, because in India today there is a huge shortage in terms of capacity to produce axles and wheel sets, and India has been a major importer of these items.
So just a bit on the last part, you've said that India has been the largest importer in terms of where these wheel sets are concerned. So considering more of these capacity and production coming on stream, what is the kind of advantage that you see for Jupiter wagons going forward? And as far as where the Europe demand is concerned, do you see any bit of pressure in terms of order inquiries currently, seeing the global uncertainties that are there?
Definitely, see, if you look at in the global market itself, there is a glut in terms of wheel sets availability, and especially in Europe. So we don't see any challenge, because the railway business, if you see globally, is expanding, and there is investment not only in India but in other markets also in this business. So we definitely see a huge opportunity in this particular segment. And in India itself, today, when we talk about wagon production, the biggest challenge which comes not only to us but to the entire industry is the availability of wheel sets. So I think once there is a local production, you get rid of a lot of this uncertainty. And when it even comes to the cost advantages, if you look at a typical wagon, about close to 30% of the cost is in form of wheel sets which go into a wagon. So for us, that itself is a huge backward integration which we achieve, and that will also result in not only in availability but in overall expansion of margins for us.
Well, just moving forward to this, Odisha expansion is an important one for the business, with the target being of around 1 lakh of production. Just want to understand, in terms of revenue, what's the kind of overall picture that you see in terms of the incremental revenue growth? I think the projection is around 3,000 crore of an odd. So from which year onwards do you expect this number to be on stream for the business, considering that FY25 you've clocked in about revenues of 3,963 crore. So it's almost double of what we are looking at in terms of where this segment is concerned.
So definitely the revenues I think will incrementally keep on going year on year, and by FY28 we expect the entire 3,000 crore of revenue to get translated. But next year our axle line, by middle of next year, our axle line becomes on stream. So that will definitely add to revenues, and by 27 is when we expect the wheel line to become on stream. So by FY28, the entire revenue will get captured, but obviously you will have an incremental growth in revenue year on year.
Right. Vivek, another aspect that you've mentioned is where you're anticipating a major tender coming in from the Indian Railways in the second half of FY26. So what is the size that you're anticipating? That's one part. And number two, just to understand that yes, the capability for a Jupiter wagons is there in terms of capacities, but a lot of times because of external factors, unavailability of some parts, you miss the guidance or you miss your own production target as well, right? So if you have to look at FY26 then, what is the kind of risk you're sitting on? Because again, we're looking at 10,000 wagons for FY26. So what are you building in? Two-part question.
So, again, in terms of, as you rightly said, that the only challenge which we see right now is in terms of the wheel sets. Otherwise, we don't see any challenges in terms of executing the order book. And that is something today, unfortunately, it is not in our control, and we have to depend on supplies by Indian Railways on that. But otherwise, we are pretty confident of achieving the targets. In terms of the wagon orders, definitely, again, to give any kind of number in terms of the quantity, it's very difficult. But if you look at the kind of expansion which railway is doing in terms of the infrastructure when it comes to freight logistics and their numbers, so it could be anything between 40 to 60,000 wagon tender which could be there.
Okay, and Vivek, my final question to you is also just a quick bit on the electric mobility side of the business that we are seeing. Now, you've discussed about launching the first commercial EV GEM TAs as well, and the annual production capacity being of 8,000 vehicles. Just want a quick update on this one. How are the order inquiries shaping up for this one?
So again, this business has two parts. One is the vehicle business and one is the battery business. The vehicle deliveries we have just commenced this month, and the market response has been very positive for us. So we expect by the second quarter to achieve a target of about 100 vehicles every month. And this year we have targeted to sell about 1,000 vehicles, and we are very confident of achieving those numbers. On the battery side, again, I think that is a business which we are very, very confident about. Especially, we are targeting the battery energy storage segment, which we are seeing considerable order books coming our way. And if you look at the demand by 2030, it is projected that India would require about close to 5 gigawatts of battery storage. With the kind of the investments which are happening on the solar side. And today, most of these battery storage units are being imported out of China. So there is a huge scope there, and we are seeing the demand also coming in. Besides that, today we are working with other sectors also. For Vande Bharat, we have a huge order book. From Siemens and from other players.
Right.
We have got now a huge order book from Brokerage for their forklift segment. And plus, we are now getting order books from other segments on the battery side. So there we are going to see a huge expansion.
So I think,
in terms of our revenues.
Right. So Vivek, I think from what you're saying as well, I think any downfall or downtick that we could see on the back of wagons will probably be met by your other segments as well, and I think that's going to be the strategy we should be watching out for. But completely out of time, we will touch base again to discuss the other businesses in detail soon. Thank you so much for joining us on the show and sharing the views you have. So that's the management of Jupiter Wagons. Trading under pressure right now, 4% downtick is what you're seeing, but key is in terms of what the future looks like. Let's quickly slip into a short break. We have lots more lined up on the other side. Please stay tuned to NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Markets at day's low. Nifty loses 200 points from day's high to trade near 24,800 mark. Sensex above 81,500. All sectors barring realty and metal in the red.
Quest Corp under pressure after reporting a net loss of 95 crore rupees in fourth quarter, led by additional expenses caused by its demerger. Margins come in below the guidance of 5%.
Protein eGov tumbles almost 9% but recovers over 5% from the day's low. And this is after some brokerages downgraded the company on the announcement that it has lost the PAN 2.0 government project.
IDFC First Bank in talks to allay investor concerns over Warburg Pincus board seat, begins conversations with domestic investors.
Pfizer gains close to 12% after Q4 profit jumps by 85% while revenue climbs over 8%. The margins expand to 38%.
The COVID scare appears to be making a comeback, with India logging 164 fresh cases since May 12. India currently has 257 active cases, with Kerala, Maharashtra and Tamil Nadu leading the number tally. Hello and welcome back. You're watching Profit Buzzers. One stock in focus today is DLF, and this is after it reported its fourth quarter earnings yesterday. It's a particularly interesting set of numbers that we are looking at in terms of what has happened in performance. FY25 pre-sales, if you are looking at for a beat, this was led by the Dahlias project launch, which happened in the third quarter. They've reported a strong fourth quarter pre-sales and collection growth as well. In fact, if you talk about the key operational trends, they've reported a 39% of a jump in their pre-sales number to 2,035 crore, while collections saw about a 51% of a growth this quarter. In terms of where the FY25 metrics are concerned, pre-sales were up around 44,000 crore at the mark of 21,223 crore, which is higher than the stated guidance of 17,000 crore. Do note that the company had already achieved its FY25 pre-sales guidance by the 9-month period itself. If you look at collections, that were up over 36%, which also resulted in the overall operating cash flow improvement that we are seeing. Cash surplus saw about a 128% of an increase to 6,221 crore. But quickly, walking through the main headline numbers as well, they had reported a 46.5% of a jump in their revenues. Margins came at 31% as compared to 35.4%, and net profit saw about a 39% of a growth. So it's overall a healthy sort of numbers that we are looking at. The company does expect to launch about 15% of their overall pipeline in this year as well. So DLF in focus on the back of results. In fact, let's see how the stock is doing currently. If you are looking at DLF, it's up over 3% in trade today. But let's discuss this with our guest who is joining us, Raghavendra Kedia, founder at Prosperity Advisors, along with Gaurav Sharma, Associate Vice President and Head of Research at Globe Capital. Firstly, I'll take this question up with Raghavendra. Raghavendra, want to understand your outlook on DLF. What's the picture that you're building in for real estate companies going forward?
Good afternoon. Broadly, we are upbeat with the commentary and the earnings of DLF. And what they have done is the earnings reporting for this Q4 has been best among its entire peers. And in spite of this slight run up in price today, the stock is still, in terms of valuation, cheaper to its peers if you compare it with Godrej Properties, Macrotech, or Prestige Estates, which are also present in the larger cap metro cities of India, DLF being majorly in the NCR region. So on valuation, there is a catch-up play in DLF, which is highly possible. Earnings, you see this stellar performance where the sales have gone up by 40% YOY basis. The profits have gone up by more than 35%. So that's excellent numbers. And we believe that for a 1 year horizon, there seems to be at least a 20% upside even from current levels and a price target of around 920 on DLF. The big will get bigger and the earnings actually would attract more investors into this entire space. And DLF being a flagship poster boy company for this NCR region in terms of listed peers of real estate sector, we believe that the bullish undercurrent in DLF would continue.
Okay, so that's the fundamental view that we are seeing for DLF. But Gaurav, let me take this across to you as well. What's your outlook in terms of where DLF is concerned, how that is looking on the charts?
Yes, good afternoon. DLF is very well placed on its short as well as long-term charts. Yesterday, the numbers came in. You have already stated the figures. They are quite impressive figures. The pre-sales numbers, the bookings, from every front, the stock has surprised. Today, what we are seeing is a broader outcome of those stellar numbers as the stock came in. The stock moved up substantially today, currently trading 3% higher on back of good sound volumes. What we see on charts is that the recent up move is likely to continue. If we can take a 2 to 3 months time view, then the stock is likely to head towards 850 levels in that time frame. Any dips from here on should be considered as a good buying opportunity.
Right, so that's with regards to DLF. Any dips can be used as a buying opportunity to come in there. Let's quickly pull up a Zydus Life as well. In terms of the profit number, 1171 is what the company has reported. That's below what the street was estimating as well. The revenues as well, that is an interesting number. The expectation was around 6,444 odd crores. If you see the number that has come in so far, that also is slightly above. Revenue at 6,528 odd crores, an uptick of around 18% coming in there. EBITDA has seen a growth of around 30% and the margins have seen a substantial improvement as well. It's the profit number which is below what the street was anticipating, and that's the reason why you're seeing that marginal cut that did come in as soon as the numbers were announced, but some recovery that's happening in terms of the stock. Very quickly, overall, Raghvendra, what is your view with regards to Zydus Life?
Well, the company has reduced its debt. The cash flow metrics looks good. So we are upbeat on Zydus Life Science at current levels, and we believe that a slow and steady march would continue. It is significantly cheaper versus its listed peers in terms of P multiples. So I think on valuation metrics, it looks attractive at current levels.
Okay, so that's with regards to Zydus Life. But let's quickly pull up a Quest Corp on the screen and see what the counter is doing in trade, because optically the fourth quarter did look strong, but the stock has been trading under pressure with around cuts of 9 to 10% coming in there. Now, what's not working? Couple of things. The company has reported a loss in the fourth quarter, and this is on the back of an exceptional number that has been led by additional expenses that have been caused by the demerger. Now, the three-way demerger is citing executional risks, and that's what the street is not happy about. Two, the revenue growth is something that the company is not able to maintain. We've seen a sequential decline that has come in there, and that's because the IT sector, which is almost 65% of their revenues, is under pressure. There is hiring slowdown, as well as you're seeing a lot of furloughs. The micro lending challenges in the MFI segment is what is putting pressure on the BFSI space as well. So these are the two segments that have been ruling under pressure. The company had guided for a 5% margin trajectory in the fourth quarter of FY25, but they have not been able to meet this. And the food business, which is also a high margin business, has underperformed. If you talk about Q1 FY26, the anticipation is that the revenue and the profitability could remain under pressure. And the collections from the clients is coming in as a concern, because they've seen an impairment charge of 120 odd crores in terms of the trade receivables. And if you talk about their short-term liquidity, that seems to be deteriorating as well, taking into consideration that the cash and the cash equivalent is at a 6-quarter low. So these are the factors which is actually not in favor of Quess Corp, and that's what you're seeing in terms of the stock price performance. Raghavendra, your view in terms of a Quess Corp, what would you advise an investor who's holding a Quess Corp to do? One, and two, do you think it's still a long-term bet, taking into consideration all the concerns that you're already talking about?
Yes and yes to both your questions.
Okay.
So we believe that we rather would see the silver linings in Quess Corp at current levels. Well, whatever the losses have been reported in this quarter, they are specifically one-off and very specific to this quarter. The most of it being the impairment charge and the demerger charges. So once this demerger is over, I think the dust will settle, the concerns will pacify, and the company has, in terms of EBITDA, the growth has been very good in terms of a YOY basis. Let us not compare specifically with Q3 or Q2, but on a Q4 of last quarter, the company has done well. In terms of the margins, we see 1.9% growth versus 1.5. So that's again positive. So we believe the large view should be bullish, continue to hold, and it's a stock where you can actually keep it in your long-term investment portfolio. 20% upside on an annual basis is possible. The commentary is very impressive. If you go through the investor presentation, they have plans to expand in Middle East, in Asia Pacific, and become a global hiring player. So the aspirations are good, and the company has walked the talk previously. So we believe with their expansion plans, Quess Corp should do well in the quarters ahead. So this particular quarter, we would actually take in terms of a one-off, and we believe that this correction is a entry and a buying opportunity for a long-term holding and investment buy.
That's an interesting take, Raghavendra. A 20% upside, and this is a stock to be a portfolio stock. That's an interesting one. Gaurav, what are charts indicating? Are you seeing short-term pressure and a long-term gain on this one?
Yes, actually, this today is a move, nearly a 10% cut is the outcome of its numbers. That has missed the estimates of the 5% figure, came in around 3%. So, it is little difficult now to actually see it from a very short-term perspective. We do have to take a little medium-term view on this stock, and from that perspective, yes, one can start accumulating the stock. What charts are suggesting is that till the point the stock is holding above 320 odd levels, it is in a good sweet space. Currently quoting around 340, so accumulation is what I am suggesting. One should hold on to the stock.
So hold is what we are seeing for Quess Corp. But another stock in focus for a second straight day is something like a protein eGov, and this is after it was not shortlisted by tax department for PAN 2.0 project. Now the stock did open at 52-week low, eventually saw a bit of recovery, but is still trading down with cuts of around 9%. Puneet joins in with more details on this.
Well, thank you for that. So definitely, as you rightly mentioned, the news flow came in yesterday for Protein that it has disclosed that it's no longer in contention as well for the Government of India's PAN 2.0 project. Now, while the project has not been finalized, the surprise factor was that it's not even in the contention to apply for this particular project and be one of the bidders as well. So that was one of the key negatives yesterday. The other aspect is that government had plans for a 1,440 crore project to overhaul the PAN 2.0. The other key aspect is that what Equirus had mentioned yesterday, they've said that this would be a material negative as PAN services contribute 50% of the company's current revenues. They've also estimated that FY26 will be muted, and they expect roughly more than a 50% collapse in revenue stream going forward over the next 2 to 3 years because of this material negative, and that's one of the key aspects. 35% decline is also expected in FY27, and while the company did mention they are looking to look at at other orders in the company's conference call, it didn't give much confidence to its investors. So that's one of the key negatives for Protean. I think over the next couple of quarters, the management will have to highlight a few strategies to gain back revenue either from newer stream or existing ones. But currently, down 20% yesterday, down almost 8.5% now, and definitely at 52-week lows. Valuations, while corrected, it's still not a value buy, so as to say. So watch out for this one going forward as well.
Okay, thank you for that, Puneet. What's interesting over here is the expectation of almost seeing a 35% of a decline in the FY27 revenue and a 75 to 100% of collapse in revenue over the next 2 to 3 years. As Puneet talked about the strategy that the business has to come out with to, get that investor confidence back in check. Protean ego will continue to face pressure. But let me take this across to Raghavendra. Raghavendra, what is your view in terms of this big project where it's not even under contention anymore for Protean ego?
So in terms of price correction, we avoid catching a falling knife. So we would stay away from Protean ego in spite of this around 27-28% price fall in the last 2 days, including today. So we would actually have a wait and watch approach. It's a company which has gotten most of its orders from Government of India, like an IT department or a registration property department. And if a similar client has not given an order in terms of this PAN card advancement technology, it's a concern. So the management of Protean has reached out to IT department in terms of understanding the rejection of their bid. But still, we would wait. The company's sales growth has not been so fabulous in the last few quarters also. So that is just added on to the concern. So at least for the next 1 or 2 quarters, we would watch very specifically on the sales growth of Protean ego. And we believe that this price correction might continue, taking the stock down to its 3-digit levels, around 950 levels, where it might seem little attractive or better. But again, we will review at levels of around 900, 950. Until then, it's an avoid and wait and watch.
Avoid is what we are seeing for Protean ego from the fundamental side. But Raghavendra, I want to understand your view as well. Do you see further downside for this? Gaurav,
Further downside?
Yeah.
Yeah,
Gaurav, coming to you on Protean ego. Yeah.
I completely agree with Raghavendra that there is no point catching a falling knife. A 35% cut is what we are expecting in its revenue in the next 2 years. So even the long-term perspective, long-term business of this company has been directly impacted, as it drives most of its revenue from the government sector and income tax department, not making it a part of a 1440 crore or project. So this is a big hit. We do not see a bounce coming in the near term. We are suggesting our clients to utilize this intraday move that it is currently not in circuit to actually exit the position.
Right, so that's with regards to Protean ego. But moving on, Pfizer and NLC, both of these stocks are in focus on the back of earnings. Varsha, what has worked for a Pfizer, and if you have to look at NLC as well, what is working for them, though NLC is coming off its highs right now?
Yeah, and thank you for that. So let me start with Pfizer because stock was up almost 10% in trade today. Now, if you see for the numbers for Pfizer, if you see EBITDA, so revenue grew only 8%, but EBITDA grew 20% and margins were 38% versus 35% last year. Now, lower other expenses drove this EBITDA for the company, and the net profit impact that you're seeing, because net profit was up 85%. This was led by higher other income and lower tax, and also lower interest costs aided net profit as well. Now, there's a deal between Pfizer US and Chinese biopharmaceutical deal. Will that have an impact on Pfizer India? So the answer is no, because if you see the export for FY24 stand at around mere 4%. There was no related party transaction by company with Pfizer US. And since this is a licensing agreement, Pfizer US will be selling the product in China only. Next on the list is NLC. Now, if you see overall, they've achieved all-time highest ever coal production, which is up 36% year on year. They've also achieved lignite production of 240 lakh ton, which is almost 2%, which has 2% growth year on year. The net profit impact that you're seeing, this was led by higher other income and lower other expenses actually aided their EBITDA margin, which was at 23% versus 17% last year.
Okay, thank you for that. Very quickly, Raghavendra, your preferred pick between a Pfizer and a NLC. I know both are not related, but where would your bets be?
Hiral, we would prefer Pfizer.
I think we have a network issue with Raghavendra. Gaurav, which charts are indicating strength further?
See, from a charts perspective, both of them are very much different from each other. On the one hand, we have Pfizer, which is, have started its recovery. Today, only it gained more than 10%. So yes, it is a start of a fresh up move. Yes, we suggest to buy the stock, but considering the kind of 10% odd move seen today, it is I would recommend our short-term traders to wait for some time, wait for some profit taking, let the prices soften up, and then look for it. Now, when we look at NLC's chart, it is consolidating at its higher levels. So it is also a good bet at current levels. So if someone is willing to buy today or maybe in just 1-2 days, so I would recommend one should take a position in NLC at the moment, as the stop loss is also placed nearby around 225, and one should expect targets close to 280 to 90 levels in the coming 1 to 2 months.
So that's with regards to NLC as well as Pfizer. Raghavendra, I want to talk to you about metals as a space. With China going ahead and cutting interest rates, clearly metals as a sector becomes a key beneficiary. Taking into consideration 2.5% kind of a run-up in the last 5 days that we've already seen with regards to the metal sector, any top picks or your view that this would be a time to enter the metal space?
Yes, I think the China stimulus would continue, and actually that would keep the metal space in bullish undercurrent. So on the large cap metal space, we have Jindal Steel and Power as our top pick. And again, from the metal and mining space, Sandur Manganese would be your second pick from the mid cap, small cap space. So JSPL, Jindal Steel and Power at 970 and Sandur Manganese at around 520 levels. These two stocks will be your picks from the metal pack, riding on the China stimulus story.
Okay, well, that's the clear picks in the metal space. Thank you, Raghavendra. Thank you, Gaurav, for joining us today and sharing your perspective on various of these stocks that we've discussed. But that's all the time that we had on this show. Stay tuned to NDTV Profit for more updates and other stuff lined up on the other side.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve.
Hello and welcome. You're watching Top Trades on NDTV Profit with me, Somit Sarkar, and my co-anchor Varsha. Well, Varsha, if you look at the benchmark, it's down over 160 points. Nifty Auto and FMCG are the top sectoral losers, while on the gaining side, it's IT, metal, but not much of a gain here.
Yes, absolutely. But let's see, the Nifty 50 that, as Somit was saying, is down almost 0.65%. Let's see who are the contributors. When it comes to losers on the benchmark index, you have Eternal, you have Shriram Finance, you have Supply and Hero Moto, who are losing when it comes to Nifty 50. Even you have HDFC Bank, RIL, ICICI Bank as well. On the gainer side, though, you have Coal India, you have Bharat Electronics, Tata Steel, Infi. On the gainer side when it comes to Nifty 50. But let's pull up sectorial heat map and let's see what's happening there, because I think none of the sectors actually are in green today. Everything is under pressure. You have Nifty Auto down almost 1.2%, Nifty Bank down 0.7%, Nifty IT is kind of flat, and Nifty FMCG is down 0.81%. Let's see what broader markets are doing. Let's pull up Nifty Mid Cap 150. Let's see what that counter is doing. Again, under pressure, 0.67% down. Let's see who are the losers when it comes to Nifty Mid Cap 150. You have Cochin Shipyard, you have Coromandel International, Imami, RVNL under pressure when it comes to Mid Cap 150. Though on the gainer side, you have NLC. Which was actually gaining an hour ago. There you go. It's 3% up on the back of earnings. You have MRPL, Greenwell, Norton, Lloyds Metals on the gaining side. Let's pull up Nifty Small Cap 250. Let's see what that is doing. Again, under pressure, of course. But on the losers side, though, you have Quest Corp, Cochin Shipyard, DOMS Industries, HEG as well. Yesterday, the stock was up almost 10%. But today, it's under pressure. On the gainer side, though, you have GMM Pfaudler, Gensar Tech, CCL Products, Jubilant Pharma, and Raymond when it comes to, on the gaining side, when it comes to, small cap 250. So overall, Somit, some counters are buzzing on the back of earnings, but overall, the market is actually under pressure.
Well, let's also welcome in our guest for the show, Sneha Poddar, the Vice President with Motilal Oswal. Sneha, how are you looking at the markets at the current juncture? For the last couple of sessions, we were completely range bound, no actions, and today we are down around 160 odd points.
Okay, very good afternoon. So basically what we believe is that post the sharp run up that we saw last week, about 4 to 5%. So the market is bound to consolidate at these levels. Even valuation wise, the market is looking a little fairly valued with the numbers. Overall, Nifty growth, if we talk about, it is roughly around just 4 to 5%. So we need to keep that in mind. The positive part is that things are settling on the trade war front globally, and with Mr. Piyush Goyal in US, probably the hopes are there that the bilateral trade deal may happen between India and US. But then till that time, probably the market will consolidate, especially post, like as I said, the market has already given a sharp up move. So one will wait and watch and then take a next call.
Right, thank you for that view, Sneha. Well, let's pull up Sun Pharma and let's see what that counter is doing in trade today. It's down 0.3%, but Macquarie is positive, has given outperform rating when it comes to Sun Pharma. Now, because due to strategic benefits that the company will see and the potential value accretion from its acquisition of Checkpoint Therapeutics. Now here's a breakdown of their reasoning. What they're saying is, despite Sun Pharma's bid being higher, that is almost 2x than as compared to other serious buyers, Macquarie believes that the acquisition will still add value to Sun Pharma's portfolio. They view Unloxicide, which is a Checkpoint's lead asset, which is a FDA-approved medicine, which is which treats skin cancer. So Macquarie believes that this is a strong strategic fit for Sun Pharma, and this addresses a crucial gap in Sun Pharma's dermatology and oncology portfolio. It aligns with Sun Pharma's focus when it comes to Medicare channel, and it sees a significant NPV potential. So what they've estimated a base net present value of over $500 million for Unloxit alone, with a bull case of NPV, that is net present value, exceeding $1.5 billion US, suggesting basically a substantial future revenue potential. Now, Macquarie has increased its earning estimates for FY 25, 26 and 27 by 1%, 3% and 3% respectively to incorporate the anticipated sales of Unloxit and updated foreign exchange rates. Now, Macquarie also identifies several potential positive catalysts when it comes to Sun Pharma, including the closing of the Checkpoint acquisition, which is the main reason, and strong Q4 FY25 results is expected on 22nd, and the launch of specialty portfolio products. So basically, what they're saying is Checkpoint and the specialty portfolio will actually aid growth when it comes to Sun Pharma. But Sneha, I wanted to have your view on Sun Pharma, because now every company has a second leg of growth. Now for Sun Pharma, it is their specialty portfolio which will actually aid margins or aid revenue for the company. But your view on the same?
Yeah, so even we are quite positive on Sun Pharma and on this acquisition, because we believe that this will further strengthen its specialty offerings, which is a key growth driver for the company. What we believe is that this will actually open the door for $1 billion kind of sales potential over the next 5 to 7 years, because their key product, which is Uncoloxid, that is FDA approved product, and it has got a huge potential. This will actually help the company enhance its presence in onco dermatology portfolio. So given all these, though we haven't factored this into our numbers, but we are quite positive that this will be EPS accretive for the company. And given the decent valuations, Sun Pharma really looks good for the from next 1 year perspective, and we have a target price of 2,000.
Right. Another stock that remains in focus is Quess Corp, and it dropped nearly 10% in trade after the fourth quarter numbers. Let's get in Puneet with more details on what led to this fall when it comes to Quess Corp.
Well, thank you for that. So definitely it's been a disappointing set of numbers for Quess Corp. While the margins have just remained between 1.8 to 2% for EBITDA specifically, we've had a 150 crore impact, which is a one-time exceptional item that's negatively impacting the company's profits. Now, they have mentioned specifically that 120 crores of that is a trade receivable. Essentially, they've given the service to the client but not received the payment, and that has been given as an exceptional item impact in this particular time frame. The other key aspect is that the three-way demerger also cites certain kind of execution risks in this particular time frame. Now, we also had the company's conference call actually is scheduled today. They did mention that the weakness actually led by ramp down in one of the NBFC accounts, but 38,000 people, essentially that's the head count, and that, while a client specific, they try to highlight it as a structure, that it's not a structural issue but a client specific issue. But the key aspect and one more thing to note is that the RBI has come out with regulations for the NDFCs and as mentioned to insource some of the key functions of collections as well, and that will impact further business for the company. The other key aspect is 65% of the company's revenues comes from the IT vertical, and headcounts additions over the last 4 quarters have been very minimal, at least for the top 5 names, and we've spoken to many in this particular quarterly results, and a similar notion has been echoed by almost all players. So that's one of the key aspects. They've also, one final thing I wanted to highlight is they've said that the NBFC account will have a 7% impact in terms of revenue and a 4% impact on margins overall for the next year. So that's another key negative. So overall, a multitude of factors that are not working for the company. Essentially, the hiring in banking as well as IT will be one of the key things to watch out for, as well as the three-way demerger and the smoothness with which they can increase the general staffing, which is the higher margin business for the company. These 3 things will be something to watch out for going forward.
Right, thank you Puneet for that. Sneha, coming to you on Questcorp, what would be the next trigger as per you? Would it be the pickup in business or would it be the demerger?
Okay, what we believe is that the pickup in the business will actually help the company. So company sounded a little confident that the other sectors will help it to offset the impact of this ramp down. And though there's a near-term impact because of this, but then the company remains fully committed from the long-term point of view. So the full year guidance which they have given is pretty optimistic, and moreover, it's focus on the GCC segment and the high margin niche businesses will also help it to actually ramp up. So the high margin segment is expected to grow anywhere between 20 to 40%, which will more than offset the ramp down impact. And if you look at on the positive side, the margins cross the 9% mark on a sustainable basis. So even that is another angle which we are finding it positive. So near term, the stock might remain under pressure, but there's a lot of potential from the long term point of view.
Right. Thank you so much, Sneha, for that. One stock that I want to, discuss about is Zydus Life Science. Let's pull up that counter. It's down almost 2.5% in trade today, and this is on the back of numbers. Let's see what numbers are. If you see, there was decent growth in sales, but the net profit impact that you're seeing is due to lower other income and higher finance cost. So finance cost was 34 crore last year, which has jumped up to 76 crore. One thing is that, and there's an exceptional item also of almost 219 crore that has also impacted their net profit. But overall, and if I were to talk about their geographical or business-wise sales performance, if you see, formulations were up almost 1.6% only, while if you see API business, API was down 24%, and internal formulation was also down 2.7%. So overall, a weak set of numbers, Somit. What is your say on that?
If you look at the US business, that has also jumped nearly 30% sequentially, but I guess that would be because of Revlimid, right? Yeah. But then Revlimid is a product that is coming out of patent and sales could get impacted. Also, there was a forex gain of around 70 odd crore, of which 50 crore has been adjusted on the EBITDA front. So that is also something that has also led to a beat. Sneha, how are you looking at Zydus Life numbers?
Okay, even we are not really positive from the short-term point of view. I mean, long-term, we believe that the company has set strategy to build global presence in cardiology, nephrology, and orthopedics. But from the short-term perspective, we believe that there's a lot of competitive pressure, and the impact of it is visible in the quarterly numbers as well. So the company is making efforts to strengthen its overall presence in biosimilars and generics, but that will take time. So from the near to medium term perspective, we are a little neutral on the stock.
Right. Another stock that remains in focus is Zinca Logistics. Now, the stock might be up in trade today, but important thing that we have to note here is the fact that the company's 56% of the shareholding will be coming out of the lock-in period. Now, today is the last day. From tomorrow, it will be coming out from the lock-in period. And this is the 6-month post-listing lock-in period, which is getting removed for non-promoters and pre-IPO investors. So this 56% of the shareholding represents nearly 4,600 crore of the market capitalization, which is nearly 4 times the IPO issue price of Zinca Logistics. Now, how have the share prices moved of the company? Now, if you look at the IPO price, it was 273. The listing day closing price was 260. All-time high was 551 rupees, while the current market price is close to 470 rupees. Now, if you compare it with the all-time high, then we are down around 16%. But when we compare it with the IPO price, the share prices of Zinca Logistics have jumped more than 70%. Now, who are those investors who can go ahead and sell their shares once the lock-in gets removed? Most likely, it is the foreign investors that could go ahead and sell, given the fact that they're sitting on handsome gains here. For example, if you look at Accel, which owns around 13.5% stake in the company, their average cost of acquisition of the shares were at 67 rupees. And if you compare it with the current market price, then they're sitting on gains of nearly 7 times. Quick Routes, they own 9% stake. Average cost of acquisition is 52. They are sitting on gains of more than 9 times. IFC and Sands Capital are sitting on gains of anywhere between 2.5 to 3.5 times. Sequoia is sitting on gains of 50%. B Capital is sitting on gains of 8.4%. Ethan Creek is sitting on gains of 5.5%, and only one investor, that is Stripe Capital, which invested in the last round of fundraising, they are sitting on a loss of just 4%. Now, of these 8 investors that we have just listed, 5 of them also sold partial stake in the IPO process, and they were Quick Routes, Accel, Sands Capital, IFC, and Sequoia. So there is a probability that these investors or the other investors could go ahead and sell, who are at least sitting on some handsome gains on Zinca Logistics. Now, of this total, around 6.9% of the promoter holding is also coming out of the lock-in period. Now, how are analysts looking at Zinca Logistics at this moment? Now, there are 6 analysts tracking the company, of which 4 of them have a buy rating, while 2 of them have a hold rating. The highest target price on the street is by ICICI Securities of 650 rupees, while the lowest target price on the street is by Axis Capital of close to 474 rupees. The consensus target price stands at around 553 rupees, which suggests a return potential of around 17-18% around from the current level as well. So that's more about where it comes to Zinca Logistics. Sneha, have you looked into this counter Zinca Logistics? Obviously, the prospects for logistics sector or the third-party logistics sector is quite strong. But do you think that this IPO lock-in coming out will remain as an overhang now on the share price?
I do not have a view on this stock.
Right, okay.
Well, Soumit, the other 2 stocks that will be in focus or that are in focus is Pfizer. Let's see what that counter is doing in trade today. The stock was up almost 10%. There you go, it's 12% up. Now let's see, if you see the Pfizer is buzzing, one reason is on the back of numbers, good Q4 numbers. So revenue was up only 8%, but if you see EBITDA was up 20%. Margins were at 38% versus 34%. Now the lower other expenses have actually aided EBITDA for the company, and the net profit impact that you're seeing, so net profit is up almost 85%. That impact is led by higher other income and lower tax, and lower interest costs have also aided net profit for the company. Now there was this news in the morning between Pfizer US. So Pfizer US and Chinese biopharmaceutical there has been deal between a Chinese biopharmaceutical company and Pfizer. Will that have an impact on India Pfizer? The answer is no, because export for FY24 stand at around 4%, and there was no related party transaction by Pfizer India with their US business. And since this is a licensing agreement between Pfizer US and China, Pfizer US will be selling that product in China. So basically Pfizer is buzzing on the back of earnings. The other stock which is in focus is Eris Life. Now overall, if you see, there was a marginal slip in the execution, particularly in their insulin business, in their insulin revenue, but the profit impact that you're seeing, so because net revenue is up 28% and net profit is up 32%, so there has been profit impact also due to depreciation and higher interest costs, and the EBITDA margin expansion that you're seeing operating. So margins were at 36% versus 27% last year. This is led by operating leverage that the company has seen, and higher tax have also impacted net profit, because if your EBITDA is up 70% but your net profit is up only 32% because of higher depreciation, interest costs, and also higher tax. But Sneha, out of two, Eris Life and Pfizer, what are your picks? And if you have any view on that.
Yeah, we do not cover Pfizer, but Pfizer after a long time has posted a good set of numbers. So that could be a turnaround for the company. While talking about Eris, we are not really very positive. What we believe is that though the company is launching various new products and recently took a price hike as well, and it's making efforts to build its overall GLP-1 franchise through API sourcing and expanding its presence in the SGLT2 space as well. But the earnings are likely to be a little volatile in the near term, given the overall weak state of biologic sales. So that could continue to put pressure on the company's numbers for the next few quarters. So from the near to medium term perspective, we are a little neutral on the stock. Though from the long term perspective, we believe that the company has a lot of potential, but it will take time to yield results. So probably any investor holding the stock from 2 to 3 years perspective can continue to hold, but in the near term, even the valuations doesn't really support the stock.
Right. Another couple of stocks that remain in focus are DLF and BL. DLF is buzzing after reporting a strong Q4 numbers, while BL also buzzing on strong Q4 numbers, plus the strong commentary that has come in from the conference call. Let's get in Anushi with all the details on both the stocks.
Right, I'll start off with BL first. Now, what we are seeing is an interesting terms of guidance for Bharat Electronics, wherein the expectation now is for a 15% of a revenue growth. Margins are expected at 27%. Do note that for FY25, the management had guided for a guidance of 22 to 25%, which they had exceeded, even in terms of where the revenues were. While revenues were in line, it's something that FY25 we should look forward to, because this is in line with their view of a 15 to 17% of a growth that they target over the next 5 years. It's the order inflows which is particularly interesting for the year. Now the target is about 57,000 crore of order inflows as compared to a guidance of 25,000 crore of order inflows last year. Now this 57,000 crore of order inflows would include a large ticket size order of 30,000 crore. This is for QR SAM, that's a quick reaction surface to air missile that we are looking at. Along with that, a couple of big orders for next generation corvettes as well that they expect to receive from the shipbuilding companies. So that is the kind of order size that we are looking at. In terms of where the capex is, they are expecting about 1,000 crore of a capex, and defense to non-defense mix is expected to be 90 to 10%. The company did say that they want to focus on higher non-defense side of the business also going forward as well. Even in terms of where the exports are concerned, exports about $120 million is the target that they've said. They're expecting about a 15% of growth from last year, and eventually want to see this number moving higher to 20% as well going forward. Overall, it was a strong set of numbers that we had seen for Bharat Electronics, with EBITDA being clear beat over here. This was also led by lower other expenses for the quarter. So this is on Bharat Electronics that we are seeing. But another stock in focus is also DLF. Now here the key takeaway, of course, being its new sales bookings for the year. If we see the fourth quarter pre-sales, they were up around 39%, while collections also reported a healthy growth of 51%. But taking the whole FY25 in perspective, pre-sales were up around 44% at the mark of 21,223 crore. Again, in 9-month period, the company had already exceeded its guidance of 17,000 crore. So this was not a major surprise in terms of them surpassing their guidance. Collections were up over around 36% for the year, while operating cash surplus was up around 128%. Now do note that their net cash position has improved further from the last quarter to 6,848 crore, and now the target for DLF is to launch about 15% of their overall pipeline in FY26. So it's overall a strong set of numbers in terms of key operational trends that we are looking for DLF, and along with that we would watch out for commentary from the management with the con call schedule later today.
Well, thank you, Anushi, for that detailed explanation on DLF and BL. Sneha, any views on both the counter?
Yes. With regards to BL, the numbers are very positive, and even the outlook that has been given by the management is quite positive. The only concern for us is that the valuation currently looks fairly valued, though we are expecting good 20% plus kind of growth over next 2 to 3 years, and we believe that the company will continue to gain market share. They have very strong cash surplus and everything, but we would wait for the better entry points. At this level, I would not suggest a fresh entry. With regards to DLF, again, good set of numbers, and we should remember that Gurgaon is emerging as a destination for the uber luxury residences, and DLF holds the absolute monopoly in that space. And given the kind of numbers and the pre-bookings that the company has reported, it's a very encouraging number. So they have all. In fact, for the past few quarters, if you notice, they have been continuously receiving very extraordinary responses in terms of new launches, whatever they've done. So, keeping that in mind and keeping the land bank that they hold and a very cash positive balance sheet that they have, we continue to remain very constructive on the stock. And herein, though, post con call, we might revise our numbers and estimates, but currently our target price is around 960.
Right. Thank you for that view, Sneha, and thank you so much for joining this conversation. Great to have you here. Well, moving on to an NDTV Profit exclusive, sources tell NDTV Profit that Emirates National Bank of Dubai is planning to take the wholly owned subsidiary route for IDBI Bank's acquisition. My colleague Vishwanath Nair joins in with the exclusive details.
Right, so the Reserve Bank of India gave its in-principle nod to Emirates NBD to open a wholly owned subsidiary in India. Of course, remember that the wholly owned subsidiary model exists, has been in existence since 2013, but most foreign banks have actually kept away from it. Now, what is happening with Emirates NBD is that according to the bidder, it will be easier to acquire IDBI Bank if a wholly owned subsidiary exists in India, and that is exactly why they are going for it. Remember that the wholly owned subsidiary model is only one way of how foreign banks can actually operate in India. The other way is through a branch system where essentially the foreign bank is the owner and it opens branches in India. Currently, Emirates NBD has about 3 branches in India, one in Chennai, Gurgaon, and then in Mumbai. And once this wholly owned subsidiary model has been approved fully by the Reserve Bank of India, and if the IDBI transaction goes through, then of course Emirates NBD will hold that entire franchise of IDBI Bank in India. Currently, they are in competition with Fairfax for this acquisition. Fairfax, of course, if you know, is a Canadian investor led by Prem Vatsa. He's a billionaire. Fairfax already currently owns a bank in India through CSB Bank, and it has to enter complicated transactions to be able to acquire IDBI Bank, and that is why Emirates NBD believes that a wholly owned subsidiary model will make it easier for them to be eligible for IDBI Bank. All in all, both bidders are currently still concerned about the way employee unions at IDBI Bank will react to the news of a foreign lender buying IDBI Bank. That is something that they have expressed to the government as well. If any further delays are caused because of this employee union, then that may cause some trouble in the sale of IDBI Bank.
Thank you so much, Vishwanath, for giving all the details. Well, on the sidelines of 16th annual day of CCI with, in an exclusive conversation, we spoke to CCI's chairperson Ravneet Kaur. My colleague Rishabh spoke about the role of CCI in FTA negotiations. Listen in.
We had the finance minister also talk about the role of regulators as part of the FTA negotiations. What sort of role do you see CCI play in the ongoing negotiations that we have?
We have these free trade negotiations which are going on, and in the free trade agreements there is normally a chapter on competition. So the competition chapter in these free trade agreements is negotiated, and we already have the India-UK FTA, which has now come into force, and we have a competition chapter in that as well. So as and when there is any requirement for new negotiations to be held on bilateral trade agreements, CCI would be contributing to that.
Ma'am, we've seen CCI act very nimbly with regards to quick commerce as well as e-commerce with the cost of production regulations as well. What exactly is the aim of these as we go ahead now?
No, the cost of production regulations were meant to provide clarity and ensure that there is consistency in how cost is determined by the Commission, and then to come to the further findings if there are any anti-competitive practices being followed by the companies.
Well, viewers, this is all the time we have on this edition of Profit Top Trades. Thank you so much and stay tuned to NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome. You're watching India Market Close here on NDTV Profit. I'm Harsh Saita. Let's quickly look at how markets are shaping up. We're seeing a bit of a slip up where the Nifty 50 is concerned. Broader markets also are under a bit of pressure. The Nifty Bank down around 400 odd points as well. But let's focus on the Nifty first. Down nearly 200 points. We're at the low point of the day. We've now wiped around 1% or so from the highs of yesterday. And therefore, could this be a little bit of concern? That's really the question, and we'll look at the technical indicators because that will be more relevant at this point. From a fundamental perspective, nothing's really changed, frankly. We've done well for ourselves over the last couple of weeks, but from a technical perspective, there seems to be some bit of consolidation, sideways movement, and some bit of correction that we're seeing today predominantly, and that's why this will become important. 24,750 is the low we've clocked for the day. Can we hold that or not will be the question. Let's look at the heat map on the Nifty as well and try and pull out what's really doing well. Some favor being found among PSUs. Coal India, BEL on the back of numbers, ONGC are just some of the names within that PSU pack which are leading the gains on the Nifty 50 index. In terms of losers, there are plenty. So the breadth actually is sharply in the negative where it comes to the Nifty 50, as you can see. In terms of some of the other gainers, steel stocks and commodities, metals is one play which is doing okay on a day like this, especially given the fact that China has cut its rates by around 10 basis points on the 1 year and the 5 year. So that has kept some bit of zing with regard to where metals is concerned, if there is any in this market. Let's look at the breadth as well. The advanced decline on the NSE are not looking pretty at this point. 2:1, 2:1 in favor of the declines as we see it. The advances declining as the day has gone by. It was a choppy first half, followed by a steady second half, which is steadily looking worse in that sense. Let's look at the mid cap and small cap indices intraday, because that will also give us some bit of favor. At the day's low, the Nifty mid cap down 200 points, 1% lower. The Nifty small cap as well, very close to the day's low, except for that one spike that we saw at the start of the day, down around 0.5%. So while not as bad on the small cap, but it nonetheless doesn't look pretty at all. So and makes sense as to why the breadth therefore is weak. Let's go across. We have Kush Bora joining us from kushbora.com. Kush, we're now just about 1% versus yesterday's maybe high, if I can call it. What do you make of the moves in the market? What are the levels you're looking for? And give us your understanding of what's happening.
Hi, Harsh. First, a very good afternoon.
Good afternoon, Kush.
Well, I think this is perhaps consolidation with a negative bias at best. At the moment, I think there is support near the 24,700 mark. The reason I bring that number up is because start of the week we're discussing, in fact, even on Friday, that 25,000 straddle was at play, where you had about 300, 350 points of range on the on either side of that number. So about 25,350 on the upside and 24,700, 24,650 on the downside. So I think that range is being tested right now. We did see quite a sharp spike on the market last week. Some cooling off is far for the court. I think this dip might just turn out to be a buying opportunity. Once again, the reason I'm not initiating a buy call is right now we've not shown any signs of a rebound. So about 24,700, if the Nifty does stem its fall there and gives you any indication of a rebound, then I think this dip might just turn out to be a buying opportunity.
Right, Kush. Good afternoon, Hiral on this side. So Nifty, that's the strategy that you're looking at in terms of Nifty. What's the view that is coming in with regards to Bank Nifty? Because in today's session as well, if you have to look at Bank Nifty overall, and if you have to compare the private banking space to the PSU banking space, there is some little bit more strength in terms of the PSU space versus the private banks. What should the strategy be?
Hi, Hiral. Well, I think banking. What's happened is that in Bank Nifty we've seen the support, or rather the resistance levels shift lower. Earlier it was 56,000. Bank Nifty could not take that out. That shifted lower to about 55,500 for the last 5 sessions, 6 sessions. In fact, that's the number that Bank Nifty has not been able to take out. I think Bank Nifty is also very close to a support zone, which is the 20-day moving average, precisely near the 54,950, 55,000 mark. So I think that this is where Bank Nifty should also attempt a reset or a hold. If it does not, then I think the next level to watch for is 54,400. Now, owing to sector rotation, owing to some profit booking because of the kind of moves that it saw since April, a couple of factors combining, Bank Nifty hasn't really participated over the last month or so. And I think with the kind of moves that it's already seen, some sideways movement is perhaps still okay. I think this is still acting as a launch pad for the next move from a very medium-term perspective. And by that, I mean 3 to 6 months. You're right that the PSU bank, pack is perhaps showing slightly more strength compared to the private banks. But let's not forget that the private banks were instrumental in getting the Bank Nifty here, and PSU banks did play a catch-up rally. So somewhat of a short covering on the PSU side, if at all. But I think if I were to pick, then I would still go with the private banking names, especially the big ones, which is HDFC and ICICI. In PSU names, SBI and then Canara Bank. These are the two that make the cut. But other than that, it's not really that kind of strength that we're witnessing amongst the other banking names.
Let's take you away from banks, Kush. Your top picks for this afternoon.
Sure, Harsh. So I will stick to the financials theme. CVSL, we've seen a rocking move on this one. Even today, the stock is actually holding its ground quite comfortably. 200-day moving average cross volumes also picking up. So on the upside, you've got 1525, 1575 as the next target, 1425. This becomes your stop loss. So the financial space, still very much in thick of things. Capital markets in particular with CDSL. The other one is a bit of a contra call, which is Blue Star. The stock has seen a sharp correction from those 2200, 2100 odd levels. It's now trying to form a base near the 1550 mark. We're seeing some early signs of, positive RSI divergence. Yesterday, the stock had a good move. Today, also, it's trying to hold its ground. So, from a contrarian perspective, 1650, 1680 being your targets with a 1580 stop loss. Blue Star is the next stock that you can consider on the long side.
So those are the topics coming in terms of Kush. So Blue Star is one that you're watching out for, and apart from that is a CDSL. Kush, let's look at the metal pack overall as well. On the back of China cutting rates, as Harsh was alluding to, anticipation is demand will increase. From a fundamental perspective, prices in terms of metals expected to go up as well. But right now, if you see, the index is seeing profit booking to the tune of 0.3%. It was trading in the positive. Any metal names that you see are picking up strength right now? You have Hindalco that will be reporting numbers as well. So what are charts indicating?
So this is my precise problem with the metal pack, right? I mean, it is so dependent on news, be it global or domestic, and it's got a few factors which affected rather sharply in this case, the China news. So we did see some sort of strength, but along with the market correction, this is also seeing profit booking. But if you ask me from a medium-term perspective, what happened is that all these stocks, including the Tata Steels of the world, Hindalco, even a Nalco and a Hindustan Copper for that matter, they had seen a good run up. And at best, what we're seeing right now in these is profit booking because most of these stocks are trading comfortably above their support zone. So what I would consider this, that at least the move that's happening today, as more of a profit booking rather than anything else in the metal names. I will remain constructive. I don't like Tata Steel at the moment because the 160 resistance is acting up very stiffly and it's moved quite a bit. If I were to pick some names, it will be Nalco. I know the stock is a little muted right now, but it's had a good run. The volumes on this one are fairly encouraging. So Nalco looks like a good move for a good stock for levels of 188 and about 195 on the upside, with 173 being your stop loss. The other one is Hindustan Copper. Not a tearaway rally, but good accumulation seen, and I will take this move. So if someone's keen, in the metal pack, then Hindustan Copper is your other stock to go with a stop loss around the 218 mark. On the upside, you've got 240 and about 250. I'm rounding this off as your next target. So, Nalco and Hindustan Copper are the two stocks that I still prefer in the metal space.
And Kush, wonder what the view with regard to auto is, because it's the top sectoral loser. A Hero is down 3, a Bajaj is down 2.5, a Maruti is down 2. All of these core names within the Nifty pack, what's the view?
So what we witnessed in the recent past was more of a short covering rally in a lot of these names. If you see, these moves haven't really sustained, and I'm not talking, just today. Even if you see, a couple of sessions ago, there was some consolidation that was starting to emerge. What also happened was that some of these stocks were not able to take out the resistance zone. So this was more of, the rising tide lifting all boats kind of a rally for, some of the auto names. If you still prefer, it's not a bad idea to consider the passenger, the four-wheelers rather than the two-wheelers, because if you see a move on a Hero Moto, the 200-day moving average resistance close to the 4600 mark, prior to that 4450, even a Bajaj Auto still after the kind of move that it's got in the last 10 sessions, still very much below its 200-day moving average. I think if you want to consider, you should still stick to the four-wheeler names. Mahindra & Mahindra is consolidating. I think a good stock like Mahindra & Mahindra consolidating is a healthy sign. That should be taken as an opportunity to accumulate. Maruti again has given way around that 13,000 mark, so 12,000 to 13,000, a broad range for this one. Don't prefer this. So from a near-term perspective, I think you should look at Mahindra & Mahindra. And if you have a medium-term to a long-term view, and by that I mean 12 months or longer, I think Tata Motors is starting to shape up well. So I prefer Mahindra & Mahindra and Tata Motors. Two-wheelers still don't make the cut for me.
Right, so that's with regards to the auto pack. But moving on, Kush, stay with us. We'll in fact now discuss HEG. It's an interesting company to watch out for. 6% is the kind of downtick that you're seeing this quarter, because today, because the company has reported a net loss. What's interesting is if you talk about FY25 as a whole, it's a pretty mixed picture for HEG, because your third quarter did show you some improved profitability. 90 to 95%, if I'm not mistaken, was the year-on-year growth that we saw in the third quarter. However, in the fourth quarter, the company has reported a loss this time around. Let's also welcome in Manish Gulati, Executive Director at HEG, to understand what's in store. Manish, good afternoon and welcome to the show, and a pleasure to speak to you as well after really long. Taking into consideration the seasonality and the kind of cycles that this business goes through, this quarter, yes, top line has seen a sequential improvement, but your rising raw material prices, whereas your lower graphite electrode prices, that has played a deterrent. How are you looking at the coming quarters as well? Because this time there is disappointment.
Afternoon, it's a good opportunity for us to clarify, and we have mentioned that in the note of our results, that this loss which you're looking at quarter four is actually not an operational loss. You see, we have invested about a 10% equity by buying 10% equity in one of the big electrode companies globally, which is called Graftech. And we have mentioned in point note 4 that it is this loss is shown because of mark to market. So you every time, every quarter, the closing share price is taken as that mark to market, and that loss is shown in other expenses. And we have mentioned that it is 160 crores for the quarter 4 and 80 crores for the whole year. So if you add back 160 crores, actually we have one of the best operational profits of 82 crores for this year, and EBITDA margin is the highest. So I think people sometimes fail to distinguish or add back these things, but it is important to take a note of this, that it is not an operational loss. It is just because we have that significant investment in equity of our competitor called Graftech International USA, and this is because of that.
For how many quarters are you going to consider taking this into your P&L then?
It's already seen one of the lowest prices. So going forward, I don't think that we'll see that anymore. And these are unrealized gains or losses either way.
Why accommodate that in your P&L then?
This is the rule. This is as per accounting standards. If you put it in other expenses, when there's a gain, you have to put it in other income. When there's a loss, mark to market, there's no other place but to put it other expenses. So once we had taken a call on that, so every time now we have to show in other expenses and justify to you and other investors.
Okay. Manish, apart from that, if you have to look at the numbers on a year-on-year basis, there is a decline in terms of the revenue, and the pricing trend in terms of graphite electrode is also under pressure. What is the trend looking like in terms of FY26 on both these aspects? Because you do have a tailwind where, if I'm not mistaken, one of the global players has shut down, which automatically gets business to the Indian players like HEG and a Graphite India, right? So how are you looking at FY26?
So let me first talk about the supply correction, which is the latest news that Resonec, one of the large players, they shut down 45,000 tons of capacity, 30,000 in Malaysia and 15,000 in China. So that is almost a 21% reduction of their capacity. And if you have been tracking us and our industry, in the last 18 months, there have been declines in other capacities as well. Graftech reduced capacity from 230,000 tons to 178, which was a 23% decline. Then there's another Japanese company called Tokai. They reduced from a level of 96,000 tons to 72,000, 25% decline. If you put all this together, it's a decline of more than 120,000 tons over a base of, let's say, 750,000 tons. So all in all, it's almost a 19%, 18.5% decline in capacity. Now going forward, the second question was about pricing. Pricing through the year of 24-25 has remained under pressure. It continues to be, now the pricing have kind of stabilized at a level. And going forward, for April to June and let's say July to September quarter, we expect our average pricing to remain at a similar level. But beyond that, we are looking at least expecting the prices to start firming up. And our peer group have already declared, and they're giving indications. They're talking about 15% rise, 20% rise. I don't know how much of that will eventually take place. But yes, towards the end of this calendar year, we are definitely expecting prices to firm up.
Point taken, Manish. This is Harsh here. Sir, you spoke about how pricing is likely going up and there is an upside bias to that. Why aren't you as bullish? Because if peer group is saying 15-20%, are you trying to be conservative, and therefore what should your FY26 numbers actually look like in terms of growth?
Yeah, conservative only because of the fact that the steel production is still low. If you compare this quarter, Jan to March versus last quarter, there's still a 1.1% decline. So we are being a bit conservative about it. But with the supply side correcting, we hope that when the market grows, some opportunities will come our way and we'll be in a good position. Because we have a 100,000 ton plant at one place. And if we compare it with the average size of, let's say our average size of, if we look at Resonac, the average size of, let's say 50,000 ton plant, and Graftech of a 60,000 ton plant, and Tokai of a 25,000 plant. So our economics, being one large plant in a place like India, is really helpful. That our cost structures are lower. We're not in Europe, not in Japan, not in US. So that way we can compete. We have as good quality as them. So we are in a good position, I would say.
Sorry, sir, and are price hikes being implemented on ground? Are you seeing that happen? And what about in your case? Are you looking to implement any price hikes? If so, what will that indication be?
Our expectation is that, let's say, towards after the first half of this year, after H1, see, any company, we are not making electrodes today for tomorrow. Any company like ours is usually booked for the next 2-3 months, obviously, because we are not taking an order today and shipping today. So once these prices started to firm up, they may take a little time to take effect. Whatever they come up with, I'm not sure it'll be 10% or 15%, but green shoots are there that yes, prices should start to firm up. And as you have seen with all our peer group, at this level of pricing of graphite electrodes, the high cost plants eventually end up closing down. So this is a clear indication that these prices are unviable, unsustainable, and eventually have to go up.
Right. Manish, just stay with us. I just want to quickly address our Hindalco, a strong set of numbers in terms of the top line as well as the profitability. It has beat street estimates. If you talk in terms of the revenue, 64,890 is what the revenue number has come in at versus an expectation of 59,251. In terms of the profit number as well, the number that we were expecting was 4,355 odd crores. That is coming at 5,283 odd crores. So that is also a beat. And if you see in terms of where the EBITDA goes, I'm just going to wait for the EBITDA number to come in on the screens right now. But in terms of the top line and bottom line, it's an absolute beat. The stock seeing marginal gains of around 0.7%. If we can quickly have the EBITDA number on the screen, 8,836. The expectation was 8,047. So a strong number from an operational perspective as well, which will clearly tell you that the margins are also a beat. So a very strong set of numbers that are being reported in terms of Hindalco. And the expectation was that the outperformance would be coming in from the non-ferrous space. It's the high alumina prices that is going to aid EBITDA growth as well. And low copper profit on a sequential basis probably would offset the impact of high aluminium prices. Novelis adjusted EBITDA per ton shipped was also down 9%, but taking into consideration the way Novelis numbers panned out, expectation was of a strong Hindalco quarter and it's beat street estimates. The stock not seeing a major reaction yet, but we will come back and revisit this one. Manish, my question coming to you now is, if I have to look at the historical side, I think a year that this industry saw back then in 2019, I think 6,500, 6,600 odd crores was the kind of top line you hit as well. How long do you think will HEG take to come back to a 2019, to make a repeat of 2019? And will it also be possible to make a repeat of 2019, or is that something which is absolutely impossible now?
That was once in a lifetime thing to happen. Of course, we wish, our investors wish to see that time once again, but we may not reach that level. But certainly, once prices start to firm up, I think I can see the turnovers going for HEG going up, and especially with additional volumes. We may not reach that to 2019, because that was something which happened with a jerk, that suddenly the polluting industries, polluting blast furnaces in China was stopped, and the other parts of the world started making more steel, and there were no electrodes to be found, and we were there. So there was a period, a good 2-year period, when there was no inventories in the market, supply chains were tight, and we all in the industry made a lot of profits. So we may not be able to have a return of exactly those 2019 times, but these are one of the worst times we are going through. And if we can sail through the worst times, I think anything which happens, firming our prices, whatever they increase to 10, 15, 20, I don't know, this year or next year, will definitely be very helpful in improving our margins. And another thing positive which we feel about our industry and HEG is that the new electric arc furnaces which are coming up, we are anticipating, and also our peer group anticipates similarly, that we are anticipating an additional demand of about 200,000 tons by 2030. And we can see these things happening on the ground. So more shift from blast furnaces to electric arc furnaces happens, more electrodes are required. So we think that medium term, long term, we have a very bright future.
So I understand that in the near term it will be difficult to try and give us some visibility with regard to margins. But what would that target margin, reasonable target margin number be when you're looking at it from a slightly medium to long term perspective, since you do have that visibility?
Whatever I have, I can share it with you.
Absolutely, sir, please.
So see, if you last year 24-25, we were at an EBITDA margin level of, let's say, around 19%. So that I think will continue for Q1 of 25-26, Q2 of 25-26, and thereafter we are expecting it to improve.
That's with regards to the overall outlook from a margin perspective. Thank you, Manish, so much for joining us on the show and having that candid view. But this is going to be a segment we should be watching out for as well. Let's just also pull out Graphite India very quickly, because both of these stocks usually move in tandem, taking into consideration the line of business. There you go. 4% is the kind of cuts that you're seeing on this one as well. But in fact, let's quickly just take a question with Kush on a HEG and a Graphite India. Kush, what are charts indicating, taking into consideration the kind of pressure that you're seeing today? And fundamentally, it's a pretty mixed picture. There are risks from a raw material perspective, but are charts indicating a buy or a sell at current levels?
Charts are suggesting a buy on dips kind of a setup, in this one. In fact, in both of them, for slightly different reasons. So now something like an HEG has actually crossed, some of the key levels much sooner and sustaining above those. We are seeing, a sharp round of profit booking today. But I think if you allow for support zones, then I think 670 to about 675 is a strong support zone for HEG. If the stock does indeed sustain, above those levels, I think this might turn out to be a buying opportunity. For something like Graphite India, it's just very recently crossed the 200-day moving average as recent as yesterday, on the back of strong volumes. And today you're seeing some sort of profit booking. Here too, a decline closer to about 535 zones should be a good entry point, given the kind of sharp move that you saw yesterday. So from about 490, the stock went all the way up until 475. So any pullback closer to the 440, 435 zones should be taken as an entry point. I wouldn't advise selling them at the moment. Today, what you're seeing is a sharp downtick, perhaps also in line with what the markets are doing. But closer to those support levels, both of them will give you a good entry point.
And Kush, anything that you're spotting with regard to Hindalco? The numbers seem to be solid. Stock also seems to be solid. But what's the sense like?
So what's surprising, Harsh, is that the stock had a spurt, a very sharp reaction, went all the way up until close to the 667 mark, but gave those gains up rather quickly. And hence, my apprehension around some of these names, some of these big names which have actually run rather fast. So on the whole, the structure is fairly okay. Maybe closer to the 655 mark. Once again, Hindalco might provide a good entry point. Also, that's the 200-day moving average support zone. So yeah, I mean, if you have it, you might want to hold it with a stop loss close to the 650 zone. And if you're looking for a fresh entry, then 655, 656 thereabouts is a good entry point to reconsider a trade on Hindalco.
Interesting one. In fact, we'll discuss this further later on from a metal perspective. But Quest Corp, that's interesting. 10% kind of a dip in spite of a strong set of numbers that have been reported. You know, one interesting commentary that I got from a fundamental analyst, Harsh, was that this is a portfolio stock. In spite of this 10% dip right now, a 20% upside is a given. And this should be something that you should hold and probably take an opportunity to enter, taking the correction into consideration. So that was an interesting view that came in with from a fundamental analyst. In fact, we have Puneet who's standing by to help us understand what are the key concerns that the street is recognizing currently. Puneet, over to you.
Well, thank you for that. 95 crores in terms of loss for the company in this particular quarter, and that's largely led by a huge one-time expense of 150 crores for the company. Out of that, 120 crores is actually a trade receivable. So they've given the service to the client and the money hasn't come out of that transaction, and that's another key negative, because they have client contracts, and while this could be something in a long drawn battle, but overall in this quarter four, that was one of the biggest negatives, that one-time exceptional item which wasn't penciled in by analysts. The other key aspect is the maintenance of revenue growth, and that the company has been unable to do. Top line saw a sequential decline of 9% in this particular quarter, and that's largely because of seasonality seen in both the IT as well as the BFSI space. IT forms roughly 65% of the company's revenues, and hence there's a big negative there. They've also not been able to maintain the guidance of 5% margins in this particular quarter, and that's because of unspecified IT incident. So the company also held a conference call this morning. They've also mentioned that the weakness in revenue as well as EBITDA is also macro-led, as I mentioned, on both sectors. But they had a specific NBFC account which saw ramp downs of 38,000 personnel in this particular quarter. The key aspect is this will have a 7% revenue and a 4% impact on profits going forward, at least in the near term. And that is the third negative which I wanted to address, because RBI has come out with new regulations. They want NBFCs to insource some of the key functionals like collections amongst others, and that would directly impact staffing companies like Quest Corp. So it seems to be a confluence of bad news together that's been come together for Quest Corp in this particular quarter, and the three-way demerger, while might help in the near term to improve general staffing, which is a higher margin business for the company, there seems to be some weakness, and the valuations are also reflected of that, at least in the near term.
Okay, thanks for that, Puneet. Thanks for breaking that down for us. Quest Corp, of course, in focus. What we're going to do is we're going to slip into a very short break. On the other side, we're going to get you heard on the street, all the dealing room chatter, and we will talk about some stocks, including the stock of the day today, Pfizer, and we'll talk about Quest Corp as well with our guests. Stay tuned. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers. Okay, welcome back. Thanks for staying with us. I want to quickly mark out the Nifty, which is down now on nearly 1% and over 1% from the day's high. So we're down 300 points now from the day's high. It's not looking very pretty. We're now testing 24,700 at this point. But before we talk a little bit about that, let me go across because it's 230 plus, and therefore I want to go across to Swami with all the chatter that's coming in from dealing room. Swami.
There's multiple stocks in focus. Firstly, it's GAIL, Adani Green and JSPL. Multiple dealing rooms are suggesting positional buy calls when it comes to GAIL and Adani Green and sell call on JSPL. Now, these positional calls are given based on technical levels. So that's keep an eye out for all these three stocks. Indigo is the other stock that remains in focus. Now, dealers indicate that there is a buzz of a potential block deal that could come in from the Gangwal Group. Post the company reports its numbers. They will be reporting its numbers tomorrow. So, keep an eye out for Indigo as well. Gangwal Group owns close to 13.5% stake in the company. Inox Wind. Now, large HNIs have been seen accumulating this counter on expectations of strong Q4 numbers. The company is yet to come out with the date for Q4 numbers, but keep an eye out for Inox Wind as well in trade. And lastly, it's IGL and MGL. Now, both these city gas distribution stocks are down in trade. Dealers are indicating that there's a potential buzz of a cut in city gas the gas allocation for the city gas distribution companies. Now, current allocation is anywhere between 37 to 39%, and this could come down to 33% is what dealers are indicating, and that's one of the major reasons why MGL and IGL both are down in trade.
Swami, you track Interglobe quite closely. I want quick follow-up on that one. Is this a concern at all in your opinion, and how do you believe the street will react if this were to actually go through?
Well, this overhang, it's more of an overhang, and it has been going on for a while. Time and again, when the lock-up period ends for Gangwal, he goes ahead and sells some stake, and we all know that he wants to completely exit from the company. He owns 13.5%. Most likely, he'll come out with a 5% block this time. So most likely, a couple of more blocks, and then he'll be completely out of the company. But fundamentally, nothing seems to be wrong for Indigo. Just an overhang that is there for the company because of this block deal that is happening from one of the promoters.
So more positive than negative.
Right.
Okay. Thank you so much, Amit, for that. Yes, he does have a very good hit rate. So you'll want to watch out for all of those stocks. I want to quickly ask Dharmesh. Dharmesh, how do you view Interglobe at this point? Of course, and Dharmesh Khan joining us. Apologies. Need to introduce Dharmesh Khan, Head Equity Research, Chola Securities, also joining us this afternoon. Dharmesh, Let me come straight to you with regard to Interglobe. What's your view with regard to an Interglobe Aviation?
Yeah, Groton, it's a constructive view. I mean, only two players are majorly left in the Indian aviation space, and with the crude prices being where they are, and it's likely to be, benign going forward. Maybe $60 to $70 a barrel on the Brent crude is likely to be the range going forward. And internationally, even demand is not rising. So that's the biggest, plus point for any aviation company which is operating in the country. And aviation itself is going for a very rapid expansion, be it airports or destinations, and the number of flyers is growing by 12 to 15% on an annualized basis. Interglobe Aviation is doing a strong capex. So going forward, I mean, because of depreciation impact, the operating profit or the EBITDA may not. I mean, EBITDA may be still be good, but the PBT level you may have a difference in the growth rate. But structurally, if one is a buyer for, I mean, this has become a wealth creator now for if you are holding it for 3 to 5 years kind of a perspective. So the advice is any such, news flow kind of a decline which is there is a good opportunity to buy the company.
Okay. Kush, your view?
Well, I think this is a good consolidation phase, for something like an Indigo. The moves have been rather sharp. It's in a rising upward channel. Just now, it's faced at resistance around the 5600 mark and slipped to slightly lower end of the band, not close, but slightly closer to that. 1500, 5300, I beg your pardon, is where that support zone comes in. So I will take this dip as long as that upward sloping channel, the support zone is intact. As I said, it comes to the 5300 mark. Around those levels, this might just turn out to be a buying opportunity. On the whole, the medium-term, long-term strength in the stock is visible. That trend is very much intact. So as long as 5300 is held, I think this will be a good buying opportunity for anyone who missed out on the Indigo rally, a couple of months ago.
Okay, so no confluence of fundamental and technical, at least on this one. But I want to quickly understand from you what you make of the index move, Kush, because we've slipped what, about 100 odd points in the last hour or so. So clearly there's pressure. What does this do in terms of taking a trade on the index? What's your view?
Harsh, what has also happened is that the call writing levels, have shifted lower. 25,000, as we spoke at the start of the show, was the pivotal range. But from there on, what's happened is that 24,900 and now 24,800. These are the levels which are seeing, some call writing. What this also suggests is that possibly we might not have a V-shaped recovery in the coming days. But 24,700 was the level that we were talking about anyway. And precisely why about 40 minutes ago at the start of the show, we did not initiate a buy call because there wasn't really any kind of rebound coming in on the Nifty. So I will wait for a day or so more. 24,700 could still well be, that support zone that we've been talking about, and the market could hold ground around those levels. So I will wait and watch, let the day pass, see, if any kind of rebound does come about tomorrow. So for me, this is the support zone. Nifty should hold its ground here. If it does not, then you're looking at 24,400, which is the 20-day moving average. But that I would say is some distance away. So hold your ground. 24,700 if held, we could see some sort of a rebound to back to 24,800, 24,850 levels in the coming days, perhaps tomorrow day after.
Hold your ground at this point. Dharmesh, your quick take with regard to how you're reading into markets. We've seen a bit of a rally. We're starting to see a bit of consolidation now from fundamental perspective. Are there some pockets which are interesting you at this point? Are you waiting and watching? What are you advising?
Yeah, definitely. I mean, from the correction point of view, today has been a sharp correction. I mean, the stocks which have rallied 6-7%, today is down almost 3.5%. So such kind of a correction is definitely, unsettling. When you, I mean, 1.5 to 2% correction is okay, but if you see 3-4% kind of a fall on the counters which are showing strength, does merit a caution. Having said that, I think, again, this is a good opportunity if you missed the initial part of the rally to get into the bus, because the macros are playing in favor of country, be it inflation rate, be it interest rate, be it monsoons, tax benefit, and now this tariff saga is settling down. Putting all these things into light, I think one space which looks pretty attractive to me, given the upcoming of the monsoon and the wedding season, is the two-wheeler space. Both Bajaj Auto and Hero MotoCorp, which has seen a good correction today, are good candidates to get into. That is one space which we are liking very much. Apart from that, public sector banking space. I mean, these two are clear winners to my mind in next leg of the upcycle. So this is the space where one should be investing into in today's form. Only one advice: don't go all in. Get it a structured, I mean, one third kind of a step down kind of approach while you are investing in this market.
If Dharmesh, if you were to put one third at this point, how long would you wait for to deploy the next one third bucket of your portfolio?
So one third I would deploy today itself in this fall which we are seeing. I mean, the Kush he's suggesting, I mean, 200 points more from here can go on Nifty, but that's okay. Next leg of decline, I'll wait till first week of June. I mean, I'll wait for this news flow on the India-US tariff thing gets settled. And by that time, you know, RBI policy would also be around the corner. So the idea is very clear, Harsh. If I buy 2% or 3% up, I am happy buying a stock on a upswing rather than on a downswing, because if it's an upswing, it gives you a clear indication that waters are settled and now the trajectory is clear up, because fundamentally these companies are good. Both Hero and Bajaj, I think the numbers would be 7 to 8% kind of a volume growth going forward in the month of May and June itself, which is better than 3 or 4% kind of a growth which they were witnessing in domestic markets. That's one factor. And public sector banks, as I've said, the numbers has been excellent for all 4 quarters and for the year. And with more leeway coming in the form of, say, lower interest rate and higher disposable income, they would reap the benefits of credit growth faster than the private sector peers, because the capital adequacy ratio is far in favor of them, along with the CD ratio. Valuation wise, still they are very comfortable. So to name a few, like Bank of India, smaller like UCO Bank, Union Bank, Bank of Maharashtra, they look pretty attractive to me on valuation metrics.
Okay, so that's the view coming in. Thank you for those views, Dharmesh. Stay with us because we're going to quickly jump to the stock of the day, which has jumped 11% today. So Pfizer is the stock of the day, and the company posted very strong performance for the March quarter. Varsha joins us with how the performance was and how she evaluates it. Varsha.
Yeah, thank you for that. So overall, you know, good set of numbers. But if you see, the highlighting factor here was the EBITDA and EBITDA margin, because if you see, the revenue growth was only 8% for the company, but EBITDA was up 20% and margin were 38% versus 35% last year. Now, lower other expenses have actually aided EBITDA and EBITDA margin, and the net profit, if you see, net profit is up almost 85% for the company. But here's the catch: net profit impact was led by higher other income and lower tax. Now, what is this higher other income? The company agreed to sell its Thane land lease at and the buildings on it, of course, which originally belonged to Pfizer, but they plan to sell it to Zoetis Pharmaceutical Private Limited, and the sale price was almost 264 crore, and company had already received almost 52 crore in advance. But the remaining portion of around 170 to 180 crore is the other income that the company has has been focusing on, or that's the other income lying in the profit and loss, and that's the reason you're seeing huge impact in the net profit. A lower interest cost also aided net profit for the company. Now there was this news in the morning with US Pfizer and Chinese biopharmaceutical deal. Will that have an impact on Indian Pfizer company? The answer is no. Why? Because if you see the export in FY24, the export stands at around mere 4% for the company, and there was no related party transaction with Pfizer US. So no impact when it comes to the agreement between Pfizer in the US and the Chinese biopharma company, because since this is a licensing agreement, Pfizer US will be selling this product in China only. But because the name is attached Pfizer, that's the reason, maybe because of all the sentiment, maybe one of the reasons why Pfizer has Pfizer is buzzing. But the other reason is strong Q4 numbers and strong portfolio when it comes to the oncology products for the company, and of course the neurological products.
Okay, so that's Pfizer for you, Dharmesh. Thank you so much for that, Varsha. Dharmesh, coming to you quickly with regard to a Pfizer, how do you view it, and how do you view the broader sector, because you're starting to see pharma numbers come through? So what's the sense like in terms of numbers? What themes are you liking? What's your key takeaway?
So So the numbers have been pretty there on the line. I mean, Pfizer, if you look at the numbers, were excellent. And as you pointed out, that 3% kind of an operating margin, plus was mainly because of a better product mix on oncology and neurology. So those are high-priced products anyways. But if you look at the entire MNC pharma space, so there's an Indian pharmaceutical companies as an MNC. So there the other factor which is playing out for Pfizer is the better growth numbers and the relative comparatively low valuation multiples. So if you compare this with say a Sanofi or AstraZeneca, is far cheaper to that, even for that matter GlaxoSmithKline. So it's trading around 10 to 15% discount to that even. Having seen all this in light and US tariff saga on pharmaceutical being played out separately, so my sense is all these MNC pharma companies will be benefited because anyways this tariff is about to come. It will definitely come, maybe 5%, 3% or whatever is the impact, but it will be there. And these companies can get protected because of their parentage being outside India. So that's one thing which is playing out. It's a momentum trade play. Other than that, for India pharmaceutical companies, say for example, Aurobindo Pharma or a Sun or a Cipla, would like to wait and stay out for some time till the clarity emerges on the entire, phasing of this tariff on the pharmaceutical products.
Okay, and what about you, Kush?
Well, I think at the moment this is a book profit kind of a scenario on Pfizer. I mean, there are more than a couple of factors pointing out that there could be some resistance. Ramesh said, this momentum trade has been building up for some time, but a very strong up move today. Now resisting at the 200-day moving average. So that's the first one. 50% retracement resistance also acting upon it. It's already overshot in the overheated territories on the RSI parameters. As I said, a few more factors going for it. So all in all, I would suggest if you have a position, it's not a bad idea to book some profits and take some money home. If you are looking for an entry point, then I think a rather decent one comes in close to the 4,800 mark, where you've got some support zone, and the stock could once again rebound and rally higher from there. But for now, you could consider booking profit partially, if not fully. So Pfizer, no initiation at the moment, and if you have a position, at least consider booking partially.
Okay, so that's the view coming in with regard to Pfizer, both on fundamentals and technicals. Let's go across to another one in focus, Eternal, which is Zomato. Shareholders have approved a cap of 49.5% on foreign ownership, meaning foreign institutional investors cannot own more than this percentage in the company. Stock under pressure on the back of that. Mahima joins us with a better perspective with regard to that. Mahima.
Right, so as you rightly mentioned, shareholders have now approved the fact that board did approve earlier that 49.5% is the cap to FI holding in Zomato. The board of directors had already approved that, and now shareholders have come out and given the approval on the same. Now, in terms of how this impacts overall, in terms of how funds will flow out of Zomato, plus how it will change in terms of the way Eternal will work. Firstly, it will trigger the MSCI and FTSE passive selling. Selling could be as much as $1.4 billion in multiple quarters. In terms of MSCI details, current weightage is around 1.3 times. This will become half, and outflow will be anywhere around $600 million to $800 million. For FTSE, the current weightage is around 1.17. The outflow could be anywhere between $500 million to $600 million after review. And first review will happen in June 2025. After that, every quarter will see outflow of around $70 to $100 million. In terms of what this means for Eternal, last QIP where Eternal raised around 85 billion, there was an increase in terms of domestic ownership which was seen. 8% overall was subscribed by domestic funds. Post the QIP, FI ownership fell to around 47%. DI ownership increased to around 20%, and currently DI ownership stands at around 23%, and FI ownership continues to fall, and now it is at 44%. Increased domestic ownership aids basically your data localization norms, your control control over inventory as well as safeguarding local consumer data. Plus, inventory-based model will be adopted by Eternal going forward, and better control over product quality and pricing will take place. Higher margins through bulk procurement could be one of the factors that could work positively in favor of the company, and easier promotion of private label could also take place. But challenges, of course, this comes with a lot of challenges, including requiring of stronger grip over operations, plus requires high working capital, and plus there could be risk of unsold and obsolete inventory as well. So this is the overall view as to how and what this means for Eternal exactly.
Okay, so that's with regard to an Eternal stock under pressure on the back of that. Dharmesh, how would you view a Zomato Eternal at this point? There's of course some bit of pressure on the business side of things when you're looking at quick commerce and how the competition is evolving there, how margin pressure is coming through. But on the other hand, food delivery doing okay and adding in terms of the way that performance adding up and aiding the cash burn which is currently happening in quick commerce. So how should you view the business and how do you view valuations at this point? Far cry from the 40 rupees that we saw at the bottom, but of course it's fallen quite a bit from the top as well.
Yes, valuations is anybody's guess. I think this is more of a concept buying on a business front, and actually to arrive at the valuation multiple, I think we are still 5 years before. I mean, it will take more 5 years for this business to evolve, and then the methodical yardstick of valuations can play out. As of now, it's more of a market share gain, and the part to profitability, like operating profit and all, how it is, at least they should be in the black. My own sense is that there will be consolidation in this entire space, quick commerce and delivery, food delivery, and the entire e-commerce space will come in for, as far as the delivery segment is concerned, will come in for consolidation. And going forward, maybe 2 years, 3 years down the line, it will be left to 2 or 3 major players. And there, to my mind, Eternal has always been ahead of the curve because it's more of a promoter-driven kind of a company, and it's always came out with new ideas and others are following up, except the quick commerce part where Swiggy first launched it. But apart from that, they have been doing pretty well. Cash burn, if you look at it, I mean, Eternal is one of the few companies which is now not burning cash that faster as others are in trying to grab the market. So there also, I think they are better off. One has to be in this space if you are an investor and a long-term investor. Definitely, this space does merit our attention. And there, I think I would pick only one stock, and that would be Eternal to be invested into as of now. Maybe as situations evolve and delivery and everything other also gains larger, pan-India presence, then one can look at that. I mean, Amazon is also into the fray. We don't know when it will come into the marketplace, but definitely it's also down the line. As of now, in this correction or corrections going forward, should be an opportunity for investors to take a long call rather than traders or somebody like that, because volatility is likely to stay here.
And what about your take, Kush, with regard to technicals on this one?
I mean, it's spending what looks like an eternity, in that 200 to about 240 band. If I were to speak in technical terms, in the 23% and the 38% retracement, it's spending a lot of time there. But I think this is a healthy consolidation. This is a healthy time and price consolidation, as you rightly said, from all the way from those 40, 45 odd levels up until about 300, where it went in about 17, 18 months kind of time span. So I think this is a healthy move. I think for me also, this is a good accumulation zone. As long as the 200, 198 kind of levels are intact, I think this should be a good buying opportunity. Momentum is missing, supply pressure at the 240 mark, so that is something that you have to keep in mind. But if you're looking at it from a 6 to 12 month kind of a horizon, maybe longer, then this is a good time to buy and hold something like an Eternal.
And the other one also in focus is a DOMS Industries. Stock has plunged. Tough set of numbers which came out yesterday. It didn't look good at the face of it. Mahima is again still with us to give us an understanding of those numbers. Mahima, what do you make of this one?
Right, so in terms of DOMS, I think what the street is not liking is the kind of margin downtick that it has seen this quarter. Plus, export shares has also gone down. In terms of the overall numbers, revenue was up 26 odd percent, EBITDA up 16%, margins came at 17.4 versus that of 18.8. Net profit was up 7%, which has been a double-digit growth otherwise in previous quarters. So I think that is something also that the street is not like. Now, in terms of what has impacted margins as well as profitability, employee benefits expenses has gone up by 28 odd percent. Other expenses has significantly seen a gain of about 37 odd percent, and depreciation has also gone up by 42%. This is because of the capex plan that is ongoing for the counter. Now, in terms of capacity expansion, the company has said that it's underway of a 44-acre land parcel in Gujarat, and the possession of first building for installation of plant and machinery will happen by the end of Q3 FY26, and they expect commercial production at the first building by the end of Q4 FY26. So I think it's the margin downtick and a single-digit growth in terms of profit that the street is not liking for something like a DOMS, and that is why the stock is under pressure today.
Okay, so that's on DOMS. Dharmesh, not sure if you have coverage on this one, but from whatever my interactions have been, very strong growth guidance, but not meeting that. In fact, margins coming under pressure, not looking good.
Yeah, we did had a IPO note on this. See, the problem is such kind of a company which is more of a product company, and if you are commanding a valuation of say 70, 80 times P multiple, so there the scope of error is not there. And if you are unable to meet your guidance, then definitely this kind of a punishment market gives you. I don't think the numbers were that bad, but seeing it in the light of the aggressiveness with which the management was giving the guidance, and now and the valuation multiples which it was commanding, so definitely, I mean, there are many people who have got it at an earlier trajectory and pre-IPO kind of a thing. So those sellings are likely to come. And the only advice to investors is, if you are buying a product company, that to a stationary kind of a product company, which anyways is, with advent of technology knowledge it's coming down rapidly. If it's trading above 70, 80 times kind of a PE multiple, please be very mindful before investing.
Okay. Interesting take coming in with regard to DOMS. Kush, of course, very limited chart on DOMS, but would you at all have a view, or maybe I can ask you something else?
So, a near-term view for sure. So I think a good support zone is at the 2440 mark. That's a medium-term support zone for DOMS. So if that is taken out, then I think the stock could see further downside of 2300 levels anyway. This 2953,000 mark was proving to be a very, very stiff resistance, where it was not able to successfully cross for the last 7-8 months, maybe a little longer as well. So all in all, pressures were evident. It is starting to play out now. 2440 is the level to watch on the down.
And Kush, I'm also curious to have your view with regard to some of the defense counters. The defense counters in the private space seem to be under some bit of pressure today. Of course, then you have a Cochin shipyard, which is down 8%. What's the view with regard to that pocket? Because it's done ever so well last week, and now you're starting to see cracks. What should an investor do or a trader do at this point?
So, Harsh, if your viewers did indeed heed to our advice as to whatever we've discussed over the last couple of days on the defense names, I think they'll perhaps be smiling even in the face of these cuts. The reason being, what we suggested was hold 50% and book out 50%. The reason being that these stocks are now again seeing that surge that they had seen up until the consolidation began 12 months ago. You wouldn't want to be completely out of these sectors. So my suggestion was to book 50% of your holdings and then re-enter at slightly lower levels. So the likes of Paris Defense and Idea Force, they are now starting to see what can at best be called a profit booking. So wait for some more time, let this dust settle. These are the stocks that you'll perhaps get a re-entry into once again. In any case, if you're holding at 50%, it's not too much of a FOMO or a fear of missing out kind of a factor anyway. So right now, if you put 50%, hold, let them find their feet again, and these are the stocks that you'd want to re-enter once they hit those support levels.
Okay, gentlemen, thank you so much. We'll let you go on that note. Thanks so much for joining us, giving us all of those views. What we're also going to do, viewers, is slip into a very short break. On the other side, we're going to get you top BTST picks, and along with that, we'll have a fresh set of guests, Neerav Ashar, Aditya Agarwala, giving us their views, and a bull versus bear on HAL. Stay tuned. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers. You have the numbers of Solar Industries flashing at the bottom of your screen. Looks like a strong set, 37% profit growth. Despite that, stock under pressure, but that's because the larger defense theme is under pressure. And we saw a downgrade coming through from a UBS on HAL, and therefore thought that it's good to do a bull versus bear on it. Anushi, standing by for a bull versus bear on HAL.
Right, Harsh. So in what we've seen for Nifty India Defence so far, last week, strong rally, about 19% of gains, but we've started seeing some bit of profit booking in terms of where these defence companies are. HAL particularly in focus. This is after it came out with its conference call on Friday that we've seen, and after that, there's been a lot of discussion in terms of where the guidance is and if the guidance is going to support the kind of valuations that the company has. So we have two notes coming. Firstly, in the bull scenario, Jefferies, they've maintained a buy on the stock but hiked the target price to 6,475, looking at a big upside here for HAL from Jefferies. Well, on the other side, UBS has downgraded the stock to neutral rating. It's the first downgrade that we're looking for HAL over here, and this is with a target price of 5,600. So despite the downgrade, we are looking at a reasonable upside coming for UBS as well. Just some of the key highlights that we are looking at as to why Jefferies has remained bullish, but UBS has remained neutral on the stock. Firstly, margin front, 30 to 31% is the projection that they expect to continue in the upcoming years as well. Now, we did see about 30% of odds or margins in FY25. They expect this to sustain given the cost optimization practices that the company is seeing for the company. So clearly on the EBITDA margin side, it is a strong point that we are looking at. Along with that, it's also the high margin service income and aircraft deliveries which should drive this double-digit revenue growth for the company for the next 3 to 5 years. Along with that, if we look at the India-Pakistan tensions also, they've happened. It has increased focus towards these defense manufacturing companies. So that is something that has increased the confidence as well. Whereas UBS has said that despite all the positives that we are seeing, most of the positives have already been priced in. That's why they're now downgrading the stock to a neutral rating. They've also cut their order book CAGR growth of 21% to 14% post the recent management guidance, which is there in terms of 8 to 10% of a growth. So that brings us to our second point. So if you look at the order book now, while that is up over 95% this year at 1.84 lakh crore in FY25 with a huge pipeline of opportunity of over 2 lakh crore as well, it's the guidance in particular wherein the street is not overjoyed by this 8 to 10% of a revenue growth guidance that we are looking at, because considering almost the huge book-to-bill ratio that the company has in terms of execution, in terms of revenue growth, this seems more on a conservative side of a 10% of a revenue growth guidance forward for the business. So that is something that we should be watching out for. But if you are talking about another aspect as to the bull and bear case scenario, if you are seeing now clearly the stock, if you are seeing the biggest cheer point for it was the the overhang which was lifted was the GE Aero delivery of 404 engine, which is expected to start this year. Now this was the expectation. The expectation is also about delivery of 12 engines by this year and itself. So that would expedite the kind of growth visibility forward for the business. However, there are the two other orders which were expected for FY28 have been pushed beyond FY28 with the expectation now that these will come through FY30 as well. This includes major platform orders including the LCA Mark II, Light Combat Aircraft Mark II, along with Sukhoi MKI upgrade that we are seeing at. So in terms of where the order book picture could play out for this is something that we should be watching out for, which brings us to our final point, which is the most important one in terms of the valuations. Now, if you are looking at 1 year forward PE of 39 times with the kind of 8 to 10% of a revenue growth that we are seeing, are valuations justifiable? That's the biggest point that we should be watching out with the company. Again, execution will remain as a key monitorable, because any supply side issues now impacting the company would directly have an impact on the visibility going forward. The stock is almost up 60% as well if you see the last 3 months. So that is something that we should be pricing in for the company. Valuation remains a key concern. On the bull case scenario, it's quite clear that increased confidence that we are seeing is also, especially after the Indo-Pak tensions that we are looking at, there has been higher focus on defense companies to expedite their manufacturing going forward. So that is the bull side that we are looking at. But overall, that's the overall picture that we are seeing for Hindustan Aeronautics. On one side, while the growth prospects remain on the healthier, it's on the bear case scenario. It's the major concern is whether the revenue growth which we are seeing, are they enough to sustain the kind of valuation that Hindustan Aeronautics command? Back to you, Harsh.
Okay, so very interesting. HAL and the entire defense pack, to be honest. Let's look at, let's go across to our guests. Neerav Ashar, Head Equity Research at Latin Manharlal Securities, joining us. And we have Aditya Agarwala, Head of Research and Investments at Invest4EDU. Let me come to you first, Neerav. Neerav, with regard to defense, we've seen a huge rally. The questions now seem to revolve more around valuation comfort and not with regard to potential. Do you feel that those arguments are justified?
Well, good afternoon and thank you for the invite. Yes, actually, the defense companies have gone through a roller coaster ride. It's been a very volatile phase for the defense companies. We had a time where the defense companies were the darlings of the market, and then, of course, there was some disappointment with respect to the execution. And then, of course, we had this surprise in the form of Operation Sindoor, where the world could see it was a demonstration of the capabilities of the Indian air defense systems and missile systems, etc. So I think it's been a kind of a game changer. This event has been a game changer, and we've seen the valuations prop up again. And again, the same question which arises with respect to the valuations at this point of time. So it's very important to bear in mind that there is a lot of lumpiness with respect to these defense projects. There is a lot of focus on indigenization. There is a lot of rigorous testing which the defense equipments tend to go through. They are subjected to a lot of rigorous testing in different conditions in which the defense equipment is used. So I think having come out of all that, having successfully passed all these exams, and we have seen the practical implementation of the same. So I think the prospects remain quite strong. We've seen India's defense exports more than triple over the last 5 years. We have an ambitious target of doubling our exports in the next 4 years, and the domestic order book is quite strong. But having said that, I think with the revenue guidance coming in so conservative, especially with respect to Hindustan Aeronautics, which we just spoke about, I think it definitely warrants some amount of caution. We need to see how the execution actually takes place quarter on quarter basis, and need to ensure that there is some amount of consistency in the deliverables going forward. To conclude, I think the valuations are no longer cheap. They are trading at more than 40-45 times at this point of time. So definitely we've got to wait for a correction to see more attractive levels before we make an entry into these stocks.
Got it. What kind of a correction will you wait for, Nirav, before this looks interesting?
I think at least 15 to 20%.
15 to 20%. Okay, so wait and watch. Aditya Agarwala, the Nifty defense, while the launch date was in April 2022, the base date for it was April 2018. In 7 years, it's been 8x. From a technical standpoint, how does this look from a chart perspective? And any names that you have, whether you have a buy call, sell call, any strong calls that you have within defense?
Hi, Harsh. Good afternoon. Thanks for having me on the show. I think the worst is over as far as the defense is concerned. We had about a year and a half of consolidation as far as this entire Nifty defense sector is concerned. Yes, it has seen a sharp up move following the escalation of war-like situation between India and Pakistan, and basically there was a switch from one sector to the other, and defense being the prime focus, everybody did look at defense as the best sector to look at during that point of time. And all that we are witnessing right now is a bit of a profit taking. While these companies do hold some challenges and some fundamental tailwinds, I think if you purely go by the chart setup, a lot of these stocks do look attractive to me, especially if you're looking to build a portfolio from a longer term time frame. To give you a few names, I think BEL, BDL, HAL, these three stocks do stand out for me. And any point of correction in these stocks, maybe a 4 to 5% correction in either of these stocks, be it an HAL or a BDL or a BEL, you should look at start buying into these names, because if you give it a year or so, I think all these stocks are going to see much higher levels, and the kind of buoyancy that we had seen in these stocks following the tensions between India and Pakistan, that is not likely to go down so soon. I think there is more room on the upside. At least 20 to 30% is what I see in these stocks. In any event of correction that you're witnessing now in these stocks, it's an opportunity to go long and hold these stocks. So the top three names for me are BDL, BEL, and HAL in defense space, followed by a Mazgaon Dock.
Okay, so those are names which look good to Aditya from a technical perspective. Aditya, your quick calls as well for the day, because we haven't had a chance to take those.
Right, Harsh. So given the fact that markets become little choppy and volatile, I've got a buy and a sell. I'm keeping a very close eye on the Nifty VIX that has actually turned upward from that support level of 16, and I'm keeping a close eye on that 18 level, though it hasn't breached that 18 and markets have seen a bit of a correction, but 18 is the mark that I'm closely eyeing for, and not for today, basically for tomorrow. If 18 level is breached on the upside as far as VIX is concerned, then you could be in for a sharper correction. Coming to stock specific ideas, like I mentioned, keeping this in mind, I've got a buy and a sell. Bajaj Auto for me is a buying opportunity after a sharp run up in the stock today. It's a bit soft in trade. It's providing you an opportunity to go fresh long at current levels. So for a target of 9,300, I'll use this opportunity of correction in trade today to go long with a stop loss at 82.20 on the downside. The second stock is a sell, Muthoot Finance. The entire structure of this stock has been butchered now, and it's looking like it's headed further lower. For a sell call, I will go short on this stock in the future segment. Look for a target of 1900 on the downside with a stop loss at 2100 on the upside.
Okay, so those are picks coming through thick and fast. Let's look at DLF as well. Q4 numbers. Anushi here with a brief on how the numbers looked. What stood out for you, Anushi?
Well, I'll talk about the operational numbers. Well, that's the big talking point for DLF. Now, pre-sales up over 39% in the fourth quarter at the mark of 2,000 crore or so. It's collections which have reported a robust growth at 51% growth that we are looking at the levels of 3,320 crore. So considering this pre-sales and collections growth that we've seen in the fourth quarter, if you take that in consideration and see the FY25 numbers, pre-sales were up around 44%. That's the new sales bookings at the mark of 21,223 crore, higher than the guidance of 17,000 crore, which the company had achieved in the third quarter itself. Do note that the bookings were expedited because of the launch of the Dahlias project, which led to these kind of jump that we are looking in new sales bookings. While if you look at collections, they were up over 36%. It's also the operating cash surplus which has seen an improvement of 128%, which again led to a net cash position to 6,848 crore as compared to 4,534 crore in the previous quarter. Now the expectation is for FY26 that they'll be launching 15% of their overall pipeline in FY26. So that would be something that is interesting to watch out for. Conference call slated later for today. So management commentary in terms of where the pre-sales are concerned is important to keep a track of, considering we are looking at a higher base for this year. Just quickly walking through the headline numbers also, seen about a 47% of a revenue jump this year. Margins stood at 31% as compared to 35%, and net profit saw around a 39% of an increase. So this is the overall perspective for DLF. It's a beat across the pre-sales and the collection guidance that we are looking for FY25.
Okay, so beat across the board. I want to quickly take it across to Aditya. Aditya, how does DLF look and some of the other realty players as well? If you have a quick view before I take a fundamental view from Nirav.
Oh, definitely. It's looking strong to me, Harsh. I think after a bit of a correction from the top, it's an opportunity to go long on DLF for a target of 800 to about 820 on the upside. Look to go long with a stop loss at 730 on the downside. One more stock that I would like to add in this space is an Oberoi Realty. That is also looking interesting to me. Excuse me. Again, a bit of a correction in the stock in trade today, providing an opportunity to go long for a target of around 1800 to about 1820 on the upside, with a stop loss at 1660 on the downside.
Nirav, do you like realty, and what within realty? Because you have a Suntech up 2.5%, a Raymond up 5%. Any of those names on your radar? What's your preference?
Well, of course, we've liked stocks like Godrej Properties and DLF. DLF has reported a very strong set of numbers, and this is on expected lines. And I think they have pointed out earlier also that they have a very low-cost land bank and a slew of launches which are there. We've already seen the super premium luxury offering, that is the Dahlias, and it has received a very strong response. And some more new projects are lined up. 15% of the launch pipeline is slated for FY26, as you rightly pointed out. So I think DLF should continue to do well. We also like Raymond quite a lot because they've got around 100 acres of land with a gross development potential of around 25,000 crores. Plus, they have entered into joint development agreements for projects worth 14,000 crores. So I think 40,000 crores projects are slated to be executed over a period of time. So it's looking quite exciting. Most of it is largely low-cost inventory with potential for superior quality gains.
Well, this stock is obviously locked in upper circuit while we are at it, but yeah, that's one option which Nirav seems to like within the realty pack. Aditya, let me come to you very quickly. The Nifty is down now 1.1%. We've slipped below 24,700. What's the call with regard to the Nifty, the Bank Nifty? What's the view on the index? What are levels you're looking at? Very quickly.
So if you're not long on the index or short on the index, completely avoid. I wouldn't trade both the Nifty or the Bank Nifty. But you already have a position. In case you have a long position, maybe you can continue to hold with a stop loss at 24,540. For me, that is a key support level, 24,540. Till the time that holds, I think markets will remain in a range between 25,000 to about 24,500. As far as Bank Nifty is concerned, that is where I think the outperformance will come in the near term. So 54,500, about 55,500, the 1,000-point range for the Bank Nifty is where I'm seeing the market consolidating. I don't see too much of a trouble in the markets going by today's down move, because clearly for me, VIX is the key index that I'm watching out for. As I mentioned, till the time it is crossing 18, I'm comfortable in the market.
Okay, so those are views on the index. Aditya, your BTST for the day.
So I've got a buy on GAIL, a very interesting chart setup. Harsh looks quite a bit a long trade candidate for me from here on. So for a target of 200 with a stop loss at 185, I'll go for a BTST here.
All sectoral indices have slipped in the red now, and for a while now. At least that's how it's playing out. Now, in terms of, there are one or two other stocks as well which are buzzing, and Quest Corp is one of those that we spoke about. Nirav, let me quickly come to you with regard to a Quest. Would you have a view? The stock is down 9%. Is this an opportunity to buy at this point?
Well, it's a very interesting space in the workforce and the staffing solution space. And I think this stock has been punished for a slight miss in terms of the performance. So I think this should definitely be used as an opportunity to enter into the stock at these levels.
Okay, and what do you make of something like a restaurant brands, Nirav? Would QSR has been, quite weak in that sense for a while now. The first signs of a zing, it seems. Do you expect this to be a sustainable theme which will last?
Well, I think QSR has been struggling for a while, and I think still we need to wait for a couple of quarters before we see really some tangible improvement in terms of numbers, and the consistency of that performance needs to be maintained. So I would be a little bit wary or cautious before making an entry into these stocks at this point of time.
Sure. Now, the other space that's buzzing is green energy. Quickly switching spaces as well. Inox Green surging on the back of order wins. Varsha joins us with details with regard to this one. 12%, Varsha.
Yes, absolutely, Harsh. So if you see, let me just talk about the the recent order win that has been announced. So they've signed agreement to provide operation and maintenance services for 285 megawatt peak of solar projects. Now the next leg of growth for this company is of course the solar projects. Now the projects belong to two major Indian renewable energy companies located across multiple sites. Now this new agreement will increase their company's operation and maintenance portfolio to 1 gigawatt, and companies are rapidly adding solar assets to its portfolio. But on the growth strategy, when it comes to Inox Green, they are targeting portfolio of 10 gigawatts in next 3 to 4 years. Their solar operation and maintenance potential is expected to reflect in FY26 revenues. And lastly, they are actively pursuing acquisition when it comes to stressed assets, which will come through the inorganic growth that they have been doing and they will be doing in the future as well.
Okay, so that's on Inox Green. Within the green energy basket, Nirav, anything that's looking good to you, and any views with regard to an Inox Green?
Well, I think Inox Green has been quite aggressive, and the market is finally paying heed to their performance potential. We've seen the renewable energy projects pick up steam, especially in the recent past. And I think their strategy of being focused on the solar energy projects with very, very ambitious targets being set out. At the same time, focus on O&M, that is operations and maintenance, which tends to have superior quality margins. And the strategy of acquiring the stressed assets and throwaway prices, I think it can work very well for the company going forward. We also like KPI Green, and we like Adani Green Energy.
Okay, Nirav, the other one that's buzzing today is a Coal India. Does this look good? Of course, high dividend yield, PSU, generally a theme during the hot summers when electricity consumption goes up, and you'll start to see those numbers trickle through in Q1. What's the sense?
Well, I think Coal India, we are seeing some of the PSU basket getting widened because we are seeing good action in Coal India. We've seen action in ONGC also. But I think yes, it's looking good from a medium-term perspective, and especially in light of the fact that it could be a cash-rich company and can expect a better dividend payout as far as the company is concerned.
Okay, and Aditya, what about charts? How is Coal India looking on charts? Because it's holding up very well in trade on an otherwise very difficult day of trade.
Yes, Harsh. In fact, this was one stock which was on my radar to give a trade here. Good that we are talking about Coal India. I think it's a good trade to take after a correction from the peak. I think it's a good correction. It is a good trade to take long here for a target of 430 on the upside. I'm looking with a stop loss at 400 on the downside. 430 should be a target. You can definitely look at a long trade in Coal India.
2% correction in the auto index, Aditya. Anything looking interesting there?
Definitely, Harsh. In fact, I did mention about a two-wheeler name within the auto pack, that is Bajaj Auto, giving you an opportunity to go long. The second on my radar will be a Tata Motors stock after a bit of a correction up move is a little soft in trade today. I think that is an excellent opportunity to go long on Tata Motors at current levels. For a target of 800 on the upside, I would definitely look at going long here. The second four-wheeler name on my radar is Mahindra & Mahindra. Again, I think a matter of time before it breaks out into an all-time high territory above 3,200. So again, in today's correction, it's giving you an opportunity to go long on Mahindra & Mahindra as well for a target of 3,400 on the upside. One should definitely look at latching on to these opportunities, both within the two-wheeler space, Bajaj Auto, within the four-wheeler space, Mahindra & Mahindra and Tata Motors.
Okay, some names for you. IndusInd Bank will declare numbers tomorrow, post-market. Plenty of things to look out for. You'll have derivative losses which have been understated, which will be booked. A profit after tax impact of around 1,580 or 1,600 odd crore. You will also see a discrepancy in accrual of interest within the MFI portfolio of around 600 crore. That will get impacted, or that will impact the numbers as well. This is a pre-tax number, mind you. Then you will have the microfinance portfolio and the recovery there, which will be in focus. Broadly, you're expecting a loss of around 320 odd crore. This is as per Bloomberg analyst estimates. This is complete, and it's difficult to call as to what that number will be. Nirav Ashar, is IndusInd on your list of stocks which you could likely find interesting at this point, given that valuations have compressed sharply?
Valuations may have compressed, but the problems are compounded. So I think we've exited this stock a long time back.
Aditya, your take on IndusInd, yes or no?
Yes, if you're a Braveheart.
Oh, Braveheart. Okay, and what are the levels you look out for?
I think it's giving a good risk to reward. So with a stop loss somewhere on 700, maybe you can look for a target of 950 on the upside.
Okay, thank you so much, gentlemen, for coming in, giving us all of those views. We'll let you go on that note. It's been a packed day per se with the way in which markets have moved, because we're now down 1%. We're just about a minute and a half from close, but we're down 1% on the index. We're holding 24,700 somehow. But when you're looking at it intraday, there's sustained weakness all through the day that we've seen, and we are just off the low point of the day, at least for now. We're around 50 odd points from the low point of the day. Okay, so that's on the Nifty. Let's look at the heat map on the Nifty 50 as well. Breath looks tough on the Nifty. It just gets worse as the day has progressed. Couple of PSUs in focus, Coal India and ONGC, two of those. You're seeing a decent uptick in a Tata Steel, which is holding up very well on a day like this. You're also seeing Hindalco on the back of numbers make that 1% move. Outside of that, it's just a coat of red across the board. Auto stocks are the ones which are in focus and under pressure. Hero, Bajaj, Maruti are three of those languishing within the top or the bottom five of or the top five losers on the index today. But that's how it's playing out. Let's look at the advanced decline as well in terms of the market breadth overall, and that's also looked difficult and keeps getting more and more tough as the day has gone by. We're now seeing nearly 3:1 on the advanced decline in favor of the declines, and it was a choppy start to the day, at least with regard to this, and therefore the Nifty mid cap and small cap, you'll get direction straight from here. The Nifty mid cap also under pressure, 1.5% lower, in fact underperforming the index today. The Nifty small cap outperforming, but just about marginally, 0.8% lower. Again, both of those just off the day's lows, but that's where the pressure continues. It's been a couple of days or a few days where the Nifty mid-cap and small-cap indices have actually outperformed the Nifty 50. Today, not one of those days, clearly. Let's look at sectors as well. Auto likely languishing right at the bottom. IT, metals for a large part of the day was in the green, by the way. It's down as well now, 0.3% lower at close. Nifty Defense is the top loser of the day. Outside of that, the consumption index saw some pressure. You saw pressure on the pharma index as well as the Nifty media. Those were some pockets where there was pressure. FMCG largely in line with how the Nifty 50 performed. IT and metals stood out for a better part of the day, but have closed in the red. That's how it's played out. Let's pull up the BSE 500 top gainers, top losers as well. And HLE Glasscoat on the back of those fantastic numbers. Pfizer as well. BASF is up 8.5% at close. Restaurant brands again on the back of numbers. Raymond just another day at the office, 5% higher. Quest Corp again on the back of everything that's playing out and numbers. Cochin Shipyard, some pressure coming on the back of the defense space being under pressure. Then you have HEG again on the back of numbers. So plenty of movers on the back of numbers on this list. Quickly on to what to watch out for tomorrow. In terms of global, those are the two Qs, but smaller ones. Let's look at the other ones. Yes, you have Page Industries. You have an interim dividend of 200 rupees per share coming. There's an IPO offering, Bellrise, which will come out with a fresh issue of 2,150 crore within that 85 to 90 rupee band. Watch out for this one. Again, some bit of zinc coming through. And Zinca Logistics will also be in focus as the anchor lock-in opens. So IPOs, again, there's plenty of moves happening now. It's just about starting. Let's look at some names to look out for on the back of earnings. I'll have my eyes on an IndusInd Bank. Plenty to talk about over there. You'll also want to watch out for the con call. PFC will be the other one within the financials basket, which will be in focus. Outside of that, within the consumption basket, a Colgate, a Protean eGov will be in focus. What to expect in terms of numbers going into FY26, that will be in focus. Uno Minda within the auto space. Star Cement, Gokaldas, Nalco are just some of the others, along with an NTPC Green, which will be in focus. But for today, completely out of time on this edition of India Market Close. From Hiral, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with.
Hello and welcome. You're watching Market Express and I'm your host Himakshi Bahugna. Now let's get straight to the show. Here's in a volatile day of trade. The Nifty dropped over 200 points, dragged by HDFC Bank. The Sensex has dropped by more than 700 points. Telecom stocks weighed on the Nifty 50 the most. Weak global cues, uncertainty over the Indo-US trade talks and high valuations of stocks pushed foreign investors away. Almost all sectors traded in the red, led by FMCG, auto and financials. Another reason for the drop was the spike in the 20-year Japanese government bond yield. Yield surged to the highest level since 2000. Rupee closes 24 paise lower against dollar at 85.64. IDFC First Bank is in talks with domestic institutional investors to allay any concerns over the appointment of a non-retiring director from Warburg Pincus on the board. Now, according to people in the know, conversations with domestic institutional investors have already begun. On Monday, institutional investors voted against a proposal to appoint a non-retiring, non-executive representative from Currency Investments on IDFC First Bank's board. And giving you another exclusive, in a bid to make its IDBI Bank acquisition offer more attractive, Emirates NBD has decided to deploy a wholly owned subsidiary in India. While Emirates NBD India has been active for some years with 3 branches in India, it received an in-principle nod from the Reserve Bank of India to set up a wholly owned subsidiary. Now, this would be through conversion of its existing branches in Chennai, Gurugram and Mumbai. Shareholders approve a 49.5% cap on foreign ownership for Eternal, aligning with its inventory-led model focus. Now, this triggers MSCI and FTSE passive selling with potential outflows of $1.4 billion over multiple quarters. Now, MSCI's weightage halves. Domestic ownership rises to 23.5%. supporting data localization and inventory control, but the model demands higher capital and operational efficiency. Quest Corp shares dropped 10% despite strong quarter four of FY25 results, reporting a net loss of 95 crore due to demerger related expenses and an exceptional loss of 158 crore rupees. Margins fell below guidance, impacted by lower sales and an unspecified IT incident raising transparency concerns. Now, the drop was also led by liquidity concerns, with cash levels at a 6-quarter low and a 120 crore impairment charge on trade receivables. DLF shines in quarter 4, crushing FY25 guidance. Net profit skyrockets, led by robust pre-sales from the Dahlia's project. Collections soar and the net cash position strengthens to 6,848 crore rupees. The company also proposed a dividend of 6 rupees per share. During their post-earnings con call, BEL stated that they are expecting 15% revenue growth in FY26 with margins at 27% and capex exceeding 1,000 crore. Now, over the next 5 years, revenue growth is projected at 15 to 17%, with a major order for next generation Covetus expected this year. BEL also plans to increase exports revenue by 15% to $120 million, with 20% growth projected from next year. Protean eGov was eliminated from the PAN 2.0 project despite earlier confidence, leading to a stock decline of 7% after hitting a 52-week low. Acquirers downgraded the stock to sell, cutting the target to 900, citing risks as PAN services contribute 50% of revenue. Analysts are expecting a 75 to 100% revenue collapse over the next 2 to 3 years, with a 35% decline in FY27 overall revenue. PNB Housing Finance approved issue of non-convertible debenture of up to 400 crore rupees through private placement. The NCDs carry a coupon rate of 7.53% per annum. While the specific use of proceeds was not detailed in the announcement, such issuances are typically used to fund business growth, manage liquidity, or refinance existing debt. Shares of Zydus Life Sciences fell in Tuesday's session after the company reported a weak fourth quarter. Now, the profit declined by 1% to 1,170 crore rupees. Revenue and EBITDA clocked an increase of 18% and 30% respectively. ICICI Securities upgraded Zydus Wellness to buy rating. The brokerage said that Zydus Wellness's Q4 FY25 organic performance was good. Best-in-class revenue growth of around 12%, driven by 7% volume growth. The brokerage also added that while unseasonal rains may impact Q1 of FY26, improved execution may trump this challenge. And in the medium term, portfolio premiumization may support margin expansion. Shares of Vali Energies hit nearly its one-month high levels on Tuesday. Now, this comes after the company's board approved the 293 crore rupees acquisition of Kamath Transformers. Now, Kamath Transformers was incorporated in 1996 and is into manufacturing transformers. In financial year 2024, the company posted a turnover of 122.68 crore rupees, while in fiscal 2023, it had reported a turnover of 54.41 crore rupees. Hindustan Foods posted a good quarter, reflecting a strong growth in ice cream and beverages. The shoe business of the conglomerate also turned operationally profitable. It expects a 3 times higher capital turnaround after it completes its full capital expenditure. Margins were, however, due to higher employee and depreciation costs. Pfizer's shares price surged over 12% to 4,990 rupees after reporting an 85% jump in Q4 of FY25. Net profit versus last year to 330.94 crore rupees. Revenue grew 8.3% to 591.91 crore rupees, while EBITDA rose 20% to 227.5 crore rupees, with margins expanding to 38.4% from 34.7%. Now, the company announced a final dividend of 35 rupees per share. Now, the rally was also supported by recent sales and marketing packed with Mylan Pharmaceuticals for 2 brands, and that makes it the stock of the day as well. Now, NLC's fourth quarter revenue grew by over 8% on an annual basis. The company received its all-time highest ever coal production. Net profit was mostly led by other income. Now, lower other expenses aided EBITDA margin. The consolidated profit of the company almost tripled from 114 crore to 482 crore rupees. Eris Life Sciences reported a 28% year-on-year revenue increase to 705.3 crore rupees in Q4, despite a marginal slip in insulin revenue execution. EBITDA surged 70% to 252 crore rupees, with margins expanding to 35.8% from 26.9% due to operating leverage. Now, net profit also grew 32% to 93.8 crore rupees, though impacted by higher depreciation, interest costs, and taxes. Margin expansion was also led by operating leverage. Acme Solar reported robust Q4 with over 65% year-on-year revenue increase to 487 crore rupees, driven by a 1200 megawatt capacity addition. EBITDA doubled to 488 crore rupees, with margins expanding to 89.5% from 68% due to operational efficiency. However, net profit fell above 76% due to lower other income. The company commissioned phase 2 of a Rajasthan project and aims for a 10 gigawatt portfolio by 2030. DOMS Industries reported a good quarter, with revenue rising by 26% and net profit surging over 7%. But the margins, however, slipped slightly to 17.4% from 18.8% earlier, and this was due to rising depreciation cost, employee benefits, and higher other expenses. And as per an NDTV Profit exclusive, viewers, SEBI is exploring to expand its regional offices. And the primary reasons for prioritizing its regional expansion is to extend its contribution to investor protection and education, preventing frauds in Tier 2 cities, and also provide more career opportunities to people from deeper parts of India. And in the latest on the Gensol engineering scam, we understand from sources that the Corporate Affairs Ministry plans to finish the probe in the company and its 18 affiliated firms soon. The aim is to conclude the probe in a beleaguered company in 3 to 5 months. Also, if enough evidence is found, the MCA can go ahead without involving the Serious Fraud Investigation Office. India is preparing to open up a new Wi-Fi channel known as 6 gigahertz band, which could make a big difference to streaming, working, learning and general connectivity. The Department of Telecommunications has already put out draft rules to de-license the 6 gigahertz frequency. At present, India mostly uses lower frequency Wi-Fi of 2.4 gigahertz and 5 gigahertz. In conversation with NDTV Profit, Hitachi Energy's MD and CEO N. Venu highlighted strong growth in transmission, renewable energy and data center sectors that outperformed the market, with exports contributing about 25% of revenue and boasting better margin profiles than the domestic market. The company plans to maintain a sustainable export strategy while keeping the domestic markets as its main focus. H-1B visa applications have dropped, reflecting reduced hiring appetite among US firms. The global layoffs have led to fewer registrations, impacting professionals seeking work opportunities in the US. Additionally, the high application fees are discouraging new applicants, further contributing to the downturn. Macquarie is bullish on Sun Pharma. It maintains outperform rating and hikes target to 2,135 rupees. Now, the brokerage sees Sun Pharma's checkpoint bid seen as a strategic win. It expects the bid to increase the pharma company's profitability. It also believes unlocks it as a strong, solid strategic fit too. It reckons that unlocks it fills crucial gaps in Sun Pharma's derm onco portfolio. Hindalco's Q4 net profit surged by 41.4% versus last quarter to 5,283 crore rupees, surpassing expectations. Revenue grew 11.1% to 64,890 crore rupees, while EBITDA rose 16.5% to 8,836 crore rupees. Margins improved to 13.6% from 13%. The company announced a dividend of 5 rupees per share. Strong performance reflects robust operational efficiency and favorable market conditions. Max Healthcare reported a 34.2% year-on-year revenue growth of over 1,900 crore rupees in Q4, with net profit rising 27% to 319 crore rupees. EBITDA grew 34% to 511.62 crore rupees, though margin slightly dipped to 26.8% from 26.9%. Now, the company announced a final dividend of 1.5 rupees per share. Strong operational performance drove the results despite stable margins. Interglobe Aviation is expected to report over 21,800 crore rupees in revenue, which is a 23% higher compared to last year. Now, adjusted EBITDA is seen to be up 27% at more than 5,200 crore rupees, and net profit is estimated to grow 36% to 2,574 crore rupees. Now, the earnings will be driven by higher air traffic, better fares and lower fuel cost. EBITDA is projected to rise 29% to 5,876 crore rupees, with margins improving to 26.8%. Key factors include favorable air traffic due to Mahakumbh's stable rupee and reduced crude prices, offsetting higher airport charges. Investors should monitor geopolitical impacts, FY26 guidance, aircraft delivery risk, and updates on business class and loyalty programs. Kotak came up with a note on Q4 earnings. The brokerage noted that Q4 earnings for FY25 was subdued, with Nifty 50 earnings growing just 4.8% year-on-year despite rich valuations. Banks and downstream oil marketing companies outperformed while most sectors faced challenges. Now, consumer companies saw weak volume growth, margin pressures and muted demand. Investment companies reported margin issues, and banks noted sluggish credit growth. IT services highlighted weak demand, reflecting a cautious economic outlook across industries. CLSA upgrades Amber Enterprise to outperform from hold, signaling confidence in its growth trajectory. The firm raises the target price to 7,275 from 7,000 rupees, citing strong quarter four performance in line with estimates. Robust growth guidance and an uptick in non-AC segments drive optimism. CLSA notes that PLI scheme will enhance return on capital employed, while margin and return improvements stem from expansion beyond ACs. Amber's diversified growth strategy is the key focus. Inox Green Energy signs a pact for operations and maintenance of 285 megawatt peak solar projects, expanding its O&M portfolio to approximately 1 gigawatt. The projects belong to two major Indian renewable energy firms. Inox is rapidly adding solar assets, reinforcing its growth strategy. HEG reports sequential revenue improvement reflecting business stability. However, EBITDA takes a hit due to rising raw material costs and low graphite electrode prices, impacting margins. Additionally, other expenses increase amid a decline in fair value of investments, adding pressure on earnings. Low price competition from China remains a key concern, potentially affecting the profitability in the coming quarters. On to some national news now. Following Operation Sindoor, the beating retreat ceremony or lowering of flags at Wagatari, Hussainiwala and Sadki joint checkpost of the Border Security Force was stopped on May 9. However, with the easing of tensions between India and Pakistan, the retreat ceremony will resume today. NCP's Chhagan Bhujbal was sworn in as the minister in the Mahayuti-led Maharashtra government. State Governor C.P. Radhakrishnan administered the oath. Chief Minister Devendra Fadnavis was present at the swearing-in ceremony. Along with his deputies Eknath Shinde and Ajit Pawar, Bhujbal replaces Dhananjay Munde, who resigned in March over allegations involving his aid in the murder of Sarpanch Santosh Deshmukh. Maharashtra government announces new housing policy, announced with the motto of My Home, My Rights, or Mera Ghar, Mera Adhikar. A comprehensive program of slum rehabilitation to redevelopment will be carried out with an investment of 70,000 crore rupees. Specific needs of low-income earners, senior citizens, women, industrial workers, and students will be prioritized under this policy. Now, the program will be implemented by Housing Department. The COVID scare appears to be making a comeback, with India logging 164 fresh cases since May 12. India currently has 257 active cases, with Kerala, Maharashtra and Tamil Nadu leading the number rally. In the past week, Kerala reported 69 new cases, Maharashtra logged 44 and Tamil Nadu added 34 cases. Maharashtra also reported 2 deaths, which according to doctors are not COVID-19 deaths, but both patients were found to be COVID-19 positive. Not just India, a resurgent wave of COVID-19 is spreading through Southeast Asia, with densely populated regions in Hong Kong, Singapore, China and Thailand witnessing a spike in cases. Health authorities are on alert in major cities like Hong Kong and Singapore. China and Thailand have asked people to take new booster vaccinations. Bharti Airtel and Google announced a partnership that brings a compelling Google One cloud storage subscription service for Airtel customers, helping address the mounting challenge of limited device storage. All postpaid and Wi-Fi customers will get access to 6 months of 100 gigabyte Google One cloud storage at no extra cost. Now, they will also be able to share the storage with up to 5 additional people. A Delhi court has acquitted 12 men accused of murdering a man during the 2020 Northeast Delhi riots, citing the prosecution's failure to identify the perpetrators or establish their role in their killing. The accused were tried of the murder of Amir Khan, whose body was recovered from the Bhagirathi drain of Gokulpuri on 27th of February 2020. A post-mortem examination had revealed 25 injuries on his body. Dakshina Kannada and Udupi district administration asked fishermen not to venture into the sea until May 23 due to adverse weather conditions in Karnataka. They also asked the fishermen at sea to return to the ports. The IMD issued a red alert for coastal Karnataka until 8:30 a.m. on May 22nd. eSpy-Trip CEO Nishant Pitti has denied allegations of being aware of Sky Exchange's activities linked to the Mahadev betting app. Now, news reports say that ED is probing eSpy-Trip CEO Nishant Pitti in the Mahadev betting app scam and making payments to shell companies. The Indian Meteorological Department has warned of heavy rainfall across states. These states include Kerala, Tamil Nadu, Puducherry, Karaikal, Konkan, Goa, Central Maharashtra and other until 24th of May. China's benchmark lending rates were lowered to 10 basis points after the nation's central bank cut its policy rate to stimulate domestic demand. The People's Bank of China revealed that the one-year loan prime rate was lowered to 3% and the five-year rate was reduced to 3.5%. Now, this marked the first cut to benchmark lending rates for the year, following a series of monetary easing measures by Beijing. China's fourth biggest state-owned bank said that they will lower deposit rates by up to 25 basis points. And now the latest on the Russia-Ukraine conflict. President Donald Trump is making fresh moves to push for peace talks. Speaking to the press, he emphasized that the US is not stepping back from efforts to stop the war and revealed that he's reached out to Russian President Vladimir Putin. Meanwhile, Ukrainian President Zelensky says that Russia is preparing new demands in a memorandum that will soon be shared with Ukraine. He hinted at broader negotiations involving the US, the EU, the UK, and possible venues including Istanbul, the Vatican, or Switzerland. Zelensky reaffirmed that Ukraine will not withdraw its troops but expressed hope that the path forward will become clearer soon. In a shocking Premier League upset, Liverpool suffered a 3-2 defeat at the hands of Brighton at Anfield. Despite taking the lead twice, the Reds couldn't hold off a determined Brighton side who sealed the win with a dramatic late goal. Manchester United is set to activate the $62.5 million release clause for the Brazilian forward Matheus Cunha. Cunha has impressed this season with 17 goals and 6 assists in 34 appearances. Personal terms are reportedly close to being finalized, with the official move expected after the season concludes. Veteran actresses Shamila Tagore and Simi Garewal attended the screening of Satyajit Ray's film RNA Din Ratri on day 7 of the Cannes Film Festival 2025. They both walked the red carpet at the film's premiere and graced it. Shamila Tagore wore a stunning green sari, while Simi Garewal walked in the red carpet in an ivory dress. The 1970 film premiered at the Cannes Classics section. And as we move into tomorrow's trade, keep an eye on Japan's balance of trade, Canada's consumer price index on the global front. Also keep in mind the dividend announcement of Page Industries of 200 rupee per share. Belrise Industries will be open for subscription and Zinca Logistics will exit its anchor lock-in period. Well, with that, viewers, it's a wrap on Market Express, but stay tuned to NDTV Profit as there's more lined up ahead for you all.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims?
Benchmark equity indices plunged sharply. The BSE Sensex falls 872 points, barring Tata Steel, Infosys and TCS. All the other constituent stocks of the Sensex end in the red. IDFC First Bank in talks with domestic institutional investors to allay any concerns over the appointment of a non-retiring director from the Warburg Pincus on their board. In a bid to make its IDBI Bank acquisition offer more attractive, sources say Emirates NBD has decided to deploy a wholly owned subsidiary in India. Sources say the MCA probe against Gensol will be completed in 3 to 5 months, adding that there may not be a need to send the case to Serious Fraud Investigation Office if MCA gets enough in its investigation. Markets must work for many and not just for a few, reiterates Union Finance Minister Nirmala Sitharaman, adding that a sudden spike in the electronic way of doing business and digital commerce globally poses new challenges for competition watchdogs to protect the free market spirit. In a significant move, the Maharashtra Cabinet approves a new housing policy, My Home, My Rights, with an investment of 7,000 crore rupees, which will aim for slum rehabilitation to redevelopment. With 164 fresh COVID cases reported since May the 12th, India sees a rise in cases and currently has 257 active COVID-19 cases, with Kerala, Maharashtra and Tamil Nadu leading the number tally. Good evening, you're watching Profit 360 on NDTV Profit. I'm Sanjana, bringing you the latest updates. Over the next 30 minutes, we'll dive into the biggest market movements along with top national and international headlines. So let's take a look at how the markets fared today. Investor sentiment took a hit as both the Nifty and Sensex plunged over 1%, marking a broad-based sell-off. All sectoral indices closed in the red, with a staggering 43 out of the Nifty 50 stocks ending lower, signaling widespread weakness across the board. Harsh now joining in with a complete wrap of the day's market action.
Well, markets have taken a bit of a breather. In fact, more than a little bit of a breather today. 1% lower. We're well off the 25K mark now. We're now staring at 24,700 in fact today. And there were signs that we could be bracing for some bit of more pressure, because we slipped below 24,700 and thereafter closed just above it. So around a percent shaved off on the Nifty. But given the kind of rally we've seen, not much to worry about. Let's look at stocks which were in focus. BL had numbers which came out within the Nifty pack. That was one of the stocks which were in focus. But outside of that, Coal India and ONGC were two of the three top gainers on the index today. Hindalco on the back of numbers was in focus, and that's the other one which was almost perked up 1% in trade. A strong set of numbers coming through on Hindalco. Let's talk about the stocks which are languishing at the bottom, and the larger theme there was auto. Bajaj Auto, a Maruti, a Hero. Three of those were part of the top 5 losers on the Nifty 50 index today. So those stocks under pressure, and of course therefore the Nifty Auto index was down nearly 2% because you saw that pressure on the Nifty Auto. Outside of that, defense was under pressure. A Cochin Shipyard was down 8%, and some of the other defense stocks, something like a Zentek, a Data Patterns, all of which had zoomed or have zoomed for a while now, saw some pressure and some cool off coming in on the Nifty defense. 2.25% lower on the Nifty defense as well. So that was the other pocket which saw some pressure. Outside of that, the outperformance was shown in the Nifty Metal, where China actually cut its lending rates, and you saw the Nifty Metal for a predominant part of an otherwise weak day sit in the green. It closed in the red though, around 0.3% lower, and so was the case with the Nifty IT. So Nifty IT and metals, even though they outperformed, you saw some pressure right towards the fag end, and that was the case even when it comes to the advanced decline and the breadth. The breadth was difficult right towards the end. It was 3:1 in favor of the reds, and therefore you saw some pressure creep through even on the Nifty small cap and mid cap index. Both of those indices, the Nifty small cap largely in line with the Nifty 50, around 0.8% lower, but the Nifty mid cap was where some real pressure was getting built in, 1.5% lower at close. In terms of big movers on the BSE 500, largely focused on certain specific names where there were moves. You saw Pfizer up 11, you saw an HLE Glasscoat which was up 20, locked in upper circuit. So a couple of those names were zooming in trade, and so did the ones which didn't do as well. Some of them were on the back of numbers.
Thanks for that, Harsh. And shares of Eternal, previously Zomato, also dropped nearly 4% today after shareholders approved a foreign ownership cap of 49.5%, raising questions about its potential impact on investor sentiment and future capital inflows. How will this decision shape the company's long-term strategy, and could it influence market confidence or investment dynamics? Mahima joining in now with deeper insights.
So as you rightly mentioned, shareholders have now approved the fact that board did approve earlier that 49.5% is the cap to FI holding in Zomato. The board of directors had already approved that, and now shareholders have come out and given the approval on the same. Now, in terms of how this impacts overall, in terms of how funds will flow out of Zomato, plus how it will change in terms of the way Eternal will work. Firstly, it will trigger the MSCI and FTSE passive selling. Selling could be as much as $1.4 billion in multiple quarters. In terms of MSCI details, current weightage is around 1.3 times. This will become half, and outflow will be anywhere around $600 million to $800 million. For FTSE, the current weightage is around 1.17. The outflow could be anywhere between $500 million to $600 million after review. And first review will happen in June 2025. After that, every quarter will see outflow of around $70 to $100 million. In terms of what this means for Eternal, last QIP where Eternal raised around 85 billion, there was an increase in terms of domestic ownership which was seen. 8% overall was subscribed by domestic funds. Post the QIP, FI ownership fell to around 47%. DI ownership increased to around 20%, and currently DI ownership stands at around 23%, and FI ownership continues to fall, and now it is at 44%. Increased domestic ownership aids basically your data localization norms, your control over inventory, as well as safeguarding local consumer data. Plus, inventory based model will be adopted by Eternal going forward, and better control over product quality and pricing will take place. Higher margins through bulk procurement could be one of the factors that could work positively in favor of the company, and easier promotion of private label could also take place. But challenges, of course, this comes with a lot of challenges, including requiring of stronger grip over operations, plus requires high working capital, and plus there could be risk of unsold and obsolete inventory as well. So this is the overall view as to how and what this means for Eternal exactly.
Thanks so much for that. And sources now indicating that Emirates National Bank of Dubai, that's known as Emirates NBD, is considering acquiring IDBI Bank through a wholly owned subsidiary, a move that the lender believes is strategically well placed and simpler compared to other potential acquisition structures.
Right, so the Reserve Bank of India gave its in-principle nod to Emirates NBD to open a wholly owned subsidiary in India. Of course, remember that the wholly owned subsidiary model exists, has been in existence since 2013, but most foreign banks have actually kept away from it. Now, what is happening with Emirates NBD is that according to the bidder, it will be easier to acquire IDBI Bank if a wholly owned subsidiary exists in India, and that is exactly why they are going for it. Remember that the wholly owned subsidiary model is only one way of how foreign banks can actually operate in India. The other way is through a branch system where essentially the foreign bank is the owner and it opens branches in India. Currently, Emirates NBD has about 3 branches in India, one in Chennai, Gurgaon, and then in Mumbai. And once this wholly owned subsidiary model has been approved fully by the Reserve Bank of India, and if the IDBI transaction goes through, then of course Emirates NBD will hold that entire franchise of IDBI Bank in India. Currently, they are in competition with Fairfax for this acquisition. Fairfax, of course, if you know, is a Canadian investor led by Prem Vatsa. He's a billionaire. Fairfax already currently owns a bank in India through CSB Bank, and it has to enter complicated transactions to be able to acquire IDBI Bank, and that is why Emirates NBD believes that a wholly owned subsidiary model will make it easier for them to be eligible for IDBI Bank. All in all, both bidders are currently still concerned about the way employee unions at IDBI Bank will react to the news of a foreign lender buying IDBI Bank. That is something that they have expressed to the government as well. If any further delays are caused because of this employee union, then that may cause some trouble in the sale of IDBI Bank.
Thanks so much for that. And moving on to another top story that we've been tracking very closely. The Ministry of Corporate Affairs is pushing to wrap up its probe into Gensol Engineering and its 18 affiliated firms within the next 3 to 5 months, is what sources are saying. Now, the investigation is centered on corporate violations, including alleged fund diversion and misuse, raising serious concerns about governance and financial integrity. Rishabh Bhatnagar joins us now with exclusive insights from his sources.
What we're picking up from sources within the Ministry of Corporate Affairs is the fact that the investigation into Gensol Engineering and the various affiliated companies is broader than we earlier expected. It will now cover about 18 companies, that is excluding Gensol. So the broader investigation now covering and spanning about 19 companies. What the MCA sources are telling us is the fact that they aim to conclude this investigation within 3 to 5 months, and that is purely on the basis of the evidence that they have. What is felt within the government is the fact that since this case is very recent, it's very hot currently, so they will be able to find evidence and they will not have to sort of confer with the SFIO, which is the Serious Fraud Investigation Office, and they can unilaterally pick it up and wind this investigation down within 3 to 5 months. Separately, what we're also hearing from the MCA is the fact that they are planning to table an amendment to a section of the IBC, of the Insolvency and Bankruptcy Code, that requires companies that are moving for insolvency to obtain CCI approval prior to approval of the resolution plan by the Committee of Creditors. They are planning to do away with this, and we expect that this amendment will be tabled in this monsoon session. So that is the recent on what we're picking up from sources within the Ministry of Corporate Affairs.
Meanwhile, at a CCI event, Finance Minister Nirmala Sitharaman underscored the importance of balanced regulations amid global economic challenges, highlighting ongoing structural reforms and the push for streamlined merger processes. She also pointed to how regulatory delays impact trade negotiations with different countries and investor confidence.
In an export-challenged, environment-challenged, energy-challenged and emission-challenged world, the increased reliance on domestic growth levers requires ensuring the right balance of regulation and freedom. India's ongoing structural reforms, whether it is asset monetization, disinvestment, and digital public infrastructure, all are geared towards unlocking market potential and deepening competition. So in this year's union budget, I had mentioned the importance of a light touch regulatory framework based on principles and trust to unleash productivity and employment. In the same vein, regulators must be guided by the principle of minimum necessary, maximum feasible in order to balance regulatory vigilance with a pro-growth mindset. In today's interconnected and fast-paced economy, delays in regulatory clearance can lead to uncertainty, disrupt commercial timelines, and potentially erode the intended value of transactions. And globally, it has an impact even as we negotiate free trade agreements with different countries, because the ability, the nimbleness, and the readiness of our regulators is very keenly watched by investors. There is no need for me to underline the importance of that, but that has a very serious connotation when you're looking at fairly within reasonable time agreeing on some free trade agreements. So whether it is litigation, whether it is time consumed in litigation, or whether when regulators are less transparent, negotiations can get complicated.
And on the sidelines of the 16th annual day of the CCI, NDTV Profit's Rishabh Bhatnagar spoke exclusively with CCI chairperson Ravneet Kaur. The discussion covered its role in the free trade agreements negotiations, exploring how competition policy influences international trade deals. Additionally, Kaur shared her views on the ongoing investigation into Gensol Engineering, addressing key concerns surrounding corporate governance and regulatory oversight.
We have these free trade negotiations which are going on, and in the free trade agreements there is normally a chapter on competition. So the competition chapter in these free trade agreements is negotiated, and we already have the India-UK FTA, which has now come into force, and we have a competition chapter in that as well. So as and when there is any requirement for new negotiations to be held on bilateral trade agreements, CCI would be contributing to that.
Ma'am, we've seen CCI act very nimbly with regards to quick commerce as well as e-commerce with the cost of production regulations as well. What exactly is the aim of these as we go ahead now?
No, the cost of production regulations were meant to provide clarity and ensure that there is consistency in how cost is determined by the Commission, and then to come to the further findings if there are any anti-competitive practices being followed by the companies.
Lastly, ma'am, the hottest case right now is, of course, Gensol, BlueSmart. What's the sort of progress, and now how is CCI involved in this case now?
The Gensol matter, CCI is not involved with it. It is NFRA, NAFRA, which has received a reference from SEBI, and the preliminary examination is going on.
And in a landmark move, Maharashtra has introduced its new housing policy, Mera Ghar, Mera Adhikar, aimed at tackling housing shortages through slum rehabilitation and redevelopment. With a 70,000 crore investment, the initiative is expected to transform urban housing landscapes and provide long-term solutions for vulnerable communities. What does this mean for residents, developers, and policymakers? Abhishek from NDTV joins in now with key insights.
It is a good news for the people of Maharashtra. Maharashtra State Cabinet has approved the new housing policy for the state, and it has the concept of my house, my rights. You know, on that line, it has been conceptualized, the entire policy. And if we talk about implementation of policy, around 70,000 crores have been kept. And this is the policy which is coming after the 2007 policy, which was the last policy decided by the government on housing. And when it comes to what will be there in the policy, you know, it will be inclusive policy for all. For example, affordable housing, rental housing, and using important and modernized technology for construction. And most importantly, lower income group, senior citizen, women-centric housing. You know, these are the new criteria that have been added, and the government is focusing on these areas. Definitely, when we talk about housing for all is the base from where this policy has been formed, and it is looking forward in the lines to give housing to everyone possible and right from affordable housing to the rental housing, and looking forward to creating land banks across the state of Maharashtra. So most important to understand out here is definitely this new policy will be a game changer for the people who are looking forward to their dream homes in future.
India is gearing up to introduce the 6 gigahertz Wi-Fi band, a game-changing move for streaming, remote work, online learning and overall digital access. Now, this upgrade promises faster speeds, lower latency and improved network efficiency, reshaping the country's internet landscape. What will this mean for consumers and businesses? Aishwarya joins us now with more insights.
Well, just to set the context, currently, if you're using Wi-Fi in your homes, in your office spaces and public spaces, it is probably 2.4 gigahertz or 5 gigahertz of bandwidth. Now, what the government has done with the rollout of delicensing the 6 gigahertz bandwidth draft is that this will enable us to have faster connectivity. It will also enable faster video calls, gaming, as well as 4K streaming, which was earlier, of course, possible, but at a lower speed, there was some sort of latency involved. Now, this upgrade will also help Wi-Fi 6E as well as Wi-Fi 7 being brought into the market. Now, the devices will be tuned, of course, and we'll see how that goes further. What it also does is it supercharges the internet, and also it is ready for AR, VR, as well as smart home devices that you may see in the market currently. Now, the indoor Wi-Fi, according to the draft, has been capped to 30 dB, which is a little technical, but what it essentially does is helps in reducing interference between neighboring Wi-Fi devices. As far as 6 gigahertz is concerned, it is open to public. There is no license needed, but it cannot be used on cars, boats, planes, oil rigs, or even drones, and is just limited to local ground use. Now, what this does is puts India on the map of the 100 countries that have opened 6 gigahertz spectrum already. And the government wants, of course, like I mentioned earlier, feedback on this by the 15th of June. So far, that's the update. The pre-6 gigahertz and the post-6 gigahertz era is going to be different, especially for those who want to use certain devices that don't match the bandwidth currently.
Thanks so much for that, Aishwarya. And now the number of H-1B visa applications received by the US Citizenship and Immigration Services has fallen by 25% for FY26. Now, this decline comes as macroeconomic uncertainty drives layoffs, while high application fees continue to deter applicants. Haripriya now joining us with more details.
H-1B visa applications for 2026 have dipped significantly by 25% to 358,737. Last year, this number was at about 44,900. From the total registrations this year, about 120,141 have been accepted, which is again lower than 135,000 odd that were accepted last year. US typically issues 85,000 H-1B visas every year. H-1B visas are the non-immigrant visas which allows skilled workforce to pursue a job in the US. Majority of the H-1B visa holders are Indians. For instance, 72% of the visas issued in 2023 were to the Indians. Mostly the Indian tech workforce depends on this to go and pursue opportunities in the US. The tech companies in the India and US both exercise this visa. In this context, the dip in the registrations is seen when there is a lot of inconsistency in the job market and there's a lot of uncertainty. We see that multiple tech giants are laying off. The most recent being Microsoft laying off 6,000 employees, Amazon laying off 100, and other companies like Intel, CrowdStrike have also laid off employees in the recent past. Another reason for the dip is also that the registration fees has been hiked significantly. In the previous US administration, that's Joe Biden administration, the fees had gone up from $10 to $215. Now with the new Trump administration coming in, there is a lot of uncertainty around the immigration policies and what it means. That's also causing a lot of confusions and concerns for the people who are looking to shift to the US for the jobs.
Absolutely, Haripriya. Thank you so much for that update. And moving on, after months of relative stability, India is witnessing a slight uptick in coronavirus cases with 164 new infections reported in the past week, bringing active cases to 257. Now, leading the resurgence are Kerala, Maharashtra and Tamil Nadu. And while the numbers remain low, health experts advise staying informed, following safety guidelines and maintaining precautionary measures. Sujata now joining us with more updates.
Amid a slight rise in the COVID-19 cases in parts of India and abroad, Maharashtra stands at the second place with almost more than 50 patients that have been reported positive of the COVID-19 disease. And at this point, it is the BMC which has reassured its people that there's no situation to worry. And even if a rise in a number of cases have been noticed, BMC is fully prepared with its COVID wards, which has been specially designed to take care of these COVID-19 positive patients. In the recent days, we saw where 2 patients admitted in KM hospital. They died, but the reason behind their death was not COVID. They were COVID positive. However, the reason behind their passing away was that one was diagnosed with cancer, while the other was facing a kidney failure ailment. And at this point, the BMC has assured that all of the hospitals, especially the BMC hospitals across Mumbai, they are ready with all the required dosage of medicines as well as wards. And all the doctors have been informed to stay on alert. As soon as a rise is seen in these cases, they will be given immediate treatment. And also, it has been stated by the State Health Department, ensuring along with compliance with the BMC that there is no such untoward incident, especially when it comes to lack of careness being given to the patients of COVID. At this point, it is we see that there was a situation of panic amongst Mumbaikars when 2 deaths were reported. However, the BMC and KEM hospital to clarify that it was not because of COVID, and especially because Mumbai has an international airport. Travelers and passengers from across the world, they visit Mumbai, and because of which the chances of the pandemic being spread are much higher. However, at this point, COVID-19 is an endemic and not a pandemic, and it is at a stage where majority of people can face it. However, it is curable through taking proper precautions, and also people have been advised to maintain safe distance from people, especially at crowded places, to wear masks and take care of themselves and ensure that they are not in touch with at these crowded places with people in unhygienic conditions. And henceforth, once again, BMC preps up for the COVID-19 rising cases in Mumbai, and also assures its people that there is no situation of tense or panic, especially when it comes to this disease, as the BMC and the State Health Department are fully prepared.
And that's all the time we had on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome. You're watching KYC. I'm Harsh Saita. We'll quickly look at the company that we're going to talk about. That's going to be Tips Music. Why are we looking at this company? Because it's super duper interesting. It's around 8,000 crore in market cap, but it has an asset base of just 300 crore. That's one of the reasons. The other reason is it has a very high free cash flow that it distributes straight to shareholders. So again, that's the other piece that you want to keep in mind. But one, what are they changing in terms of strategy? There is going to be a large change. The number of songs that they produce annually is going to go down by 70%. Yes, you heard that right. And there is a reason for that change. Now my question is to the management is going to be as to whether that large change is actually warranted or not, and whether that rationale is punchy enough for that large change. So that's the first thing I want to know. The second one is what gives them confidence to guide for a 30% growth when the number of songs that they are producing is going to come down from 450 to nearly 125 at the very maximum. So despite that sharp fall in the number of songs that they're going to produce, what's giving them confidence to drive a 30% growth for the foreseeable future and not just for FY26? The third one is going to be the outlook on cost per song. Cost per song has gone up from 8 lakh rupees for production to 16 lakhs. And this is average cost per song. That's the math we've done basis the commentary that's come out at the end of Q4. So over the last year or so, we've seen costs rise very, very sharply. What's the outlook going forward? Given that there are these large changes when it comes to the number of songs, does the cost of song change as well? And therefore, what's the impact of that on margins? And therefore, are they confident of maintaining that 64% kind of margin number? Last couple of things that I want to know is what happens to the free cash flow that continues to come in. They've done large amounts of buyback over the last few years. Does that continue? Do they continue to distribute the cash to shareholders? And last one, what's the aspiration from a 3 to 5 year period? So it all looks good, but if you're able to justify the rationale and you're able to take care of margins, what's in it for the next 3 to 5 year period and beyond? What is it that the company is looking to achieve? This and more. But let's first, as always, dive deeper into what exactly does Tips Music do. And I'm going to quickly pull out what it does. First, it was founded in 1988. It has around 11.5 crore subscribers on YouTube. It's basically a music production and thereafter streaming company. So it produces and distributes the music that is produced by them. They are into the acquisition and exploitation of music rights. So they have already a bouquet of music songs for which they have rights, and those rights, they have a library of around 30,000 odd songs, and those rights are thereafter distributed. They also have produced and released around 40 Hindi films over the last 2 decades or so. They also sell theatrical, satellite and various other rights to distributors and broadcasters. A lot of this currently is with regard to music. It's a debt-free company. It has around 271 crore of cash and investments. This is as per their investor presentation. I want to just highlight that because cash otherwise on the balance sheet is not as large. The company earns all its revenue from license fees. Something to keep in mind. 70 to 75% of its revenue is through digital platforms. Not surprising, given YouTube, Spotify, the advent of digital is what the company has capitalized on, and the remaining 20 to 30% odd comes from other digital platforms. You have 45 to 50%, and those other digital platforms are platforms like a Zoom TV, right? So you have TV channels which broadcast music as well. So those are also some other means in which they make money. But 45 to 50% of the digital revenue. So to kind of break this down, 70 to 75% of total revenue comes from digital. 45 to 50% of the digital revenue comes from YouTube. So you have around 35% of the top line coming straight from YouTube. The export of services is a large chunk of their revenue. The domestic, not as much, because most of these streaming services are all sitting in the US. They're platform companies. Now, in terms of digital versus non-digital, that's the breakup. 75 versus 25. So non-digital now commanding a smaller share and will continue to come down, mind you. Let's talk about partners that they have and they distribute through. And these are just illustrative because there'll be several more partners as well. You have YouTube, Meta, Spotify and Apple Music among the plethora of other partners that they have. This is in terms of the new songs that they added every year. FY22 saw 276 songs, FY23 896, FY24 733. Here's where things start to change. You look at the degrowth, 18% in FY24, 40% in FY25 and a likely 70% lower from that point in FY26. So you will want to watch out for this number as to why this is falling, and we will talk a little bit about that with the management. Let's also talk about the YouTube views which are being clocked, especially over the last few quarters. You look at the way in which the YouTube views are shaping up, and this obviously depends on number of days as well. But broadly, you have 5 crore plus views, around 6,200 crore plus views that, or 5,000 crore plus views that it clocks nearly every single quarter. And that obviously has an effect on the top line of the company. So that's how it's shaped up. Now let's quickly look at the metrics that we'll look for with regard to this one. We'll first look at the income statement. We'll thereafter look at the balance sheet, the cash flow. We'll look at shareholding. We will look at return ratios. We will look at street cred. We'll look at valuations, and we'll look at analyst recommendations. We'll look at all of these and try and assess as to whether this is a good business or not to possibly consider. Let's start off with the income statement. And if you look at the income statement, at least over the last 3 years, it's very healthy growth that you're seeing. Top line has gone up from 140 odd crore to 311 crore, which is a 32% growth. EBITDA has gone up from 86 odd crore to 210 crore, which is again a 30% growth. Margins have expanded a wee bit, which has allowed profitability to go up by 37%. It's difficult to give a business like this with a past performance, 3-year performance like this, anything but a thumbs up. So we've given it exactly that. It's as good as it can get. One thing that you should know with regard to how the numbers have shaped up, they largely spend their expenses, which is before EBITDA. All their expenses are largely on creating music, creating content, and they actually expense that out immediately. So say for example, they are creating a song in Q4 of FY25. They will expense that entire amount in Q4 of FY25, but the revenue largely from digital means, will come for maybe the next 1 year, sometimes if lucky over the next 5 years as well. So therefore you'll have recurring revenue over the next 5 years, but your expenses are realized upfront. And therefore you're seeing the kind of margin number that you're seeing, because the expenses for a song which was launched 3 years ago were already booked 3 years ago. And therefore that income continues to flow to the top line. As the income continues to flow to the top line, you have margins which are holding up very well. But you might have some expenses in a quarter or two which may be elevated, because you will be producing more songs in a particular quarter than another quarter. And therefore you might see some bit of choppiness on a sequential basis with regard to margins. But overall, when you're looking at the annual trend, you're seeing margins between that 60 to 67% kind of bracket, more so in an even tighter range between 63 and 67%. So that's something you want to keep in mind, that you don't want to look at this business from a quarterly perspective. You want to look at it from an annual perspective, whether they are able to achieve the annual numbers that they have been looking to achieve. So that's something you want to take care of. Now let's talk about the balance sheet. So income statement behind us. The balance sheet, one, its net worth is roughly 210 odd crore. Its net worth will continue to rise, but it's doing buybacks on a regular basis. It's a cash rich company, mind you. They did mention in their PPT that they have 271 crore of cash plus investments. Now when you're looking at cash on a standalone basis, you can see the number on your screen, around 40 odd crore of cash. They had 131 crore of cash at the end of FY24 as well, which they've used for some buyback as well in April of 2024. So something again to keep in mind is that they regularly distribute the cash that they have. They don't hold on to cash for a very long time. They hold on to cash only to produce new music over the next quarter or two. So that is something again that you want to take care of. The second thing is there's no debt on the balance sheet. It's a clean balance sheet. The asset base is extremely small. We spoke about that. It's just about a 300 crore asset base in terms of total assets. And last off, they regularly buy back shares. So your equity, your absolute equity base has continued to shrink. In terms of when I'm removing reserves and surplus from that equity line, just the equity base is shrinking on a consistent basis. Over the last maybe 10 years or so, we've seen a shrink on that number. Something again to look out for, that the equity base is shrinking. So that's with regard to the balance sheet. It's a thumbs up, because there's very little to nothing to complain about in terms of either debt or in terms of cash. There's sufficient of all of those factors. Let's talk last about cash flow now. Cash flows are largely in line with profitability. There was a chunky amount in FY24 which came through, due to which there was a little bit of excess cash flow which came through in FY24. FY25, that has normalized. Largely it's a steady state in terms of the cash flow, nothing to complain about. In terms of cash balances, they keep smaller balances. I did speak about that. Also, they have a high payout to shareholders. So they largely pay out all of their profit to shareholders. Let's now talk about return ratios. In terms of return ratios, the asset base is very small, and hence the return ratios that you are seeing on your screen extremely high. I want to also highlight that this is one of the highest return ratios that you will see. But it's that type of industry where if you're expensing out immediately and you're not capitalizing any of your costs with regard to music made, your return ratios will tend to be higher. I want to highlight FY21, the ROCE was 47%, FY22 62%, FY23 62%, FY24 79%. That's how the return ratios have gone. ROE is also 48, 63 in FY22, 64 in FY23, 81 in FY24 and 86 in FY25. So you're seeing a gradual inch up with regard to ROEs as well, but expect that to happen because you've expensed out a large part of whatever you've built in terms of IP, and the unwind of that is happening in subsequent years, and therefore that explains the ROC and ROE metrics, but it's a strong number and hence the thumbs up. Now I want to talk about shareholding for a bit. Promoter holding 62% odd, 64% odd, no concerns with regard to that, and therefore we won't delve into this too much, but a clear thumbs up with regard to promoter holding as well and shareholding as well. There's plenty of skin in the game. Let's talk now about street cred. The last 6 months, the stock has been under pressure. Year to date, the stock has been under pressure, but the 1 year returns on the counter is good at 49%, and the 5 year returns is very strong. We'll give this one a neutral. That's how we look at street cred. Now let's look at valuations. Now when you're looking at valuations, Tips Music trades at around 49 times. You have Saregama, which is the other competitor, which trades at 51 times. But you look at the 1 year forward of Tips, and this is where it starts to kind of stand out. While it's an expensive counter, 1 year forward, it's looking at 39 times. And when you're looking at maybe 2 years forward, it'll compress even further to sub 30 times because the growth clip is very fast. So valuations, there seems to be some comfort, but you want to see whether the new strategy is getting executed, because currently it's sitting at 50 times. If the new strategy does not execute well, then you might not see such a fast compression in price to earnings, and hence we've given this a neutral because there's a bit of a question mark there. The last one is with regard to analyst recommendations. There are 5 buy calls, 1 hold call. There's only 6 analysts covering this, and hence we're cautious. We've given this a neutral on that count, but the return potential is 21%. In terms of multiple, this is trading at the lowest multiple in the last 12 months, 1 year forward, that we have seen this trade at. So at 39 times, the multiple is also the lowest, and hence you are seeing that upside that we are seeing. Let's quickly though go across to Kumar Taurani, who's the managing director at Tips Music, on what the strategy is and what he is looking at in terms of market share. Welcome, Mr. Taurani. It's good speaking with you. Let me first start off with why this change in strategy. Why go from 450 odd songs to do 100 to 125? What's the thought process behind this like?
No, we won't give out market share. On the contrary, we will increase our market share. See, when we make 500-600 songs, so our time is limited. It's distributed in all the songs. We have a team of around 10 people. So if you calculate, one person is making 50 songs a year average. I'm talking just an example, a number, and 50-60 songs versus 10 songs he has to make. So I think he will be more focused and give me more quality, and we can reject more songs. And we are not compromising on the quality and on the money also. Whatever money we have planned to invest, we will invest that money. We will sign bigger artists. We will do bigger marketing. All that we will do. So that is a focus for coming years.
Got it. So that's for FY26. What about beyond FY26? Will you go for a larger base in terms of songs beyond?
Please understand that our focus is on quality. So maybe 80 we karenge, yeah, maybe we can go up to 150 also. That's not a hard and fast rule. Okay, we have to just stick to a number. Whatever good quality songs we will get, and we have a budget, we will invest and we will acquire or produce. I think the way FY26 is behaving, I think more or less we are already there, and I think this year. Okay, maybe last year some songs left out, maybe it will touch that number, but around 125, 150, yeah, this year.
And sir, the total market in terms of how India is shaping up is going to grow from around 7,000 to 10,000. So despite that, you will stand out and you will continue to do 100 to 125. So the number of songs is not going to be the focus at all.
I think we must realize what is the success number. I think if you see, our main focus is on film side. So if India produces 1,000 films, the success ratio is only 8-10%. So our focus is we should be in that space maximum. And if you see my tips ka track record from 2005, 4, 5 onwards. 90s, we were a very aggressive player. We were the 60, 65, 70% of that period's content tips has acquired. And if you see at that time, from 88 till 2002, 3, anywhere, any award function or any award, out of 10 songs, 7, 8 songs, of top 10 songs, 7, 8 songs belong to tips. And among the 5 nominations in many awards, we had 3, 4 nominations. So we want to, after that, when market changed to physical to non-physical, so we concentrated on maybe 30, 40 songs a year, but my success ratio is 90%. So that is the key to the music business, I feel. And touchwood, we have a very experienced team, so I think we can make it. And that is the next growth for us as well. So I think our focus is there. Plus, one more thing, nobody understands that music business repertoire catalog is very, very important. If we all combine entire industry produce good new numbers, then our new numbers business will be 20-25%. But still 75-80% will be a catalog business. Whatever your favorite songs over the years you have selected, you have separated, you have made your own playlist, you won't forget listening those. In case you like 2 more songs, you will add to your playlist. But you keep listening all those songs over the years you have liked. So, and whenever there is no good new releases, so there will be a 95% of a catalog business. Only 5% will be new releases. So majority is catalog, and our catalog is touchwood doing very, very, very well. If you see, there is no major new releases we have done for last 4 or 5 years, and we are growing 30% year on year. So that is because of our old repertoire, whatever hard work we have put in last many years, that is actually giving us fruits.
Right, no, so I fully appreciate what you're saying. So, but you've also guided for a 30% growth. Give us the breakup. How much of that comes from old songs versus how much will come from new? And will that 30% growth be sustainable?
I think so far our new releases, you can say 15% contribution and 85% comes from catalog. But our going forward, our target still is a 30% top line we have to do for next 2 years, at least 3 years. So among that also, we want new releases should be more. So now target is we should achieve 20-25% to new releases and 70-75% should be a catalog.
Very interesting. Now, sir, the other piece is with regard to costs. When I'm looking at, and I've done this math, the cost per song has doubled last year versus this year for you. Where do costs go in this new shift in strategy? Where do costs go?
Cost will continue to rise. Harsh, please understand, we can acquire a song from 50,000, say, leke 7-8 crores also. So that is the range. So we can't actually pinpoint. If I'm taking a big blockbuster movie of a multi-star film or something, so I have to pay 25 crores, 30 crores, 40 crores. Pata nahi abhi kya ho raha hai. But there's a very tough market. But we are not in that rat race. But there is like that.
Point taken. And sir, therefore, where should margins be at? 85% is from old catalog, 15% from new. Costs will rise. Where do margins go?
My catalog is doing really, really well. So our margin and then that entire catalog, whatever we release, whatever music we make or acquire, we release that music, we write off that content cost in that same year. So that is a big advantage Tips has. This is not, we are not doing from now. We are doing this since beginning. If I carry forward for 4 years or 10 years, then I have to pay more tax and it will hurt my cash flow in those days. Those days there was a very cash flow was very tight, so we have to need money quickly. So we used to write off entire content cost same year. So that is from beginning we are following. Still we are following that.
Okay, so sir, therefore EBITDA and PAT should also grow at 30%.
EBITDA will maintain. And PAT also, we are trying we should be at 30% in the 30% range, 30% top line, 30% bottom line. We should achieve PAT. That is our target for this year, next year. Yes.
What about distribution? You're a low capex kind of business, and therefore, will you continue to distribute dividend?
We give it to our, we declare dividends, or whatever last year we made money. Last year our PAT was 127 crores. We given 136 crores to our investor shareholders by way of buyback and dividends. So we keep continuing doing that. Big dividends.
Right. Sir, talk to us about what the aspiration is in the next 3 to 5 years. Your low capex intensive, your 30% growth on top line, bottom line. What's the aspiration in the next 3 to 5 years?
See, we are very focused on this business, music and films. We have both two separate companies, films companies separate, music companies separate. And we are very focused and we are really doing good. I feel we can really do good in film business as well. It will take little time. But I think our focus is to build these two businesses properly and keep growing. And if we don't want to do anything other than this, so very focused, we'll continue doing this.
Okay. And so what's the risk like therefore? It looks like a very low risk business, 85% of top line largely guaranteed. Is the distribution model a risk?
I don't feel there is any risk there because they also need a business. They are also having they are not paying us any, earlier they used to pay us upfront, minimum guarantees, but now they are paying us from earnings. So they also making money from us and they are getting content, you can say directly free actually. Okay, they are sharing some money with us and on a streaming basis or a advertising or a subscription basis. But we are investing so heavily, so they understand that. So I don't feel anything about that. And this is happening for last so many years. And if you think this is the same practice they are doing internationally. So why you want to disturb a smooth business is going on? Nobody disturbs that, I feel.
Okay. Thank you so much, sir, for coming in and breaking this down for us. Very interesting, and wishing you all the very best for the next year or so on this new strategy and its implementation. But what we're going to do is we're going to quickly also look at the ratings that we've given, the KYC rating on this one. Such strong growth, definitely a thumbs up. Balance sheet, thumbs up. Cash flow, thumbs up. Return ratios, we've seen how return ratios have gone up because the asset base is so low. Shareholding is a thumbs up, 65% owned by the promoters. Street cred, there's been some bit of a hiccup with regard to returns over the last 6 months or so, but the last 12 months have been solid. Valuations, again, not looking cheap by any stretch. It's at 50 times. That's what its peer also trades at. But there's going to be a new strategy at play. Whether that valuation holds fair or not is a neutral on that count. And analyst recommendations, just very few analysts covering this one. So we've given this a 6.5 on 8 on KYC, at least for the moment. So that's our KYC rating. With that, it's out of time on this edition of KYC. We hope you found this helpful. Very interesting business. At least that's how I found it. Stay tuned. More action on the other side. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims?
Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Now, when it comes to financial decisions, a lot of them are influenced, shall we say, by what other people do. What is your neighbor investing in? What is your best friend investing in? And when you meet somebody at a dinner party, for example, and they say, hey, what are you doing with your mutual fund investments? You should be investing in scheme A, B, and C. And invariably, those schemes are sectoral or thematic schemes that have done particularly well over the last 6 months. And you feel, what have you done? Why have you made the decisions that you've made? Well, we're here to tell you that you're not really in a very small minority. In fact, most people get their decisions wrong when it comes to investing in sectoral and thematic funds. And we'll talk about why that is. We'll also talk about how you should approach your investments into these schemes. Joining me today is Himanshu Kohli, the co-founder of Client Associates. Himanshu, thanks so much for joining me and for speaking to me about this very interesting topic. Now, I did send you a few questions in the run-up to this conversation, and the data that you've pulled up is quite eye-opening. In this entire realm of nearly 200 schemes, it turns out that not many of them have been able to beat their respective benchmark and the wider benchmark either.
Right, Alex. So I would say what you mentioned, it's a typical social conversation. Someone says, I have invested in a defense fund. It has done phenomenally well. I have invested in ABC fund. It has done very well. And next day you want to pick up your paper and just maybe invest over there. So you're chasing maybe certain themes, certain excitement which is happening. And I would say the simpler you keep it, the boring you keep it, it is better for you from a long-term point of view. So if you see the data, very few funds have actually beaten the respective benchmarks. Very few funds, active category, have been able to beat the broader category, which is BSE 500 as a benchmark. Now, we do not think it's the best thing for investors to just chase certain themes basis what their neighbor has told them or their friend has told them, or maybe what they have seen some excitement on some one of the news channels. It is very important to put your whole investment thesis into an investment policy statement. How much should be the core portfolio? How much should be the satellite portfolio? And if satellite portfolio is offering you one or two themes which you can just top up, what should be the best approach to go for it? Should it be through a pure passive index or should it be through an active manager over there? It's extremely important over there.
It's an important point that you raise. And what we'll do is we'll delve into some of the details. I think, Himanshu, the tendency also is to look at fund selection like you would look at an equity portfolio. And here, I think a lot of people, and this is data that proves it, most people venture into equity mutual fund schemes. And I know that that trend is shifting, thankfully so. People are looking at fixed income, people are looking at hybrid as well, which is a good sign. But the reality is that most investment takes place, retail investment takes place in the equity space. And people do select this basis how they would normally select a stock portfolio. Do you think that's the reason why you have a problem? And the fact is that we don't have a lot of history, a lot of expertise when it comes to selecting investments.
Right. So I would say a lot of people, they are chasing returns, chasing performances. In fact, the more detached you are with the portfolio, the better the performance is. So if you see from 1st of Jan till 15th of May, 4.5 months, there are 196 thematic funds which are there in the system. Only 14 of them have been able to outperform their respective index
and the broader markets. Only 25% of them have been able to perform their respective index. Now, it is better to go to diversified mutual funds, or maybe if you want to add certain themes in your portfolio, it is better to go maybe through the index strategies. Uh, that is something which I would say is a better way to manage it. In fact, some of these hybrid funds, a lot of people said asset allocation should be in your hand. Why are you giving the discretion to the fund manager? In fact, if you see the data 3 years rolling, 5 years rolling, some of these asset allocation funds or balanced advantage funds or balanced funds, they have actually done far better because investors are detached from the investment decisions. There are no inefficiencies which comes into picture over there. And if they are particularly bullish, those fund managers are particularly bullish on certain themes, let's say banking, financial services, or defense per se, they can always overweight in a diversified fund towards those themes and give you that alpha creation if it's possible.
And the data that you've shared in the sectoral and thematic category, I just want to pull that up on the screen while we're at it, just to drive home the point before we go to Himanshu and ask him what he is advising at this stage and what he's seeing basis the trends that are currently prevailing. In the automotive space, for example, there is only one fund and it hasn't beaten the benchmark. PFSI, much more populated, but none have beaten the respective benchmark. Both benchmarks also not beaten. Consumption, there's one fund out of 18 that has managed to beat both the benchmarks. You have the most outperformance in the tech space, where you've seen 4 that have managed to beat their respective benchmarks, but they've not really managed to beat the broader market benchmark, which is the BSE 500 in this case. So it's not really looking like a pretty picture. But having said that, Himanshu, it's not like you don't recommend investing in sectoral thematic. You pointed out that there can be a tactical allocation. So if one is to look at this juncture, what the landscape looks like, how does it look like to you?
So Alex, we always believe in a core and satellite strategy. Core is 80% of the client's portfolio, which can be across large, flexi, oblique, multi-cap, oblique, mid and small cap, diversified funds, oblique certain indexes. Then there is a satellite. So let's say there is a theme which, let's say, banking and financial services is looking very good. So about a year back, 9 months back, we gave a call that we would like to add 10% over there. Now, there one can pick up one of these active managers or just the pure index over there and build the portfolio around it, because let's say if interest rates comes down, or maybe the sector has not done very well in the past and today is available at a reasonable valuation, some of those things really bring alpha in clients' decisions. So this core and satellite approach really helps us. And sometimes we do not have anything in satellite, then maybe the 100% portfolio could be a core portfolio also.
Okay. I want to talk about some of these aspects, because you've shared certain data. I was looking at the top performance and the bottom performance over the last 1 year for the sectoral thematic categories. And I was looking at some of the more popular themes and sectors, right? So things like IT or tech, and things like infrastructure. And I found, Himanshu, that there is a very wide variance in the top performer and in the bottom performer. In certain cases, there is negative returns as well, whereas the top performer is gaining about 20% or 18% or thereabouts. Why is that? And talk about the way that these funds are curated and the portfolios are made.
Right. So let's say if we see some of the top performing themes have been defense, which has given about 28% returns in this year. I think a lot of it has happened because of this latest India-Pakistan tension. Defense stocks have done fairly well over here. But at the same point in time, they have become expensive. Now, financial services, as a broader theme, has done fairly well. It is also an outperformer right now because of the interest rates being low, the margins have been maintained, all those things. And it was not a top performing sector maybe 3 years before this. So this has actually come up quite well. And if you see some of these sectors which have not done very well is, let's say, pharma, for example, or IT, for example. A lot of it is dependent upon US also. Maybe there is some discretionary cut which is happening over there. So some of these things have actually not done very well. So if broader market, which is BSE 500, has given 2.5% returns, the range of certain themes could be anywhere between 28%, which is for defense, and minus 11, 12% for IT, which has actually happened over here. So I would say uh, these themes, they bring so much of excitement to people that I want to chase a particular theme because I've heard there is some major thing which is happening because of Mission Sindoor, or something is happening in the technology side. For a retail investor, it's better to just stick to more diversified funds, even to maybe broader uh, uh, asset allocation or balanced advantages funds, because there the fund manager is actually taking a decision, and some of these retail investors do not have the ability to hire a professional wealth management firm to advise them on their asset allocation needs. So they can actually go to ready-made solutions over there. But yes, HNIs, UHNIs who can afford to have an advisor over there, there my advice is do not get carried away with certain sectors. Just keep maybe a smaller portion, which could be 10 to 20% to certain satellite themes,
Yeah.
and then participate over there.
Okay, let's break it down though. And since you've mentioned defense a couple of times, I want to specifically ask you about that. There are a few more options that are available apart from the HDFC Defense Fund in the passive category as well. But considering the kind of run-up that you've seen in the defense pack as a whole, 20% plus last week, maybe some cool-off is seen this week. But would you take money off the table, tactically speaking, right now? If someone was to come to you, Himanshu, and say, look, I had this, I've been doing an SIP over the course of the last several months, and it's given me, what, 55%, shall we say, over the course of the last 1 year. And of course, that is point to point. You would probably have gotten more basis your SIP. Would you take money off the table?
So I will also take into consideration what is the capital gains tax which will be applicable, because if I'm paying short-term capital gains, it's also an added cost to me.
Yeah.
Is there any exit load which is applicable in case I take it out? I need to give weightage to those things because that's an actual cost which I'm paying over there. Ideally, I would like to be in the long-term capital gains tax regime, and I would like to be off the exit load period. Then it makes sense because clearly the valuations today in this sector are looking expensive. And since I have made very good returns, and if there is no adverse penalty I need to pay, maybe I would like to rebalance it over there.
But if the first 2 points that you raised in terms of short-term capital gains and exit load are not ticked, then you would say that incremental investments into the space might be stopped and you can hold. Is that a valid approach?
Absolutely. So in case there is an exit load as well as a short-term capital gains, I would like to hold on to whatever I have invested over there, provided I'm not overexposed to this one particular sector, which in most of the cases will be the case. And fresh investments, I will recommend not to go in for this because already the sector has run up quite a bit. And today it's an expensive sector to buy.
Okay. Just on the point of exit loads, you pointed that out, and for most people would know about this, but for the few of you that are coming across the theme for the first time, what happens is that a few fund houses actually, put a load on selling of the units in a mutual fund scheme, and this is to incentivize you or to stay longer, rather disincentivize you from selling too early. Himanshu, is that a fair assessment?
I would say there are merits and demerits. Merit is if someone is coming in a scheme, they need to have a certain minimum time horizon, because otherwise if there is no exit or entry load, people can become more traders. So the whole thought of lock-ins or having an exit penalty is you come in as an investor, which is with a certain long-term view over there. While, yes, if there is a penalty, maybe the fund house makes more money at the cost of the investor. So that's a disadvantage to the investor. But to me, it sounds more like protecting the interest of the investor and getting the right kind of an investor with the right kind of a time frame to come into those schemes.
Yeah, and there are some very prominent names that have a pretty long a period for which they choose to have an exit load, and the likes of the largest mutual fund scheme in India also has a pretty long period. But let's talk about a few of these other themes, Himanshu. And if you were talking about tactical allocations, and you mentioned banking and financial services, I do want to ask you about that specifically, because the way that I see it, most diversified funds, or even something like a Nifty 50, Nifty Next 50, would have a sizable allocation to banking and financial services just purely by dint of the fact that these companies have a pretty large weightage. So why would you want to go and have a further satellite allocation?
Right. So let's say if an index gives me 30% exposure towards these, and today I feel this sector is slightly undervalued with maybe attractive valuations. And if, let's say, FPI inflow starts coming in, which has just started happening also, and with interest rates the way they are, and there could be a likely rate cuts which could happen. Now, maybe the sector, I'm expecting it to outperform. So then I would rather be maybe 35 to 40% rather than 30%, which, let's say, a diversified fund is giving it to me. So I want to be overweight over there. And one of the ways over there is, since if I'm positive over there, to take maybe a particular sectoral call over there and go for a pure sectoral fund over there or an index over there. Because there are certain tailwinds which are fairly strong over there in this particular sector. So idea is always how much you want to be over and above what the benchmarks are offering you. And if you want to, you're bullish on a sector, there is actually no other way other than to go for a pure sectoral fund.
Okay. I want to delve into each of the sectors that I've selected. I've selected pretty much the biggest sectors where there's most population of schemes. Consumption is the next one I want to talk to you about, because everyone's talked about consumption over the last few months, not FMCG, but consumption. And from that perspective, a lot of people have also started investing in this, thinking that at some point there's going to be this whole bonanza in the way of the income tax breaks that will come through April onwards, and these companies will start reporting better numbers. There's going to be returns through the roof. How have you looked at it, and are you advising your clients to look at consumption theme?
So consumption is actually a big theme in India, because almost 85 to 90% we are dependent on Indian consumption. We are not too much into exports. So consumption is going to do fairly well from a long-term point of view. And right now, I feel the valuations are fair over there. If one has to go over there, maybe go through diversified funds and let the fund manager decide how much they want to put in the consumption and which category of consumption they want to put in over there. So I'm not advising any particular sectoral fund over there right now, because it's not, I have a long-term positive view, but valuations are also fair. It's not undervalued over there.
Okay, so that consumption out of the way. Infrastructure. And here, Himanshu, I think a lot of people are positive because of the growth story in India. And ultimately, for India to grow, power infrastructure has to grow. But the reality is that you've seen significant underperformance by a few schemes in this category as well. How would you approach this, and would you advise looking at this tactically?
So I would say we are quite bullish on India, and infrastructure is something which will actually lead to India growth story over a long period of time. So if we see all the data, the road construction, the railways which is happening, infrastructure which is getting built up in the country, whether it is power, next few years, there will be a lot of action over here. So I would say, yes, I'm extremely bullish on infrastructure. Only thing is, going through infrastructure fund per se, if I want to pick up, let's say, 5 stocks over there, and because of a particular sectoral fund or because of a particular index which I choose, I get 40 companies over there. Maybe 5 of them I'm very bullish on, but 20 of them I'm average, and maybe 15 just come in as a baggage over there. So there I'm saying, unless you have the ability to pick up those 5 stocks, do it yourself, or maybe just go to a fund which may want to emphasize slightly more on infrastructure, but not a pure sectoral fund. That would be a right approach over there, because I do not want to get the baggage of 15 stocks which will come as a part of my pure infrastructure fund. I would like to just see if the fund manager can pick up the winners, or I have the ability through my own office to pick up the winners, pick up those stocks and hold on to it for a long-term period of time. So short-term tactical call, no. Long-term, I'm very, very bullish. Fundamentally, infrastructure is going to do very well in India.
Okay. Himanshu, there are few schemes in this category that are very old. And I'm not asking you to necessarily recommend any, but I'm sure that you've studied the portfolios. For example, DSP India Tiger. And right. I looked at the last 1 year performance, and I've looked at the fact that it's down 0.84%. But since inception, it's 17.7% CAGR, and it's significantly beaten the benchmark, right? So what explains the underperformance? You have Tata Infra also that is relatively underperformed, Quant Infra is underperformed, whereas on the other end you have an outperformance by something like an LIC Infra, which is a positive 8.8. So there's a pretty big divergence here.
Right. So it also depends on which stocks they have selected, how much overweight they have gone on a particular stock. So if you ask me, there will be always a short-term divergence, but long-term they should actually move more towards the mean part of it. But over here, Alex, I would say infrastructure Tiger Fund, for example, has given phenomenally good returns over last 20 years. Over last 20 years, it has done fairly well. But last 1 year, the theme of value has come down. Growth has actually picked up over here. And some of these value stocks have not done very well in the recent past. But if I just take out last 6 to 12 months and before that, 3 years previous to this, value was doing very well. And that's where infrastructure or some of the PSUs, they were actually outperforming a lot. But a time for growth has actually come in for last 8-9 months. And that is where maybe you have seen a negative return in some of these infrastructure oblique value themes in the last few months or so.
Okay, let's round off the list and talk about pharma, healthcare and technology. And would you advise getting in tactically to any one of these, considering the kind of news flow that is coming in from the United States, and that's having a bearing on these practically on a daily basis, Himanshu?
Right. So very interesting point, Alex. Now, something which is not doing very well and has fallen, typically the tendency is to move away from there. I would say IT and pharma, healthcare, they are great long-term themes. And if it has fallen, maybe it's the time to become slightly greedy over there. And yes, there could be more news flows which could come. There could be higher volatility in these sectors as we see. Maybe if someone has to pick up, where valuations may suggest that you pick it up, but maybe go in a systematic manner. Don't buy it on day one. Maybe spread it over next 3 to 12 months, depending on your profile, whether you're aggressive, moderate, or conservative.
Okay. Now, to bring this conversation home, just a point. You've spoken about satellite allocation of 10 to 20%. Now, how would you approach this? Because you see opportunities in sectors in particular. It's like you have stocks. When you have dry gunpowder, you will deploy at once. So there is a lump sum investment, and you've pointed out in certain sectors you can stagger your investment. Is an SIP approach appropriate here, or would you tactically shift out of certain things and shift into a sectoral thematic fund?
So let's say 80% is more like a core portfolio.
Yes.
There, Alex, we believe one should just enter and hold on to it for about, let's say, 5 years, because equity is actually a 5-year kind of a time horizon is required. Even if exit load moves away after 1 year, your long-term capital gains tax kicks in after 1 year, but you hold on to your core portfolio with a 5-year view. Satellite portfolio could be with a 1 to 2 years view, minimum 1 year because of the taxation and loads which are applicable up to 1 year, adverse taxation and loads which are applicable up to 1 year. So there I would say certain themes where I am seeing certain volatility. Let's say I mentioned to you about IT or healthcare because of tariffs or because of whatever is happening in US right now. A lot of it is happening. Volatility is happening because of that. It's likely to continue for some more time. So there it's more prudent to do systematic investment plan, SIPs. Now, I know there could be an opportunity today, but I want to reduce the risk also because everyone focus on one R, which is return, but second R, which is risk, is equally important or even more important. There, I would say if someone is extremely bullish, maybe do a shorter term, 3 months SIP, but don't go lump sum over there. Also, when you have to move this, you have to see from where you can pull it out. Is it fresh savings which you are getting from your monthly salaries? Maybe use that. If not, maybe some money is lying in liquid funds, use that. Or maybe some places where you have actually completed a 5 years period and there is a reasonable returns over there and you want to take advantage, maybe redeem that and invest over here.
Okay. Himanshu, the last point, and I'm not pushing you to make recommendations, but we've spoken about BFSI, we've spoken about healthcare, and we've spoken about IT. And these are three themes that you seem to like at this juncture based on everything that is happening. Specifically, from the list of schemes that are available, what schemes, according to you, are well run and that have a good track record that my viewers can look at closely?
So I would say, Alex, rather than recommending you any particular schemes, I will say there are certain fund houses which are very well run. Whether it is HDFC, whether it is ICI, whether it is Nippon, some of these fund houses, they are run very, very well. If you are going in for the thematic schemes, I would emphasize that maybe go for the index funds over there. Or maybe if you are to still want to go for an active manager in these themes, pick up from one of these good houses where you are very sure about the long-term duration, maybe the governance systems, credibility has been established. So I would recommend maybe going for good houses. Again, as the data I have shared with you, I see a lot of merit in going through pure index funds rather than active managers for these thematic schemes.
Yeah, very, very well put, because active managers have failed to beat the benchmark over a period of time. Himanshu, thanks so much for joining me today. Pleasure having you on the show.
Thank you so much. Thank you, Alex.
All right, that brings us to the end of this edition of Your Money Matters. It's possible that you're left with a few questions after this conversation that we've had, even though it's been pretty detailed. But I'd invite you to write to us in the comment section and let us know what you'd like to know about, and we'll take it up in future shows. Thanks so much for watching. This is NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims?
Right, a number of factors have stood out for Hyundai Motor India in its Q4, and several factors have aided that bottom line outperformance. Among them, the mix as well as the average selling price and the lower discounting in a pretty tough operating environment. I'm joined by Tarun Garg, who's the COO of Hyundai Motor India, to talk about the quarter gone by and to talk about the outlook going forward. Mr. Garg, thanks so much for taking the time. Let me start by asking about that volume picture. Understandably, for yourself as well as the industry, it's been a little bit of a sluggish period. Do you see that changing in FY26? What is the anticipation for volume growth for you?
Thank you. Actually, if you see, India is one market where the car industry has been steadily growing, over the past, of course, 30 years. I have been in the market now for 31 years. After every 5 years, there is always 1 year where the growth is muted, sometimes negative. I don't think it should really disturb us, because post-COVID, we also all saw that market had grown by more than 20%, and again, almost 10%. So obviously some kind of a demand moderation had to happen. On top of it, a car customer does not like uncertainty with the tariff scenario and the geopolitical situation. Obviously that crept in. So I think this is very normal. Also, in any case, this period of April to August is a period where there is generally heat wave in the country. There are no festivals. So I think it's very normal. What we have to do is how to navigate this situation. You saw in our last quarter results how, despite sluggish market, we were able to keep our discounts low by introducing some new value trims for the customers, by making sure that the SUVization continues. Our SUV penetration, in fact, in the last fiscal touched now 68.5%. The rural penetration continues to go up. The first-time buyers continue to go up. Overall, we could get a EBITDA margin of 12.9% for the year, and in fact 14.1% for the last quarter. So I think a good balance between volume and profit is what has helped Hyundai Motor India. Now we have a very aggressive product pipeline in place, and the Pune plant kicks in the third quarter of this fiscal.
Yeah.
So I think things are looking up.
So things are looking up, but then am I right in assuming that you will grow along with the industry, and what is that level of growth that you're anticipating in volume terms?
Look, if you talk about the next 5 years, obviously with the kind of model mix and the kind of new model launches, and of course the Pune plant capacity being added, because we are currently at 824, we will add 170,000 in phase 1, which is in October to December quarter, and then 80,000 in 28. So which will help us reach 1.1 million. So we are definitely looking at beating whatever the industry growth happens in the next 5 years. As far as this year is concerned, we have given a guidance of an export growth of 7 to 9%, and domestic, of course, like I said, probably in line with the industry. Siam is saying around 1%, so we should be broadly in line with that.
Okay. So thanks so much for giving me clarity on that. Would you say that with the addition of the new plant in the third quarter, overall, therefore, capacity utilization might be a little bit on the lower side overall in FY26, and that will of course pick up, Mr. Garg, over the course of the next 5 years, as you point out?
Look, Hyundai has always prided itself on having a very good capacity utilization. Over the past so many years, we have managed a capacity utilization of between 90 to 95%. One big reason for that has been, in addition to our very strong domestic presence, we have a very strong export portfolio. Currently, export constitutes about 20 to 21% of our sales. Going forward, we plan to take it up to 30% by fiscal 30. So I think while the new plant comes in, yes, initial period, obviously it cannot reach 100% immediately. I mean, that is for everybody to know. But I think the kind of track record we have, we believe that, and the new model launches, we should be able to really reach a good number in a very short time. Exact month and exact numbers would be very difficult for me to give. But I don't think there is anything of very undue concern which is coming because of the Pune plant. On the contrary, I think it will be a turning point for Hyundai, like I said, because we have managed to marry our new model introduction with the capacity addition of the Pune plant.
Okay, talking about the market X, the ICE, so I'm talking about EV and I'm talking about CNG. In both of those, what is your opinion of the current playbook for your company? For example, can you give me a sense of what the current booking numbers are for the Creta EV, and what is your playbook in terms of CNG?
So look, as you know, Hyundai Motor India is a part of the Hyundai Motor Group, and the advantage we have is that we have all kinds of technologies. At the entry level, we are offering the customer petrol and CNG. At the SUV level, we are offering petrol, diesel, and now with the Creta electric as well. Of course, in the Varna segment, petrol and turbo. So we are very confident that this kind of technology agnostic approach will really help us to navigate the future challenges. On the EV space, Creta EV has had a very good response. We are selling more than 1,000 a month already. And I think going forward, the kind of model plan we have, like we said, 6 EV models by 2030, we are going to launch. Also, it is coupled with a very strong localization drive. So currently, we have battery packs which have been localized. Now with the Indian partner, we are going to localize the cells as well. Also, we are doing a big, thing on the DC fast charging infrastructure, because so far we are focusing on the AC fast charging AC charging infrastructure. But now we believe, based on the customer research, we have seen that customers are hesitant to take their cars on the highways. So we have taken it upon ourselves to a big time focus on that activity. Currently, the number of DC chargers, including the DC chargers on the dealerships, is already about 88, 89. We plan to take it up to 600 by 2032. Okay. So I think CNG is about 13 to 15% currently, going up consistently. EVs, we believe by 2030 we should be in the range of 15%. And of course, we have also announced the launch of hybrids in the future as well.
Understood. Okay, understood. Now, I want to specifically talk about what you mentioned in terms of the SUV increase, right? Of course, as a country, there has been this move towards the SUV category, and as a result, the small car category has shrunk, Mr. Garg, and you've been witnessing this for 30 years, so you know exactly what I'm talking about. So would you say that, considering that the pricing of the small car is now coming very close to that small SUV category, that this small car category will continue to shrink? And what is the implication for you and your portfolio?
Look, I would say that the customer's choices have changed because his key buying factors have changed. So it's not as if the price range like for example, in the price range of 6 lakhs to 10 lakh rupees, earlier there was nothing called an SUV so much. Then of course the venue segment opened up, and now the extra segment has really opened up. So it's not as if the customers are not buying the cars, say in the 6 to 7 lakh rupees range. Only they are shifting from hatches to SUVs. Why? Because they are getting a good body type, they're getting more space, they're getting 6 airbags as standard, they're getting more features. So I think as an Indian, I'm very happy because this shows that people are progressing. That said, hatches are still about 23% of the overall market. Indian market is 4.3 million. That means hatches are still constituting about 1 million. We are very much there with i10 Neos as well as with i20. So I think we are a full range manufacturer. We need to give new solutions to the customer. For example, the dual cylinder CNG in Neos and Exter has really taken the CNG penetration up. And like I said, Extra has been launched. Going forward, maybe some new segments will open up. What is the most important thing is whether the first time buyer is coming to you or not. I think that is where Hyundai has been able to shift the first time buyer from hatches to SUVs, and my overall portfolio first time buyer has gone up from about 34-35% 5 years back to about 40% now. So I think there's no need to worry, and I'm very happy that we are progressing as a country.
Yeah, interesting. And I think that is what has had a bearing on your operating performance as well, that mix, what you're talking about, right? But speaking about segments, and you're saying that a few segments might open up, Mr. Garg, but can you give me a sense? You have a pretty wide bouquet of products, but do you see any gaps that you need to fill? You said that you have a very extensive pipeline. Can you give me a sense of what gaps you're intending to fill?
Look, obviously new segments are always emerging. I already mentioned about Extra. A few years back, even Creta was a new segment. In 2015, when we launched the Creta, SUV penetration was 13% of the overall market. Who would have thought that Creta will end up being the number one brand across all models? Last 2 months that has happened. So I will not be very specific here, but I would say that with full model change of the existing models, what happens is they become more bigger. And that is where the new opportunities come. So we have very clearly identified some of those opportunities. More details, please wait for the Investor Day, which we have already announced in September, where we will be giving a detailed deep dive into our future models and the new segments that we are going to enter.
I look forward to that, Mr. Garg. My last question to you has to do with the margin profile. And you mentioned the various reasons why it has come in at what it did in the fourth quarter. You've given us the expectation for both exports as well as domestic. But there are a few factors that played out in your export mix as well, with Africa having a larger share. That had a bearing on the margins. So would you say that you would either maintain or better your margins in FY26?
Look, it is very difficult to give exact future guidance, on the margins. But what is more important is your volumes increasing? Are your, especially in the export area, we are really looking at new markets as well. Like, for example, Venue in Indonesia, Venue in Yemen. Going forward, we are going to have Extra left-hand drive, which will open up some markets in the Latin American space. Already we launched the Extra right-hand drive in South Africa. So EVs, we started with, Nepal, even Bhutan, where exports had been muted or banned, have opened up. So we are really looking at all kinds of markets, not only the neighboring markets, not only the Middle East and Africa, which have been very, very strongholds, Latin America. I think there are many opportunities to open up. A big factor here is, like I said, the capacity, because last few years probably capacity constraint, was making our export efforts a little bit muted. But now we are going full hog on exports, and we believe that going forward exports can contribute 30% to our overall volumes.
IRB Infra. Now, if we look at what has happened in their fourth quarter, they've reported a 4% of a revenue growth, which the profit which grew by 14% compared to the last quarter, and the toll revenue also saw about 17% of a jump. Now, the company does expect a lower double-digit growth in FY26 in their toll collection. But to talk to us about all the developments that are happening and the growth expectations for FY26, we are joined in by Anil Yadav, the Director, Investor Relations of the company. So, firstly, welcome to the show, Mr. Yadav. I would like to start off with the Q4 numbers. Your assessment of the overall quarter, how have they shaped up? We are looking at a 4% of a revenue growth, but it's the margins wherein we are seeing higher expansion this quarter. So talk to us about these headline numbers.
Yeah, I think thanks for having me here. With respect to the Q4, we have witnessed healthy revenue growth. In fact, if you look at the full financial year, we have our revenue growth was around 23% as against India's overall toll collection, which grew around 12.5%. So we have seen a robust growth as far as toll collection is concerned. And in terms of the quarter gone by, we have witnessed a 17% toll growth. And for next financial year, because in FY25 we started a couple of TOT projects where the toll collection was better than our estimate. And in FY26 2026, we are not adding any new asset per se. With the existing asset, our revenue is expected to grow between 10 to 13%. We have witnessed 10% growth in the month of April. It's a like to like, roughly 3.5% kind of tariff revision and plus the traffic growth. We have couple of projects where we're tolling for one project, which is 4 to 6 laning project. There, the tolling from 75% it will become 100% and plus 3 years inflation. So there, the tolling will increase, and plus Ganga Expressway project we are expecting to start by second half of this financial year. So we are expecting growth on that count. So we expect around 10 to 13% kind of growth on toll revenue and similar kind of growth on the PAT as well.
So 10 to 13% is the growth that you're expecting in the toll revenue is what you're saying. Now this, if compared to, FY25, we've seen about a 23% of growth. Isn't this on the lower side that we are looking at this number, considering that in FY25 we did have a couple of setbacks also related to elections and other factors, muted orders. So just want to get your perspective on that.
I think in FY25, there was an impact of two projects which started from 1st of April 25 itself. So the base revenue didn't had those two projects, so that's why the growth is higher. Even the Hyderabad project also started during the financial year. So there was also impact of this three projects on the FY25 revenue. Now in FY20, those base are already improved. From the improved base, we are expecting around 10 to 13% growth. Here, we are not factoring any new toll road addition in the current financial year. If we add more projects, then definitely growth will be much better what we are discussing today.
Okay, so that's the perspective that we are seeing in terms of where the toll revenue growth is concerned. Now coming to your order book, just want to understand the overall picture in terms of the current order book, which is there roughly at the size of 30,000 crore is what we are looking at. What's the kind of execution that we are supposed to see for FY26? New order inflows also, if you can give a color on all these three aspects.
I think the order book is in excess of 30,000 crores, and large portion of the order book is O&M order book. We expect out of this order book around 3,500 to 4,000 crores kind of execution in FY26. But if you look at IRB, the 85% value comes from the asset business. And if you look at IRB private InvIT, where we are planning to transfer the three assets to the public InvIT, and the EV what we are transferring is around 8,500 crores and expected to realize equity value of roughly 4,800 to 5,000 crores. With 5,000 crores of equity realization, typically the BOT and TOT gets funded 70-30 debt equity. We can bag another project of roughly 15,000 with 5,000 crores kind of equity, which is getting released from the sale of their three assets. And there is enough pipeline available, I think almost 600 billion worth of TOT opportunity, that is 60,000 crores of TOT opportunity available for bidding. And there is almost 450 billion, approximately 45,000 crores of BOT pipeline is also there. As and when those projects will come for the bidding, we will be participating for those bids.
Right. Anil, good afternoon. This is Hiral on this side, and happy to speak to you as well. Firstly, you mentioned about the bid pipeline with regards to BOT as well as the TOT, which is the toll operate transfer projects which are underway. Now, one aspect is the pipeline looks pretty strong, but the kind of competition which is coming in is also pretty intense. Taking that into consideration, what's the realistic picture that you see that could translate into an order book for your company?
Yeah, that's a very good question. And in terms of, as you rightly mentioned, we have seen intense competition in EPC and HAM. And you might have noticed that project is going 40-45% below NHAI TPC as well. And this is the project which is getting awarded on EPC and HAM. If you look at historically also, we are not bidding for EPC, very selective on HAM. And going forward also, we will be focusing on TOT and BOT. And if you look at the TOT and BOT which got awarded, in last 2 to 3 years, we have not seen more than 3 to 4 players coming and bidding for the TOT and BOT. So I think there will be some competition in BOT and TOT, but not that intense competition which we see EPC and HAM, because BOT and TOT are capital intensive project, and where typically we are competing with the funds and not the EPC guys.
So tell me one thing, Anil, from historic performance, if you have a bid pipeline of say your 100% is 10,000 and the conversion rate is say 50%, currently taking competition into consideration, whatever the number be, what according to you are you baking in terms of conversions?
Yeah. So in terms of, if you look at our asset base, we have asset base of 80,000 crores. Our aim is to reach an asset base of 1,40,000 crores in next 3 years. So we are talking about roughly 15 to 20,000 crores kind of order accretion in terms of BOT and TOT.
Okay, Amit, you mentioned about, there being pressure with EPC and HAM projects wherein because of intense competition, there's a bit of pressure in terms of margins also. So taking all that in perspective, if you have to see a sustainable margin profile going forward for the business, what are the kind of margins that should be expected?
So I think as far as company is concerned, EPC is only complements the asset business. We don't do any kind of third party EPC. We are doing the EPC for IRB assets and EPC and O&M for the public and private InvIT as well. So considering that, I think we should be able to maintain the margin what we are reporting so far. And in terms of our market share for TOT, it's almost 33% market share for the TOT projects.
Okay, so that's in terms of the margins that we are looking at. Now, in terms of, you have talked about the strategy to monetize assets from private InvIT to public InvIT. Just want to get your overall perspective for FY26. What is the kind of outlook or strategy that you have in this? There's been an increasing focus towards this area that we have been seeing, right?
Yeah, so IRB has devised one policy which we coined as BEST, that is the best. B means bid, execute, stabilize, and transfer. So we are bidding the project. We are executing those projects through a private InvIT. Once the asset is stabilized, we will transfer it to the public InvIT, and we will unlock the capital and again use that capital for the future bidding. For example, private InvIT is bidding with an equity IRR of 14 to 15% and transfer those assets to at 12.5% to the public InvIT. Again, use that capital for bid the future opportunity. So that is the stated objective and strategy for the company, and we are going to implement the same.
Okay. Anil, in terms of the CAPEX plan and the outlay that the government has in terms of FY26, the growth number that we've seen so far, do you see that incrementally flowing in, right now in terms of business, or are you seeing a disconnect there?
I think the government has a robust plan. If you look at last 1 decade, the large infrastructure spending was done by the government itself. And now the government wants to monetize those assets, and government pushes basically to do most of the project on the PPP basis. So that will consist of BOT, TOT, and also certain strategic importance assets will be on a EPC and HAM. So I think if the award activity will start, I think there is a robust order book. But having said that, because of the last year was first half was impacted because of election. In the second half also there was lower activity as compared to the previous years. And if you look at, we are in this sector from last 3 decades. And historically also we have seen 1.5 years lull in terms of awarding, and thereafter the awarding activity again starts. So I think going forward, the kind of opportunity which government has showcased, I think there will be enough opportunity coming our way, and as and when the bidding will start, we will participate for the same.
So that's the outlook so far. But Anil, the key over here is from an investor perspective that the stock has been seeing cuts of almost 25 to 30% in the last 1 year. Anything that you have in terms of investors as to where is the improvement going to come from, specifically taking into consideration the return ratios?
So I think if you look at with the existing business, as I was talking about, with the existing business, we will be growing 10 to 12% in terms of the bottom line is concerned. And if we'll back the more product, there will be further improvement in terms of the profitability is concerned. I think on price, if you look at the price, it was not largely driven by the business. I think overall sentiment in the market, especially small cap and mid cap, was impacted in last 6 months. So there I don't foresee that people have a concern on the business. It's across the spectrum. In the road sector, the award activity is low, and I think it's a temporary feature, and in long run we will see the more project will be up for the bidding.
Right. Thank you, Anil, so much for speaking to us and the investors as well, clearly. So that's interesting. The bidding pipeline seems to be strong. Profitability is expected to improve, and from here on, there could be improvement going ahead as well. So that's with regards to IRB.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in?
Welcome. You're watching The Big Question with me, Tamanna Inamdar. What happens when the very people who are building the future get left behind? It may sound like a far-fetched situation, but with the way things are progressing, it's becoming more and more of a reality with each passing day. In a move that has shaken up the tech world, just a few days ago, Microsoft laid off 6,000 of its employees, a total of 3% of its global workforce, making it the company's biggest workforce reduction since 2023. Ironically, amongst the ones to be axed was one of Microsoft's own AI directors, proving that even leaders of artificial intelligence are not immune to the very revolution they've championed. In fact, Microsoft CEO Satya Nadella says AI now generates 20 to 30% of the company's code. This is not a standalone story. Companies across the board are handing out pink slips. Data from the layoff monitoring site Layoffs.fyi reveals that more than 61,000 employees in the tech sector have already been let go in 2025, and we're not even halfway through the year. Just earlier this week, IBM said it has used AI to automate several HR functions, effectively replacing nearly 200 HR roles. The move comes amid reports that IBM is planning to lay off up to 9,000 employees across various locations in the US as part of a large-scale corporate restructuring. Google also trimmed its workforce, laying off 200 employees in Global Business Unit, which is responsible for sales and partnerships. Similarly, Amazon has also slashed 100 roles in its Devices and Service Unit, the team which oversees developments of products like Kindle, Echo, and Alexa. Chegg, a US ed-tech platform, too said it would lay off about 22% of its workforce, or about 248 employees, to cut costs and streamline operations as students increasingly turn to AI-powered tools like ChatGPT over traditional ed-tech platforms. And imagine this list is just from May. The beginning of 2025 saw Meta slashing 5% of its workforce, 3,600 employees, and this is only the beginning perhaps for Meta. World Economic Forum's Future of Work report 2025 warns that 39% of existing skill sets will become outdated by 2030, while 40% employers anticipate reducing their workforce in roles where automation can take over. But here's the twist. AI is not always the efficiency solution it's made out to be. Take Swedish fintech company Klarna, for example. After replacing nearly 700 human workers with AI systems starting in 2022, the company has gone on a course reversal, admitting the results fell short. The tech didn't deliver what was promised, and now Klarna is rehiring humans to do the jobs machines couldn't. So it's a slippery slope in that sense, and hence we ask the big question today, is the AI threat to your job already here. Now, to speak more on this, I'm joined today by Dr. Ramanand, Director, Center of Policy Research and Governance, Ananya Batra, founder and CEO of Listener AI, joining us on the show. I'm also speaking with Arsh Goyal. He's a software engineer and tech content creator. Shruti Swaroop joining us. She's founder of Embrace Consulting. Welcome to all of you, and thank you so much for your time with us here on the show today. We're trying to understand what this AI future looks like. We're not coming to the conclusion that it's a threat or it's not a threat, but we need to definitely understand what's happening. So Arsh, I'm going to start with you and ask you that simple question. We've been talking about this for a while, that AI is going to replace some very core jobs. Have we seen the first real signs of it this month alone?
So it's again a very debatable question. We have seen big tech companies, be it Nvidia's CEO Jensen saying that we don't need to learn programming. We have seen Meta's CEO telling about that they will be removing all the mid-size engineers, and a statement coming from Salesforce saying that they won't be hiring any software engineers this year. So it is a matter of threat to software engineers, as in their thought processes changed a lot. When it comes to the situation this month, yes, companies have been doing restructuring as a part of cost cutting. Some part of this restructuring might be rewarded to AI being in practice. Plus, there are multiple other factors that companies are thinking of, and there are many new roles that are coming in when it comes to AI, so that people can build along those lines. People can make their workflows efficient using AI. And the scenario has been in this state from past 2 to 3 years. And specifically, if I'll tell you, the market of freshers is something that's the most hampered, or there's a lot of turmoil with a lot of engineering graduates passing out each year with low skill sets, and companies are not willing to hire those. So that's the situation right now.
You know, there's a NASSCOM estimate that you could see over 20%, 20 to 30% of jobs in India being replaced by artificial intelligence. I mean, this is already here. Ananya Batra, give us the real world view on how you were looking at hiring, how you were looking at the changes AI brings. And it seems like a no-brainer for any company, right? If you can get software or you can get AI to do the job instead of having to hire people, then it is more cost efficient.
Right. So see, just like you said, right, it's a double-edged sword. So internally, we have been, actively pursuing using AI tools for our entire engineering team. So things that could be done in, say, a week are now being done in like a day or two, right? So there is definitely an increase in efficiency. But see, again, when it comes to this firing news, right, it's more about firing the B and C players rather than the A players. So the A players are still there. They actually have increased their efficiency quite a lot, some even by 10x, right? So just by using these AI tools like Cursor or Windsurf or anything that comes to mind, right? As far as that is concerned, I think the B and C players will always be churned out. I think that's the case in any organization in any field, right? With that being said, back in the 1914, right, when Henry Ford was sort of building the assembly line, the people who built the assembly line were let go of a while after it was built, right? So, I mean, a lot of new jobs were created as a consequence of that, and the world is a lot better, right? It's a better place because of that. So we can't argue that he shouldn't have built the assembly line and he shouldn't have fired those people, right? Because it did lead to
one minute. We've gone through a lot of thoughts together. Let's just break them down one by one, Ananya. You said that this will impact the B and C employees, not the A employees. Correct? Yeah. Now, who's determining who's A, B, and C?
It's efficiency, right?
And what is the chance that a B cannot transition to an A and an A can't transition to a B at some point?
That definitely happens. So, Bs become As and As become Bs. In fact, there's a lesser chance of As becoming Bs than Bs becoming As, right?
Right.
But see, with that being said, a lot of the mediocre developers, even like say 6 to 7 or 10 developers, right? They've become really good because of these AI tools. They've actually learned quite a lot. Not by, just simply because Cursor and tools like Windsurf, right? They help you learn and also write a lot of the code, right? So that's not the case here. So I'd say it has a lot to do with agency itself. So if you're a developer who, wasn't that great in the pre-AI era and now is shipping code with 3 or 4x efficiency, right? You're still far ahead of a lot of the people, right? I'd say it's a function of agency rather than anything else, right? And as far as the A and B and C, sort of distinction is concerned, it has everything to do with the output, right? So you can look at a person's output and you can force put them in XYZ.
That's still you're in a position to do that. I mean, what really struck me with all of the developments in the last few days, and I'm going to come to you, Dr. Ramanand, was that the head of AI development has also lost his job to AI. I mean, by all stretch of the imagination, he would be in A category. Just going by the categories that have been listed out on this conversation right now. I don't know if you can win this fight by thinking, okay, I'll make sure I'm an A and not a B and C.
Tamanna, I will say I'm not going to enter this debate whether A will replace B or B replace A. I'm concerned more about how much prepared we are for this this transition. If we are understanding this AI transition, just like we have seen the BIM movement of 1990, then we are totally misreading all the script. It's not like that. AI, I will say, is a huge moment for the human, history, and we need to understand that. And not only we need to understand, but we need to prepare for this thing. Today we are talking about how some software companies have replaced or kind of fired some of its employees. But in last 1-2 years, we have seen this thing in banking sector, in a lot of publication houses, in media industry, in hospital industry, and everywhere it's changing. Whenever this happen, I usually think about it, and I usually ask simple question: whether as a community, as a society, we are getting prepared for AI transition, or we are just trying to kind of react on this issue.
No. So one second. This is an important point you've raised, Dr. Ramanand. Prepare how? How do you prepare to do something? And I'm coming back to what Ananya said. How do you prepare to do something in 2 days, which otherwise as a human takes you 10 days? Why am I talking about this ABC business? Because is it about skill, ability, and will, or is it just about technology doing something better than you do?
No, it's all about the idea. It's not only about the skills. I will say AI सिर्फ अभी 2 साल में नहीं आ गया. We are assuming it will come from last 5 years. So how our academic institution, how our industry has responded to them. If we are still teaching in our colleges the traditional method, if you will learn this thing, you will get the job. So this traditional approach is not going to help us. If you are understanding as an industry, we need this kind of a workforce for certain period. That certain industry is going to fail, or certain company is going to fail.
Shruti Swaroop, your take on this. And what bothers me is, yes, some jobs will go, maybe there'll be some other enhancements, but that'll be different people, right? That same person who was doing something. Let's talk about the IBM case where people in human resources have been replaced. I mean, what are they going to go and do with AI now, which makes them hireable somewhere else? This doesn't seem like a battle that can be really won beyond a point.
Thank you, Tamanna. I was hearing the conversation that is happening. I think we need to divide it in few parts. Firstly, how much of layoff in percentage is happening because of AI, and how much of it is happening because of business changes, world changes, the agility that one needs, because the world is continuously changing. So I think let's first, let's look at real numbers. We have numbers that say that 44% of job losses in 2024 were due to AI efficiency. But overall job losses percentage-wise are far more. So we need to understand that not every job loss can and will be because of AI. So that's one. Secondly, the roles which are going, and we know for a fact which will go, are the ones which can be easily replaced by AI. So clerical roles which don't need as much of value add. Research will always going to be there. Research, you cannot take research completely and convert it to something else. What are things that will always stay? So there are things like, for example, 3 years back, we used to think that design is going to be there. Today, design has been replaced by AI. But we know that the quality that is coming out of AI generated graphics is not at par with human generated ones. So we need to also understand that not everything can be replaced. Certain roles will be, certain roles will continue to stay. We have to keep moving with the times, upskill ourselves so that we have basic understanding of AI, so that we can have intelligent conversations, so that we at least know how to humanize and ensure we are getting best quality out of AI.
No,
I think that is what we need to understand.
Shruti, my only issue with this is, so you're saying the research roles will not be replaced. Those in research listening to this right now might be thinking, okay, phew, the clerical roles will be replaced, but then there are a lot of people doing clerical roles in terms of sheer numbers, absolute numbers. There are more people doing clerical roles. So they cannot become researchers. What do they do? My issue with whenever we talk about this subject is, and I'm not saying it's wrong, this response that AI is going to be an enhancement tool, you can just do other things better, other people will do that job. What will you do?
So AI helps you upscale. AI helps you scale your business.
Yes.
What will people do? I think there is a huge need for people to understand that there are. So, for example, your question, what happens to HR people who've been laid off? There's a lot of advisory work that can be done that you still need people to do that. There's a lot of consulting work that can be done. You still need people to do that. So those are roles which are still there and they will always be important. You can never let that go. The other question about clerical roles, I think there is a huge need to upskill. And when I say upskill to understand technology, upskill to understand AI, upskill, I think any role where you're adding value will continue to stay.
Okay, I don't know, Arsh, you want to come in on this? Because broad generic terms always sound great. What is going to happen on ground when you have so many people suddenly looking to upskill and then do what and go where?
So it's always the issue when it comes to India as the market with a lot of people looking out for jobs and there are no jobs. But at the same point of time, if I show you the industry perspectives, we don't have good engineers to hire. This is something that's coming from the industry, and I've been in this space from past 2-3 years, looking out at multiple top tech companies who come here, who establish GCCs, and they're looking out for tech talent. But it's still very hard to find good tech talent in India. So it is definitely upskilling that needs to happen. And this upskilling, not only in the tech skills that we generally say, if you want to become a software engineer, these are the 5 things that you need to learn. This is something that is going to be asked in your interviews. But at this point of time with OpenAI or companies like Google, Meta, shipping out updates every 2 weeks or every week, we need to understand that this is something that we need to embrace it along. We need to keep ourselves updated with whatever is happening in the industry. Whichever tools are coming into the market, we need to constantly see how we can use those tools in our workflows and make things easier for us. So the overall narrative, overall perspective is upskilling should definitely be there, and it is not just for people who are graduating from college, but anyone and everyone who is
fair.
in the industry.
All of these things need to be done. Now, I want to come back to the question: as a society, as a people, who is going to make this happen? The onus so far in all our conversations has been on the individual.
Yeah.
You upskill, you learn technology, you get better, you go from B to A. But is that a possibility for everyone to actually do? Dr. Ramanand wants to come in. Yes.
Tamanna, in my understanding, individual cannot face this challenge alone. Government and industry should come together and to invest more in the parts of education and in upskilling work. Whatever we have done, it is very less, to understand the AI, the impact of AI. Undoubtedly, if we will not act together and immediately, it is going to impact, all parts of the society. And when I talk government, I should mention clearly, it is not up to only for the central government. इसमें स्टेट गवर्नमेंट का भी पूरा रोल रहेगा, क्योंकि स्टेट गवर्नमेंट के जो इंस्टीट्यूशंस हैं, जो लोग निकल रहे हैं जिस स्किल्स के साथ, उनकी क्वालिटी अच्छी नहीं है. और यूजुअली अक्सर हम दिल्ली में जब बैठे रहते हैं तो हमें लगता है कि सेंट्रल इंस्टीट्यूशन अच्छे होने चाहिए, सेंट्रल है, बट सेंट्रल का एजुकेशन में बहुत कम ही रोल है. ज्यादातर रोल स्टेट गवर्नमेंट्स का है। अगर आप एआई की डिबेट को, टेक्नोलॉजी की डिबेट को अगर आप स्टेट में जाकर के देखोगे और समझोगे, एंड यू विल फाइंड कि वी आर नॉट प्रिपेयर्ड एनफ। That's why I told in beginning.
I don't know what state governments can do. I mean, Ananya Batra, I want your take on this. How do you ensure? And obviously, if you're running a company, it's not your business. It's not your owner's beyond a point. You want to turn a profit. You want to grow your business. It's not your business to ensure that enough people are hired. But how do you ensure that you have the right mix in place when you go ahead with AI adoption and with all the people that you're speaking to? The core question we're asking today, has that moment of inflection already arrived?
See, this scenario that you're talking about, right? It has happened before in history. So, like I said before, in the 1940s, right, when the assembly line was being built, a lot of people who built the assembly line were fired, right? But that doesn't mean that shouldn't have happened, and we shouldn't have built the assembly line. So, see, I'm saying when you juxtapose this to the current situation that we're in right now, it is a very similar situation, right?
I'm so sorry, Ananya, but that's a tired argument, and I've actually been hearing it from the last several years. A, we're not in the 1940s. B, this is going to be a shift which is much more drastic than moving from one form of manufacturing to assembly line. This is going to change things in scales that we can't even imagine. That's the conversation I have with people in the field. And then at the end of it, the core message is too bad for those who lost those jobs to assembly line. Now, if they're in large enough numbers, can we then say too bad?
No, we're not saying that. We're not saying that at all. In fact, see, according to the World Economic Forum, right, about 11 million jobs will be lost, but 17 million jobs will be created, right? This is by 2030. So we're not saying that all these jobs will be permanently and these people will be jobless and homeless or whatever, right? We're not saying that at all. So this will be a temporary displacement. And see, the displacement is going to happen a lot quicker than it happened in 1914. So if it took like a decade or two to replace those people, replace those jobs, now it's going to take a lot lesser than that, right? It's going to take a fraction of that. So see, when we look at the bigger picture here, right? And when we look at the people who are sort of letting go of, it's all those repetitive tasks, right? So for example, even when we look at the coding jobs, it's all the boilerplate code that is being written by AI. And maybe some junior engineers would write that code, right, before pre-AI, right? It's those kind of people who are getting replaced, and it's everything that's repetitive that's getting sort of replaced, right? And that's being done by AI, and which I see on a longer time scale, right? That's a net positive. I see that as a good thing.
Okay, now here's the tricky bit. 11 million and 17 million, those two figures. How many of those 11 million are making it to the 17 million? 11 million who are losing jobs, how many of them are making to the 17 million which are new jobs? And if junior engineers are getting cut out right at the get-go, because it's starting with the lower rung, right? You don't have a chance to become mid-level or senior. Your career has effectively ended at junior. So that's the tricky bit, isn't it, Shruti? How do you go out and you skill yourself for a job? How do you prepare? I mean, the 20-year-olds or maybe the people in the late teens watching right now are going to wonder, so now how do I even prepare for this?
Manda, if you look at the 20-year-olds today, they are also of the mindset that it's okay to keep changing careers. We know people who had done tourism during pandemic and today they are doing, psychology and HR and IT. So I teach a lot of students who are in colleges and business schools, and the kind of mindset they have is very different. We know some roles are important, so we know renewable energy is important, we know research is important, we know electric vehicles are important. So I think that ability to move across jobs is there in the 20-somethings today, and we need to give them credit for it. They are not as hardwired to a particular career as we were when we were growing up. I think let's appreciate that one part of it. The other thing is, as far as upskilling is concerned, and I think Dr. Ramanand was talking about it a little while back, the government of India is doing a lot of work both at the center level and the state level to upskill. Telangana government is doing that. Maharashtra government is doing that. There are programs like Future Skills Prime, Yuva AI, India Mission. All of these programs are there to upskill people. And we are doing a lot of effort to ensure that there is opportunities for everybody. Now, as far as unemployment is concerned, it has been there year on year. If you look at April, the unemployment rate in that month of April in India was 5.1%. What are we doing about it? We are trying to ensure that jobs are being created and the onus of that is being put back on organized corporates. And both governments and we as an individually, I think each one of us, I run my own organization and each one of us is taking the onus of ensuring there are opportunities there. And we need to take onus of that. We cannot give it all out to, as you were saying, it cannot be an individual's job to go and look for a job. We all need to create an ecosystem that supports everybody, whether it's in terms of upskilling, it's in terms of opportunities, it's in terms of the agility of saying that, okay, you were doing tourism yesterday, today you want to do renewable energy, fair enough, as long as you have the skill sets, you're giving quality, I am open to at least experiment.
Yeah, so that's from the employer point of view. Arsh, you're a software engineer and tech content creator. Today, if you wanted to be a full-time software engineer, would you be able to do it? How would you upskill? Give us your own perspective.
So when it comes to upskilling at this point of time, I totally agree with all the panelists. It should not be just the onus of an individual, but at the same time, government is doing a lot of things when it comes to India AI mission. Even the Googles and the Microsofts of the world have been taking a lot of initiatives, putting in a lot of courses for people to upskill for anyone and everyone. You mentioned about the HRs getting laid off, right? So if at all that HR is getting laid off, there is a course that they can start from the beginning and they can complete it in some point of time that will make them job ready in this AI market. So all of these big tech companies along with the government is trying to put in efforts. And if we just compare this situation right now of a 17-year-old or a 20-year-old here in India with a 17-year-old or 20-year-old in the US, so the difference that you see is people there are trying to build on their own. So they're building those AI products, they're selling those AI products and making those companies. So if at all that transition comes to India, we would have more jobs, more people looking out for AI jobs, as well as more people building those AI startups themselves. Coming on to getting a job in this market, fundamentals are very important when it comes to software engineering. You should be your core fundamentals are very important whether AI comes in or whether AI doesn't come in. So core fundamentals that are still taught in colleges, you should be well versed with those. Apart from that, it is the constant upskilling and upgrading yourself within this market that will put you in the pedestal and you will be in the top.
How do you start that process of upskilling and upgrading? What is the ABC of it?
So when you say upskilling and upgrading, once you are done with your fundamentals, right? When it comes to somebody getting a job in software engineering, you need to know a programming language. Then you need to upskill. You need to learn one framework. Then you need to build some projects and showcase it in a package form that is called your portfolio. So that's a basic set of credentials that you need to get a software engineering job. But now, as of now, with AI coming into picture, if at all you have some projects in which you can implement those AI applications or you can build some AI product, and it's not that hard, right? If somebody is already a software engineer, he knows how to read, how to understand code, he can build his own website, or he can build whatever he wants through different tools that are available in the market. Ananya was mentioning about Windsurf, about Cursor. So these are very, very helpful tools. And if somebody is already a software engineer, it would be easier for him to understand and build upon these tools. And it is very easy at this point of time to learn. There are so many resources. If you want to learn, you can go to YouTube, that's available for you for free. If you want to learn in a structured manner, there's so many courses out there that are available for very cheap, even for Microsoft, Google, Amazon, Nvidia. So they have launched their own courses.
Sure, go out and start. Just as we wrap up, Ananya, where do you think this is going? And yes, I get the point that Shruti is making, that not all job losses are about AI. There's global recession. Every company may have its own reasons. You can't get into the detail of it. But there's no denying that AI is one big factor. How far do you see this going? Are we just at the beginning of seeing this huge sea change of employment, efficiency, and tools that companies use?
I do think that we are at the beginning. Some say that, this is sort of similar to the internet era, right? This is sort of similar to the early 2000s when the dot-com bubble was happening. So I do think that we are very early in the entire AI cycle. As far as, your argument goes as, okay, what happens to 17, 19, 20-year-olds, right? I also know 17-year-old millionaires who didn't know how to code last year, but they learned everything by themselves. A lot of the code was written by AI and they built their own AI products. Now they're hiring people, right? So we are seeing people like that as well So everything that we talked about today, right? I think it can be solved by agency. Everything that we sort of talked about, all the job losses, right? All of those questions are answered by agency, right? So all of these things are a function of agency, is how I see things. And see, as far as the areas where AI is having the most impact. Of course, coding is one of the biggest markets, right? Not the biggest, but in the medical field, right? And for lawyers, AI for lawyers is also growing very big. There are so many other fields, right? AI in agriculture. See, the possibilities are limitless. So, I mean, someone with very low resources could also build, something very big of themselves, right? They could become a millionaires. I'm not saying this is going to happen overnight, but you can, of course,
Stop
do this.
fearing it. I think that's great advice. Stop fearing it. Look at it as another opportunity, another tool. Maybe that mindset change is the first place to start, and then, of course, a quick AI-aided search will find you the right tools for your sector and industry to help you upskill. But this has been an interesting conversation. This is a story we'll keep tracking very closely. Thank you so much to all of you for joining us on the show today, and to our viewers as well. Thank you for joining us on The Big Question. We'll be back tomorrow, same time, same place.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know?
Thanks for staying with NDTV. You're watching the Tuesday edition of the World Report. I'm Arjun Samar Mahendran. Let's take a look at what's making headlines around the globe. US President Donald Trump and Russian leader Vladimir Putin failed to reach a breakthrough on a Ukraine ceasefire during a 2-hour phone call Monday. Now, Trump struck an optimistic note, saying Kiev and Moscow will immediately begin negotiations, while Putin's more guarded comments signaled he hadn't softened his maximalistic demand so far. Here's what both the leaders had to say.
Did you ask President Putin to meet with you?
About what?
About Ukraine.
Of course I did. I talked to him about it. I said, when are we going to end this, Vladimir? I've known him for a long time now. I said, when are we going to end this bloodshed, this bloodbath? It's a bloodbath. And I do believe he wants to end it. You know, when I made the call, I told the people last night, I spoke to the heads of the different countries, but I said to them, we got to get going. And I did say also, if I thought that you couldn't do it, I'd step away, because what are you going to do? We don't have boots on the ground. We wouldn't have boots on the ground, but we do have a big stake.
States set forth his position regarding the cessation of hostilities, and the truth on my behalf that Russia also wants a peaceful resolution of the Ukraine crisis.
And meanwhile, my colleague Nina gets you this ground report straight from Washington, D.C. Take a look.
Well, US President Trump sounding extremely optimistic on the back of his phone call with Russian President Vladimir Putin. I don't think that President Trump can afford at this point in time not to sound like there's some forward momentum. He said last week that nothing would happen until he and President Putin had spoken. So in the very narrow scheme of things, that's a mini triumph. It's a mini victory. But it's also possible that President Trump believes that by injecting the right tone, it gives the lack of progress a kind of a shiny wrapper on a rather disappointing parcel. Since there has been no movement, we know that there's been no progress, there is no ceasefire, nothing's really changed, except that President Putin and President Trump have spoken. President Trump referenced on the back of that phone call with President Putin a possible trade angle, and we know that trade and investment deals are very much President Trump's thing, which, given the fact that he is capable of injecting a degree of chaos into trading relationships with partners, it does seem counterintuitive. But given his track record of cutting deals, especially if you look at his latest trip to the Middle East and the deals that he's been cutting with Gulf states, it's certainly a language he speaks, the language of trade and investment, and a number of foreign governments are lining up to offer President Trump deals in the hope of better preferential treatment.
Union Commerce and Industry Minister Piyush Goyal held productive discussions with US Commerce Secretary Howard Lutnick, focusing on expediting the first tranche of the India-US bilateral trade agreement. Now, Mr. Goyal shared an image of the two leaders shaking hands, stating good discussions with Secretary Howard Lutnick towards expediting the first tranche of India-US bilateral trade agreement. Israeli Prime Minister Benjamin Netanyahu allowed minimal aid to enter Gaza Monday, saying that he had to prevent mass starvation for practical and diplomatic reasons. Now, Netanyahu said Israel will take full control of Gaza, the besieged enclave, while acknowledging that the move to let aid through was motivated by mounting international pressure from allies. The UK, France and Canada in fact threatened sanctions and also demanded Israel stop its military actions, while US President Donald Trump's administration has also launched a behind-the-scenes pressure campaign, as per the Washington Post's latest updates. The leaders of Canada, Britain and France on Monday threatened actions against Israel if it does not stop a renewed military offensive in Gaza and lift aid restrictions as well. Now, this piles further pressure on PM Benjamin Netanyahu. The Israeli military, meanwhile, announced the start of a new operation on Friday, and Mr. Netanyahu said earlier on Monday that the country would take control of the whole of Gaza Strip. International experts, meanwhile, have already warned of looming famine. Here's more.
As the UN warns of a looming famine in Gaza, Canada, Britain and France have issued a joint statement threatening action against Israel if it does not stop the renewed offensive in Gaza and lift the restrictions on the movement of aid in Gaza. The statement by the three leaders of these countries says that it is unacceptable and also a breach of international humanitarian laws that Israel has blocked the movement of aid into Gaza, and it is evident in the shocking visuals coming in from Gaza that is showing the population dying of starvation. It has also been said that starvation is being used as a tool by Israel against the people in Gaza. Meanwhile, the joint statement says that any new settlements in West Bank are also unacceptable to them, and this comes at a time when Benjamin Netanyahu has said that they want to take over the whole of Gaza. Now, this is also leading up